and make it simple, and then finding a way to be able to communicate that both internally and externally.
I think it's relationships, whether it's working with investors, bankers, with the senior management team, with the board. Having your head down is one thing as a finance person, but keeping your ears open is super important as well. And I think that all of that is what kind of builds out being a successful CFO.
Watch Chief Future Officer only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Mumbai. This is Bloomberg. The global economic playbook is being rewritten, and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
Good morning. This is Horizons Middle East and Africa. Our top stories this morning. Hormuz standoff. Oil rises for a fourth day as the U.S.-Iran stalemate drags on. Brent holds above $91 with little traffic moving through the strait. Gulf tensions flare. The UAE accuses Iran of launching 2 ballistic missiles towards its territory. And Abu Dhabi cuts trade and financial ties as Tehran rejects the allegation. And chip makers sink. Asian stocks drop as the semiconductor sell-off deepens. Investors are retreating from one of the year's hottest trades amid elevated bond yields and geopolitical uncertainty. It has just gone 8:30 a.m. across the Emirates. I'm Abir Abamar in Dubai. Let's update you with another look at where risk assets are sitting this morning. Still risk off when it comes to the equity space, albeit S&P futures flat to the downside. That follows negative sessions in the S&P 500, in the Nasdaq 100, and most precisely in the SOX gauge, which dropped about 5% yesterday. That followed, of course, a positive session the day before. We've seen those moves throughout the past few months or so, but this time around, we're seeing really elevated bond yields across the world. We're not just looking at the United States, where the 30-year yields are at the highest since 2007, the 10-year yields the highest since early 2025, and that brings a lot of questions about what the Federal Reserve decides to do next. We await, of course, the FOMC meeting minutes for July and what clarity that sheds on the market. But then when it comes to Asian equities, 2.2% lower. The Kospi in South Korea is lower. Japanese equities were dropping as well. We saw a blockbuster debut in China, so that is some positive news where it surged more than 600%. That's Unitree, and now moderating some of those gains. And then, of course, Brent crude prices edging closer to that $92 on the barrel mark. The stalemate in the Middle East continues. The back and forth remarks do continue. Movement through the Strait of Hormuz does not continue. It is a fraction of where it was pre-war. So we continue to monitor whether those negotiations actually will happen between the United States and Iran. But for now, that stalemate is very real in the war that's been going on for about 6 months at this point. Let's continue with the oil story. Oil is rising for a fourth day as the U.S. and Iran show no signs of progress towards a peace deal after almost 6 months of conflict. The stalemate leaves the Strait of Hormuz in doubt, with little traffic transiting the waterway and pressuring global energy markets. So joining us now to discuss this is Karen Young, Senior Research Scholar at the Columbia University Center on Global Energy Policy. Karen, good morning. Good to have you with us this morning. I want to start with the stalemate. I want to start with what we've been really seeing over the past couple of days or so, that technical expiry for the MOU on Monday. Right now, I know I've asked you this question multiple times over the past few months, but who has more leverage at this time?
Well, thank you, Abir. Good to be with you. Again, we're in this kind of no peace, no war scenario. President Trump says that he wants to go back to economic pressure. So the new plan is very much like the old plan, the maximum pressure campaign that we saw under the first Trump administration. And that is going to put more price pressure, and less volumes are getting through the strait, as you say. And this is meant to put a pinch on Iranian revenues. But, you know, the Iranian leadership has shown resolve, and that they are willing to accept the pain of economic hardship and to pass that on to their citizens. What's different perhaps now in this new announcement from President Trump, and particularly from the Secretary of the Treasury, Scott Bessent, is that the willingness is to perhaps extend this onto third parties, or what we think of as secondary sanctions. So in the financial world, those firms that are helping to facilitate trade, we would expect then the pressure to mount. And this announcement, which you mentioned in the UAE, to kind of sever all trade and financial flow ties between the UAE and Iran, would be presumably part of that pressure.
Karen, just when it comes to those wider negotiations, we don't know if they're in fact going to take place. But Ghalibaf, who is the top Iran negotiator with the United States, said that from Iran's side, the Strait of Hormuz will not open unless the U.S. Stops all military operation, removes the naval blockade, and gives back the frozen assets, as well as the oil sanctions. So ultimately, what I'm trying to ask here is, do you think that President Trump is ultimately going to have to make a deal, and it will be a bad deal?
Well, if President Trump wants Iran to back down, there will have to be concessions. And what Iran wants are access to frozen assets, and they want sanctions relief. So yes, that would be part of any negotiation. But that's not part of the talks right now, as far as we know. And so the sort of waiting game and this sort of, game of chicken, who's going to blink first, or who's going to retaliate first, who is going to show that they are more willing to escalate. And that could very well be Iran, because President Trump has announced he wants to go with the economic route, not the military route. He can always change his mind, but that's his plan for this week.
So do you think that's a coherent strategy, the economic isolation route?
Well, like I said, it's the new plan, but it's the old plan. It's been tried before, and Iran has successfully weathered that kind of economic pressure. Now, can it be done in a more sustained way? It's very difficult if you don't have a coalition, partners that are willing to enforce those kind of sanctions, and others who are, presumably buyers of Iranian oil and facilitators of Iranian financial transactions. They have to go along with that as well. And the U.S. will make, other countries potentially, really unhappy with that kind of decision.
Okay, Karen, let's just move on to the energy flows in the Strait of Hormuz that have been massively affected, of course, with the effective closure, is what we've been calling it, on the Strait of Hormuz. At what point do you think that those disruptions to Gulf supplies start to become structural rather than temporary premium risks?
I think that's already happening. I mean, we already see the restructuring of our energy system, what's happening in terms of the build out of new pipelines and new infrastructure to avoid the Strait of Hormuz. It will take time, but we're talking about a 2-year window. So, there are workarounds happening already, including production in other parts of the world. We've seen a massive increase of oil production in the Americas, in the United States, but also in places like Brazil, Guyana, even Venezuela, Argentina. And so the system is sort of working out other locations, other modes of transit. And certainly within the Persian Gulf, we're seeing the practices of different kinds of transit, turning off transponders, using these different routes, which is, risky and dangerous. And the kind of transfers from, inside the Persian Gulf to outside, the ship-to-ship transfers. All of these are new practices, new mechanisms within the oil trading system. And so I think we're going to see more of that. It's new infrastructure, it's new geographical locations of production, and new practices of sales and movement.
All right, Karen, we're going to have to leave it there, but appreciate your time as always. Karen Young, Senior Research Scholar at the Columbia University Center on Global Energy Policy. Now, Bank of Israel Governor Amir Yaron says the country's GDP is less than 1% below pre-war trends. Yaron told Bloomberg the country's economy has shown agility throughout the ongoing conflicts in the Middle East. Take a listen.
The Israeli economy and the Israeli people have shown great resiliency throughout the war. We've seen it in credit card expenditures, VC money coming in, export. It's part of the dynamic and agility of the economy. And in fact, the numbers I just said about GDP have brought GDP to be about just below 1% from its long-term pre-war trend. That, in reference to other wars, is a big accomplishment. The big fiscal challenge, however, ahead is managing what I call the fiscal trilemma. And any new entry government after the election will have to deal with it. And that is bringing Israel back on a path that is a declining debt, managing the defense expenditure, and obviously they will be derived partly from the map of security needs that will arise. And third, investing in growth expenditures, growth engines, and managing these three is going to be difficult. With it, there are going to be issues like how do you bring the ultra-Orthodox community back into the workforce? How do you draft them? These are social and political issues, but we have shown in the bank they have immense economic ramification as well.
So you have some idiosyncratic issues that you just laid out that you have to deal with, but other ones that Israel is facing are things the entire world is at the moment. The impact of higher oil prices, even though Israel might be a little bit more insulated. The impact of AI. Israel is certainly a hub for AI innovation. As you go to Jackson Hole, what do you expect to be the dominating big picture issue that you and your peers really need to discuss and maybe have hard conversations about?
I think part of it, AI is in the minds of everyone. Is it increasing productivity as we expect? Is it going to actually increase prices, or actually ultimately we're going to see the gains of productivity lowering inflation? Which one is going to come at what phase? That's obviously going to be one issue. And the other ones are, and related, are financial markets. You mentioned the high yields. Where are they going? Why are they moving the way they are? Are they expressing actually growth? Are they expressing inflation? These are the type of issues that I think will be discussed along the meeting.
That was the Bank of Israel governor speaking to Bloomberg's Danny Berger. Coming up, we will speak to the CEO of ABSA Group as the South African bank accelerates expansion across the continent. That conversation is coming next. This is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up to the minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hodern in Beijing, China, and this is Bloomberg.
Welcome back to Horizons Middle East and Africa. South African bank ABSA Group has reported an 8% increase in headline earnings to 12.8 billion rand in the first half of the year. The bank saw growth in its South African business, which offset a decline in profit from operations elsewhere on the continent. Our chief Africa correspondent Jennifer Zapasaja joins us now from Johannesburg. Jen?
Yeah, thanks so much, Abir. With me now is Kenny Fihla, the CEO of ABSA Group. Kenny, thanks so much for your time. So let's just start here. Abir was saying you announced your results yesterday. We saw a bit of green shoots here in South Africa, which offset some of the declines elsewhere in Africa. And yet you have ambitions to expand across the continent. Can you just speak to what that plan looks like and how much is actually in motion at this point?
Thank you, Jennifer. I think our plan is progressing exceptionally well. We are in the process of integrating the operations that we bought from Stan Church in Uganda. We are also consolidating our two businesses in Tanzania, and that work is already underway. We have applied for a representative office in Angola, and we intend to enter that market as well. In addition, we've got a rep office in Nigeria, which we are exploring the possibilities of converting into a merchant banking license. So clearly we have to continue to diversify our presence in the African continent as we see that as a massive growth opportunity.
How much have you seen, Kenny, the conflict in the Middle East potentially creating some headwinds to that ambition or potentially opening up opportunities, which I know you said during the earnings results yesterday?
Definitely created headwinds in the first instance in that the level of client activity that we were seeing in the past subsided slightly, which also meant that from a trading point of view, our global market business did not do as well as was the case, say, in the first quarter of the year. Global markets still grew by sort of 8%, but we think that growth would have been significantly higher if it was not for the Middle Eastern sort of war. Secondly, there has been some headwinds in Ghana and Kenya in particular, resulting from a massive decline in interest rate. That seems to have plateaued at the moment, and we think that that puts then a very, very good foundation for us to grow as we think about 2027. Outside of those two headwinds, the business is robust, client numbers are growing, and we continue to do exceptionally well in South Africa, where our headline earnings grew by 17%.
Are you concerned, though, Kenny, about the reliance on markets like Kenya and Ghana? How do you anticipate or expect to grow some of your earnings in those countries, considering some of the headwinds that you were just pointing out there with interest rates?
I think we have to accelerate the diversification of our business. We've got many African markets that have huge potential. If we think about the infrastructure development that is taking place in Tanzania, clearly we think there's a lot that we can do in that market. We also think that there's a lot that we can do in markets like Uganda, like Zambia, and also Angola, which is why we are intending to enter into the Angolan market. The dependence on 2 or 3 big markets is fine if you've got tailwinds. But as soon as you experience some headwinds, you are vulnerable to massive shocks, which is why then the primary thrust of our strategy is to diversify our revenue streams, both in terms of geographies, in terms of business lines, but also in terms of client segments. And we think there are huge opportunities in our business banking, as well as in our personal banking space, to increase our market share in some of the markets that we operate in.
Let's come to South Africa, because you did cut your GDP growth target to 1.5% in 2026. Many banks have also done so. The IMF, though, has about 1.1%. Do you attribute potentially the rosier outlook to some of the structural reforms? And are you actually seeing this show up in the business yet, or not at this point?
We are definitely seeing progress. The reforms that have taken place in the electricity sector have resulted in a massive growth in our own asset book in support of renewable energy initiatives. We think that progress ought to continue as government consolidates the unbundling of Eskom, separating it into generation, transmission, and distribution. That alone will trigger a massive investment in the development of the transmission infrastructure and networks. We're also seeing reforms taking place in the logistics sector, unlocking the potential of our rail infrastructure, which will then promote exports and allow particularly our mining companies and those who produce commodities, bulk or soft or hard commodities, to be able to access the export market. The export capacity of South Africa has been constrained largely by logistical problems and bottlenecks. By just unlocking that and making it more efficient, we think that will increase the productive sector and accelerate the economic growth. We're also seeing some changes that are quite positive in a number of areas, how government partners with business, broadly speaking, and how it is starting to think about leveraging the private sector capability to accelerate economic growth and improve government delivery on a number of social services.
Well, we have to leave it there with you. Always appreciate your time, Kenny Fihla, the CEO of ABSA Group, joining us there in Johannesburg. Kenny, thank you so much for your time. Abir?
Jen, great conversation with us. Of course, Bloomberg's Jennifer Salpis-Sacha, our Chief Africa correspondent, with the CEO of ABSA Group. Now, coming up, we will take a deep dive into the EU's efforts to rebuild its tech autonomy, a plan that may need at least $3 trillion. More on that story next. This is Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Welcome back to Horizons Middle East and Africa. Brussels has pledged to spend 30 billion euros to build 7 AI gigafactories across Europe. But Bloomberg Intelligence data estimates the EU will need to spend at least $3 trillion by 2035 to be truly self-sufficient when it comes to technology. So joining us now to discuss this is our Chief Europe Correspondent, Oliver Crook. Ollie, back at the studio today, but with an important story. So can you just walk us through what this path to AI and tech autonomy in Europe will look like?
Yeah, absolutely, Abir. I mean, it's something we talk a lot about here in Europe, about autonomy on a number of different sort of strategic levels. Obviously, defense has been sort of front and center. But of course, the technology in AI, seen by many as just as important, if not even potentially more important in terms of economic growth for the future and trying to gain some autonomy there. But what's been instructive here is that Bloomberg Intelligence has broken down what that will actually cost and in what sectors that money actually needs to be invested. And as you mentioned there, it's a pretty hefty bill. We're talking about a $3 trillion investment through 2035. That is going to be mostly concentrated in sort of one of the greatest deficiencies, which, as you can see there, is cloud infrastructure, where Europe is very, very dependent on outside countries, particularly the United States. The semi-cap equipment overall will take about a $500 billion investment. This is an area in which there is some autonomy by the Europeans. There actually is a fairly strong semiconductor manufacturing operation within Europe, but they don't make the hyper-advanced AI chips. They make things that go into basically industrial processes, go into cars, they go into sort of smart appliances, things like that. Another $500 billion will have to be spent over on foundries. And of course, the last one there, the large language models, about $300 billion worth of investment, because the Europeans don't really have a major player within the large language model space, with the exception of the French company Mistral. And you can see that represented in European market share for large language models, which approximately now have 11% of the market share, which is far below 88%, which is going to be mostly dominated by the United States and China. The one good news for the Europeans is that they are sort of dominant in one critical space, and that is the machines that actually make the chips themselves. That is ASML, that makes those lithography machines, basically totally dominant in that market. But again, that is only one sort of part of the ecosystem, and in order to gain autonomy, you need to have much more control. And to say that even if all things go as according to plan by this Bloomberg Intelligence, that still will not get the Europeans full autonomy, but it'll certainly move them forward significantly.
Okay, Ollie, just quickly, beyond technology, how realistic is a fully autonomous Europe? Critically, how much would it cost?
Yeah, exactly. I mean, listen, if $3 trillion sounds like a lot of money, to get sort of broader autonomy, it's going to cost $14 trillion through 2035. And these are the kinds of investments that are going to be very, very competitive to make here in Europe. They're going to have to be in defense. They're going to have to be in energy. They're going to have to be in the power grid, the AI and technology tools, as we've been discussing. Of course, we've been talking about climate for the last couple of weeks. You need to insulate against that. And you can see there represented on the screen, a failure to do that may blow out that GDP gap that we've been seeing spreading between China, between the United States, and of course, Europe.
All right, Oliver, we're going to have to leave it there. And that is it for Horizons Middle East and Africa today. Keep it here with us for Daybreak Europe. This is Bloomberg.
Very famous dogs. You have they look like balloon kind of figures to some extent. How do you make those?
In the case of the balloon dog, I blew up a balloon dog. So I had this balloon, which is kind of like latex type of piece, molded it, cast it, and then blew that up in scale and put it into a clay, and eventually had that transformed into stainless steel.
So when you have a balloon dog, let's say, a regular size one or then a big one, do people say, Jeff, you're crazy? Were you shocked that people were willing to pay very high prices for this?
When I was making my first balloon dog, one of the purchasers was Eli Bro. And originally I thought I could make a balloon dog for around $300,000 that I could manufacture. It's a large piece, over 10 feet long, or 12 feet long, 10 feet high. But it turned out that the fabricator came back to me and said, you know, Jeff, I can't do it for $300,000. It's going to be $650,000. But eventually, then they raised the price again, and they finally brought it up to 1.6 million. And I told Eli that this is the reality of it. I showed him everything, and he ended up paying for the production costs.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
And a very good Wednesday morning to you, live from London. This is Bloomberg Daybreak Europe. I'm Chad Thomas, and here are your top stories. The tech sell-off deepens. Chip makers leading Asian stocks lower as global long-end bond yields hold at multi-decade highs. Oil climbs for a 4th straight day as President Trump hardens his stance on Iran, insisting no talks are taking place with Tehran. And President Trump delays new Canada tariffs just hours before they were due to come into effect, saying the two sides have reached a tentative deal. Now let's take a look at what's happening in the markets this morning. Asian stocks dropping with that semiconductor sell-off. This morning's decline being led by South Korean shares, with chip bellwethers Samsung and SK Hynix both falling. Europe futures essentially flat. Europe, of course, not quite as exposed to the AI trade. And in the U.S., NASDAQ futures down slightly as we watch whether that tech sell-off continues there. We'll also be looking closely this morning at the FOMC minutes when they come a bit later on in the day. Let's take a look now at the cross-asset picture. Oil rising for a 4th day with no sign of progress toward a resolution between the U.S. and Iran after almost 6 months of conflict. Brent climbing this morning toward $92 a barrel. Treasury study at this hour following that global bond sell-off we've been following all this week that has pushed 30-year yields to levels we haven't seen since the financial crisis. And the Canadian dollar up this morning against its U.S. counterpart, that after Trump delayed those 50% tariffs on Canadian products as they continue to negotiate. Now let's take a look at some of the key events we'll be following throughout the day. July inflation for the UK is due at 7 a.m. local time, with CPI seen ticking higher. At 10 a.m. UK, we'll get the final July inflation print for the euro area. And at 7 p.m. tonight, we'll be watching minutes from the Fed's most recent policy meeting. Lots to get to today. Let's get started. Tech leading stocks across Asia sharply lower this morning. Let's get a check on all the overnight action with Winnie Xu in Hong Kong. Winnie.
Yeah, good morning, Chad. We are seeing Asian stocks tracking those losses from its U.S. peers overnight. And it is really still that chip sell-off continuing amid the higher oil prices, plus the elevated yield environment, which is usually bad for tech stocks because of how these high valuations rely on the future earnings, plus some concerns when it comes to the rising borrowing costs weighing on the capex spending when it comes to these U.S. hyperscalers as well. Now you can see that tech is really leading declines today. MSCI Asia overall euro down about 2%, having its worst day in 3 weeks. Now, Kospi down about 5%, but also we are seeing tech-heavy gauges in Japan and Taiwan following those declines as well. Now, on the days when you're seeing weakness in these markets, that's usually when Hong Kong shares doing slightly better. As you flip the board and see how that's showing up today, we have HS Tech down slightly less than 1%, so doing slightly better, but the overall weakness is still being seen specifically in our internet names, and Baidu here down about 12% after the company released quite disappointing earnings, some concerns around the massive capex spending, plus a slowdown in its AI growth. Now, the bright spot, though, is in Unitree Robotics. The company just had its IPO earlier today in Shanghai, with shares jumping as much as 630% at the open after the company has raised about $900 million. Now, this is making this company the very first publicly traded humanoid robotics company in China. So it does have a very significant role when it comes to that AI race between China and the US. Now, flip the board, we also take a look at what's going on in the bonds market, because it still is that big story today in global markets. Of course, we are seeing treasuries stabilizing a bit after the 10-year yield having reached that highest level in about 19 months. And you are seeing Asia bonds following those moves, with Japan, Australia, and New Zealand all seeing yields falling back a bit. While when it comes to currency space, we are seeing the Japanese yen strengthening just a bit, moving away from that 160 level against the dollar, against a weaker greenback as well. Back to you, Chad.
Bloomberg's Winnie Xu in Hong Kong. Thank you, Winnie. Bonds are steadying this morning after that sell-off, which pushed long end yields across the globe to multi-decade highs, with the U.S. 30-year yield hitting its highest since 2007, and peers across Europe also under pressure. Let's bring in Ben Ram, cross-asset strategist at Bloomberg MLive. Ben, what are the biggest drivers of this pressure we're continuing to see in the bond markets?
Morning, Chad. I think principally there are three big drivers. One of them is the AI-related capex spending, of course, which of course is the biggest catalyst at the moment. The second one is, higher deficits. The U.S. hasn't tried to wean itself away meaningfully from the idea of higher deficits, and that is feeding through into the longer end of the curve as a risk premium. And the third one is the inflation aspect of it, because, the U.S. has missed its the Fed has missed its inflation target for the better part of 5 years now. So that is also, if you combine all those things together, what you get is a massive risk premium at the longer end of the curve. And that's what we have been seeing happening with the 10 and 30-year segment. Now, interestingly, Chad, a few years ago, any of these governments could have raised financing at pretty low rates, rock bottom rates, but gone are those rates. And what does that tell us? It tells us that, the neutral rate of interest has probably shifted higher. And that's the biggest takeaway here. The neutral rate represents the equilibrium between the supply of funds and the demand for funds. Now, we have seen a demand for funds soaring because of the AI spending, and that is not being met with adequate supply, and that is the push that we are seeing higher in yields.
And then we've been reporting overnight that some bond traders are beginning to hedge the risk of a Fed rate cut next year. How will markets react to this changing central bank outlook?
Well, I think that's a tail risk. I mean, as you mentioned, it's a hedge that they are putting on, so which is very much a tail risk scenario. Given the economy that we are in, what would require prompt the Fed to cut rates would be a scenario where the economy goes downhill, i.e. the jobs market sours a lot. And I don't see that happening just yet, but it is probably a prospect, which is why they're putting on the hedge trades. But if that happens, the sell-off in duration that we are seeing now will abate, and it will go in the reverse direction. We'll see a massive bid for 30 and 10-year bonds, but we are nowhere at that stage. And as I want to emphasize, that is the tail risk at the moment.
Ven Ram, Bloomberg MLive strategist. Thank you, Vem, for joining us this morning. Oil trading higher for a fourth day after President Trump insisted there are no ongoing talks with Iran. The standoff leaves the Strait of Hormuz in limbo, with traffic still a fraction of pre-war levels, as Washington prepares to ramp up economic pressure on Tehran. Bloomberg's Abir Abu Omar is in Dubai for us. Abir, with no talks underway, where does the U.S.-Iran conflict go from here?
Good morning, Chad. Well, I mean, when it comes to the talks themselves, it also depends on who you're talking to. President Trump says that there are no ongoing or planned talks with Iran. Jared Kushner, who's been a very active negotiator in this whole thing, says that some talks could be ongoing. They're active. As a matter of fact, he says that different areas of the Iranian government, conversations with those are ongoing. So there's a little bit of discrepancy in those statements as well. But then from the Iranian side, of course, you're seeing that the top negotiators there, the top negotiator, Ghalibaf, with the United States had said that the reopening of the Strait of Hormuz and commencing any kind of negotiations with Americans is not going to happen unless the U.S. stops all military actions against Iran, lifts its naval blockade, unfreezes those assets, and then lifts the oil sanctions. Of course, the concessions that were reached in Switzerland in June, those that were rendered meaningless by both Iran and the United States. And so you're still seeing those back and forth remarks. And we're choosing to look at what is happening on the ground and the reality of what is happening on the ground. And even that does not paint a very positive picture, because until yesterday, you were still seeing attacks happening in the Strait of Hormuz. The UK Navy reporting a vessel that was hit with one casualty reported there, and then some other vessels that were making erratic moves in the waterway before deciding to stop by the Qashm Island by Iran because of the threat that Iran still poses on those vessels that are trying to make their way through the waterway. And this is really why you're seeing Brent crude prices settle nicely above that $90 a barrel mark. So quite elevated, not as elevated as what we saw during the peak of this war, but still above what we were seeing in the past couple of weeks or so, Chad.
Well, in Abir, the UAE says 2 ballistic missiles were also fired towards it from Iran. What does this tell us about the wider situation in the Gulf region?
Yeah, so yesterday at around 7 p.m. or so, we received those missile threat alerts on our phones. And then the UAE government came out moments after and said that it was targeted by two ballistic missiles of Iran. Iran rejects that claim, of course, but the situation has been escalating in the region. The UAE hasn't had those alerts in quite a really long time. We saw, of course, other countries in the region getting hit. We saw ADNOC ships. Those are the UAE's energy companies' vessels being attacked in the Strait of Hormuz about a weekend ago. And so those escalations have been happening in waterways in the Red Sea as well, but we haven't seen this level of threat in a while on the UAE, particularly. Of course, the UAE said through the foreign ministry that it's halting trade and financial pacts or trade and financial relationships with Iran until further notice, that it rejects and condemns those Iranian actions. And so what we know now for further negotiations to happen between the Gulf and Iran is perhaps what we heard from Jake Sullivan, of course, the former national security advisor under Joe Biden, who said something that is quite a consensus among some analysts, and that is that Gulf countries may need to eventually just have or broker their own kind of deals with Iran, regardless of that relationship that they have with the United States, just because this stalemate has been going on for quite a while, and it's really affecting the regional economies in the picture when it comes to those oil exports. And while, of course, higher energy prices are positive for these exporters, the lack of movement in the Strait of Hormuz and now what we're seeing in the Red Sea is going to ultimately be net negative on them. So a lot of unclarity still, Chad, but a situation to monitor over the next couple of days or so.
Bloomberg's Abir Abu Omar joining us from Dubai with the latest. Well, still ahead, UK July inflation data is out at 7 a.m. We'll discuss that and more with Freya Beamish, chief economist at Global Data TS Lombard. But first, China's biggest humanoid robotic firm makes all the right moves, surging more than 600% at its Shanghai Open. That's next, and this is Bloomberg.
latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Next week, Bloomberg is live at the Jackson Hole Economic Symposium. Tom Keene and Lisa Abramowitz, along with Michael McKee, will bring you news and interviews with Fed leaders, policymakers, and economists shaping global monetary policy. Tune in for continuing coverage and a special episode of Surveillance, August 28th at 9 a.m., including full coverage of Kevin Warsh's first speech to the conference. The Jackson Hole Economic Symposium on Bloomberg. Context changes everything.
Welcome back to Bloomberg Daybreak Europe. Unitree Robotics shares opened 629% higher in its Shanghai trading debut this morning. More than $900 million was raised in the IPO, making it the first publicly traded humanoid robot maker in mainland China. Let's bring in our China correspondent Minmin Lo in Hong Kong. Hey. Minmin, why was this such a successful IPO?
Yeah, a very successful one. I think it's come off the highs now, but it's still about 400% or so higher than the offer price. So huge interest in this stock because, of course, everybody wants to get a piece of the pie, right? This is the first pure play humanoid robotic stock to be publicly traded. And it is one of the most prominent companies in China, one of the market leaders. In fact, it was a market leader for a long time, but then last week it was overtaken by Edgybot, which is another Chinese company which had surpassed it in robot sales. But we're also at an inflection point when it comes to humanoid robotics. JP Morgan, for example, projecting that this year's global shipments could hit 60,000, and by 2030, that could go up to 1.7 million. So this is a close to 30-fold increase. And so that's why people just want to get in at the early phase of this growth cycle and to, of course, capture some of the returns there, given that this is one of the few profitable companies in the humanoid robotics sector.
And Minmin, how does Unitree plan to sustain its economic and product performance in the long term then?
Yeah, it's been investing on product development, on research, expanding its product capacity, and you saw some of the videos just now of the robots performing gymnastics, and it has one new robot called Superman that can jump as high as 2 meters. I'm not sure what you need a robot to do that for, but certainly we're seeing some of these leaps in the technology that has been quite eye-catching. But some of its vulnerabilities include the fact that it hasn't invested as much in its AI models. So to address that, it has partnered with DeepSeek, which is investing in Unitree for a 2.3% stake, and will then offer DeepSeek to help power the embodied intelligence of these robots. It also has very strong sales. Last year was 5,500 humanoid robots that were sold by the company, but one of the vulnerabilities is that it's heavily reliant on the academic institutions as a key client. So that's also something the company has acknowledged, and they're looking to diversify that. And of course, another headwind is regulatory headwinds from the US right after the Trump administration has banned these new models of humanoid and quadruped robots. That could be a headwind for Unitree, although analysts say that for this company, they will still have likely no problems expanding into other regions outside of the US.
And as we look sort of projecting out into the future, what do we see as the uses for these robots? What sort of areas do you think they'll be most likely to be used?
So a lot of humanoid robots I mentioned earlier has been sold to academic institutions. So a lot of it is research-based. When it comes to the quadruped, depending on how hardy it is, there are different grades of them, and Unitree produces some of the more competitive ones. But the hardier ones, they are able to go into industrial usage, even, for example, search and rescue, fire operations, going to check on power grid systems, navigating dangerous mines, for example, and of course, when it comes to consumer-facing sort of robots, a lot of these robots nowadays are being used as companion robots. They can even teach you, for example, to practice speaking Chinese, for example. So a lot of these Chinese humanoid robotics startups, they are experimenting with many new types of products. Some of them are assisting the elderly with mobility issues, for example, plenty of use cases. But of course, question is whether it will see the sort of mass scale usage that would be key for future monetization.
So fascinating, Min Min. I'm going to be looking for my invitation from you to come there and check them out myself with you in China. Bloomberg China correspondent Min Min Lo joining us this morning. Now coming up, your pledges billions to build its tech autonomy, but analysts say it should be spending trillions. Those details are next, and this is Bloomberg.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend. This is Bloomberg Television.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Welcome back to Bloomberg Daybreak Europe. Brussels has pledged to spend 30 billion euros to build 7 AI gigafactories across Europe. But Bloomberg Intelligence data estimates the EU will need to spend at least $3 trillion by 2035 to be truly self-sufficient in technology. Well, joining us to talk about all of this is Chief Europe Correspondent Oliver Crook. Ali, what does this path to AI and tech autonomy look like in Europe?
Yeah, so listen, Chad, I mean, we get all these sort of initiatives out of the European Union. It's not always clear what they mean, how much money is actually committed by various governments and these sorts of things. So that 30 billion figure is actually a much lower figure in terms of what the EU is going to pledge. It makes a lot of assumptions in terms of what private investment is. But Bloomberg Intelligence has very helpfully mapped out what a roadmap for actual tech autonomy in Europe would look like. And the bill for that, Chad, is going to be $3 trillion through 2035. And that is, of course, an absolutely huge sum of money. In terms of the priorities. Number one on there, you can see it on your screen, cloud infrastructure investment, $1.5 trillion. This is an arena in which the Europeans are still very dependent on other countries, particularly the United States. There's going to be some investment in semi-cap equipment. That's more than $500 billion. This is an arena where there is some strength in Europe because, as you know, there is some investment in already capacity to build semiconductors, but mostly analog, things for EVs, things for sort of smart appliances, not so much the very advanced semiconductors for AI. And of course, another $500 billion will have to be spent on foundries, to say nothing of the large language models, which will require $300 billion worth of investment, and where the Europeans, as you can see on your screen right there, have a very, very small market share. Really, the only big player within that space is Mistral. The only place where the Europeans really are dominant, and this is in one particular sector thanks to one particular company, is the lithography machines, the machines that build the chips themselves, ASML. They basically completely dominate that market. But basically, Chad, if we look at $3 trillion investment, regulatory overhaul, all of these sorts of things, that will get Europe on the path, but that will not even get them full autonomy because of how far behind they are on technology.
Ali, how likely is it then that the EU and Europe can catch up on AI, given how far behind they are?
Yeah, so listen, this is the big question, I think, for European policymakers, and also how to sort of construct things in order to get things on track to catch up with the United States. I think there is a side of things that starts to think about the realisticness of such a goal. I mean, there's another piece of research out from BI which looks beyond just the technology sector, thinking about defense, thinking about energy, thinking about power grids, all of those sorts of things. That is going to cost $14 trillion through 2035. And as Europeans sort of face down the highest borrowing costs we've seen basically since the financial crisis, very stretched budgets fiscally, there's going to have to be a very difficult conversation in terms of budgetary triage, where you actually need to spend that money. And is AI and technology really going to be number one when you're dealing with trying to support the very large European welfare state? You've got to obviously spend a lot more on defense, and the technology is obviously absolutely critical, particularly when you look on what you're seeing at your screen there, when you look at the GDP gap between the United States and the European Union. You know, these were economies that were basically quite close to the same levels of productivity, quite close to the same levels of GDP, and you can see that gap on the screen basically blowing out, and that is going to continue to happen if the Europeans basically cannot catch up on technology.
Bloomberg's Oliver Crook joining us from Brussels this morning. Bloomberg, Ali, thank you so much for joining us. Now to some corporate news. Bloomberg understands that Anthropic's revolving credit facility is set to rise above its roughly $10 billion target as the company prepares to IPO. Meanwhile, the information reports that Anthropic is planning to give shares with extra voting power to its CEO, Dario Amodei, and other co-founders. OpenAI is tightening safeguards on its models after a breach involving Hugging Face raised fresh concerns about cybersecurity. The ChatGPT maker says it will step up monitoring of unreleased models, aiming to alert safety teams to concerning behavior within 30 minutes. The company is also restricting internet access for certain models and introducing stronger controls on higher risk tasks. Meta has been accused of deliberately designing Facebook and Instagram to turn children into compulsive users and boost advertising revenue. A lawyer for 29 U.S. states made the allegation at the start of a federal trial in California. Meta denies the claims and says the states are seeking unreasonable design changes and an outlandish payout. Well, let's take another look at the markets this morning. We can see that Asian markets down, dropping with that semiconductor sell-off. This morning's decline being led by South Korean shares, with chip bellwether Samsung and SK Hynix both following. Europe futures also essentially flat. Europe, of course, not as exposed to the AI trade. We'll be watching, of course, the UK CPI data coming out at the top of the hour as well. And in the U.S., we have NASDAQ futures down slightly as we watch whether the tech sell-off continues there. We'll also be looking closely at the FOMC minutes later in the day. And we also have the big U.S. retailer Target reporting earnings, so we'll be watching to see what they have to say about the state of the U.S. consumer. Coming up, UK inflation data for July is widely expected to tick higher. We'll discuss the outlook with Freya Beamish, chief economist at Global Data TS Lombard. That's next, and this is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
And a good Wednesday morning to you, live from London. This is Bloomberg Daybreak Europe. I'm Chad Thomas, and here are your top stories. The tech sell-off deepens. Chip makers leading Asian stocks lower as global long and bond yields hold at multi-decade highs. Oil climbs for a fourth straight day as President Trump hardens his stance on Iran, insisting no talks are taking place with Tehran. And President Trump delays new Canada tariffs just hours before they were due to come into effect, saying the two sides have reached a tentative deal. Now let's take a look at what's happening in the markets this morning. Asian stocks dropping this morning with that semiconductor sell-off that we've been seeing. This morning's decline being led in particular by South Korean shares, with chip bellwethers Samsung and SK Hynix both falling. Europe futures flat this morning. Europe, of course, not quite as exposed to the AI trade. And in the U.S., NASDAQ futures down slightly as we watch whether that tech sell-off is going to continue there. We'll also be looking closely at the FOMC minutes coming later today. All right, let's take a look at the cross-asset picture now. Oil rising for a fourth day with no sign of progress toward a resolution between the U.S. and Iran after almost 6 months of conflict. Brent climbing this morning toward $92 a barrel. Treasury steady at this hour following that global bond sell-off that we've been following all week that has pushed 30-year yields to levels we haven't seen since the financial crisis. And the Canadian dollar up this morning against its U.S. counterpart. That after President Trump delayed those 50% tariffs on Canadian products for 3 days, saying the two sides have reached a tentative deal. Well, UK inflation data for July is out shortly and is expected to show a jump due to a rise in household energy bills. Let's get more on this now with Freya Beamish, Chief Economist at Global Data at TS Lombard. Freya, thanks so much for joining us this morning. So what are we expecting from the CPI data that's coming out?
Yeah, so that sort of off-gem price cap has protected consumers from the worst of the Strait of Hormuz shock so far, but it is now shifting. So we're gradually seeing that lagged effect of energy coming through. I'm very much looking through that. I think actually even Bank of England research suggests that given how slack is appearing in the UK labour market, the second round effects of this shock are going to be less than markets have been seeing over the past kind of actually 10 years or so since we've had that continuous mismatch in demand and supply since Brexit in the UK labour market. The second round effects of these types of energy shocks have been quite big, but the labour market has now come back into balance and actually gone into slack. So this time around, it's more likely that we see inflation coming down quite quickly.
So do you think we should be looking today and in the future at core CPI as opposed to the wider gauge then?
Yeah, I think, prior to this kind of rise of negative supply shocks, which is a systemic feature of the new sort of global macro regime, central banking 101 was that you look through this type of a shock. But because there have been so many of them, a lot of central bankers, the way they think about how inflation gets formed, inflation expectations are worried. They're worried that will start to de-anchor. So these types of shocks are having more weight than they have done historically. But with the Bank of England, which is at the more hawkish end of the spectrum in that sense, when you actually look at the report, it sounds way more dovish, and it's just the headline that is coming through on the more hawkish side, completely focused on oil. In fact, Bailey was almost just reading out what oil prices had done at the beginning of the last meeting.
So if you're the BOE, what do you do at this point?
I mean, we don't expect them to hike this year. I think actually, one of our biggest causes is that probably the terminal rate for the Bank of England could be significantly lower than it is just now. And you almost have like the opposite situation playing out in the Bank of England versus the Fed. For the Bank of England, it's all about imported inflation. The labour market is slack. For the Fed, more of a question mark there in terms of actually, is this domestic inflation that is starting to sort of to pick up? Obviously not in the latest data, but on a trend basis.
We have oil back over $90 a barrel now. What does that mean for the picture, inflation picture, more broadly across Europe?
Yeah, I mean, it does translate more into Europe than it does in the US, just because of the structure of the market here and the weightings in the basket. I'd say it's actually, so I have a sort of contrarian impression of this, because I think as energy shocks come through, it destroys demand. And so it depends like where you are in the cycle as to how persistent that actually is. In Europe, there's a little bit less demand resilience than there is in the US. So for Europe, it probably washes through more quickly, whereas in the US, there's a little bit more kind of resilience there. And if anything, like second round effects would be bigger in the US.
We've seen these incredibly high bond yields in the U.S. and also now even if we look to Germany yesterday, for example. What is driving this from your point of view?
You know, I think it's so many things. I think that there's so many sort of macroeconomic shifts. We call it the new global macro regime. So partly it is this greater likelihood of negative supply shocks. Negative supply shocks push up inflation, destroy demand, destroy the hedging properties of bonds for equities. And so investors should be asking for more to compensate them for the deterioration of those hedging qualities for bonds. But at the same, that's the sort of the negative reason around yields, why yields might be rising. At the same time, this is a re-leveraging cycle. You hear a lot about kind of crowding out. I think that's a very negative way of putting it. I think there's just good demand in the private sector and maybe a bit of fiscal profligacy across the world at the same time. And that's actually not a bad place for equities, at least in the short term, as long as the Fed keeps up with it.
Well, you're talking about the demand in the private sector. So is it essentially the AI build out and there's so much money that's flowing into that investors have choice? Do I buy a treasury or do I buy a bond being sold by a tech company?
Yeah, I mean, I think, there's a re-leveraging cycle when, most of us have been used to for like more than a decade a deleveraging cycle. So that instantly is going to mean that there's more demand in the economy. I was speaking to John Greenwood recently about this, and he was pointing out that debt is about a re-leveraging cycle is about quantities, and the Fed is moving with respect to interest rates. And that's 25 basis points each time is never going to actually keep up with the pace of that expansion of quantity of debt. So we're in a re-leveraging cycle. That's not necessarily a bad thing. It probably means at some stage that the Fed is going to be behind the curve. That's not necessarily the case just yet. We're also in a cycle where wage growth is more likely. We've got a sort of a tightening of the labour market on a global basis. Even from China to across developed markets. So that's always going to put upwards pressure on kind of trend inflation. We've got a world that is more likely to have these negative supply shocks. Again, that is going to put upwards pressure on inflation and drive up term premium. And we've got a situation at the long end of the curve where it's much more likely that governments are going to be issuing onto hedge funds rather than real money investors that have more sort of stable supply. So you get more volatility at that long end of the curve. That then feeds back into the term premium because it makes it more difficult for hedge funds to clear the market.
So what can the Fed do here?
I think the Fed can just, get out of its inertia state, start hiking rates and sort of move the economy on from that.
Freya Beamish, thank you so much for joining us here on Bloomberg Daybreak Europe. Freya Beamish, Chief Economist at Global Data TS Lombard. Well, Carlsberg is expected to post strong numbers at the top of the hour after the Danish brewer emerged as one of the big beneficiaries of the World Cup this summer. Let's bring in Sarah Charlene, Bloomberg's Copenhagen bureau chief. Sarah, what are the big questions hanging over Carlsberg going into these results?
Yeah, as you just mentioned, Chad, the World Cup is one of the things that we're definitely going to be looking for. Carlsberg has already been mentioned as one of the big winners from the tournament. They have really strong presence in some of the countries that did well in the World Cup: England, France, Switzerland. So that's some of the things we're going to be seeing if that really translated into stronger organic volume growth. There's also, we're looking for maybe there's some softness in the overall beer market. Analysts are saying that we could see overall trends being really soft for the second quarter. So it's a bit of like whether the World Cup can outweigh some of the, maybe more some of the structural headwinds.
And Sarah, talk to me a little bit about Carlsberg in China. Bad weather in China has been mentioned as a concern for them. How big of a problem could China be in the numbers today?
Yeah, like we've seen the bad weather in China prop up in basically all of the analyst loans we've been going through. China is a strategic market for Carlsberg. It's really incremental for them to build out their ABSA strategy, and they've been struggling a bit in China. There's been weak consumer spending. Some of the customers have opted out of the more expensive beers and gone for some of the lower priced premium lower priced local brands. So we're going to see if Carlsberg is going to frame this as just really big, poor beer sales in China because of poor weather. This is like a structural problem in demand. And I think this is something that could really move the share price. We've seen from years ago that they said that beer sales in China could weaken, but they still keep it as one of their major strategic points.
Sarah, Carlsberg expanded its partnership with PepsiCo during the quarter. Are we expecting to hear more on that today?
It's certainly something that investors and analysts are hoping for, especially like here in Denmark and the Nordics. Carlsberg has traditionally partnered up with Coca-Cola, but they said they're going to change the partnership and move it on to Pepsi. Now we also see other geographies, recently Azerbaijan, where they're moving over to a Pepsi bottling partnership. I think the big question is, can they convince drinkers in these markets to switch to Pepsi instead of Coke? Because they're really, for the whole soft drink strategy, putting a lot of hopes on Pepsi. And with beer demand declining globally, not just here in Europe, Carlsberg is really putting a lot of hopes on its soft drink strategy. And that's also one of the things that investors and analysts are going to be looking for this second quarter. If we're going to see like a bigger sales in soft drink, can maybe outweigh some of the weaker trends that we're seeing in beer.
Sarah, thanks so much for joining us this morning. Sarah Charlene, Bloomberg's Copenhagen bureau chief, will be watching for those results coming out at the top of the hour. And don't miss our interview with the Carlsberg Group CEO, Jacob Arup Andersen. That's at 7 a.m. London time. Now coming up, a popular ex-minister has called for wartime elections in Ukraine. We'll have more on that next. And this is Bloomberg.
Western countries, all of them are cutting funding to Africa. And some of these programs were supported by funding coming from Western countries, like for human resources, for testing, for transportation of samples. And suddenly, African countries have to think how to fund money and to cover this gap. But it takes some time. And I think the combination of all of these factors are fueling this mistrust that we see at community level. We value the support we got and we are still getting from the US. And we think that if we continue to work together, and there is no reason for the US not to work with Africa CDC, Africa CDC is the leader in terms of public health in Africa.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizon's Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Mumbai. This is Bloomberg.
Welcome back to Bloomberg Daybreak Europe. President Trump has delayed planned 50% tariffs on billions of dollars of Canadian products for 3 days. The last-minute reprieve came in a Truth Social post with Trump saying the two sides have reached a deal in principle. Bloomberg senior editor Derek Walbank reports.
Donald Trump delayed tariffs on billions of dollars of Canadian products. There were supposed to be 50% tariffs, and walking up to the very deadline, just hours to go, it was unknown on both sides whether or not this was going to take effect or if there was going to be a sudden reprieve. The answer in a Truth Social post, sudden reprieve. It's 3 days long, and in those 3 days, we need to come to a deal of some sort. Trump said, subject to the finalization of documents, was the exact way that he put it. We got a little bit of a different readout from Canadian Prime Minister Mark Carney. He wasn't quite as definitive. He said substantial progress has been made, although there is important work still to be done. Now, the trade dispute between the U.S. and Canada has ranged for quite a while, right? And it's a little bit difficult to say what all of this is kind of about sometimes. Canada has struggled to figure out exactly how to go back and forth with Trump. They've tried under Justin Trudeau to have sort of matching reciprocal tariffs, and they've tried under Mark Carney to take a little bit more of a conciliatory tone. They have been able to get some things done, but either which way they go, it does look like, time and again, things come forward and they get by there. So Canada's really trying to get to a point where it can sort of underline this and not have to do this all over again.
And that was Bloomberg senior editor Derek Walbank reporting for us. Now to some other top stories we're following this morning. Rising ocean temperatures could fuel more intense storms in Europe later this year. According to new research from World Weather Attribution, the Mediterranean is heating twice as fast as the global ocean average, with some waters more than 6 degrees Celsius above normal in June. Researchers say man-made global warming was the main driver of record high sea temperatures around parts of Europe in July. Well, Swiss voters are set to reject a proposal to strengthen the country's neutrality in next month's referendum, with the new poll showing 62% opposed. The initiative was sparked by Switzerland adopting EU sanctions against Russia. Moscow has urged voters to back the measure. And a popular former defense minister has called for Ukraine to find a way to hold elections during the war, strongly hinting at his own political ambitions. Mikhailo Fedorov questioned whether Russia should effectively be able to determine when Ukrainians can next choose their government. Ukrainian bonds have emerged as one of the standout trades in global debt markets, delivering huge returns for investors willing to take that risk. Let's get more now on from Seljuk Gökhaluk, Bloomberg's emerging markets reporter. Thank you so much for joining us this morning. Tell us about this rally in Ukrainian bonds.
Yes, it's been a surprisingly good year for Ukraine's bonds this year. Sovereign dollar bonds have already returned 12% so far this year. This is even better than last year's full year returns, 10%. I mean, there are several factors supporting Ukraine. One of them is global risk sentiment. People are chasing yields from Venezuela to Ukraine. And there aren't many countries in Europe, in European indices or emerging market indices, that offer investors 12% or 13% yield like Ukraine. And at the same time, we have very strong European Union financial support for Ukraine. Many European countries see Ukraine as defending Europe against Russia. IMF help, and at the same time, recent restructuring. All these factors convince investors that Ukraine is a good bet for the long term.
And what do you think are the key factors then powering this confidence in Ukraine?
One of the things that we mentioned, a recent factor in the story is battlefield wins by Ukraine. Ukraine is deploying drone technology and is making, attacks deep inside Russian territory. This makes investors believe that a surrender or sudden collapse of Ukraine against Russian advances is now less likely. This kind of is going to push Russia come back to the table, negotiate, and then find a solution and end the war with Ukraine. This is kind of making bonds more attractive, cited by many investors.
And to what degree do you think bond investors are following sort of what's happening politically in Ukraine? How much do they care about that, the reshuffling that's been happening within the government, for example?
At the moment, if you look at the prices early this morning, there isn't a big reaction, to be honest. There isn't a big sell-off so far in bond prices, or also we do not see a big increase. The thing is that probably many of the factors like European financial support, Western support for Ukraine is unlikely to change because of the internal political developments. But we will see and get more details in the coming days.
Thank you so much for joining us. Bloomberg Sergey Korolik joining us to talk about Ukraine. This morning he has a great piece out on the terminal. It's our priority feature for the day, and of course you can also read it on digital. Well, there's plenty more to come on Bloomberg this morning. We'll be looking at some of our favorite charts that have caught our eye. We'll be back after the break with that. This is Bloomberg.
Up to the minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hodern in Beijing, China, and this is Bloomberg.
When news breaks,
A redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherry-Ann in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Earnings season is here.
I think it is a significant moment. Record quarterly profits.
Bloomberg is first to break the numbers.
Stock traders blow past estimates at France's biggest bank.
With the smartest insights.
Do you think
The age of the mega deals in pharma is back.
Growth has been more than 60%.
The investment bank, as you say, has done extremely well.
We're just getting some slight signs that maybe consumers are adjusting their behavior.
Continuing coverage on Bloomberg. Context changes everything.
You can't just think about traditional factors or sectors or regions or even asset classes, because that AI tentacle is absolutely everywhere now, and that's only going to get worse. And so really important to stress test portfolios for an AI factor.
And that was JP Morgan Asset Management's Gabriela Santos warning of AI concentration risk. And Gabriela is spot on with those comments, and we can illustrate that with our charts this morning. So let's take a look at our first chart. Our first chart shows us how the market is receptive, at least at this point, to that enormous volume of debt being issued by big tech companies to fund the AI build-out, with investors snapping up these issuance. And that's giving investors, of course, choice where to put their money into, and that's having an impact on treasuries. So let's take a look at our second chart. If we turn to that, we can see that the U.S. interest payments on its bonds have shot up to a record $85 billion as the U.S. continues to issue, of course, huge amounts of debt. So the sheer volume of debt out there for investors to choose from is part of what is driving up yields. All right, let's take a look at our third chart this morning. That brings us to the Fed and whether they might be whether the hike might be starting to lose some steam. That's, of course, in part due to the weak economic data that we've been seeing out of the U.S. in the last week. If we look at the chart here, we can see that the likelihood of an increase at either the September or December meetings is now under 40%. So it's been, if we go back to July, you can see that it bumped up there a little bit, and it's now been dropping down a fair bit in the last couple of weeks, down below 40%. Well, to access, search, and save all of the Bloomberg Terminal charts used on this show and across Bloomberg TV, Terminal subscribers can use the function CHRT TV Go. And let's take a look at some of the key events we'll be watching throughout the day. July inflation for the UK is due at 7 a.m. local time, with CPI seen ticking higher. At 10 a.m. UK, we'll get the final July inflation print for the euro area. And at 7 p.m. UK, we'll be watching, of course, very closely what's coming up from the Fed's FOMC meeting minutes, those policy meeting minutes coming up later on today. And of course, don't miss our interview that's coming up with the Carlsberg Group CEO, Jacob Arup Anderson. That's coming up in just a few minutes' time from now. That's, of course, going to be on the opening trade with Guy, Tom, and Skylar. They'll also be looking, of course, at the UK inflation data that is coming out at the top of the hour as well. That's it for us here on Bloomberg Daybreak Europe. Have a very good, wonderful Wednesday, and this is Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation. As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market. Let's go to Scarlet Fu, who's taking a closer look at drone companies.
With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space.
Excellent reporting. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Good morning. It is Wednesday, August 19th. Here's what's on the agenda. Chip stocks tumble, oil gains for a fourth day, and we get the latest read on UK inflation.
That's just dropping now, Tom. We'll get to that in a minute. We'll get to Carlsberg in a minute. The chip sell-off is certainly a big feature of the landscape out in Asia. You saw it yesterday in the United States. You're getting it in Asia. You're not getting it in Europe. So the Kospi's down by nearly 6%. Eurostoxx 50 futures, though, barely budging this morning, down only 0.2%. That's the difference in terms of the exposure to the AI narrative. And there's a bid back in the bond market. A small one, but there's a bid back in the bond market. The countdown to the opening trade starts right now.
So yes, a significant drop in terms of the chip equity names yesterday. The SOX, the Semiconductor, the Philadelphia Semiconductor Index dropping close to 5% by the close stateside. You had the likes of Nvidia, but also Intel, also the optical makers as well. Is this a question of chip makers facing those higher yields? Is that the challenge? Is it the issuance that we're seeing at the long end? Not just government issuance, but also, of course, the AI company issuance that we've been talking about. The demand continues. The structural demand and drivers for these memory companies continues. We know expectations are high, but it seems like there are question marks once again. We've seen this cycle again, but are the dynamics different this time around?
Does the market understand what is happening? How good is the market's line of sight on what this cycle is going to look like? The fact that it is still probably cyclical, that chips are cyclical. How smart is the market at understanding that? Because the world feels extraordinary when it comes to this market at the moment. I think it's really hard to predict. So you've got to expect some volatility.
And I think the struggle is if we don't know why we're selling off, we don't know what stops it, right? So it looked like it was yields yesterday because you had a more concerning rise in yields because term premium was going up, but yields have stabilized today, and Asia is still doing very poorly.
But wasn't yet Asia just a reaction to the sell-off that we saw yesterday in the SOX? The question is now, does the Nasdaq continue that trade? Does it continue to turn, or does it stop with the drop we've seen in the Korean market this morning?
And is it Asia-related in particular because you had SoftBank announce this massive 1 trillion yen bond issuance that weighed on Japanese stocks, and so, does it feed through?
Yeah, and that raised question marks, didn't it, about the health of the balance sheet. Once again, for SoftBank, which, of course, underscores a lot of the financing for OpenAI, and then we get back to that circular financing risk. Anthropic, interestingly, we were reporting on the fact that the revenue run rate was coming in at around $65 billion US. Some people's take on that wasn't strong enough, that wasn't high enough, and so there's question marks about that. But we also know that as well as the debt issuance, there's the equity issuance, the wall of equity issuance that could be coming down the track from the likes of Anthropic as soon as this year. Maybe OpenAI as well. Still debating within the ecosystem as to when that happens. But there will be equity issuance alongside the bond issuance.
Big capital raise in China today. More of that coming as well. So just again, the challenge is more equity is coming to the market in a market that has got used to equity being taken out by buybacks. We're now cash flow negative on many of these companies. And look at what Alphabet's. We don't often get to talk about kangaroo bonds. Love it. But Alphabet's raising money at 7%, nearly 7%. Down in Asia.
That's a pretty good
down
yield.
In Australia.
Yeah, and if you think about the idea that credit has been pretty contained, except for the ones that are borrowing massively, 7% pickup seems pretty good relative to equities.
You can get 6 or 7% risk-free versus putting your money to work in equities with the lack of the clear sight that you're talking about. I mean,
is it risk-free? I don't know.
Investment grades.
Yeah.
Alphabet, kangaroo bonds, they're being well received, it seems. But there you go, 7%.
But you've got to pay for it, and you get this crowding out effect. And again, you get, is the tech trade crowding out the government trade? Is the government trade crowding out the tech trade? And what's the opportunity cost to the rest of the economy in terms of all of this?
And some of these issuances are very, very concentrated, right? It's long duration IG that's something like 40% is tech or AI. So I think that's quite concerning. And you have all these other factors going in terms of geopolitics, what's happening with the oil price. And I think yesterday we had more concern around that feed through to equities. Yes, because oil prices rising feeds into higher yields, but also because you're having refined products questions in terms of gas prices being very up in terms of Europe, but also diesel, and that's a direct feed through into your agricultural products, into your manufacturing, into logistics, that kind of thing. Either you pass that on to consumers or you have margin pressure. And so
and it goes into everything. And that's the issue. We're going to talk to Carlsberg in a minute. What does their input price story, cost story look like at the moment? We'll talk to Evie Hambro later on the show. He specialises in miners. Miners, it is a huge portion of their business. What the input cost story is going to mean for them going forward. Diesel's a big portion. Electricity's a big story. Sulfuric acid's a big story coming out of the Gulf. That's a factor. All of these things that go into everything that we consume on a daily basis are going up. And we're going to talk about the Bank of England data in just a moment.
If we don't have line of sight on the AI trade, as you were signalling earlier, then we certainly don't have we don't have line of sight on what's happening in terms of Hormuz and Iran. And you're right to rate. This isn't just oil and gas, which is up, by the way. European gas futures up about 130% year to date. It is helium. It is the petrochemicals. It is the fact that supply chain takes time to work through, and inventories are being drawn down, and we don't have clarity yet. The poly market odds, or at least some of the betting market odds, suggesting that you're not going to get the odds of Hormuz opening by July of next year have dwindled. So expectations are shrinking, but we still don't have clarity in terms of what that means across all these different factors as we continue to watch. It seems at least a US administration digging in on this.
Let me read you some numbers. UK CPI is on the screen this morning. Month-on-month 0.3. That's up. Now, let me just give you some background before I read some numbers. You've got a reset of the Ofgem price cap, and it is up significantly. This is the price cap on energy for UK consumers. It is being reset significantly high. This time last year, it went down a lot. This time, we're rising a lot, plus 13%. So that's what you've got to factor into your thinking in terms of what you're watching here. So month on month, we are up to 2.9 from 2.6, in line. The core number is slightly stronger than anticipated. It was expected to drop back down to 2.5, but it's up. It remains at 2.6. Services are down pretty much in line with expectations as well. So what you're seeing here is imported inflation, which is the big story for the UK economy right now. It is different to what you're seeing over in the United States, which feels domestically generated. Here, it is all imported. You've got huge slack in the labour market. You are way to the right domestically from where potential is. Sorry, way to the left. That's the issue here that the Bank of England is facing. Yep.
No, I was going to say the pound, a little bit of a movement higher, 135, just up 0.1% in terms of a very modest reaction there. And markets continuing to price in about 30 basis points of hikes from the BOE by the end of this year, though the Bloomberg Economics thinks the BOE will stay pat.
OK, let's talk about some of the corporates that we're watching and talking about the input prices story that we are watching as well. Carlsberg out of Denmark with numbers this morning, narrowing its full-year organic operating profit forecast. It's nice to get some certainty in a world that feels so uncertain right now. Jacob Arup Andersen, the CEO of Carlsberg, joins us now to discuss. Good morning. So you're narrowing your operating profit forecast for the year. Every day on this show, Jakob, we talk about the huge uncertainty that there is out there at the moment. What gives you certainty right now to be able to do this?
Well, first of all, we always navigate in a lot of uncertainty, so it may feel like there's a lot right now, but I think that's it's unfortunate. It's a permanent feature of being a CEO. If you look at right now, 2026, we are basically almost through the big summer season across our key markets, and therefore we have a lot of certainty around the delivery on those key big months for the beverage industry. That gives us a lot of confidence in our ability to deliver on this increased narrowing of the guidance that we've just come with today. If you look at it, Western Europe has had a very solid summer, so has Central and Eastern Europe, and that's a key driver for us, including some of the major growth markets like India and Nepal, etc. So it's a very solid delivery over the summer that gives us confidence. And on the top of that, we're also delivering higher than expected synergies out of the Britvic acquisition. So both of those elements are important.
Okay, you bring up Britvic. Jakob, it feels looking at these numbers that the stability almost comes from the soft drink side. Are you now a soft drinks company rather than a hard drinks company, I guess, for a better way of putting it? Is that how we should look at this? How have soft drinks done versus beer?
Yeah, you're spot on that the soft drinks part of the business is doing incredibly well. So we're not a soft drinks business. We are a diversified beverage business, which means the multi-beverage gives us a lot of strength. So you have beer in India doing incredibly well. You have soft drinks in the UK doing incredibly well. And all of those elements means that we can also weather any hit we get somewhere in the portfolio. Today, a third of the business is now soft drinks. And it also, of course, then plays a major role in our performance. And if you look at soft drinks in the first half, it's up 9%. So we have 9% volume growth in soft drinks in the first half, which of course is a significant growth rate within our industry. So soft drinks is clearly pulling up our performance, and that was the whole reason why we've done the strategic moves we've been doing.
Jakob, and you mentioned the Britvic integration and the synergies that you're seeing there. Where are you in terms of finalising that integration? Can you give us an update on that progress?
Yeah, so the overall integration in terms of especially the commercial agenda is going incredibly well. We were faster than expected in terms of taking out all the basic synergies, and that's also why we are increasing the synergy realization this year. It means at the end of this year, 80% of the synergies of Britvic will have been realized, and that's actually 80% of the synergy target we raised. Last year.
Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars, Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Asia is at the forefront of some of the world's biggest stories. I'm Sherry-Ann in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Welcome back. A couple of minutes to go until we start equity trading here in Europe. Lots of volatility in the States, chip stocks. Lots of volatility in Asia, chip stocks. Europe, not so much. We'll see what ASML does this morning. But broadly, that is the narrative. This was the session here over in the United States yesterday. Europe went out not too far away, actually, from the lows of the session, which came towards the back end. But the Philadelphia Semiconductor Index was off sharply yesterday, which has kind of fed into the Asian session. You're certainly seeing that in the Kospi, but it's unlikely to feed into the European session. Let me show you some numbers out of Europe. They are a little bit more benign. Stocks 50 futures, 0.2% to the upside. FTSE's up 0.1%. DAX futures up 0.2%. You're getting 5% moves in the US. You're getting 5% moves in Asia. Europe, not so much, Tom.
OK, you checked on the chip story, of course, and we will be zeroing in on the potential read across to the tech space then in Europe. You mentioned ASML. We'd be watching, of course, names like ASML, names like ASM, ST Micro, of course, Infineon as well, to see if there is a read across in an environment where European futures are pointing high by 0.2. Carlsberg in focus, of course. We've been speaking to the CEO. They have upgraded or edged up the outlook, nudged up its outlook on the back of strong soft drinks demand. So we'll be watching that company. ING, this is a story around trimming its stake in a bank called TTB. So ING cutting its stake. We'll be watching that stock as well, Guy. Financials in focus.
OK, here we go. European equity market open. Feels like it's going to be a fairly quiet kind of story relative to the global turbulence we are seeing out in Asia, in the United States, as I say. And you do wonder whether or not this is a feature, not a bug this morning in terms of what we are seeing. OK, let's give you some numbers. What are we going to be seeing? Are we going to see tech stocks sell off? What are we going to see in oil stocks and miners this morning? I think will be interesting as well. OK, FTSE 100 out of the gate, up as expected. Let's call it 0.1%. I'm being slightly generous. We're mid-August. Let's be generous. We are flatlining, basically, in London. We're expecting a very similar picture elsewhere. Stock 600 is doing something similar. FTSE's now flirting with positive and negative territory. We're going nowhere at an index level. The CAC, the DAX, the AEX, the IBEX are all expected to do something similar. Below the surface, though, interesting things might happen. Are we going to see some underperformance from the AEX? No, we're not this morning. There you go. That's interesting. So I'll be interested to see what ASML does. But the IBEX is doing nothing. The CAC's up by 0.2%. Tom, what do you got below the surface? What's going on there?
Well, just touching on ASML right now, because that is actually up 0.4%. So that is interesting in the context of that pretty significant sell-off in the semi space. ST Micro is down 0.8, though, on the flip side. In terms of what is happening across your sectors, basic resources is currently your leading sector, up 0.5%. Media is seeing the biggest losses, down around 0.3%. Chemicals on the other side of the ledger, seeing very modest gains of 0.3. Construction also up about 0.3%. Travel and leisure gaining so far in the session, just 0.1%, and energy is there with oil prices, of course, at around $91 a barrel. Tech as a sector is down 0.2%, so it's amongst the losers. But again, ASML is holding its head above water with gains of around 0.6%, Guy.
It's the biggest points gainer in Europe. You don't need to see much of a move with ASML to keep kind of things looking actually fairly rosy. I'm curious as to why. It's interesting because you've got Infineon down, you've got some of the other chip names down. The pharma sector looks like it's under a little bit kind of more pressure, but it's mixed. Astra's up, Novo's down, Nestle's down, but some of the other staples are doing slightly. I'm struggling to see a clear narrative emerging out of Europe this morning. This feels more like an August kind of picture in front of me here rather than anything else. Elsewhere in the world, there's clearer narratives, I think. Europe, I think, not so much.
Yeah, I mean, I think gilts are very much following the global story until we have yields down this morning at the 2-year point, on the 10-year point, and that very much follows what we've seen in Europe and the U.S. with this kind of stabilization with yields, and kind of contrast for what you saw from inflation data this morning, where, yes, headline was in line, but it was a rise, and I think more concerning for the Bank of England was that we got core CPI higher than expectations, even if it was flat. And the pound rallied on that. So maybe the gilt move is more to do with global expectations rather than what happened with inflation this morning.
We were talking about the buyback story, SK Hynix, during the break. And so the red head across the terminal right now, SK Hynix shares erased those losses of 8.3% post-market on that buyback story. So returning pretty significant capital to shareholders, SK Hynix. At this moment, of course, where we've seen that stock started the session down double digits, repaired some of those losses then post-market as they look to return cash to shareholders.
Take money off the hyperscalers, give it to your shareholders. And to your, as you pointed out, also to your workers as well. which is an interesting story as well. But that seems to be the flow at the moment. Hyperscalers cash flow negative, spending a lot of money right now. SK Hynix, one of the big beneficiaries of that. How they use that, I think, is interesting. Do they use that to increase capacity, which could have an increase in terms of the pressure later on, or do they just give it back to shareholders?
Well, the other way to read it would be they're not putting that cash to play in capex.
Yeah,
so
but that's
maybe they're starting to see exactly. So maybe they're starting to see. But so far, investors seem to be welcoming the return of capital to shareholders. Let's get a broader take on these markets then, and bring in for further analysis Aliki Rufiak, who is portfolio manager over at Rebecca. Aliki, good morning.
Good morning.
Thanks for joining us. You lent into risk, so you've upped your risk in the month of July, and that, of course, was a month when we saw a significant sell-off. Do you remain confident that you want to be leaning into risk, leaning into equities at this point? What is giving you that confidence, if you have it?
I think if I take a step back and look what happened over the last couple of days is, again, we see the same narrative that equity markets are kept hostage of the conflict in the Middle East, right? We've seen rising bond yields and some weakness, some softness, particularly on the tech sector at the back of higher bond yields. However, on the other side, we have also seen very strong fundamentals, right? The quarterly two earnings have come very strong, both in the US but also Europe. So we've seen better earnings expectations there. And for us, what is also important is the fact that earnings growth is broadening out outside the tech sector. So other sectors are contributing to this more positive picture. If I look then at the inflation front and assess a little bit the situation there, because obviously inflation is a risk and is a risk to earnings if it becomes sticky. And at this point in time, I think we are in a very different environment and very different narrative compared to 2022, when we saw inflation rates shooting up. And we also had a very supportive second round effects that effectively supported central banks to increase rates at a much faster pace. For now, we think that second round effects are relatively muted. If I look in the US, latest employment numbers outside on the payrolls front have been weak. So weakness in the employment market is not boding well from a growth perspective. But also the inflation prints that came out last week, both on the consumer and producer side, have been broadly in line or below expectations.
Okay, so there's a lot to unpack there. Can I just focus on the here and now?
Yeah.
The sell-off that we've seen overnight in the US and Asia with chip stocks, would you buy that dip?
So we favor emerging markets as part of our overall kind of like more pro-risk stance, and I think there we're selective. And we are selective because, obviously, AI has contributed quite a lot in terms of driving emerging market returns since the beginning of the year. But what we've currently seen is that the market is starting to differentiate between kind of the different regions, and particularly with regards to their exposure to the AI theme. If I look at the different countries, Korea and Taiwan come to mind. They have been like predominant drivers of performance. And from our perspective, we like the space. We think that if AI capex continue to be very strong, this would also support equity markets vis-a-vis that the earnings coming in line with expectations for the very high valuations of the space. But we are also deploying active management approaches in order to be able to navigate this more volatile environment.
Higher bond yield is going to be a problem for equities. The equity yield is disappearing rapidly at the moment. Why do I need to own equities when I can own bonds at these kinds of levels?
I think on the yield perspective, if we look at the catalysts that they have driven rising bond yields, there are two stories. The first one is very high real yields. So that's one factor that is underpinning higher bond yields. And the second one is the increase in term premia that we've seen in the market, particularly in the US. And there the market is focusing more on the fiscal situation. Sure. So higher fiscal risks that could point towards higher yields. For us, what is built in from an inflation perspective, so the oil price shock and expectations for higher inflation is likely to be transitory, right?
Sure, but those first things you mentioned aren't. If we're worried about long-term debt sustainability of governments and you've got a crowding out effect coming through from AI, yields are going to stay higher. Do I need to revalue equities off the back of that?
Absolutely. I think it depends on growth. And when it comes down to growth, at least what we've seen in Europe, the narrative is a bit different. Markets were expecting growth to be weaker during the US-Iran war. The data have actually surprised on the upside. So from that perspective, we see growth coming in a bit better than expected on the European front, at least. And on the other side, we've seen the broadening out of growth expectations on the earning front. And this supports that returns are going to come from on equities from other parts of the universe. So the AI is a kind of like a predominant story. And for us, index concentration is a risk. So the way that we access equity performance is kind of like towards from a more diversified perspective. We are also focusing on factors that are likely to outperform during a higher rate environment. Value is one. And we are also looking for style diversification. So fundamental strategies, but also combined with quant strategies where you can also harness this factor premium in a more efficient way.
When US-Iran, the conflict first began, both bonds and equities sold off together. How do you insulate or hedge portfolios against those repeated supply shocks?
We do see that over the short term, and given the fact that we have a re-escalation of the conflict in the Middle East, that equity-bond correlation is becoming positive. So we have added some tail risk hedges in the portfolios. One is the Norwegian krona, which is an oil-sensitive currency. And on top of that, it provides us with a positive carry relative to the euro, which is what we are playing Norwegian krona against.
We've had this massive compression between EM yields and DM yields. Is EM compensating you for the risk? Is it just the fact that EM isn't as risky relative to DM as it was previously?
So from an EM local currency debt perspective, we are more positive in the medium term, and this comes at the premise of a weaker dollar. We've seen very recently the repricing of Fed rate expectations towards kind of like a more cautious dovish stance, and this has supported the space. We also see during a high interest rate volatility environment that the emerging market local currency denominated index has a lower duration compared to the global government index, and that helps us also to manage that exposure with regards to interest rate risk better.
Likia, nice to see you. Thanks for stopping by to see us. We really appreciate it. Thank you very much indeed. Likia Rufiak, Roboco Portfolio Manager, joining us here in London. Call 6 looks like this. As we've already indicated, ASML not succumbing to this big chip sell-off that we've seen around the world, certainly in Korea overnight and also in the United States yesterday. In fact, it's up by circa 0.5%. Schneider's a little softer, though. You are seeing some of the defensives performing. Nestle is up. Some of the pharma's very mixed this morning. LVMH doing nothing. Let's get other moves that we are watching. Lots in the chemical sector this morning. Plenty of other sectors to watch as well. What's Alex Morgan focusing on? Let's find out.
Well, let's kick off with Carlsberg then, shall we, Guy? Obviously, that's been one of the main earnings stories this morning, down around 1.5%. Now, this is obviously, yes, specific to this particular firm, this company, but also the broader sector challenges we were talking about for brewers, for drinks manufacturers, as people turn to low and no alcohol drinks. But Carlsberg opening down this morning, that, of course, talked about the challenges, the double-edged sword, as the CEO put it to you, about heat waves, obviously driving up demand in one sense, but obviously causing all sorts of other challenges on the other side. So Carlsberg off the back of all that this morning, down nearing now 2%. Let's turn to Geberit, the German sanitation manufacturers. You see them in commercial and obviously in people's home bathrooms, sinks, pipes, etc. Opening up around 7% this morning off the back of their second quarter profit, which was above estimates, gaining, as much as 8% this morning for Geberit, doing well and in the green. Let's turn it over to Straumann. Now, they are the manufacturers of dental implants. This is an interesting one, down around 7%. Now, the news from them this morning, they reported profit for the first half of the year, which had beat the average estimate and named a new CEO. However, opening down and in the red for Straumann this morning. Want to keep an eye on, maybe, to unpack that one a little more. And finally, let's turn to Ambea. They are a Nordic health platform online. up around 10% this morning, really doing quite well on the back of that company's news this morning. So a blend of the green and the red, folks, but Carlsberg, obviously the main talking point that's been on the programme, that is down, and they are in the red this morning.
Morgan, thank you very much on some of the stocks on the move this Wednesday. Coming up, more on those Carlsberg results then. We're going to bring you the highlights from our earlier interview with the company's CEO. That's next. This is Bloomberg.
The global economic playbook is being rewritten and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today. Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Mumbai. This is Bloomberg.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this yield forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Bringing you up to the minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hodern in Beijing, China, and this is Bloomberg.
Earnings season is here.
I think it is a significant moment.
Record quarterly profits.
Bloomberg is first to break the numbers.
Stock traders blow past estimates at France's biggest bank.
With the smartest insights.
Do you think the age of the mega deals in pharma is back?
Growth has been more than 60%.
The investment bank, as you say, has done extremely well.
We're just getting some slight signs that maybe consumers are adjusting their behavior.
Continuing coverage on Bloomberg. Context changes everything. Next week, Bloomberg is live at the Jackson Hole Economic Symposium. Tom Keene and Lisa Abramowitz, along with Michael McKee, will bring you news and interviews with Fed leaders, policymakers, and economists shaping global monetary policy. Tune in for continuing coverage and a special episode of Surveillance, August 28th at 9 a.m., including full coverage of Kevin Warsh's first speech to the conference. The Jackson Hole Economic Symposium on Bloomberg. Context changes everything.
Okay, here we go. 17, 18 minutes into the session thus far. This is what we're looking at. Unchanged is the takeaway from that board, and we've kindly written it for you. We are doing nothing. In terms of the sector story, construction, basic resources, energy are up on the downside. Banks, real estate, and media in terms of the sectors that we are watching. We don't have a great weight in terms of tech. It was interesting to see, though, that ASML did not fall in line with the chip story around the world. I do wonder whether or not that's maybe partly down to what we've seen with SK Hynix recovering over the last few minutes.
Yeah, and the details after the close over in South Korea, after it faced, of course, significant pressure in terms of the share sell-off. The details coming through on that is that SK Hynix has announced a $28.6, let's call it $29 billion share buyback plan as the company generates record cash flows amid the AI boom. Let's get the details, bring in Bloomberg senior strategist Neil Campling. Neil, what do we know about the buyback announced from SK Hynix? Is it going to put a floor under the share price? Is this a tell in terms of how they plan to approach things going forward?
I think the market had been expecting a buyback, and given the record cash flows, it was kind of they had the fiduciary duty, I suppose, to announce that. The talk last week about potentially one of the highest regarded sovereign wealth funds potentially taking a stake in Hynix and Samsung probably adds to the buy case for the stock, perhaps. But it doesn't remove the fact that the volatility around the stock, around the market, around chips is going to continue, I think, especially because there are, I think, a lot of, should we say, tourists in the stock rather than fundamental owners of these kind of.
I mean, should we put the latest sell-off in chip stocks down to volatility? Is it something more macro? What's really the driver here?
I think there is a macro point that we have to keep in mind here, which is that we have free cash flows from the hyperscalers turning negative in the outlook. They're coming to the market and they're raising debt. So that also leads to the weighted average cost of capital going up for the equity. And so there are all these issues, and when you see the long-dated treasuries moving higher, as we've seen in recent weeks, that creates pressure points that weren't really here for tech for the last decade or so.
Well, we can blame the tourists. The market likes robots.
Yeah, it does, and I mean, in terms of robots at scale, China has been actually in this area way beyond any of the other sort of companies in the US, etc. So there is appetite, particularly in the Chinese
This is the
market.
Unitree IPO that's come through this morning. Was it 600%?
That's right, yeah.
They kind of, as we were talking earlier, the Chinese authorities, though, are kind of pricing these things, arguing that they should be priced low, so you get a nice pop.
Price to go and then pop, and then, but then, of course, I suppose then the thing is what happens further out from that. Can it maintain the share price up at these levels when you have a lot of retail interest in these kind of markets? And that's where we obviously see pressures in South Korea. So let's see what happens in the Chinese market.
Neil Campling, covering robots, tourists and everything else in between. Thank you very much indeed. Carlsberg shares a little lower this morning after the Danish brewer narrowed its full-year growth outlook towards the upper end of its range. After a strong performance in soft drinks in particular helped underpin the sales volume in the first half. We spoke to the company's CEO. He emphasised on his ability, his firm's ability, his team's ability to deliver on the guidance.
We are basically almost through the big summer season across our key markets, and therefore we have a lot of certainty around the delivery on those key big months for the beverage industry. That gives us a lot of confidence in our ability to deliver on this increased narrowing of the guidance that we've just come with today.
Let's go to Copenhagen and talk to our bureau chief there, Sarah Scholin. The stock's a little softer this morning. The earnings, the guidance looks pretty good. They've narrowed that. What am I missing here? This looked like a reasonably positive picture, but the market's taking a little bit of fright. So what should I be taking away from the earnings?
Well, you're right, Guy. It's a perfectly decent report, but I would think it's lacking a spark. It's lacking something that's going to get everyone super excited about the outlook now. As Jacob or Andersen said in the interview earlier, they have a pretty good visibility of the second half of the year, and it looks nice. It's within the guidance, but they didn't raise the guidance. There was no expectation of that, of course. But there's nothing to say like this is a company that's just going to knock it out of the park. But they're doing pretty well. As you also said, soft drinks was one of the highlights. That's really what's driving the growth in the second quarter this year. Mainstream beer volumes were largely flat. The CEO pointed out two things in the soft drink area. It's the Britvic integration is going really well, and that's also helping support some of this sales growth. They are integrating the company faster than I had anticipated, so they're looking at 80% integration of synergies by the end of this year. This is more than they had said earlier. He also said the Pepsi partnerships are doing really well, and a lot of the soft drinks volumes are driven by Pepsi sales. And I was just on a media call before getting on this show, and the CEO said that they're likely to engage in more Pepsi partnerships in the coming years, although he couldn't say specifically which one or if it was a certainty. China has been a big drag this quarter. We talked a lot about really bad weather in China, and he said it's just they're a lot weaker than expected, and it's something because of high inventories now that's probably gonna go all the way into this third quarter of this year, where they're gonna see maybe some weaker sales in China.
Yeah, so the weather clearly a challenge in China. He was pretty explicit about that. What about the heat waves in Europe and how that's impacted the business?
Well, it's a bit of a two-edged sword, really. I think a lot of people are inclined, me included, to go to the pub when the sun is out. We're going to have a pint more or 2 pints more when we have really nice weather. But when it comes too hot, there's a point where people start tipping over into just drinking tap water, not even soft drinks will do at that point. And we've seen some of that this summer. There's also been some festivals where they put a ban on alcohol just to get people to drink more water and soft drinks. But overall, for this quarter, it's seen as a positive for Carlsberg because the weather has been nice across most of Europe, so people have come out to drink more beer and soft drinks.
Okay, Sarah Sjolin, restrained, I think, in your consumption maybe of beer in the face of the heat that Denmark's been facing as well. Sarah, thank you very much indeed for the breakdown of what we've seen from Carlsberg. As we've been saying, the stock is a little lighter so far in the session. One of the other headlines for the day really should have been Red Banner. It has rained in London.
I would actually quite like the idea of standing outside in the rain with a beer in my hand. That sounds like quite an attractive option at the moment.
Not something we'd have said 6 months ago.
No, definitely not.
Shocked when I ran to the car this morning. I was like, what? It's raining?
What is this stuff that's coming from the sky? Yeah. Long way at last. I may regret saying that, by the way.
Yes. Well, there's some reporting suggesting that we're going to face significant storms in the winter, rising sea levels. You've been dipping your toe in the ocean.
Rising sea temperatures.
Sea temperatures, not levels.
Levels may come, but temperatures are up.
And levels may come over the winter. So Europe may need to brace for some pretty significant storm action over the winter. Again, there's some Bloomberg reporting on what this is doing.
And I mean, it never lets up, right? In terms of if you have it in the summer, if you have it in the winter. And I do wonder who bears the cost of that. Is it the consumer? Is it companies? Or increasingly, is it governments that have to spend to insulate the fact that you're going to have these natural disasters?
All of the above, though, isn't it?
Yeah.
That's just the story. And you think about, keep coming back to it, the food industry. Terrible summer. If it rains a lot, terrible winter.
Yeah,
both of those two things.
Planting season.
Yeah. So food prices go up, food prices stay up, the rate of inflation just increases, starts to get embedded, you get second round effect. That's the kind of scenario we hope doesn't apply here. But so many of the CEOs that we talk to that come on, this is what they talk about. We are now used to this. That's the turn that we're working with.
And crop prices are already very high right now.
Yeah.
And we were talking with one of our earlier guests about EM versus DM. And this is very much my worry for EM debt, is the fact that you have a higher share of the inflation basket that's food. And so, eventually you get that feeding into inflation expectations. De-anchoring happens more quickly there.
Well, the bulls may lean on the argument that, look, we continue to underestimate the ability for corporates to adjust, to have that resilience, and that they've learned from all of these different shocks, and that resilience is now built in at the corporate level.
We'll talk about this from another industry perspective. We're going to talk about this next, about the mining industry. Energy's kind of circa 20%. Labour's a pretty big input cost as well into copper mining, etc. What does that mean in terms of future prices going forward, in terms of the cost of production? Anyway, Evie Hambro is going to be here. We'll talk to him next about that. This is Bloomberg.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream. And a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start on the third floor or the lobby. You actually have to start in the basement.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Happy Wednesday. This is the opening trade. We are 30 minutes into today's session. So after 5 straight days of losses for European stocks, you're currently flat across the benchmark. Of course, significant selling overnight in Asia and the US when it comes to the chip names. But so far, that hasn't really percolated through the European space. The DAX is currently holding flat as well. Modest gains coming through for the CAC current. Gains of 0.3%. You're largely unchanged on the FTSE 100 as well, adding just 6 points at 10,734. Guy.
It's August the 19th. I bring that up because we're mid-August, and that volume number probably speaks to the idea that we are mid-August. That's the narrative. Higher 260, 319 down. I don't think there's anything really convincing there in terms of the makeup of this market. Sectors are actually quite interesting, as are single stocks. So let's talk about some of the single stocks. FL Smith is a mining equipment company, beaten a raise this morning. Market likes that. Let's go from equipment to plumbing equipment. See what I did there? Geberitz, up by 7.44%. So this is the sanitation company. You probably see the name every time you go to the washroom. It's EBITDA beat, certainly being welcomed as well. And talking of plumbing, Frontline Shipping is doing very well this morning, near a 15-year high in terms of freight rates. Homos is the factor here. This is a company that's benefiting from that. I tried to find a link. I'm not sure I succeeded in all of that. Let's talk about Carlsberg. It is out with earnings this morning. We spoke to the CEO a little bit earlier on. The numbers look good, but there's no, as Sarah was saying earlier from Copenhagen, there's no real spark here. And I think that's why the stock is down by circa 2%. Smith & Nephew is down a little bit as well this morning. Its CFO is exiting the business. And Soitec, I'm just giving you an example maybe of one of the chip stocks that are under pressure this morning as a result of the sell-off we've seen out of the US and out of Asia, Tom.
OK, here's what else you need to know this morning. Oil is trading higher for a 4th day after President Trump insisted there are no ongoing talks with Iran, the standoff leaving the Strait of Hormuz in limbo then, with traffic still a fraction of pre-war levels, of course, as Washington prepares to ramp up economic pressure on Tehran. UK inflation accelerated in last month after energy bills surged, ending a short period of respite for hard-pressed British households. Consumer prices rose 2.9% from a year earlier, up from a 15-month low of 2.6% in June. The Trump administration, meanwhile, has delayed 50% tariffs on billions of dollars of Canadian products for 3 days. President Trump announced the decision less than 2 hours before the new levies were set to take effect, saying the two sides had reached a tentative agreement. Canadian Prime Minister Mark Carney wasn't as definitive, saying progress was made, but stopped short of saying they had a deal. They should spend $30 billion to build 7 AI gigafactories across Europe, but Bloomberg Intelligence data estimates the EU will need to spend at least $3 trillion by 2035 to be truly self-sufficient in technology. Joining us now is Chief Europe Correspondent Oliver Crook. Ollie, what does the path to AI and tech autonomy in Europe then look like realistically?
Yeah, so listen, we've got some research out from Bloomberg Intelligence, which helps us sort of pave a little bit of a roadmap to what that would actually look like, and critically, Tom, how much that would actually cost. And the number that they've come up with, as you mentioned there, is $3 trillion worth of spending across the entire ecosystem through 2035. Now, very helpfully, they've sort of broken it down into the key sectors, which we can go through now. The main one, the biggest spend, is going to have to be that cloud infrastructure. $1.5 trillion worth of investment over the next few years will be required there to sort of cut back on its dependency, specifically largely on the United States. The semi-cap equipment spending upwards of $500 billion there. We should say the Europeans do actually have some strength and some autonomy in this sector on some of the semiconductors. They're mostly the analog for industrial capacity. They're used in cars, they're used in sort of the sort of smart technology within our homes, but not so much for those AI key chips that will require additional spending in Europe to the tune of about $500 billion on foundries. There is, of course, the question, Tom, about the large language models, a topic you spent a lot of time covering. $300 billion worth of spending required there. And you can really illustrate why that is when you look at the sort of market share that the Europeans have in terms of those large language models. They only have one really significant player, that is Mistral. And if you look at the sort of market share in 2026, that is only about 11% of the market, as you can see there on your screen. Of course, the one point where there is actual dominance in Europe in this ecosystem is, of course, for those lithography machines, ASML, really down to one company. This is really where Europe has some leverage within those discussions about kind of that tech ecosystem, and something that really the entire ecosystem cannot do without. That being said, if you were managed to mobilize all of that money, get some harmonization across regulations across all these countries, that $3 trillion worth of spending, that would still only take you part of the way to autonomy. So it's a very long path ahead, indeed, if the Europeans want to achieve tech autonomy.
Yeah. They've got to be able to pay for it. Christine Lagarde this morning saying, I think she was in Geneva, saying that Europe can't be left behind. But can Europe kind of catch up at this point, Ollie? How much is it going to cost to catch up?
It's going to cost, $3 trillion just for the technology. But again, Guy, you're going to be talking about a lot of different sectors where the Europeans need to catch up. And if $3 trillion sounds like a lot of money you've got to spend, Bloomberg Intelligence has done the research that in order to gain basically full autonomy, you need to spend $14 trillion over the next few years. And that will have to do with the investments in defense, in energy generation, the power grid, all of the other sort of sectors. And particularly when you think about kind of what is the budgetary triage, when these governments need to sort of select what they're going to spend money on, what is going to be number one? Obviously, the welfare state is going to be one of the huge things that they really going to have difficulty cutting back on politically. Obviously, defense takes center stage. So there's a real question about whether or not the AI and technology is going to be at the number one in terms of the need for investment. Obviously, it's very important for economic growth. We were showing the chart there just a little bit earlier. It wasn't so long ago that the European economy and the American economy were quite comparable in terms of their size, but also in terms of their productivity. What we have seen in recent years, thanks to this technology story, is that those growth stories have completely blown out. You can see they've completely come uncoupled. So if the Europeans really want to catch up on that growth questions, there are going to have to be some very big conversations about where they're going to spend their money. And particularly now, as we're talking about borrowing costs, the highest they've been since the financial crisis, that spending story is not going to get any easier here in Europe.
There's a lot of savings. You just got to convert them into spending or investments. Ollie, thank you very much indeed. Oliver Crook joining us on the AI challenge in Europe. Talking of AI challenges, metals, many of them critical for the AI revolution. And their prices of these metals have been skyrocketing. Joining us now, Evie Hambro, Global Head of Thematic and Sector Investing at BlackRock. Good morning.
Morning.
Basic resources have done well this year. Metals have done well this year. The basic resources sector has done well this year. But a lot of that's come from the steel sector. I was looking through the numbers this morning, and I was surprised that names like Antofagasta and Rio haven't done better on the back of these rising metals prices and the margins that these companies are producing. Am I missing something here?
I don't think I'm missing something. I just think we've just got divergence in performance. So, you mentioned Rio Tinto, but then you look at BHP, it's done twice as well.
Yeah. Why is that? So why am I getting this divergence?
Well, it's down to the difference in commodity mix. So these companies produce different metals, and the different metals have derived different performance outcomes. So you mentioned the steel names. They've been absolutely fabulous this year, and they've been through a real kind of renaissance over the last kind of, I guess, decade in terms of their performance. So, obviously you've got some tailwinds, European legislation, the carbon stuff, China imports and the tariffs and so on, buy local, and then you've got this massive, you've just been talking about the 3 trillion that's got to be spent, or 14 trillion that's got to be spent. That's not going to be spent on thin air. It's not all going on chips. There's going to be an enormous amount of infrastructure that goes into. So whether that's power and batteries and cables and transformers and switchgear and all the buildings.
Isn't that all
in
the price already?
No, definitely not. No,
okay.
We've got a long way to go. And I think one of the things that I think I mentioned on a previous attendance here was the thing that had frustrated us the most is that you've got the kind of the shiny toy that everybody's looking at, that everybody talks about, which is technology, data centers, and chips. And none of that functions without everything else that feeds into it, the kind of supply chain that goes into it. The multiples on the companies that are the shiny toys are enormous, whereas the multiples on the companies that are attached to the same trend but are just not as exciting were a fraction of what the end outcome is. Still attached to the same demand path, same growth trends, etc., and in many cases, higher resilience when it comes to their profitability, with stronger moats around those businesses, yet trading on a de minimis multiples relative to the ones that everyone's focused on. We're starting to see that re-rating. If you look at some of the charts that we use on your systems, you can see that change in re-rating coming through. So, we talked about some of the diversified companies. The leader BHP has gone from a kind of 4 times EV/EBITDA multiple to an 8 times EV/EBITDA multiple. Now that's not what it used to be. It used to be 12, 20 years ago. So there's still room to go. So in answer to your question, absolutely.
On the supply side, are you worried at all that a lot of these critical mineral productions, including copper, is concentrated in emerging markets?
No, it's not at all. I mean, the minerals come from where the geology is. So you can't move the mines. So the supply chain is the supply chain. I think what governments are most worried about is where they're going to get their minerals from. So you take the EU, for example. How many mines are there that produce these key commodities situated in the EU bloc? Very, very few. So the EU has massive dependency on supply from other countries. And so, yes, at a political level, from a national security level, there are clearly concerns, which is why you're seeing all this legislation around critical mineral supply. It's why in the US is providing so much capital to bring back production and conversion of commodities into useful products into the domestic US. And that capital is going to unlock supply through time. But it's going to take many, many years for this to happen.
I mean, I guess part of the equation, too, is that you get this resource nationalization, you get critical minerals used as a negotiating tool. On that front, how has China's role changed within the commodity market?
China remains the largest consumer of commodities in the world, and they are the world's supplier of many of the manufactured commodities. So the things that, rather than the pure commodity that sits in the ground is converted into something that is then converted into a finished metal, China does that second stage, a lot of that second stage. So they have huge market share, especially in some of the metals that none of us know that we use every day. The rare earths everybody's talking about and so on. So there is a weaponization of commodity supply, and I think China has been very efficient in being able to use that as a negotiating tool, hence the response from other countries around the world to try and protect themselves from that.
Copper's been up, double digits year to date. We're just below 14,000 today, so it's a little softer in the session today. There's been apparently a delivery to the LME. Given the tightness, though, in the copper market, what are you hearing, what are you seeing in terms of the miners about getting more supply? What is the ability to add more supply to this market, given the demand and the constraints?
Yeah, I think those handlers at the warehouses must have a bit of a shock seeing metal coming in. Most of the metal's
been going the other direction,
it's been going out. So no, I think the market is very, very tight. And I think that there is obviously speculation around what the tariffs are going to be in the US and the flow of material into US warehouses, the massive shortages and very, very low levels in rest of the world warehouses. And that's created this tightness, and you can see that playing out in these premiums for immediate delivery. There are clearly some games going on. Maybe things are a bit more acute than they probably need to be, but the trend is very much your friend in this scenario.
If the tariffs don't come through from the US, because all that stockpiling that we've seen into the US, does that collapse the price?
Yeah, well, we saw that movie last year. There was speculation around the tariffs. The prices went to very, very elevated levels. The news on the tariffs came out. It wasn't what people were expecting. Prices came back, and then they've done nothing but kind of move higher. And I think it's the trend in the market. The other stuff that sits around the short-term pricing is noise. The trend is absolutely your friend here. So you look at the trend. What's driving the trend? It's declining grades at existing operations. It's tired, very, very old assets. It's a lack of new development of supply coming into the market. It's the very, very long time it takes to bring on new supply. It's the challenges that existing assets are facing. And you've seen the big headlines out of Codelco, where the new boss of Codelco has come out and said he's going to prioritize profitability over production. And he came out and said, we are not going to meet our production goals. That is a massive statement from one of the world's biggest copper producers. And the market's kind of absorbed this news, and prices have responded to that. So we are seeing a very, very tight market. And it's very easy to say, well, OK, it's gone up a lot and we should ignore it. And it's too late. The reality is, if you've done that, you've missed out.
What about the cost of production? Diesel prices are up massively. I'm assuming a lot of the machines in many of these mines run on diesel. Electricity prices are up significantly. I'm sure they use a lot of electricity. Sulfuric acid up a lot. What impact will these have on margins, or is the price moving faster than input costs?
Yeah, so some commodities, the price is definitely moving faster than the input costs. You haven't mentioned labour. Labour's gone up as well. So there's definitely a cost pressure within the industry. And, but that's not new.
It feels like it's accelerating, though.
It is definitely accelerating, but some of it's probably short term. If we get a resolution in the Middle East, I'm sure the diesel prices will come back and the sulfur prices will come back.
Yeah, we've been saying that for a while now.
We have been, but this is only a recent conflict. Yeah. It hasn't been going on for years yet, and we'll see what happens. And these markets tend to find a way of kind of reconnecting, and we saw that with regards to Russia's invasion of Ukraine. Very, very huge price moves in the gas market short term, and then they started to soften back. But when we look at the market today and you look at the cost of production and you say, well, how has that changed over time? I started this job 32 years ago. The copper price was 60 cents a pound. It's now $6.50 a pound. Cost of production was, a few cents per pound. Now cost of production is $2 or $3 a pound and the price is $6. Fast forward 10 years from now, it's probably going to be $10 a pound and the cost of production will be $4 or $5. It's just that it's the direction that everything's going. So I don't think it's anything new that we're seeing
here. So you can pass it on.
Yeah, and I think we will have greater visibility on cost impact in the second half, because in the first half, a lot of the companies were carrying inventory that they bought. So they would have pre-bought diesel, pre-bought sulfur, and so on. So we'll see more of that clarity in the second half of the year.
That detail will be interesting, won't it, in the second half, in terms of the cost. Evie Hambro, always a pleasure. Global Head of Thematic and Sector Investing at BlackRock. Thank you. Coming up, oil, meanwhile, continuing to push higher as the US and Iran, of course, lock into what looks like a stalemate at this point. More on that story coming up. This is Bloomberg.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, succession starts now.
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
Welcome back. Oil rising for a fourth day as the US and Iran show no signs of progress towards a peace deal after almost 6 months of conflict. The stalemate leaving the Strait of Hormuz in doubt, with little traffic transiting the waterway and pressuring global energy markets. Let's get more with Bloomberg's Abir Abu Omar standing by for us in Dubai with the latest. No signs of talks then. Two sides seem to be digging in. And the UAE, meanwhile, is cutting most of its contact, it seems, with Iran.
Yeah, good morning, Tom. So this is, of course, after a ballistic missile threat alert that we all received here in Dubai yesterday, with the UAE foreign ministry later saying that it was targeted by two ballistic missiles from Iran. Iran denying those allegations, but then the UAE coming out and saying that it has cut all financial and trade ties with Iran. A senior advisor to the president, Anwar Gargash, a very important diplomatic figure here, saying that news of providing financial facilities to Iran are untrue. This is just moments ago. So threat in the region is escalating again one more time. This is the first type of such an attack that we saw in the UAE, at least for more than a month at this point. Of course, other countries in the region had been attacked over the past couple of months or so. Meanwhile, of course, traffic in the Strait of Hormuz, the prospects of that returning to anything that resembles normalcy is nowhere near. We reported this morning that two Chinese-flagged tankers had made U-turns, stopping in the Strait of Hormuz. So the risk of Iran or the U.S. military really hitting vessels that are trying to make their way through the Strait of Hormuz is still very much there. That deal between Iran and Oman is nowhere in sight. We still don't have a formalized draft. But Tom, perhaps what is the most interesting is a report that came out from the Financial Times earlier today saying that Iran, this is citing, of course, two people close to the regime, saying that Iran might be considering hitting Europe if the U.S. decides to escalate this war front again, citing Cyprus and a British airbase that had been targeted before by a drone, by an Iranian drone, citing that as a possibility. So could we see the parameters of this war widening even beyond the Middle East and what we've reported in the Red Sea? The Yemen-based Houthis, of course, are active there against Saudi Arabia, Saudi vessels and Saudi energy infrastructure. That is a real threat now, and the threat of this war widening is, of course, sending Brent crude prices rallying for a fourth straight day. It's settling nicely above that $90 per barrel mark. And so signs of danger all across the Middle East and potentially beyond.
Okay, Bloomberg's Abir Abu Omar, thank you for that update. Let's look ahead to what else we're watching throughout the day then. The AI summit gets underway in Seoul. The ECB's Christine Lagarde has been speaking at the World Economic Forum's International Business Council. That will continue throughout the day. On the earnings front, stateside, Estee Lauder, Lowe's and Target. And at 7 p.m. UK time, we get the Fed minutes, of course, for the previous month. And it is reported that President Trump will be hosting an event with technology leaders, meanwhile, at 7:30 p.m. UK time.
OK, let's figure out what we do with these markets. We're mid-August. Let's just kind of always remember that and try and figure out, therefore, what we can really learn. Adam Linton from our MLive team joining us around the table to wrap things up. Is that a fact that we need to think about? At the moment, this market seems to be very choppy. Tech up, tech down. Yields are up, today were stable. There seems to be kind of big moves, but actually once you start to examine them and what's kind of backing them in terms of the volume that goes with them, maybe a little less.
Yeah, I think that's important. When you look at European equities, yes, we've had a little bit of a run of some down days, but ultimately we're still in close proximity to record highs. Volumes are thin and volatility is relatively low. I mean, what we saw kind of yesterday is, yes, we saw a bit of tech angles creep into Europe, but we know it has a lower gearing. But for Europe, again, what the issue is what we're seeing in developments in the energy market. So we're seeing rising Brent crude prices, we're seeing rising prices further down the barrel. And on a weighted basis yesterday, we saw some underperformance in industrials, and then also dynamics in the yield curve. We saw losses in financials, which has been a real key driver of the moves that we have seen throughout the year. So in that context, it is harder for Europe to act as a diversifier if there is some tech angst. But ultimately, the story for Europe has been one of resilience this year. Q2 earnings were solid. Expectations for Q3 and Q4 relatively upbeat. We've seen upgrades from Barclays this morning. So yes, there are reasons for caution, but alarm bells not ringing yet.
How does the bond view fit within that outlook in terms of yields have stabilized more today, a little bit of upside on bonds? Can that continue?
I think, for European, bond yields, I think, we are seeing some stabilisation, but I think it's hard to be too constructive in European paper at the moment. I think when you consider the drivers whereby we've kind of rolled from these crisis after crisis, where it's COVID, it's been Ukraine, Russia, it's now US, Iran, without kind of a geopolitical off-ramp, we'll see increased borrowing costs, and that constrains European governments. And we've seen real acute strains in the French debt markets now, where they really kind of embody this trade-off that a lot of European governments are dealing with, whereby if they don't get their deficit down, they're going to risk the bond market. If they take tough spending decisions, that's a problem for the electorate. And we know we've got this French election looming next year. And does that sow the seeds of populism? The National Rally are leading in the polls. And we're seeing a real markets widening in French and German spreads now. And we're kind of approaching those levels we saw in, I think it was June 2024, where we saw that snap election. And from a cross-asset perspective at the time, that was also a Euro story.
Gilts are getting a bid today. Is that on the inflation story, or is that the broader reset that we're seeing in bonds, at least for today globally? Is that a function of that element, or is it more inflation and traders kind of repricing around the BOE?
I think it's a combination of the two. I mean, the UK CPI data, that was in line. The rise, that was widely telegraphed. And I think that's been kind of read as Bank of England have enough to be able to sit on their hands. The odds of a September move are particularly unlikely. I think what's more interesting for the gilt market is going forward. If energy prices stay elevated, there's clearly a tension between what the market's looking for and what the Bank of England is. Bank of England's much more concerned about the inflation growth trade-off relative to the likes of the ECB. We saw a study last week from the UK Treasury that was leaked to us suggesting that if the crisis drags on until the end of the year, UK growth could be zero next year. So I think the Bank of England are attentive to this, whereas market pricing is more concerned with inflation angst. So if the Bank of England are seen to be caught behind the curve, then we could see potentially a bit of steepening in the UK yield curve. And as we know from previous episodes, that also could be relevant for the pound.
Thank you very much indeed. Nice update. Adam Linton joining us from our Markets Live team. What have we got coming up? Ed Yardeni is going to be joining the team a little bit later on, Chief Investment Strategist at Yardeni Research, joining the surveillance team at 12 p.m. London time. Earlier on this week, I think there was a well-read story on the Bloomberg Terminal talking about the fact that he's not hitting the panic button when it comes to yields just yet. So we're going to be exploring kind of when he would hit that panic button. We'll do that later. That's it for the opening trade. This is Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television. We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
A global sell-off in tech stocks deepens on concerns over higher borrowing costs and geopolitical uncertainty. Higher oil prices also weighing on sentiment, Brent climbing for a fourth day as President Trump says talks with Iran to end the war are no longer taking place. Plus, 50% US tariffs on Canada are paused at the 11th hour. President Trump says a tentative deal to resolve the trade dispute has been agreed. Well, a very good morning. Here is how markets are shaping up this Wednesday. Global stocks on the back foot. Chip stocks having slumped stateside yesterday. They were down in Asia this morning, and it's been a drab start here in Europe as well. Futures steadying, though, in the US as we head towards the Wall Street Open. Nasdaq futures just in the green now, as are S&P E-minis. Oil, as you can see, up again, $91.60 the barrel is where we trade on Brent. This on that lack of diplomatic progress in the Middle East. But Treasuries somewhat stabilising after the rout that we saw globally yesterday. Now traders looking ahead to the Fed minutes later. So the 10-year yield there at 4.68, weaker 2 basis points. Finally, the Canadian dollar stronger after President Trump agreed to delay those tariffs for 3 days. We'll discuss whether Mark Carney's on the same page as Trump later on in the programme. But let's turn to the European markets map. We have had, as I say, an unenthusiastic start to the day, but the CAC 40 in Paris is the outperformer, up 0.3%. The Spanish IBEX, just one of the laggards this morning, but there are many I could pick from. Basic resources leading the gains sectorally, but banks are bottom of the basket. Those are your markets. Let's get started.
Newsmakers and market movers. This is The Pulse.
Good morning and welcome to The Pulse. I'm Lizzie Burden in London. We begin with European stocks subdued as investors monitor the global chip sell-off amid elevated bond yields and geopolitical uncertainty. Joining me now is Bloomberg senior strategist Neil Campling for analysis. So, Neil, what set off this latest retreat for chip stocks? Because it seems like loads has happened since we spoke yesterday. And actually, it seems to be somewhat easing. Nasdaq futures pointing higher.
A little bit more calm this morning, perhaps, Lizzie. But to put things in context, we'd had the big pullback, we'd had a big rally. And then taking a step back, investors are probably now looking at the fact that we've got free cash flow from the hyperscalers turning negative. We've then got the raisings that we are seeing by many of the AI firms now, where they're attracting very high yields, which is attractive for bond investors. And perhaps global investors are seeing better potential returns in that market than they are from the equities themselves. So that raises some questions around this whole race to become the kind of the AI champion, if you like. So there are many moving parts. And that's all around free cash flow, it's around returns, it's around, in fact, one of the Bloomberg macro strategists overnight was talking about weighted average cost of capital, WACC, which is something that has never really been a key concern for tech stocks historically, but now seems to be coming to the fore. So that's something to keep a watch on.
It's interesting that the tech story is not just an equity story, but a bond story as well now. Where does it then leave the wider AI and tech trade? Because the sort of volatility that we've seen on the Kospi feels like the new normal. I'm just checking in on the Kospi here. And yet again, we're down more than nearly 6% today.
It's been a very volatile market, as we know. There's been a lot of retail participation in that market as well, and the foreign investment flows back and forward, and very short-term in nature. And we've heard this morning from Hynix, for example, announcing a large buyback, which can be justified by the fact they're having very high free cash flow at the moment. But then those with longer memories will remember that this commodity part of the market, in terms of memory, can be very volatile in terms of free cash flow and earnings. So are they providing sort of future proof, or are they actually sort of providing returns which aren't necessarily sustainable if the market turns in the future?
Yeah, and of course the retail investor is such a key component. You would think they'd been burnt by now by the roller coaster ride that is the Kospi. But let me just stay in Asia, because we've had this whopping great debut from Unitary Robotics in Shanghai. Shares up 629% off the IPO. So it's a humanoid robot maker. Embodied AI is the term.
Yeah.
You know, this sort of fantasy AI, we've heard a lot of excitement about. But why is this particular company creating such excitement?
I think that if we look at the robotic market on a wider basis, then obviously China has been a fast adopter of robots anyway, given the high manufacturing complexities in the country. They have 70% share of robots. Humanoid robots, China produces 97% market share, up from 85 to 90 last year. So they are the leader in humanoid robots. And it's something that people like Elon Musk have talked about a lot in the past, but it's China that's actually developing the technology, and this is a global leader as well as Chinese champion, if you like, for that industry.
OK, I was just lost in those pictures there. I feel like that robot's going to come and get me. Neil, thank you very much. Bloomberg's Neil Campling. Now, let's layer on the geopolitics to the weight on sentiment this morning, because we've got oil trading higher for a fourth day now after President Trump insisted that there are no ongoing talks with Iran. The standoff leaves the Strait of Hormuz in limbo, with traffic still a fraction of pre-war levels, as Washington prepares to ramp up economic pressure on Tehran. Bloomberg's Abir Abu Omar joins us now for more. Abir, I mean, no talks underway. We're asking where the conflict goes from here. When do we expect details on that economic pressure that the US is threatening on Tehran?
That's a good question, Lizzie, a difficult one to answer, really. And then when we talk about the fact that there are no wider talks happening, that's according to President Trump, that's according to the official Iranian line. But then Jared Kushner, President Trump's son-in-law, and who has been an active negotiator in these talks, did say that there are some active discussions happening with Iranians. So you're seeing that back and forth yet again in the statements by both the United States and Iran and officials there. But what really matters in all of this, Lizzie, is that the official line when it comes to what is happening between those two is that we just don't know, and we don't think that there are wider negotiations happening. What we do know, however, is that Oman and Iran are still in the final stages of talking about that pathway in the Strait of Hormuz to reopen it. But then physically what is happening on the ground is that the threat of those attacks in the waterway are still very much there, with the latest from the UK Navy yesterday saying that a vessel was hit in the Strait of Hormuz by an unidentified projectile, one casualty there. Just now, today, our energy teams reporting that 2 Chinese-flagged vessels had U-turned in the Strait of Hormuz and are now idle. And so you're seeing, as you have mentioned in your intro, movement in the Strait of Hormuz really a fraction of what it was pre-war, and then the prospects of that returning to normal anytime soon is, of course, dimming by the day.
And Abir, we're just reporting right now that the United Arab Emirates says it's cutting all economic ties with Tehran, having accused Iran of firing ballistic missiles at its territory. What does it tell us about the wider relations in the Gulf region right now, how the tectonic plates are shifting?
Yeah, that's in focus one more time. Of course, the Gulf region had been the main victim of the Iranian retaliation at the start of this war, at least. That's calmed down slightly over the past couple of months. Of course, countries like Bahrain and Kuwait were still under attack. And yesterday in the evening here in Dubai, we all received ballistic missile threat alerts on our phones. The UAE Defense Ministry later on saying that it was targeted by 2 Iranian ballistic missiles. The Foreign Ministry, as you have mentioned, later on said that it was cutting all trade and financial transactions with Iran until further notice. And then Anwar Gargash, who is a senior advisor to the UAE's president, a very important diplomatic figure here, saying that news of providing financial facilities to Iran is untrue, unfounded. He was on X earlier on, just moments ago, as a matter of fact, reiterating that line. And so when you talk about the relationship between the Gulf and Iran generally, it's been in tatters since the start of this whole thing. Bearing in mind the geographies, however, perhaps the line from Jake Sullivan in an interview he did with Bloomberg yesterday, saying that maybe the Gulf will ultimately, or the region, countries in the region will ultimately have to come up with their own pacts with Iran to avoid being hit again. And that is something, of course, that is worth keeping an eye on and something we will definitely be keeping an eye on in the coming days and weeks, Lizzie.
Abia, thank you so much. That's Bloomberg's Abia Omar out of Dubai. So we've got the higher oil prices to reflect on concerns about the fiscal picture, the tech jitters as well, all weighing on sentiment. Let's pull it all together and get some analysis now with Maximilian Ulier, who is head of European equity and cross-asset strategy over at Deutsche Bank Research. Max, good to see you this morning. Thanks for coming back. Are you tempted to get bearish now?
Good morning, Lizzie, and thanks for having me on the show. I'm a lot less worried than you are. I actually put out a note yesterday, apologies for that, but calling the market boring because we actually have the lowest volatility in the market for this time of the year in 20 years. So we get a lot excited on all the news, but even if you look at today's move, right, it's only 3 basis points up in the Euro stock. So I'm far away from getting nervous, really, on the opposite. I do think that we get more volatility looking ahead, right? We have the midterms coming up. We have regional elections in Germany, which will create a few headlines, I think, right? The rates, inflation, Iran topic is going to be on people's minds. And earlier in the show, you talked about AI and semis, and I think, that's also going to come back. We already see it. But, compared to what we've seen, it's probably going to be lower volatility than in H1. And none of this, I think, is going to derail the positive trend in equities. We think markets will continue to go up H2.
OK, so boring can be a good thing, and maybe we'll get more volatility from September. But we've got yields pulling back this morning. If the war does rumble on, and Trump says that there's no, well, he doesn't seem to be looking for a deal, that's at least what he's saying, is the reprieve in the bond space likely to last?
So if you put it in the bigger picture, right, if you look at GDP now in the US, for example, you have 4%, earnings growing at 30. I think in this context, I wouldn't be too worried about rates below 5. Obviously, once we hit 5, there's going to be this psychological fear coming back into the market. But for now, actually, the higher demand and thus the higher inflation have been very supportive for equities. If you look at Q2 earnings season, then we saw 5% in Europe, a 5% surge in sales, including energy, 10% surge in sales. So companies were able to pass on higher prices. And as they hedged roughly 75% of their energy cost for full year 26, they've been able to increase their margin and get to very new and better earnings levels. So as long as we stay below 100 in oil, and even if rates go a little bit higher because of demand, I'm not worried. I get worried once we see the longer ends stay high or moving higher and inflation coming down, because that probably means that the market is more concerned about deficits and about debt levels than really inflation, right? So equities are a nominal asset class. They benefit from high inflation as long as it's demand driven. if we see rates go up further without inflation following or leading it, that's a very different picture. But we are far away from that, right? Things are moving in the right direction. PMIs have been holding up better than we thought. So for now, I'm not worried that rates levels will derail equities.
Well, sorry to be the devil's advocate here, Max, but is it not just the case, perhaps, that we're still waiting for the impact of the Iran war to feed through? That, well, let's take a look at the UK. We've had CPI rising today. The expectation is that inflation's only going to accelerate for the rest of the year. Could the impact on earnings and the economy just still be in the post?
Yeah, I do think that that's the biggest risk right now, that people are not paying enough attention to where SPRs are in the US, that the oil market is in short supply. But the market has been aware of the situation now basically since March. So a lot of this should be already digested and be well understood. Again, as long as we don't move significantly above 100, and we are far away from that right now, I'm not worried. Once we do, agreed, that's a downside risk and potentially the biggest risk for the rest of the year. On the geopolitical space, and I think one example was the news on Canada, I do think that the US administration has a bit of an incentive to cool things down and to try to keep energy prices in check and also not create new conflicts, because we are so close to the midterms, right? It is 50-50 right now for the Republicans to get the majority in the Senate. So, they need to play their cards right now, and creating new conflicts and having high energy prices is probably not what they want. Whether they can control it, different questions, but I think they will try to.
Yeah, and of course that's been the logic since the start of the war, that it doesn't make sense, that the midterms are ahead, the war needs to end at some stage, and yet we're not there. Just on the inflation point, because you're saying that this is one of the reasons that could drive volatility from September, how much of a risk event is Jackson Hole for you?
Jackson Hole, to me, is a non-event. If you look non-event is obviously saying too much, right? But for an equity perspective, it's probably not. If you look at the last 20 Jackson Holes, the effect on equities was basically zero. I don't think that they will be able to pull off something that will cool down worries on rates. So not sure what they're going to say. Typically not really giving you a good idea what the next rate move will be or the next hike or cut will be. So not sure that this will really play a big role. Sorry again for making this a little bit boring, but I don't think that would be a big trigger for markets, unfortunately.
Okay, Max, good to see you. Thanks for joining us. Maximilian Uhler, never boring, Head of European Equity and Cross-Asset Strategy at Deutsche Bank Research. Well, coming up on the pulse, a summer thirst for soft drinks underpinning sales volumes at Carlsberg. We'll get you the details next. This is Bloomberg.
The latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
The global economic playbook is being rewritten and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling the steel forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg this weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Earnings season is here.
I think it is a significant moment.
Record quarterly profits.
Bloomberg is first to break the numbers.
Stock traders blow past estimates at France's biggest bank.
With the smartest insights.
Do you think the age of the mega deals in pharma is back?
Growth has been more than 60%.
The investment bank, as you say, has done extremely well.
We're just getting some slight signs that maybe consumers are adjusting their behavior.
Continuing coverage on Bloomberg. Context changes everything.
This is The Pulse. I'm Lizzie Burden in London. Now back to earnings. Carlsberg has narrowed its full-year growth outlook towards the upper end of its range after a strong performance in soft drinks helped underpin its first half sales volumes. The brewer's CEO, Jacob Andersen, told the opening trade about the company's numbers.
We are basically almost through the big summer season across our key markets, and therefore we have a lot of certainty around the delivery on those key big months for the beverage industry. That gives us a lot of confidence in our ability to deliver on this increased narrowing of the guidance that we've just come with today. If you look at it, Western Europe has had a very solid summer. So has Central and Eastern Europe, and that's a key driver for us, including some of the major growth markets like India and Nepal, etc. So it's a very solid delivery over the summer that gives us confidence. And on the top of that, we're also delivering higher than expected synergies out of the Britvic acquisition. So both of those elements are important.
Okay, you bring up Britvic. Jakob, it feels looking at these numbers that the stability almost comes from the soft drink side. Are you now a soft drinks company rather than a hard drinks company, I guess, for a better way of putting it? Is that how we should look at this? How have soft drinks done versus beer?
Yeah, you're spot on that the soft drinks part of the business is doing incredibly well. So we're not a soft drinks business. We are a diversified beverage business, which means the multi-beverage gives us a lot of strength. So you have beer in India doing incredibly well. You have soft drinks in the UK doing incredibly well. And all of those elements means that we can also weather any hit we get somewhere in the portfolio. Today, a third of the business is now soft drinks. And it also, of course, then plays a major role in our performance.
What are the heat waves doing to your business, Jakob? Is it driving demand for beer, or is it raising prices for some of those crops that go into the production of these products?
No, listen, I think it has dual impacts, as you're also saying. Of course, heat waves across many of our geographies will impact our business positively. So when there's better weather, then people will be drinking more. On the other hand, we're also seeing that once temperatures get to a certain level, the consumers actually move towards even tap water if it gets too hot, and therefore there are certain temperature levels where it just gets too hot to drink beer or soft drinks, and therefore it's a double-edged sword. We also saw this summer in France. There were even a ban of selling and drinking alcohol at major festivals at one point during the season. So it's a double-edged sword. On the production side, you're right that some of our commodities, they will be more impacted by this. We are seeing crop seasons becoming more volatile. That's why we're spending a lot of time on securing our supplies on long-term contracts. That's why we're putting a lot of money into helping the agricultural industry develop new, more climate-resistant grains. So it's really, for us as an industry, it's a job we have to do together with the agricultural industry to ensure steady supply of our key commodities.
The CEO of Carlsberg, Jacob Andersen there, and we can get analysis on those results and what Jacob had to say with Sarah Scholin, Bloomberg's Copenhagen bureau chief, who joins us now. Sarah, is he fighting the inevitable there, talking about not being a software business, saying that Carlsberg is a diversified business, but is it actually an unstoppable trend that Carlsberg shouldn't be fighting?
Well, I think they've been very smart in moving into something beyond beer. We're seeing across many of its key geographies that beer sales are soft. Consumers are moving partly for health reasons and partly due to cost of living pressures. They're moving away from beer. Some of them are looking for low or no alcohol beer if they're looking for health reasons. And some of the, when you're looking at the cost pressures, they're going into some of the lower price brand or the local brands. They're trying to diversify themselves where they have premium beers that people specifically target. And then they also want to broaden out their business, sort of just hedging themselves against situations where beer is just not the biggest sales item anymore. I was on the media call after this interview with Guy, and he specifically addressed this, and he said they will continue to be a brewer. But if you look some years down the line, traditional beer would just not be the biggest product of them anymore.
But you would think where he's saying that when the weather's hot, people simply don't want to drink alcohol, they just want to drink water, that this trend is something that's only going to keep growing, people turning away from alcohol and towards softs, right?
Yeah, and he also said at some point people don't even want to be drinking soft drinks anymore. They just want tap water. It's just simply too hot to consume anything other than just keeping yourself hydrated. I think this is new. Usually we've seen the brewers say, oh, when there's good weather, then it's really positive for sales. But now I think like they're at this tipping point, they can also see it, as Jacob also says in the interview, as a double-edged sword.
Well, Jakob, if you're listening, I feel like you should remember the last time that we spoke. I did say, just drink water, and so it's proving. Sarah, thank you for the analysis. That's Bloomberg's Sarah Sholin. Now, to some other top stories that we're following for you this morning. Ukraine's former defence minister has called for the country to find a way to hold elections during the war. Mikhailo Fedorov questioned whether Russia should effectively be able to determine when Ukrainians can choose their next government. The 35-year-old was dismissed from his post last month, and his address will be widely interpreted as a challenge to President Volodymyr Zelensky. Elsewhere, Swiss voters are set to reject a proposal to strengthen the country's neutrality in next month's referendum, with a new poll showing 62% are opposed. The initiative was sparked by Switzerland adopting EU sanctions against Russia. Moscow has urged voters to back the measures. Well, let us take a look at how things are shaping up in these markets. Euro Stoxx 50 currently up 0.1%, about the same for the broader Stoxx 600. You're seeing just a tiny bit of downside in London. The CAC 40 up 0.4%, the clear outperformer this morning, but the DAX in Frankfurt also pretty flat. So it is a slow start here in Europe, but we are managing to eke out gains despite all of the headwinds, whether that be the tech jitters, the bond story, though even that seems to be stabilising somewhat. The 10-year Treasury yield down 2 basis points, and indeed yields lower across the European curve as well across the continent. Stocks futures stateside also pointing higher. But coming up, we shall focus on the UK stock market, continuing to lose companies to deal making. And we'll bring you a conversation with one of the key players in that market. That's next. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the skill set that you would advise every aspiring CFO to develop?
Psychology.
I think analytical skills are important. Obviously, you need to like the numbers. If you don't like numbers, then don't go into finance. It's sort of like a recipe for disaster if you don't like numbers.
Not only for the CFO, but also the company's management. That's a communication and the collaboration.
I spend a lot of time figuring out how to take the complex and make it simple, and then finding a way to be able to communicate that both internally and externally.
I think it's relationships, whether it's working with investors, bankers, with the senior management team, with the board. Having your head down is one thing as a finance person, but keeping your ears open is super important as well. And I think that all of that is what kind of builds out being a successful CFO.
Watch Chief Future Officer only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
Good morning and welcome to The Pulse. I'm Lizzie Burden in London. These are your top stories. A global sell-off in tech stocks deepens on concerns over higher borrowing costs and geopolitical uncertainty. Higher oil prices also weighing on sentiment. Brent climbing for a fourth day as President Trump says talks with Iran to end the war are no longer taking place. Plus, 50% US tariffs on Canada are paused at the 11th hour. President Trump says a tentative deal to resolve the trade dispute has been agreed. Well, let's get more on that last story and bring in Bloomberg's Jill Desis. Jill, it seems like Canadian Prime Minister Mark Carney isn't as definitive as President Trump when it comes to this tariff deal.
That's right, Lizzie. What we heard from the White House was effectively that, they had reached some kind of an agreement. Of course, they didn't give us a whole ton of details except to say that some discriminations that Canada had implied on U.S. dairy products, alcohol. As you may recall, many Canadian provinces have stopped selling American alcohol over the past year or so. That's, some of those things that the U.S. had pointed out. But what Mark Carney has instead said is basically that they've made substantial progress, that's his words, but that they're still working toward a final agreement. So I think, and the other thing, too, to really kind of point out in all of this is that neither side has really addressed some of these larger, weightier issues that Canada at least has said that it wanted to address, such as sectoral tariffs on steel and the automotive industry. So you've got some really, really big issues here that don't seem to have been completely resolved at this point. And in the meantime, just, I think that the main news here being that pause that's apparently in place, we've got a little bit more time to see whether or not they can actually work something out.
And what could derail these talks now?
I mean, at this point, Lizzie, you have to remember, this is still, fairly volatile, administration sometimes when it comes to actually working out, tariffs here and there. So I think, you've got some considerations that the U.S. side certainly has that I think are worth considering here. Trump also said that one thing that he wants included in this is the Keystone XL pipeline. That would be a revival of this oil transport project between Canada and the United States that was effectively shelved under former President Joe Biden. I think that there's a couple of things in there that you really have to say, are we actually going to see something come to the table here? Because, we've seen Trump express frustration with Canada in the past. This deal really came, 2 hours before it was supposed to go into effect, or at least this pause came into, 2 hours before it's supposed to go into effect. So I think there's a lot to kind of consider here. It's not a definitive deal written down on paper yet, but at the very least, a little bit of a reprieve as we wait to see whether or not these two nations can work something out.
Well, it seems like the market's taking Trump at his word here. The Canadian dollar is up about 0.1% against the greenback. 138 is where we trade right now. Jill, thank you for the update. Bloomberg's Jill Desis there. Now, turning to the UK, of course, we had inflation data earlier this morning, accelerating in July after energy bills surged, and that ending a short period of respite for hard-pressed British households. Let's get some analysis now. We can bring in Matt Bunny, UK economist for Bloomberg Economics. What stands out to you then, Matt, from these numbers? In line on headline, I think, a beat on core. Does it mean that the second round effects are more of a worry?
So this is the question everyone's kind of thinking about right now. The banker said they don't see a great deal of evidence of second-round effects, at least in their previous meeting. In today's release, as you say, headline came in as expected. That was driven largely by higher energy bills as the off-gen price cap reset. So we're seeing wholesale prices flow through to households. Weighing against that, fuel prices came down in line with oil prices. Obviously, oil prices flow through faster to fuel prices. The kind of interesting point, I think, was around services inflation. So headline services came off, but if you look at the underlying services inflation, stripping out some of those more volatile components, there was some signs of stickiness there, which I'm sure will catch the Bank of England's attention. Looking ahead, we expect that inflation pressures will continue to grow over the coming months. And based on current energy market futures, we think inflation will likely peak around 3.3% by the end of the year. OK, so inflation only going to climb, but yesterday's labour market data pretty weak. Where does that leave the Bank of England? Already you've had 3 dissenters. Does it all just add up to holds for the rest of the year? So our base case is for the Bank of England to remain on hold for the remainder of the year. I mean, clearly they will be cautious, though, given we still aren't out of the woods yet with regards to the energy shock. What's worth keeping in mind is that the labour market remains loose, the demand backdrop is subdued, and we think that will be enough to keep the Bank of England on hold. Of course, there are upside risks. If energy prices remain elevated, or if we start to see upside surprises in the inflation data, that certainly could be enough to see the Bank of England hike before the end of the year. OK, Matt, appreciate the analysis. That's Matt Bunny, UK economist for Bloomberg Economics. Well, staying in the UK, the stock market is losing the equivalent of more than $2 billion a week to takeovers of London-listed companies. Property services company Mighty is one of the latest to go, bought by OCS Group for £3.1 billion. For an overview of UK M&A activity, let's now bring in Bruce Embley, private capital partner at law firm Clifford Chance. Bruce, nice to have you with me on set.
Thanks, Susie.
You're actually, Clifford Chance, the legal advisor for EasyJet in the takeover by Apollo. I wonder if you think that this is the start of things to come for UK PLC. Big private equity giants buying up British icons.
Well, I think we've had a spate of P2Ps for many years now, and I think the interesting thing certainly this year is the focus on bigger deals, and that seems to be where a lot of the private equity money has been going, which is into bigger, higher quality assets. That's actually a theme we've seen on the US as well as the UK. So EasyJet is an example of that. Intertech is another example of that. The same is happening on the US with businesses like AES as well. And I think that is really just a trend where private equity is now, I think, certainly at the big fund, looking at higher quality assets, which are often coming at a much bigger value, and forming consortia where they'll bring in different investors as well. And so this definitely, 2026, I think, feels like the return of really, really big M&A. We're not just seeing that on private equity, we're also seeing huge deals on the corporate side as well.
Well, it makes you wonder how long it'll last. And I'm not saying it's a bad thing, right? But what policy levers could stop this outflow of British firms to foreign firms and PE?
Well, you say that as if it needs to stop.
I'm not saying it's a bad thing, but if I were the Burnham administration and I didn't like the look of it, what would stop it?
Well, the regulators have many tools in their armoury, and you will see some of the more sensitive sectors like defence and energy maybe getting a little bit more scrutiny, and there are all sorts of tools that can be used. But of course, any healthy capital markets needs a healthy takeover regime as well. And this is not just a UK phenomenon. So, and of course, you want to see, you talk on one hand of private equity taking private a company, but that's often a form of exit as well. So like the Shawbrook IPO. So it's a bit of a circular theme where what might be bought might also be returned to the stock market.
I do want to come back to the exit backlog, but just on where you say we've got a trend of bigger deals, you've talked about as well how it's consortiums now leading the way, and I wonder whether that's more about spreading risk or if it's just that, you know, little players haven't got the firepower, individual buyers haven't got the firepower to make these moves.
Yeah, I think there's a number of factors. It's a very good question. So the reality is, for the size of deals you're sometimes looking at, if you want a lot of equity in that, you will often bring in 2, 3, maybe sometimes for the really big deals, even more partners, and that can often lead to a more balanced board, more different perspectives on the board. But of course, the key whenever you're putting together a consortium from an M&A practitioner's perspective is they've got to be like-minded. There's no point forming a consortium where one person has a much different view in terms of how long the assets should be held than somebody else. But you do seem to see a lot of the same players teaming up over and over again.
Yeah, so they're all on the same page. So then on that exit backlog, when do you expect it to clear? And when does the decline really in PE returns, what does it mean for the future of the industry?
Yeah, and this has obviously been a theme for a few years now, which has capital deployment being outpacing capital returns. Yeah. I think, and it is front of mind for all private equity funds. It's very hard to raise a new fund if you've not deployed any from the previous one, and I think we will see more exits. We've already had a couple of very, very big exits this year, and that I think will continue.
And you've said in your notes that PE's being selective is not in a slump, but we have so much talk about this bifurcation between winners and losers. Is there a time when you start to think we'll see more tangible signs of firms in real distress?
In terms of distress, I think very rarely is distress just a capital structure issue. There's normally always a fundamental theme that is running through that business, and I think a lot of the time M&A gets blamed as a sort of that was the reason. Whereas it's always more complicated than that, and I think there's been a lot of talk about sectors hitting the wall and not actually hitting the wall either at all or at quite the pace that was expected. So I think there will be strains, and of course we read about companies in distress all the time, but I don't think there's a great panic that there's a wall of distressed companies coming down the line. And I think on the exits front, one of the big themes we've noticed over the last few years is PE is prepared to hold on to assets for a lot longer these days. And I know that also the continuation vehicle has been a source of much debate over the years, but I think that's just a well-accepted piece of the M&A machinery now. So when you're looking at the need for exits at the same pace that might have been happening 10 years ago, I think you've got to factor in the fact that deals are now bigger and there's often been held on to for a lot longer as well.
But where you've got the consortiums that we were talking about before, do you expect to see smaller PE firms having to consolidate just to stay in the game?
No, because there's different value entry points. So people, I think the last 6 months has been, there's been much more focus on the large cap funds, and they probably had more of the press headlines. But the year before that, mid-market was much bigger. I think we've seen a lot of change in the venture capital market as well. So I think every business has different entry points, and of course with a different risk and reward profile, and that will continue to be the case.
All right, Bruce, really interesting talking to you. Thanks for coming in. Bruce Embley there, private capital partner at Clifford Chance. We're coming up on the programme, the booming tax strategy that's helped the ultra-wealthy whittle down their tax bills and why it may be too good to be true. More on today's Big Take next. This is Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in 1.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Next week, Bloomberg is live at the Jackson Hole Economic Symposium. Tom Keene and Lisa Abramowitz, along with Michael McKee, will bring you news and interviews with Fed leaders, policymakers, and economists shaping global monetary policy. Tune in for continuing coverage and a special episode of Surveillance, August 28th at 9 a.m., including full coverage of Kevin Warsh's first speech to the conference. The Jackson Hole Economic Symposium on Bloomberg. Context changes everything.
You can't just think about traditional factors or sectors or regions or even asset classes, because that AI tentacle is absolutely everywhere now, and that's only going to get worse. And so really important to stress test portfolios for an AI factor.
JP Morgan Asset Management's Gabriela Santos there warning about the risk of AI concentration. And staying with tech, Brussels has pledged to spend 30 billion euros to build 7 AI gigafactories across the continent. But Bloomberg Intelligence data estimates that the EU will need to spend at least $3 trillion by 2035 just to be truly self-sufficient in technology. Whopping great numbers. Let's bring in our Bloomberg Chief Europe correspondent, Oliver Crook, who's been across it all. So, Ollie, what does the path to artificial intelligence and tech autonomy actually look like in Europe now?
Well, it's paved with many, many trillions of euros, and that's sort of the problem here in Europe. And even these initiatives that you get from the EU from time to time of, $30 billion here or there, first of all, it's not really cleanly $30 billion. It's making a lot of assumptions about private investment. Only a part of that comes from the EU and nation states. But again, that's only a drop in the bucket from what we're really talking about here. So it's been very helpful to get a roadmap laid out by Bloomberg Intelligence in terms of what would actually be, what the cost would be and where that money needs to go. So $3 trillion by 2030. The biggest sort of need is going to be cloud infrastructure. You can see it there, $1.5 trillion worth of spending over the next few years. The semi-cap equipment, about more than $500 billion there. To be fair to the Europeans, this is a sector where they actually do have some capacity. Some of the foundries that make some of the chips that go into things like EV, industrial capacity, appliances for the home. That is a place where Europe is relatively strong, but they still need to get some of those AI chips, right? So they still have to spend upwards of, $500 billion on foundries, to say nothing of course, the large language models themselves, something that Europe is very far behind on. They really only have one main contender in that category, and that is Mistral, and they only hold about 11% of the market share in that space right now for the Europeans. So if you want to gain a little bit more traction, a little bit more dominance, a lot of money needs to be invested across the board. The one place where they do have some dominance, and they really are absolutely crucial, is in the building of the machines that build the chips, right? We're talking about the lithography machines that ASML basically globally dominates. This is a market that is completely dominated within Europe and really a choke point. If ASML disappeared tomorrow, that would be a major problem for all of the companies in the AI space across the globe. That you can't really say that about almost any other company within Europe. That being said, even if you did get $3 trillion worth of spending, you did get alignment on regulation. That wouldn't even give you full autonomy for the Europeans because you're still so far behind and you just don't have some of the companies required.
Well, yeah, what about full autonomy outside, beyond tech? Is that actually realistic? And if we're already talking trillions, how much would that cost?
Yeah, I mean, if $3 trillion seems like a lot of money, how does $14 trillion strike you? Because that's what Bloomberg Intelligence says would have to be spent till 2035 to get autonomy, not just in terms of the tech space, but we're talking about defense, we're talking about energy. We've been talking about that for a very long time. The grids need a massive update. You have climate, of course, we've been talking about over the last couple of weeks, insulation around things like that. And at the same time, of course, Lizzie, politically, you can't really cut back the social welfare state here in Europe in order to get sort of an advantage in this sort of AI race. So really for budgetary and for companies and all of these sorts of things, there's a little bit of triage that's going to happen of where this money needs to be allocated. And if you go and think about having to allocate that money at a time where you have bond yields as high as they've been since the financial crisis, money is very, very expensive. And you can see it on the screen there, the cost of falling behind in technology. The Europeans and the Americans had really comparable economies for a very long time. They had comparable productivity for a very long time. But you can see that spread is just blowing out, and you can see China sort of coming up the rear there in terms of growth. So this is a real concern for the Europeans. But in terms of actual immediate spending, a lot of that focus is going to remain on the social welfare state, but of course on defense. So it's not clear if the AI is going to get the attention that it really needs in order to boost that growth here in Europe.
OK, Ollie, great reporting. Bloomberg's Oliver Crook there, our chief Europe correspondent. Well, some of the other top stories we're following for you today, staying in the tech space. OpenAI is tightening safeguards on its models after a breach involving Hugging Face raised fresh concerns about cybersecurity. The ChatGPT maker says that it'll step up monitoring of unreleased models, aiming to alert safety teams to concerning behaviour within 30 minutes. The company is also restricting internet access for certain models and introducing stronger controls on higher risk tasks. Meanwhile, Bloomberg understands that Anthropic's revolving credit facility is set to rise above its roughly $10 billion target as the company prepares to IPO. Meanwhile, The Information reports that Anthropic's planning to give shares with extra voting power to its CEO and other co-founders. And China has taken a major step forward in its efforts to match SpaceX's ability to launch and recover rocket boosters. This video clip posted online shows a rocket tapering its thrust to touch down gently. The rocket was developed by Land Space Technology, a private Chinese launch provider. And while the landing is a big breakthrough, getting the booster ready for another launch is likely to be a significant challenge. Well, those are some of our top stories this morning. Now, for months, wealthy investors have been piling into one of the hottest trades on Wall Street, so-called tax-aware long-short accounts, which have helped legions of millionaires whittle down their tax bills. Brokerages, including Charles Schwab, have made millions of dollars from the trade, but Now they're pulling back on what's been described as the next great American tax dodge. It's the subject of today's Big Take, and Bloomberg's Charlie Wells is here to explain more. So, Charlie, this seems a tasty story. What is this tax strategy? How does it work?
So it's a little bit counterintuitive, right? Because when you're thinking about an investment portfolio, most people think about trying to generate, the biggest market returns that they can. But key to this tax-aware long-short strategy is actually to generate losses and to borrow money in order to do that. So that sounds a little bit, kind of against what normal principles would say, but this can help wealthy people reduce their capital gains taxes. And that is incredibly appealing right now at a time when the markets have been up significantly, when there are a lot of people sitting on some of these capital gains. It's a way within this broader sort of tax alpha strategy to reduce these tax bills. And there's some $1 trillion floating around here. So you're kind of betting on companies, betting against them, and then borrowing in order to amplify all that.
Okay, and so how lucrative has it been so far?
It's been incredibly lucrative. So this is something that, wealthy people in the United States have been really attracted to. What we do know is that in 3 years, millionaires have poured some $150 billion into these sorts of strategies. And this really, could be considered a really big boon for the likes of Fidelity, for the likes of Schwab, which help facilitate these sorts of strategies. But they've pulled back. And I think that's something that's really striking and what we look into here, because Fidelity basically stopped opening new accounts for new customers. And Schwab significantly pulled back from this, despite the fact, right, that there are billions of dollars in fee-paying dollars here, lots of competition, lots of new entrants coming into the space.
So then why are the brokerages getting cold feet?
Well, I mean, Lizzie, that is the key question here, right? And I feel like with a lot of these stories, the best stories, the questions are really simple. Why would businesses pull back from something where there's a lot of demand, where there literally are tens of billions of fee-paying dollars potentially on the line here? Now, we went to these companies, right? So we talked to Fidelity, and they basically said they saw explosive growth and that it would be prudent to take a moment to sort of assess what's going on. Schwab talked about that growth as well. They also talked about some of the technical issues here, right? Because you're effectively shorting a lot of companies. Some of these portfolios have thousands of positions, hundreds of pages of tax documents. What happens if there are significant losses? I think that's the question. Could there be a market disruption? It seems like Schwab was concerned about that. There's also the issue of regulation. And right, we know the Trump administration is pretty tax-friendly to wealthy people, but even officials in the Trump administration's Treasury Department have been looking at some of these broader strategies, saying that maybe they cross some lines that shouldn't be crossed. What we are seeing here is, from a technical standpoint, from a regulatory standpoint, and then even from a consumer standpoint, right? Because a lot of financial advisors, we went to over a dozen financial advisors and talked about these strategies. Clients love the idea of cutting their tax exposure, right? It's hard to resist, but they don't necessarily understand the technicalities of all of this, and so that's a concern as well.
So if I can't do that, how else can I save on my taxes? Not that I've made juicy returns off the stock market, Charlie.
I'm not in a position to answer that question, but look, this is a live issue. We're heading into the midterms. There's no doubt that these strategies, the issue of taxes is going to be front and center.
All right, Charlie, thank you so much for the reporting. I do recommend that Big Take. Bloomberg's Charlie Wells there. Now, let's check in on these markets as we round out the programme. We are looking at things really not having picked up at all here in Europe. The Stoxx 600 now flat to the downside. The FTSE 100 down 0.2%. The CAC 40 still in the lead, up 0.3%, but losses for the DAX in Frankfurt as well. Stateside, a little bit more of a brighter picture. We've got S&P E-minis and Nasdaq futures both flat to the upside. But oil still powering ahead, as you can see there. Brent up for a fourth day now, 91.74 the barrel on the lack of progress in the Middle East. Bond space, though, bit of relief today. The 10-year there at 4.69, down a basis point. Now, coming up later on, the CEO of Estee Lauder is going to join Romain Bostic on the close to disc earnings. That conversation at 8:30 p.m. London time. But for now, we'll pass you from London to New York. Bloomberg Brief coming up next. This is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
very famous dogs. You have they look like balloon kind of figures to some extent. How do you make those?
In the case of the balloon dog, I blew up a balloon dog. Yes. So I had this balloon, which is kind of like a latex type of piece, molded it, cast it, and then blew that up in scale and put it into a clay, and eventually had that transformed into stainless steel.
So when you have a balloon dog, let's say, a regular size one or then a big one, do people say, Jeff, you're crazy? Were you shocked that people were willing to pay very high prices for this?
When I was making my first balloon dog, one of the purchasers was Eli Bro. And originally I thought I could make a balloon dog for around $300,000 that I could manufacture. It's a large piece, over 10 feet long, or 12 feet long, 10 feet high. But it turned out that the fabricator came back to me and said, you know, Jeff, I can't do it for $300,000. It's going to be $650,000. But eventually, then they raised the price again. And they finally brought it up to 1.6 million. And I told Eli that this is the reality of it. I showed him everything, and he ended up paying for the production cost.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
It's 5 a.m. in New York City, 10 a.m. in London. Good morning, I'm Vonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. A global chip sell-off taking a breather as SK Hynix announces a massive share buyback plan. A bond rout also easing ahead of the latest FOMC minutes and a 20-year Treasury auction. And the Trump administration delays 50% tariffs on goods from Canada for 3 days after a tentative deal. A little bit of a rocky session now across Asia. Let's get a check on those markets. We'll begin with Winnie Su in Hong Kong for the latest. Winnie.
Yeah, good morning, Bonnie. Well, we did see Asian stocks tracking U.S. peers lower as the chip sell-off deepens in our region amid the higher oil prices and elevated bond yields. Now, overall, we did see MSCI Asia down about 2%, having its worst day in 3 weeks, with tech-heavy South Korea's Kospi index down nearly 6%. However, interestingly, during the later hours, especially after a market already closed, we did see things reversing a bit, with SK Hynix reversing those earlier losses and in fact trading higher in post-hour trading because of that announcement of the massive share buyback plan at about $29 billion. Now, before we take a look at what's going on in the bond space, because we are seeing treasuries stabilizing after that big sell-off, and with that we also see that Asia bonds seeing a bit of a support, with yields also falling across the region. Now, when it comes to the Japanese yen, also edging higher just slightly after we see that the U.S. dollar also weakening a bit.
AI jitters evidenced again today. Winnie, thank you so much. Winnie Su there in Hong Kong. Now let's get to London for a look at Europe with Justina Lee. Justina.
Good morning, Bonnie. Now, it's a pretty quiet day here today, with the Stocks Europe 600 essentially flat. You know, energy shares are gaining a little bit following that move in oil. We're having some stability in tech, of course. Now, what I find interesting today in the bond market is that we're seeing quite a stark outperformance in short-end UK gilts. And the reason for that, if you flip the board here, is that we did get UK CPI data, and the headline figure did tick up a little bit, but ultimately it was in line with expectations, and also it reflected some factors that kind of had been expected already. And so this is giving some room for the BOE to maybe not think so much about hiking just yet, especially since the other day we also got some pretty weak payroll figures in this country. And so it does seem like there could be some dovish repricing in the BOE's rate trajectory here, Vani.
Justina, thank you so much. That's Justina Lee in London. Here in the US, sentiment is improving today. So we got that nice rally in chip stocks Monday and then a massive sell-off yesterday. The Philly Stocks Index down 5% and it bled into Asia. For once, we're not actually following Asia's lead. At least for now, it seems like Nasdaq 100 futures are pointed higher after that sell-off yesterday, and S&P futures as well. Russell 2000 futures are trying to make their mind up still. Now, there's a lot going on here. There's also the Australia bond sale by Alphabet, which drew a yield of 6.98%, which was fairly elevated. Another signal of those AI jitters. And then SK Hynix with that share buyback plan, obviously easing some investor fears that were out there. And then you have the 20-year Treasury auction today. It looks like it's going to be a massive yield for the Treasury as well. That said, we are seeing yields lower on the day. 2-year yield down another basis point. We're still around 415.60. The 10-year yield is holding below 470. And the 30-year yield is right back down, all the way back down to 527.62. We're about 5 basis points off our high, which was a record set since 2007. This all as oil continues to hold its ground as well. We have Brent trading well above $90 a barrel and WTI around 85, and Bitcoin back in the picture as well, is above $64,000. All right, let's get to some individual movers now with Chloe Melly.
Good morning, Vonnie. SK Hynix ADRs are jumping this morning after announcing this massive share buyback plan, which of course should reassure investors that have been really worried lately about this AI overspending. And speaking of AI, we also have Keysight Technologies that is in focus this morning after yesterday reporting a forecast that was ahead of expectations. And the analysts are saying it's a company that's really well positioned for this continued spending on AI infrastructure, as well as spending on defense and 6G networks. And so we're seeing that reflected in those shares this morning. And finally, Trainline here in the UK is down significantly after the Competition Authority opened an investigation into the company's use of drip pricing, which essentially means not disclosing the total price up front to consumers. And so we are seeing this probe into the company really weigh on the shares. We're down almost 16% this morning in London.
All right, Chloe, thank you so much. Chloe Melly will be back later in the hour. Also coming up on your brief, Keith Lerner of Truist giving the bull market the benefit of the doubt. He joins us later. So this latest announcement from SK Hynix lifting sentiment following that global chip rout. The South Korean tech giant planning to buy back $29 billion worth of its own shares. It is an effort to ease the concerns over the durability of AI spending. Bloomberg's Neil Campling joins us now for more. There was clearly a need to do this, Neil, now that we see stocks rallying. Is this the trick? Is this what companies need to do? Just start buying back shares?
Well, it kind of helps, Bonnie, doesn't it? We have been expecting a buyback announcement for the last couple of weeks, so at least that's put that concern to bed when they've announced it. It's not necessarily going to end the jitters around the whole AI spending argument, of course, because whilst they're generating a lot of free cash flow at the moment, they've also announced significant capex spending. And then there's all questions around how the accounting treatment will be, whether you're cancelling treasury shares, etc. So it's not as, it doesn't read to me like a simple way of like a US buyback does in terms of cancelling the stock, etc. So let's wait and see how this plays out. But it's an incremental positive for the stock in the short term, at least.
Yes, and it is August, we should say. But again, it is an indicator of sentiment and at least directionality as well. Alphabet paying just under 7% to borrow those longer dated funds in Australia. Multi-part deal, the 20-year tranche was set at 6.98%. Now, the US Treasury is looking at 5.27% today, Neil, for 20 years as well. It's quite the spread, but at the same time, Alphabet is paying up, right?
It really is. I mean, we've obviously seen on the Treasury curve at the long end the rise in rates recently. And, you'd have to ask, would Alphabet have to pay 7% going back just a couple of months ago when they were generating significant free cash flow? Whereas, of course, in the last quarter, for the first time, they had negative free cash flow. So this is, I think, a sign that, the AI trade is getting more expensive. And that's whether it's equity or whether it's borrowing through the bonds, etc. And then it raises questions if you're a global investor, do you need to take kind of, in some respects, the single stock risk on the equity side if you're going to get paid a lot on the bonds. It does raise questions.
Yeah, I mean, that's just the thing. Is it crowding out the equity trade for these same companies? I mean, if you can get 7% on, some Alphabet debt, why would you take the equity market risk unless you're sure, and I don't know how you would be, that the equity is going to outperform?
Yeah, exactly. Especially when you're seeing the big cap tech stocks often moving, double digits on a single day, based on especially around the earnings prints. So it definitely is adding risk, if you like, to those arguments. And we're now seeing things like weighted average cost of capital, WACC, being questioned about in terms of individual tech stocks for the first time in a long time that I can remember.
Wow, WACC. I didn't think I'd hear that on the programme. Warren Buffett would be very pleased with you, Neil. Thank you so much, Neil Campling there. The bond market also finding some respite after that global sell-off. This as traders are shifting gears again and hedging the risk that the Fed cuts rates in 2027. Let's get more with Bloomberg's Ven Ram. It's fascinating, Ven. Citi has been saying the next move is a cut for the longest time, against the grain. It now appears that maybe the bond market is starting to weigh that consideration at least.
Well, they're thinking that, this is clearly a tail risk, and that's why they're hedging the bets. I mean, they're thinking that, look, this combination of very high yields at the long end and softer patch of growth data that we have seen, they're wondering whether that will just push the economy over the brink and cause a recession, and that will cause the Fed to cut rates. And that is the tail risk that they're pricing in. I don't see it happening quite yet, but, this is the nature of the markets. They want to cover the other side, and that's what they are doing. From all aspects of the economy at the moment, yes, we are going through a soft patch in terms of the economy, but in terms of yields, we are going higher. And I think that, financial conditions are a lot loose, even despite the higher rates that we have seen. So I think it's a distant prospect, if you ask me.
We have a 20-year debt sale later on, $16 billion worth. It looks like the Treasury is going to have to pay something like 5.27%. How does that stack up in the context and history of 20-year sales, Ben?
Well, I think it's going to be another big size and scope on the number, the rate at which they actually sell. I think it may be around 5.29 based on indications. So I think that will be a slight concession to the secondary market yield, and I think so there may be a tail on the auction, a modest tail on the auction, but it will go through with or without hiccups. It will go through. There's no question about that. So I think that the message from the markets is very clear that the equilibrium funds rate has shifted higher. That's the neutral rate we are talking about. Where the governments could raise funds at 1-2% just 5 years ago, they are now having to pay up. And that shows that this AI-led investment boom and the demand for capex is pushing the equilibrium rate higher, and that is going to stay, and that's going to be a persistent feature of the cycle for the next few months.
Yeah, everyone's just going to have to pay up a little bit more, a bit more of an incentive for the appetite that's out there. Ven, thank you so much, Ven Ram. Now to other top stories trending on the terminal this morning. Singapore has announced plans to give tax breaks to individual fund managers. A key part of the proposal is to exempt a share of profits made by fund managers when they deliver strong returns for investors. The move aims to boost the country's asset management industry and get ahead of rival Hong Kong. Unitary Robotics in China, well, their shares surged 460% in their Shanghai debut after raising $904 million. The IPO makes Unitary the first publicly traded humanoid robot maker in mainland China. A popular former Ukrainian defense minister posted a video calling for wartime elections to unseat President Volodymyr Zelensky. Mikhailo Fedorov was recently fired by Zelensky, triggering nationwide protests. In the YouTube video, Fedorov questioned the long-standing war with Russia, stating that waiting to elect a new leader until after the war would be giving the power to Russia. Coming up, a last-minute delay. President Trump pauses tariffs on Canadian goods just hours before they were set to take effect. We discuss next. This is Bloomberg.
weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETFs behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Next week, Bloomberg is live at the Jackson Hole Economic Symposium. Tom Keene and Lisa Abramowitz, along with Michael McKee, will bring you news and interviews with Fed leaders, policymakers, and economists shaping global monetary policy. Tune in for continuing coverage and a special episode of Surveillance, August 28th at 9 a.m., including full coverage of Kevin Warsh's first speech to the conference. The Jackson Hole Economic Symposium on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Vonnie Quinn in New York. Oil edging higher for a 4th day as tensions rise in the Middle East. The UAE saying it's cutting all economic ties with Iran after accusing Iran of firing ballistic missiles at its territories. This as the FT reports Iran is eyeing military targets in Europe should President Trump decide to escalate. Joining us now from Dubai is Bloomberg's Abir Abu Omar. It's a fascinating report in the FT, Abir. It's the first time that we've heard something concrete via sources on Iran and what it would do in order to retaliate if it wasn't in the region. How is this FT report being received?
Yeah, good morning, Vonnie. Well, the parameters of this war have already been widening in the wider Middle East. If you were with the Yemen-based Houthis militia in Iraq, of course, we've reported that multiple times. But this FT report's coming out today, citing 2 sources close to the Iranian regime, saying that Iranian regime is considering or might consider targeting bases in Europe if President Trump thinks about escalating this war militarily. What the report says is that Cyprus might be a destination or might be a target if that escalation were to happen, citing a British airbase that was the target of an Iranian drone previously in the war. That could happen again. So, of course, a dangerous precedent if it were to happen in the wider of Europe. That would mean you're widening the parameters of the war significantly beyond the Middle East. And then, of course, at the heart of all of this is oil prices and the Strait of Hormuz. And the report does have some escalation from the Iranian side on the Strait of Hormuz if President Trump or the United States were to escalate this war militarily even further. So we're looking at what is happening right now in the waterway. And you're still seeing a trickle of the movement that was there pre-war, Vonnie. Of course, we've reported that multiple times, but we're seeing more evidence of that every single day. For example, our energy teams reported early in the morning that 2 Chinese-flagged vessels had made a U-turn in the Strait of Hormuz and are sitting idle because, of course, of that threat of being hit by Iranian missiles. And, of course, speaking of that, yesterday here in Dubai, we got exposed to that for the first time in some time, I would say, where the UAE's defense ministry said that it was targeted by 2 ballistic missiles in or from Iran. Iran denying that, but then again, we heard from the foreign ministry later on saying that it has cut all financial and trade ties with Iran until further notice, citing these violations. Anwar Gargash, who is a senior advisor to the UAE's President Mohammed bin Zayed, of course, a very important diplomatic figure here, saying earlier on X that news of providing financial facilities to Iran are untrue. So you're seeing a tick up in those escalations yet again. And this is definitely reflected in what you're seeing in energy prices. Brent, since yesterday, rallying above that $90 on the barrel mark and settling nicely above that now for a fourth straight day in the green, of course.
All right, Abir. Thank you so much, Abir Abu Omar. The Trump administration has delayed 50% tariffs on Canadian products for 3 days. That announcement coming less than 2 hours before those tariffs were set to take effect. President Trump posting on Truth Social that the two nations have reached a tentative deal. Joining us now is Bloomberg's Brendan Murray for more. Brendan, any idea what might be in this deal and why, once it came down to the wire, both countries seem to have been able to at least delay more tariffs?
Yeah, exactly. Well, they came down to the wire basically because there are a couple of key sticking points. One of those is the auto tariffs that Canadian negotiators want to see negotiated down. There's also the issue of Canada's dairy controls that the U.S. wants to see loosened. There's a ban on American-made spirits across many of the provinces in Canada, and so there's a long list, and it's no surprise that they're going to try to buy themselves some more time. 3 days is the new deadline, Friday at midnight. So it sounds like from the Canadian Prime Minister's perspective, there's still some important work to do, were the words that he used. But President Trump, of course, said that a deal is near, pending the paperwork, essentially. Often, though, the paperwork is, and the fine print is really the hardest, slowest part of a trade negotiation to get over the finish line. So we're going to watch very closely over the next couple of days to see whether they can bridge those remaining gaps.
And of course, an extension can always be extended as well. Brendan, this would have implications potentially for the NAFTA trade agreement that's still being renegotiated, right?
Yeah, exactly. This will set the tone for the broader negotiations that are taking place with Mexico and Canada and Washington. And if this turns into something where there are tariffs applied and retaliation from Canada, then that sort of spoils the whole atmosphere around the negotiations into the U.S.-Mexico-Canada trade agreement that all three countries want to get some certainty on. The Trump administration wants to tighten up some of the restrictions and improve U.S. production and bring some production back from Mexico and back from Canada. And so those will not be easy talks ahead, but we will see in the days ahead whether the U.S. and Canada can repair this relationship on trade and put it on track for a longer-term stability and certainty.
And of course, very disruptive for businesses. I mean, this was literally hours before these tariffs were due to take effect, so they would have had to have been prepared at least.
Yeah, exactly. So this was going to hit, these U.S. tariffs were going to hit about $20 billion worth of Canadian shipments. That's not a huge amount when you consider that the whole trading relationship is $800 or $900 billion, but it's very targeted and it hits industries that Canada doesn't want to see hurt right now with its economic prospects. So this would, this would be sort of the first step in the a tit for tat kind of situation where Canada has shown in the past that it will go after sort of targeted regions, constituencies, industries to hit the U.S. with tariffs.
Yeah, absolutely. Brendan, thank you so much. Bloomberg Trades Hour, Brendan Murray. Coming up, President Trump pushes for a meeting with North Korea's leader Kim Jong-un. More on that and what else is making headlines in your front page news next. This is Bloomberg.
anything we do in Africa is going to be more risky than the US. I think the approach we want to take is, how are we being compensated for that risk? And one of those is obviously going to be a valuation question. In our minds, valuation is a lot more attractive in Africa, even if we adjust for some of those Africa risks that a lot of Western investors see. So yes, in a lot of ways, you take some of those models that, as I said, might be more asset medium or asset heavy. There might be some more inherent risks. However, if we're saying we're adding some risk because of that kind of model, but we're now solving a core problem as opposed to maybe a nice to have solution in Africa, that might actually offset it. Where if you're solving something that people really absolutely need and can't live without, in a way that then that's a lot less risky. So again, we'd encourage investors to have a less binary view. In other words, the US isn't risky, Africa is risky. That's going to lead to a lot of complications down the road.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
This is Bloomberg Brief. I'm Vonnie Quinn in New York. Time now for your front page news. First up, the New York Times leading with the latest in U.S. elections. A pivotal Senate race in Alaska, a Democratic Socialist and an upset win in the Florida primary, and President Trump facing endorsement setbacks in both Florida and in Wyoming. That was your primaries roundup. Next up, the Wall Street Journal is reporting President Trump is pushing for a meeting with North Korea's leader Kim Jong-un. He's said to have privately discussed a potential in-person meeting as soon as November when he visits Asia for the APEC gathering of world leaders. And finally, the Financial Times is reporting China is easing limits on NVIDIA's H200 chips. Small batches have been allowed to enter mainland China as Beijing tries to aid its leading AI companies, and they can also use them in Hong Kong as well. Let's take a look at your markets into the Wednesday session. Don't forget, we have the FOMC minutes later on today. We also had that massive sell-off yesterday that was bleeding into Asia, but then got arrested after SK Hynix said it was going to buy back $29 billion worth of its shares. So it looks like it could be a brighter future for the Nasdaq today. The 20-year yield also in focus with that auction later on.
Today, Wayfair sees immense potential in brick-and-mortar stores.
When we got into physical retail, our view was that, even if the market continued to grow for e-commerce, probably a large chunk of the market in the space would stay offline.
Kate Gulliver showed me around Wayfair's new 150,000 square foot Atlanta flagship store.
When customers who have seen us online come into the store, they're generally a bit surprised by actually the breadth of what we offer. Often if you're going online, maybe you're looking for something particular. But when you come into the store, you walk in, you see the market square, you see all these pillows, you see the decorative accents. So what we're seeing actually is that in store, we do really well in some categories that online are, less a percentage of the total.
How does technology help in kind of making it seamless online to store?
I think
and vice versa.
The biggest thing is for the customer on the front end, that she can be in the store, that she can actually shop here, go back home, complete that purchase. And if you look at these sort of price tags and everything, they're all these digital tags. That's because they're the exact same prices they are online. So you're not going to be surprised that you saw something in the store and then you decided to purchase it online, that it's somehow different and that the offering is different. It's actually very consistent. But when she's here, she can have her app open and everything that she's doing here can be very similar to what she's doing at home. And I think that consistency is quite important.
Good morning. This is Bloomberg Savannah.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It's 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning, I'm Vonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. A global chip sell-off taking a breather now as SK Hynix announces a massive share buyback plan. A bond rout also easing ahead of the latest FOMC minutes and a 20-year Treasury auction. And the Trump administration delays 50% tariffs on Canadian goods for 3 days after a tentative deal. Let's take a look at these markets. Interesting ones today after the SOX index fell 5% yesterday, a massive rout that bled into Asia, but then got arrested also in Asia with SK Hynix announcing this massive buyback. It was a really fascinating movement. We're seeing NASDAQ 100 futures. They were higher earlier, just fractionally lower now, so we'll see how the US digests all of that news. And we had that rally for chips Monday, so it's just seems to be day by day now, depending on sentiment. The Russell 2000, while it had seen a record earlier this week, also off just a little bit. Let's take a look at yields, because we have the FOMC minutes later. We also have that 20-year auction. Looks like it might draw a yield of 5.29 and change, actually. The 30-year yield is at 5.2815 right now, so that'll give you some kind of an indication. And in fact, that's a little bit higher than we started the session earlier on. The 10-year yield staying below 470. And then if we look at oil, that's where we see a bit of pressure as well. Another couple of chips did a U-turn in the Strait of Hormuz. That and the fact that the president is saying there's no talking going on with Iran, well, that all has the market a little bit jittery. Also, the FT report that Iran has been looking at military sites in Europe potentially if Donald Trump decides to escalate. For some stocks to watch now, let's get to Chloe Melley in London.
Good morning, Vonnie. SK Hynix ADRs are up this morning about 5% after announcing a plan to buy back $29 billion worth of its shares, which is, of course, something that could be quite reassuring to investors that have been so worried lately about this AI overspending and the durability of this spending on the technology. And so we're up about 5-6% in pre-market trading there. Moving on to Norfolk Southern, which is also in focus today after the rail regulator resumed a review of Union Pacific's bid for this company. This would create the nation's first coast-to-coast freight network. This could be a huge transformative deal, and so we're up about 2% on the back of this morning. And finally, let's move over to the UK, where Trainline is down significantly after the Competition Authority opened an investigation into whether or not the company used drip pricing, which essentially refers to not disclosing the full total price upfront to consumers. And so we are seeing this probe really dragging down the shares this morning. We're down more than 15% in London this morning.
Some move there, Chloe. Thank you so much. That's Chloe Melley there in London. Keith Lerner of Truist seeing U.S. large caps becoming more attractive, writing the weight of the evidence continues to support giving the bull market the benefit of the doubt. The uptrend is supported by an earnings boom, a resilient economy, broader participation, and more reasonable valuations. Keith joins us now. He's CIO and Chief Market Strategist at Truist. I mean, when you put it like that, Keith, it sounds very obvious. Why wouldn't this bull market continue? And yet we see such ructions. The SOX index down 5% yesterday. SK Hynix having to come out with a share sale to calm the market. How jittery is this market really?
You know, it is pretty jittery in the short term, and but I will say, going back to the quote, I mean, I still think we have to give this bull market the benefit of the doubt. It's earned it through kind of these carousel of concerns that we've seen not only this year but through the last several years, and we're coming off a historic earnings season, so we've had this earnings boom. You know, that said, you know, as we kind of move deeper into August, into September, I do think that it is going to be a bit bumpier here because, you know, one of the main things that has overwhelmed these kind of outside forces is this earnings boom. And now we're going to move past that earnings boom where there's going to be much more focus on inflation, interest rates, Jackson Hole, upcoming inflation reports, the, you know, next employment report. So it's going to turn much more macro where I think you'll see more mixed trends as opposed to the earnings season, which has been really almost one-sided to the upside.
Yeah, we were so spoiled this earnings season, Keith. What if we don't get that again? I mean, was this a one and done and next time we'll get nice surprises potentially, but you couldn't possibly have that kind of an earnings season again, could you?
I think it will be tough to top this earnings season, but on the same token, I still think the path forward is of higher earnings. And, you know, if we think about the earnings for this year, the upward revisions relative to past years is one of the strongest we've seen in history. Typically, we don't see this type of strength unless we've come out of like a recession or a downturn. What's notable in our work is now we're starting to see estimates come through for next year. And so far, the trend we're seeing for 2027, our estimates are moving also higher at a more rapid clip than normal. So, listen, I think the earnings story is still positive. Have we hit the, you know, as good as it gets? Maybe, but I think in the same token this year, if we look at the S&P as an example, the valuations have reset, and the year-to-date gains for the S&P are all earnings driven. The PE has contracted by about 9 or 10%. So I think the good news is I don't know the market's anticipation that we're going to be able to duplicate this, but it does expect earnings to continue to move upward and to the right over time.
You're still finding tech very attractive, industrials as well, but it's based on the AI narrative, right? How resilient is that AI narrative?
So we've long kept during this bull market an overweight to tech, and as you mentioned, the adjacent play is industrials. You know, we wrote a note a few weeks ago talking about the kind of the love-hate relationship with tech. Every bull market has a dominant theme. We still think AI and tech is a dominant theme. We still are showing the strongest earning trends within tech, but we also have to realize coming off of the March lows until June, you know, tech was up almost 50% and semiconductors were up almost 90%. So I think some of the volatility that we're seeing here more recently is that you just went a long way in a short period of time and you reset expectations higher. At least the good news over the last month or so is that you reset those expectations lower. Valuations for the tech sector is at the lowest premium, or one of the lowest premiums we've seen over the last decade. So I still think that trend is intact. But I would also say, Bonnie, you know, look at yesterday. We have energy, which were overweight, making new highs. You have healthcare making new highs. So I would say it's not just a tech story. It's tech and others. Again, healthcare, financials, alongside that tech and industrials and energy are current overweights.
Yeah, financials, healthcare, as you say, energy, and then also small caps as your preferred rotation hedge. What are your clients saying to you about fixed income right now? Because if you have yields this high and such risk in the equity market, even if it all looks, you know, pleasant at the moment, right? But there's going to be a lot of volatility, as you say, a lot of choppiness. Would your clients rather take, you know, a fixed 5 or 6% yield?
Yeah, well, you know, it's somewhat mixed out there. On some side, we're seeing people see this as a you know, a great opportunity. On the other side, if you're a borrower, you're seeing, you know, a different perspective. But from our view, we do think yields are somewhat attractive up here around 470. We kind of stress test this and said, let's just say yields even move, you know, another 50 basis points higher. On a 1-year forward basis, you would still have a positive total return because that carry or that coupon, you know, is at one of the highest levels we've seen over the recent decades. So from our perspective, we're saying for our clients that, you know, if you're in fixed income and even if yields move a bit higher, we're getting rewarded for where yields are relative to, you know, some of the risks that are out there today.
So there's going to be a 20-year Treasury auction a little later today. It looks like the government is going to have to pay 5.29% roughly. Alphabet had to pay Australians and whoever else bought the Aussie bonds 6.98%. Do those AI-related yields go even higher, Keith? And at that point, would they become quite attractive, or would they start to look a little riskier?
Yeah, so we're actually, it's funny you mentioned that, we're monitoring the credit spreads from the AI side as one of the key risks to our positive view. And we're looking at that more of kind of what it's telling us for the equity market, because, in totality, we're actually seeing pretty broad moves upward in credit spreads. But this is from balance sheets, excluding a couple of companies that are somewhat under leveraged. Obviously, a lot of focus on cash flow. So, listen, as far as if they're attractive, I think most of these big cap companies still have really strong balance sheets, and I think the investment grade is somewhat attractive at those levels. But again, from the equity market, I'd rather see those credit spreads stabilize as opposed to moving up, because that's showing you that kind of tension between this great opportunity, but also some of the concerns that in markets with those credit spreads moving higher.
So, Keith, we're coming into, the second half of the year. We're in it, and August is effectively over at this point. Is there anything that we should be aware of between now and the end of the year that perhaps we can avoid? Any pitfalls that typically happen that maybe we should just try to avoid this year?
Yeah, the one thing I try to do is, what our team tries to do is just kind of zoom out and focus on what's the main drivers, what regime are we in, and, continue to look at earnings as our North Star. But, we are in this midterm election year. August is bucking some of the, historic weakness. I mean, we're up over 2.5% this month. But, it's very normal in September and October before the election to see a little bit of a pullback. I would focus less on that and what the primary trend is, which is, in our view, still higher, and use pullbacks as opportunities. But, I mean, as I mentioned, we have all these macro uncertainties out there. Jackson Hole's a big deal. But ultimately, I think it will come back to corporate profits. And then lastly, Vani, it's always the things that we're not talking about, which is the biggest risk. As an example, I don't think many people had on their bingo card, the Iran-U.S. tensions heating up like this year. So I think it's something that's going to come from left field, curveball that we'll have to adjust to. But again, at this point, going where we started, we still think this bull market has earned the benefit of the doubt.
The nightmare of a black swan. Keith, thank you so much. Keith Lerner of Truist. Now, to other top stories trending on the terminal this morning. The UAE says it's cutting all economic ties with Iran until further notice after accusing it of firing ballistic missiles at its territory. The UAE has traditionally been one of Iran's main commercial partners. Iran relies on the relationship for access to foreign goods and hard currency. The Trump administration has announced sanctions on the president and senior trial lawyer of the International Criminal Court. In a statement, Secretary of State Marco Rubio said the court is corrupt and fatally politicized. The move is the clearest indication yet that the U.S. wants to cripple the institution rather than sideline it. China has recovered a rocket booster on land for the first time. According to Xinhua, the rocket successfully landed on its legs in the northwestern province of Gansu after helping send a satellite into orbit on Wednesday. This marks a major step towards catching up with U.S. companies such as SpaceX. Coming up, a surprise win in Florida. The primary election sees another victory for the Progressive Democrats. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream. And a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start on the third floor or the lobby. You actually have to start in the basement.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors.
We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Democratic Socialist Angie Nixon there scoring a surprise win in Florida, while Republican Byron Donalds, backed by President Trump, cruised to victory in his gubernatorial primary. Kate Ackley of Bloomberg Government joins us now from Washington. We'll start with a roundup of the primaries. You know, obviously we saw Angie Nixon there win, another progressive. Terry Haynes of Pangea has been making the case for the longest time that the progressive wins help Republicans keep Congress in November. Is that a broadly held belief right now, Kate?
Well, it's certainly the belief among Republicans. And so this was not a race that was going to be rated very competitive anyway. Angie Nixon will be taking on incumbent Ashley Moody, who was, of course, appointed to that Senate seat to replace Marco Rubio, who became Secretary of State. It was, not viewed as a super competitive seat anyway, but this is something that Republicans will highlight, not just in Florida, but it's sort of their nationwide messaging that the Democratic Party has gone not just too progressive, but, in this case, with a Democratic Socialist candidate winning there, and Angie Nixon, who you were just playing the clip of. Again, like you said, it was a surprise. I think Democrats had thought Alex Vindman was more likely to win that Democratic primary. So this really does play into the messaging that we're hearing from Republican candidates nationwide, that the Democrats are too extreme, that their party is being dominated by the progressive wing, and in some of these cases by candidates who identify as Democratic Socialists.
And then just to pick out another one of the primaries, Alaska serving us up another fascinating story, and it could actually be the state that decides what happens in the midterms.
Right. Well, we know two candidates have made it through the primary there. They do things a little bit differently, not partisan. And I think it's the four top qualifiers who go to the general. But the two main candidates that you have on the screen there, former Congresswoman Mary Peltola, who's obviously won the Congress seat there. The House seat is statewide. It's an at-large seat. So she's already won the state before when she was serving in Congress, and she's going to be taking on the incumbent Senator Dan Sullivan. Of course, that's the interesting race where they had two Dan Sullivans on the ballot, an unusual situation. But yes, this is shaping up to be a very competitive race. I think we're going to hear a lot about Alaska between now and Election Day.
Yeah, could decide control of the Senate. Can we move to the Trump pick for the FDA position? So he picked an aide, Heidi Overton. She's a deputy assistant for domestic policy, but what she actually also is a medical doctor with a doctorate in clinical investigation from Johns Hopkins. Now, does that mean that she could actually stop the boat from capsizing? The FDA has been in trouble.
Yeah, we've seen a lot of turnover there. There's reports of a lot of turmoil. Of course, that was the role that Marty McCary had. The health organizations, under Robert F. Kennedy Jr. have had a lot of, people coming and going, people rank and file, people leaving. Of course, this is an agency, the Food and Drug Administration, has, broad purview over what people eat, what the drugs that are approved and so forth. So we will be watching that. She would need Senate confirmation for that job. And of course, that's never a sure deal, but we'll definitely be watching that and seeing what happens there.
All right, Kate, thank you so much. So much going on overnight. It is appreciated. Kate Ackley of Bloomberg Government in Washington. Stock futures are wavering, but we did have a global chip rout. SK Hynix calming the scene, though, with some AI spending fears in the air. It bought back $29 billion of its own shares, and that caused the stock to move higher. Joining us now is Bloomberg's Neil Campling. So Neil, it's one of those things where you look at it and then after a minute you think, hang on, this is actually really interesting that this would have this impact on the market. If you think about it, Warren Buffett used to say the reason he didn't get involved in tech was because he couldn't discount future earnings because he didn't know how to value them, right? It turns out that might actually be a broader concern now for tech investors.
Yeah, it's so the Hynix cash pile that you just shown there, for example. Remember the buyback they're talking about now is greater than the cash that they have on the balance sheet. So, there's that question on one side of things. Then we have this, the Alphabet bond overnight, where 7%, kind of near 7% coupon, which is really quite high for a tech company. Tech companies have over many years been able to generate significant free cash flow that for many of the hyperscalers is now looking somewhat negative. So it's raising lots of questions, and then we start talking about what happens to some of the financial metrics, weighted average cost of capital, which we mentioned before the bell this morning. These are changes some of the risk premium around equities when you have other investors now who are geared into the AI trade, whether that be through the bond markets or equity markets.
Yeah.
So there's more questions and answers today.
Well, I do want to point people to your daily before the bell wrap today, especially because, it's fascinating. But in there, you have another statistic, Goldman estimating that AI-related borrowers accounted for 18% of U.S. investment-grade issuance this year, up from 1% in 2024. That's a huge difference.
It's quite staggering, isn't it? I was taken aback when I read that myself earlier. And actually, if you look at the longer end, in the very long-dated 15-year plus, the Goldman's estimated it could be as much as 40%. So even higher geared there. So yeah, it's a real surprise, and it's something that I think will have macro traders and investors taking a closer look at.
All right, I would encourage everyone to read your Before the Bell, where you bring back WACC, weighted average cost of capital. Neil, thank you so much. Neil Campling. More retail earnings on deck this morning. Target, Lowe's and TJX all set to report. This, of course, after we got Home Depot yesterday. Let's bring in Bloomberg's Maddie Parker. What do we know about the consumer from Home Depot, and what might we learn today, Maddie?
Yeah, morning, Vonnie. It's a big day for big box retail results. It kind of helps that a lot of them report at similar times. We can use Home Depot as a bit of a guidance for how some others might perform as well. We saw in Home Depot, obviously, they beat estimates. It was a promising set of results, given the kind of general landscape in the housing market. It's indication that even though people are feeling a little bit kind of downbeat in sentiment around housing, the high mortgage rates, cost of borrowing, amongst other things, the housing stock, it looks like people are still leaning into some of those renovation projects. It's safe to say I think they got a bit of a boost from the heat over the summer. There are products like patios, grills, and things like that that do very well, of course, in heat waves. So it'll be interesting to see whether Lowe's, kind of a main competitor of them, will be able to perform. We know that they've been leaning a lot into AI, into their digital expansion, and also trying to push into professional contracting as well. So some analysts expecting to see good results, particularly after the Home Depot.
Maddie, thank you so much. That is Maddie Parker. She'll be all over all of those results. This is Bloomberg.
up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersetchi in El Ula, Saudi Arabia, and this is Bloomberg. Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Now a look at what's ahead today. First up, retail earnings from Target, Lowe's and TJX all on deck before the bell. Then the US Treasury set to sell $16 billion worth of 20-year notes. That's at 1 p.m. and will be closely watched, as will the minutes from the July Fed meeting at 2 p.m. Eastern. Let's take a look at some pre-market movers. SK Hynix ADR's shares much higher on plans for a $29 billion share buyback. Expect a lot of chatter about that today. Norfolk Southern up almost 2%. The regulator is looking at a joint application that Norfolk is doing with Union to create the first coast-to-coast freight network, apparently. White Fiber down 20%. Dilution concerns here. It's buying data centers and decided to issue convertible senior notes to the tune of $250 million. And this is your macro picture into your Wednesday session. This is Brief.
The Mutua Madrid Open is underway. Spanish wildcard Caitlin Quevedo took out her childhood idol Venus Williams to reach round 2. The 20-year-old fought back from 3-love down in the second set before closing out her first win of the season in just over 2 hours. And don't forget, you can watch all the action live daily and head on over to tennischannel.com to download the app.
At any point in your tennis career, did you say, I've had enough and I'm just going to retire at the top? Do you ever worry about that problem, staying too long?
It's a great question, and it's one that I think every athlete finds a different answer to. Mine came a little bit later than when I would have liked. I think stubbornness was a great quality that shaped a lot of my victories, but in the end of my career, I think it became a flaw because I was so stubborn to get healthy, for my shoulder to recover. I was also at an age where just my body didn't recover as quickly. And so for a year or two, that stubbornness got in the way of other great things in my life.
What would you say is the thing you're most proud of having done as a tennis player? Was it winning Wimbledon? What was the highlight of your tennis career?
I'd say consistency. I think consistency is, you can have results and they could, come at various times in your career, but I was consistent for many years, and you have to show up. You don't just show up to play first round of the finals, but you have to show up for press conferences before every match, before every tournament, and just the consistency and the mental wear and tear of showing up week in, week out. So I felt like I consistently showed up for for my team, for my sponsors. As I look back, I'm proud of that.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
We've had a very good rally in stocks, particularly off of the summer lows.
The appetite for risk is still exceptionally strong.
Things are not as screaming a buy.
It's fair to be skeptical. It's fair to be careful about it.
There is room for this to continue.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Wednesday, look at a snap, a three-day slide, attempting to find firmer ground following global bond market jitters. Heading into 20-year supply from the Treasury later on this afternoon, together with another read on the Federal Reserve's last meeting. Fed minutes just around the corner.
And they take on new importance today for two reasons, really. One, also because obviously there's been a lot of questions of credibility about Kevin Warsh, the resolve of this Fed, following that little bit of a shaky news conference. And then second, of course, the bond market has been reacting. So are they going to react? Maybe because we have this vacuum of communication that we're so used to. Are they going to react more than they normally would when the minutes come out?
2 p.m. Eastern Time. Typically, I wouldn't really get too excited about Federal Reserve minutes.
Either would I. Can you believe I'm even excited today?
This feels slightly different. And it feels different because several mistakes were made in the news conference. Now, you can attempt to defend what happened in that news conference, but I think the idea that they were mistakes was validated by the Cleanup Act that took place through the Financial Times. Ultimately, that reinforced the idea that errors were made. So you've got an opportunity to massage some of the minutes here, to re-clarify, re-emphasize the message, and 2 p.m. is the time to watch to see if that happens.
Yeah, Mark Cabana put it yesterday saying some rookie errors happened at that press conference, which is why he thinks Jackson Hole is going to be incredibly important because it's going to be cleanup at the Federal Reserve when it comes to Kevin Warsh's speech. And what's happening on the long end of the yield curve, yesterday Mark Cabana says, I know you guys want to talk about the snowball effect of all of these issues that are affecting the bond market right now. He says mostly a Fed story.
Well, let's turn to the bond market now and talk about 2s, 10s and 30s. I have never seen so much ink used to talk about the bond market when 30-year bond yields ended the session lower by 2 basis points. Wasn't a move, it's been subtle, just been a grind higher. It's been really quite orderly. It's the levels people are talking about, not just stateside, and we've said it repeatedly, but worldwide. In Japan, 30-year yields are levels we haven't seen since the 90s. In the US since 2007, in Germany since 2011. You see it from region to region, from country to country, nation to nation.
Right, you're just going to have higher yields. And this is where potentially Mark Cabana, who says it's mostly a Fed story and maybe the United States is driving it. But the fact of the matter is that you have this all over the world. You can see it's due to a ton of issues. Growing fiscal deficits, you have absolute insatiable demand and issuance coming from these hyperscalers, and then inflation and the fact that you have energy prices going up.
Well, let's talk about crude, Brent and WTI this morning. Speaking of a grind higher, we're back at 92 on Brent. Brent this morning up by 1%. The president said there are no talks, there are no planned talks, and there is very, very little detail on the path forward from here.
No talks, no plans to schedule talks, and as you say, Jonathan, no details. The president claims the Strait of Hormuz is open. At the same time, find me vessels that are feeling very confident about going in and out. Of course, there's some that are turning their transponders off, but we are not back to pre-conflict norms.
We know the consumer squeezed right now. You can see that in the sentiment data. We're going to see it in the retailers potentially as well. Lows just dropping. We'll get to the details on those particular earnings a little bit later in the program. Target the one to watch, expecting that one around 6:30 Eastern Time. Then the big one in the next 24 hours, you'll hear from Walmart tomorrow morning. That's the lineup for today. A little bit later on this afternoon, a big focus on the Federal Reserve. 2 p.m. Eastern Time, we get those minutes. An hour before that 20-year bond auction. That 20-year, a bit of an orphan, as we often say, unloved on the yield curve. We'll talk about that issue a little bit later. Coming up this hour, Cam Dawson of New Edge Wealth as equities attempt to snap a 3-day session slide. General Karen Gibson of Academy Securities as Iran weighs attacks on U.S. targets in Europe. And Lindsay Rosen of Goldman Sachs as the AI build-out crowds out the debt market. We begin this out with stocks steady as the global bond sell-off slows. Cam Dawson of New Edge Wealth writing, we see higher rates as having already weighed on risk assets, but thanks to super strong earnings growth, the impact has been masked. Cam joins us now for more. Cam, good morning. It's good to see you. That bond market move wasn't a big move yesterday. What spooked this market? People talking more about that and less about a 5% slide in semis.
Yeah, I think when we think about the relationship between the bond market and what happens within equities, it's really helpful to think about the two components of equity prices. You have, of course, valuations, which we think are immediately impacted by higher bond yields. It shouldn't be lost on investors that the low in the 10-year yield happened back in October of last year, and that coincided with the high in the S&P 500's valuation. So if you're in an environment where you continue to see these upward pressure on interest rates, it suggests that you have a draining of liquidity and more downward pressure on valuations. Then comes the question as to whether or not these interest rates will actually weigh on earnings growth, because it has been strong earnings growth that has forgiven all sins for this market, because you've been able to see earnings grow so far faster than even the valuation compression. And that then raises the question of, will higher interest rates crimp at all the demand for, or the ability for, these hyperscalers to continue to spend on CapEx? The Treasury wasn't the only one issuing a 20-year bond. We also saw Google issue a 20-year bond at a 7% coupon rate. So I think the big question is, will these higher rates ultimately make this kind of CapEx less attractive? At this point, there seems to be no sign of that, but certainly that would be something to watch.
Cam, many people suggesting this is somewhat reminiscent of what happened in 2023, where yields started to break out higher and forced corrective action from the then Yellen Treasury to tighten up maturities and bring things away from the long end. Do you think this is a situation that brings back memories of 23, or is this backdrop different?
Well, I think the key thing about 23 is that Yellen did try to increase issuance at the long end. She slightly increased the coupon bond issuance, and the 10-year Treasury yield ripped 150 basis points right in her face, and that caused the need to be able to pull back on that coupon bond issuance. At this point, we've not seen the Treasury talk about increasing coupon bonds. In fact, they changed the language in some of the quarterly refunding to say going from changes, or going from increases down to changes, which led some people to hope that maybe that they were going to decrease their coupon issuance. The problem is there's no room to do so. You already have bills as a percentage of Treasuries outstanding at 22%. Prior to the COVID era, you had bills as a percentage of Treasuries outstanding closer to 13 to 15%. So we're effectively already at crisis level bill issuance, even though we are certainly not in a crisis.
We certainly didn't have this issuance from the hyperscalers either back in 23. And Cam, that's the change. And you mentioned that 7% coupon, potentially a 7% coupon at the 20-year tranche, I think, of the Alphabet piece down under. Cam, clearly the cost of capital is going up. The cost of money is higher. And to your point, the earnings story has really insulated this equity market. But the earnings story increasingly is being powered by the debt issuance by the hyperscalers, and they're going to have to pay up now. So do you think one starts to inform the other? You alluded to it. Does the higher cost of capital begin to undermine the earnings story that's insulated the equity market for much of this year?
Does 200 basis points of increased capital costs keep you from spending on what you see as an existential need in order to continue to grow your business? That is the big question for these hyperscalers, because what we're seeing from them is the continued willingness to spend. There was absolutely no sign in the second quarter earnings that they're pulling back on spending at all. And if you look at the consensus expectations for hyperscaler CapEx growth this year, it's now at 96% growth. There's an expectation that will grow another 30% in 2027 and another 20% in 28. And the fascinating thing is that as we get into 27, the expectation is that free cash flow generation is expected to go even more negative for these hyperscalers, which just means that they will have to rely on even more outside capital, even bigger debt raises in order to meet their spending plans. But there's one more catch. If you look at the street consensus into 28, they have an expectation that free cash flow is going to rebound really mightily, not because CapEx is getting cut, because you're going to start seeing a big return on all of this investment. And of course, that is the ultimate question, is what is the ultimate return that we're going to see from all of these dollars spent? And it very much remains to be seen.
And at some point, is there a cost of capital at a level that would have these hyperscalers change some of their decisions on what they're spending on and how much they're spending?
I think that there's an interesting lesson that we learned in the lead up to prior crises or prior credit issues in prior cycles. What you've typically seen is that long-term bond yields do typically go up later cycle because of this higher demand for capital. And what that leads borrowers to do is actually shift some of their borrowing to be more short-term. So you could see it pre-GFC, you could see it pre the tech bubble bursting. You saw a big explosion in commercial paper borrowing. So for us, the guide mark on the road as to whether or not this is nearing the end or the cost of capital is getting too high is not whether or not Google is able to raise debt at a 50-year maturity. It's whether or not you start seeing more borrowing at the short term because borrowers are trying to get the cost of borrowing down in the very near term. If we start to see some more short-term borrowing, you have an asset liability mismatch, and that could certainly be something that causes the credit portion of a cycle to become more pernicious. We're not seeing it yet, but that's certainly something we would watch given this rise in long-term yields.
Cam, for you, do you think the Fed meetings minutes today take on a new level of importance?
I think it is interesting as we're going into Jackson Hole next week to see if Chair Warsh is at all serious or all concerned about the rising part of the long end of the yield curve. We know that Trump cares about the long end. We know that Bessent cares about the long end, what is uncertain is if Warsh cares about the long end as well. And if he sees higher interest rates as at the short end as a tool to help him keep long end rates under control. I would think the other thing that's important to watch within the minutes and potentially into next week as well is any mention of the balance sheet. Warsh has been pretty much committed to saying he wants to shrink the balance sheet, but with a 10-year yield knocking on 5%, we're not quite sure if that is necessarily feasible. So given how much of this market is moved by bond market volatility, it certainly is much more important given just the big moves we've seen in the yield curve.
Cam, it's good to see you. Cam Dawson there of New Age Wealth. Some significant moves in the yield curve at the long end of the curve over the last several months. Seen, you can picture it. Kevin Warsh in his office, door knocks. Outside, the Treasury Secretary, Scott Bessent, with some things to say about that performance in that news conference. This is fiction. I've got no sources for this. You can just imagine the kind of pressure that the Fed chair will come under increasingly if you continue to see this bleed higher in yields. Mark Cabana of Bank of America was alluding to some of this, not that story, but alluding to the idea that tactically speaking, going into next week in Jackson Hole, there's some work to do here. There is some work to do at the Federal Reserve to do something about what's happening in this bond market. If the Fed chair passes the opportunity and doesn't address it and doesn't do anything to say or settle the nerves that we're starting to see emerge in fixed income, not just in America, but elsewhere too, things could get even more jittier.
It's
Jittier a word?
I think so. It is in my vocabulary.
Jittery?
Yeah.
Whatever.
So, twitchy, yippy.
Twitchy is a better word.
These are the words that people like to use, especially the president, when it comes to the bond market. And to Cameron's point, it is the long end. It is the 10-year yield that this Treasury Secretary is focused on. And maybe there's not a knock at the door, Jonathan, but we know that the Treasury Secretary and the Fed chair in all administrations have lunch or breakfast every other week.
Yep.
So they're going to have lunch or breakfast before Jackson Hole. And
Jittery.
And I imagine Scott Bessent is going to say to Kevin Warsh, you got to clean this up.
470 right now on 10s, 30s, still a problem. Let's give an update on news worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. The UAE says it's cutting all economic ties with Tehran after accusing it of firing ballistic missiles at its territory. The Gulf nation, traditionally one of Iran's main commercial partners, says it's halting trade and financial transactions until further notice. President Donald Trump delaying 50% tariffs on billions of dollars worth of Canadian products for 3 days after 11th-hour negotiations. The White House saying the duties were halted after Canada expressed a commitment to remove discriminations on U.S. autos, dairy and alcohol. The president also saying the Keystone XL pipeline may be awoken from the grave. Shares of Lowe's lower in the pre-market. The home improvement retailer reporting second quarter earnings that topped estimates but cut its full year guidance. The company said it's updating its outlook to reflect operational results for the first half as well as current demand trends. And that is your Bloomberg Brief. John.
Vonnie, thank you very much. More from Vonnie in about 30 minutes' time. Up next, dipping hopes for peace.
Iran is broke, totally broke. I want to give them every last chance before decapitation.
They want to make a deal, but they're not going to make the kind of a deal that I feel is necessary.
At some point, maybe they'll do something and then they get blown away.
In just a moment, we'll catch up with General Karen Gibson of Academy Securities with crude back in the 90s over the last couple of days and holding on to those levels. Live from New York City this morning. Good morning.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
The retailers in focus this morning. We should hear from Target in the next 30 minutes or so. We heard from Lowe's, the home improvement store, a little bit earlier on this morning, cutting their outlook. That name is down by more than 3% in the pre-market. Target later this hour. Should be hearing from them. Then tomorrow, the big one, Walmart, just around the corner. Walmart dropping on Thursday morning. Let's turn to the equity market story. Equity sliding for 3 consecutive sessions. We're looking to stabilize the story, just about unchanged on the S&P. On the Nasdaq, down by 0.2%. In the bond market, 2s, 10s, and 30s. For all the talk of a sell-off in the bond market, 30s actually rallied on the session yesterday. Yields were lower by a couple of basis points, but the trend has been clear. It's been higher. And we're holding on to these levels for longer and longer. 30s, close to 530.
But maybe that tiny bit of a rally yesterday was because everyone was so gung-ho that this is going to be a disaster, and they realized, wait, if it's so bad, Kevin Warsh is going to have to come out and clean it up in Jackson Hole. Maybe akin to, I know what you're going to say, Christine Lagarde.
Yeah, I remember the news conference. We all do. We're not here to close spreads. Then we had the Cleanup Act. I think there was an interview scheduled for the same day to try and address some of the issues. The FT article reminded me of that. It was just acknowledging mistakes were made in the news conference, regardless of what you think. That is an acknowledgement that mistakes were made in the news conference. They need to clean it up in the FT piece. You've got another opportunity in the minutes, got a major opportunity next week in Jackson Hole.
It was an ink in the FT that people familiar with the matter said, realize we made some errors in that press conference. And if inflation is hot, we will hike interest rates. I think that said it all for you, that they recognize that there was an issue here and they have a reactionary function. I think the market, though, wants to hear it come out of Kevin Warsh's mouth. If you have to clarify, AMH, if you have to clarify that the interest rate tool is the primary tool and not the balance sheet, something's gone wrong with communication. You're right. Something went wrong with communication. Amateur hour, for sure.
Without a doubt. Let's turn to commodities. Brent crude this morning in the 90s, 92 on Brent and up by 1%. Under surveillance this morning, dimming hopes for peace.
Iran is broke, totally broke. I think it's going to end pretty soon. I don't think they can go much longer. At some point, they're going to say, we just can't take it anymore. I want to give them every last chance before decapitation. They want to make a deal, but they're not going to make the kind of a deal that I feel is necessary. At some point, maybe they'll do something and then they get blown away.
So here's the latest this morning. Crude back in the 90s, looking at 92, as talks between the US and Iran have completely stalled. The Financial Times, check this out, shocking story, reporting Tehran is considering attacks on US military bases in Europe should President Donald Trump escalate the war. Joining us now, Bloomberg's Abir Abu Amar, out of the region in Dubai. Abir, welcome to the programme. That is a serious story from the Financial Times this morning. What's the reaction across the region?
Yeah, good morning, John. So essentially, the Financial Times citing two sources close to the regime in Iran, saying that Iran may be considering attacking Europe if President Trump were to escalate the war militarily in the region. Now, Cyprus came up as a potential target. Cyprus was attacked, or a British base there was attacked by an Iranian drone throughout this war, or through the course of this war. That came up as a potential target yet again. Iran also saying, according to those couple of sources that the FT is citing, that subsea fiber optics in the Strait of Hormuz may also be considered as potential targets. Now, let's talk about what is actually happening in the region. The Strait of Hormuz, that is still blocked by both the United States and Iran. A trickle of movement, nowhere near the levels that we saw pre-war. As a matter of fact, we just reported that 3 Chinese flagged tankers have made U-turns in the Strait of Hormuz because they're just afraid of what potentially could be the response from Iran. We've seen attacks up until yesterday, with 1 casualty reported in the Strait of Hormuz, and then an escalation yet again in the UAE yesterday evening here in Dubai. We all received those missile threat alerts. The UAE Defense Ministry later saying that it was targeted by 2 Iranian ballistic missiles, and then saying through Foreign Ministry that it will cut all financial and trade ties with Iran. Anwar Gargash, John, who is a very important diplomatic figure here in the UAE, an advisor to the UAE's president, said earlier on X that news of providing financial facilities to Iran is completely untrue. So again, escalations in the region are ticking up once again, and that is really why you're seeing the market reaction, as you have mentioned, Brent edging very close to that $92 on the barrel mark, a 4-day rally.
Abir, appreciate the update and the coverage in the region over the past few days. Abir Abu Amar there of Bloomberg. To build on this, General Karen Gibson of Academy writing, the fact that both sides are making demands they know the other won't accept is a depressing indication of how far apart we are in terms of concessions. General Gibson joins us now for more. General, welcome to the programme. I want to start with that very serious Financial Times piece. From your standpoint, your awareness, your experience, what kind of capability do the Iranians have to reach these bases in Europe?
Yes, certainly. So I think first it's important to scope which bases in Europe. As you've indicated, Cyprus is a very likely choice. It would almost certainly, I think, be some kind of base or nation in Europe that is providing access or basing for U.S. forces, in much the same way that Iran has attacked Kuwait, Qatar, Jordan, other regional nations that are hosting U.S. forces. In terms of capability, if we're looking at Cyprus, it is feasible for missiles from Iran to go as far as Cyprus. When you start extending that far, say 1,000 kilometers, you do begin to lose accuracy, and that's a problem. They could fire at Cyprus with drones that were launched closer from some kind of proxy, whether that was in Syria, in Lebanon, even in Iraq, and then potentially even sabotage of some kind of sleeper cell or operatives that are closer to Cyprus. But I think that's primarily what we would be looking at, is potentially missiles, drones, also potentially sabotage.
General, there's one line that jumps out to me, and it's that Iran's retaliation would depend on Washington's action, according to the insiders. How real and tangible is this threat, or is this just the Iranians using the press as a negotiating tool?
Well, I think both are quite feasible. One, I think the threat of launching some kind of attack against a European state that is hosting or enabling U.S. military capabilities that are being used against Iran is a threat in case the United States escalates. I think it's using these kinds of leaks or communication as a warning of this is what could happen should the U.S. grow tired of this sort of economic standoff and return to more kinetic strikes, in much the same way that in this last round of strikes, they exhibited an ability to use proxies to expand against broader oil infrastructure, whether that was in the Red Sea or in Egypt. I think they're also saying, look, we could go even further, and we could go to European bases that are hosting your forces, should you choose to return to an escalatory kinetic path.
Where do you see the conflict right now? The president says the Strait of Hormuz is open. It's been demined. We just had reporting that 3 Chinese tankers, obviously the Chinese are the ones that are buying Iranian crude, had to make a U-turn.
Yes. Well, as we've talked about before, Anne-Marie, the president can say it's open. Iran can say it's closed. But what really determines, in many cases, traffic through the straits is those decisions by commercial entities, shipping companies and the firms that insure them, who decide that the potential for profit is worth the perceived risk of sailing through. And they're the ones that are making these calls to, in this case, do a U-turn based on this very high perception of risk. And I can't say that they're necessarily wrong in making that call. But again, it doesn't come down to what the president says as to whether or not the straits are open for business.
General, well said. It's good to get the update from you. Thank you. General Karen Gibson there of Academy Securities. The president is clearly finding it difficult to get out of this. Before he went into this, we talked about this repeatedly. This was out of character. Typically for the president, any kind of foreign venture, and we've seen a number of them, a few in Iran and a number elsewhere, they've been limited, targeted, with very well-defined, achievable objectives. This is so different and was different. And I still sit here today wondering, what on earth did they get into this mess to begin with?
Well, this is why the polling on this is so poor. I think it's because part of it, and Mark Short talked about this yesterday, he worked for, of course, Trump won. The American people have been told a number of reasons why we are now involved in this war that was supposed to be just a few weeks and is now lasting months.
Crude responding to all of this. Back in the 90s, just short of 92 on Brent crude on my screen right now, up by 1%. WTI in the mid-80s, around 86. Coming up on the programme, we'll catch up with Jennifer Huddleston of the Cato Institute as Meta's landmark child safety trial continues. We'll also catch up with Yahira. She's got your morning movers. Shares of SK Hynix getting a lift this morning. That stock is up by close to 4% in the pre-market, following a multi-billion dollar share buyback. That story just around the corner. Live from New York City, you're watching Bloomberg TV.
How do you see AI changing gaming and game development in the future? Look, I think the biggest thing that I'm thinking about is how do we just make sure it's solving problems. On the game development side, I've gone to a lot of our studios, with big and small, and I'm blown away with how they're using AI in the production pipelines, how they're using it for iteration and prototyping. That's not production ready, there's still work. And 30% of game development is software. And so there's the traditional applications that we see in enterprise. At the same time, I do not think AI will replace AAA games. I think it's entirely possible, though, that AI represents a new category of games and a new type of development and enables more people to create and participate. And we'll keep an eye on that, and we'll see how we best serve that.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Three-day losing streak on the S&P 500 this morning. Some stability just about on the S&P. We're just about unchanged over the last 3 days, which happens to be the longest losing streak in about a month. We're down a little more than 1%. It's not been a massive slide at the headline level on the S&P 500. Within that, the semis getting a lot of attention in the last 24 hours. The semis down by 5%, the worst day so far this month. In August. Switch at the board and get to the bond market. Lots of talk about what's happening at the long end of the curve. Twos still well anchored off the back of some weaker than expected data over the last week. We're around 416 on the 2-year. If you're looking at the 10-year this morning, around 470 at the longer end of the curve. This is getting all the attention at the moment. Around 530 on 30s. Yesterday, briefly, the highest level since 2007. Then just a little bit of buying came in going into this 20-year bond auction later this afternoon.
Because maybe people expect that the Federal Reserve is going to say something to clean up the long end of the yield curve. The fact of the matter is, though, when you hit a level that we haven't seen in decades, especially 2007, right before the great financial crisis, that gets everyone's attention at a time when there's this insatiable demand for the debt on the corporate side, and there's higher inflation potentially coming down the pipe with things like energy costs, and there's no fiscal discipline.
Speaking of demand, let's get to demand over at Target. Target, comparable sales coming in at close to 4%. The estimate was 2.43. That's better than expected. The outlook better as well. They've lifted their full-year outlook over at Target. The stock is up in the pre-market by a little more than 1%. It's not a massive reaction to some decent news because we've had a huge run-up in this name. That name is up by something like 55% year-to-date heading into the print as the turnaround effort in Target begins to bite.
Yep. We hear from the CEO. We're encouraged by the progress made so far, and we're also clear-eyed about the important work still ahead. Target has made a ton of changes on execution. They are going back to what Dana Telsey has called Target, having some of these high-end brand partnerships, and that is getting people through the door.
We'll spend some time on that name throughout this morning, looking ahead to Walmart in about 24 hours' time. Target in the pre-market down by about 1%. As we count you down to the cash open, 3 hours away, let's get you some single names. Yahira has more. Hey, Yahira.
Hi, John. We start with Lowe's. We are seeing those shares falling 2% in the pre-market after the home improvement retailer cut its full-year outlook, now expecting comparable sales to be flat. That is because Lowe's says consumers are still holding off on those bigger optional home projects, things like renovations and upgrade, echoing the same type of caution that we heard from Home Depot yesterday as higher borrowing costs make those projects more expensive and elevated mortgage rates keep people from moving and, of course, taking on those projects. Meanwhile, we are seeing SK Hynix ADRs also rising nearly 4% in the pre-market after the chip maker unveiled a massive $29 billion share buyback, a move that helped steady the market after yesterday's tech sell-off. It's a big vote of confidence at a time when companies like this one are spending enormous amounts of capital on AI. And what SK Hynix is essentially telling us here is that it's going to continue that spending, but it's also going to return cash to shareholders, something that investors have been pushing for from this company as its cash pile only grows. And we end on Norfolk Southern. Those shares are also rising nearly 2% in the pre-market after regulators restarted their review of its massive merger with Union Pacific. The process had been frozen since May due to them looking into demanding more details on things like competition. But now they say that there's enough information to move forward to review the deal, which would create America's first coast-to-coast freight railroad. John.
Yahara, thank you. Thanks for the update. More from Yahara in the next hour. On our radar this morning, the president delaying planned 50% tariffs on Canadian products for 3 days. Trump announcing a tentative trade agreement just hours before the deadline. Elsewhere, OpenAI's second quarter results disappointing investors. The Wall Street Journal reporting the company's 18% jump from the previous quarter came in below expectations. Rival Anthropic more than doubling its revenue in the same period. And finally, Pennsylvania Governor Josh Shapiro ordering strict limits on data centers across the state. The new guardrails will require local approval for permits. Pennsylvania joining New York and Texas in pushing back against the facilities which are critical to the future of AI.
Because they all want to get reelected. I mean, look at the latest Quinnipiac poll that came out in July. 75% of individuals who live in Pennsylvania said, I would not want a data center in my community. So Josh Shapiro is trying to walk this line because originally he went out. Amazon did a big deal in Pennsylvania, wanted to get tech companies to come into the state, wanted to have that capital flowing, wanted to have those jobs. And then you get the pushback from local communities. What is this going to do to our power prices, our electricity prices? And no matter if you are Republican or Democrat, it is clear I do not want a data center in my backyard.
It's bipartisan, to your point.
Absolutely.
It's blue, it's red. From your standpoint, how are you thinking about the race between China and the United States with this in mind? Because you'll see a very different approach. If you want to build a data center in China, they'll just build it. They don't care about the fallout. They're in quite the same way. They don't have to worry about getting re-elected.
I did think of this when I'm seeing all this pushback. At some point, if it becomes that the race is so tight and the United States starts to lose, you could potentially see on the national level, maybe an executive order or on a national level saying to win this race, and this is the future of our economy, there's going to have to be a federal mandate on what is not and what is not allowed.
It would be deeply unpopular. I feel like I'm getting drawn into the midterm conversation again.
I know.
But this is a midterm issue.
It.
We wondered that at the start of the year, whether electricity, energy, the stuff we're talking about, the NIMBYism, so to speak, not in my backyard, whether that would be a feature of the midterms or whether that was too soon. Not too soon at all.
Feature of the
way
midterms.
Before the midterms even begin.
Feature of the midterms. I think it will be the issue for 2028. And we already saw it play out in the governor race in New Jersey as well as Virginia.
That's the latest on Pennsylvania this morning. Elsewhere in tech, the landmark Meta trial entering its second day. The social media giant rejecting accusations it targeted children with technology designed to make them compulsive users. The company projecting the trial could lead to penalties of as much as $1.4 trillion. Jennifer Huddleston of the Cato Institute writing, the significance of this case could extend beyond Meta. The consequences would also impact smaller platforms who might be more hesitant to offer opportunities for speech, given the cost if they face similar litigation. Jennifer joins us now for more. Jennifer, welcome to the programme. I've heard, and you've heard, the comparisons to tobacco and the tobacco industry from decades ago. How does that comparison stack up from your standpoint?
I think it's very different because when we're talking about these platforms, we're inherently talking about platforms for expression, both in the way these platforms offer opportunities for users to express themselves, but also in the way that they design their own features, the way that they decide how they want to rank different things. That's also a form of expressive activity. So that makes us very different than some of the other claims or comparisons that we've heard in the past, and means that it could have significant consequences, not only for the development of this technology, but also for users of all ages.
So that's why this is really a landmark case, because it might not just be Meta. Do you see this extending into other social media platforms?
I think there are two ways to think about this case. The first is, what does it mean for Meta as a platform who is facing the potential to have to significantly change its product, as well as those quite substantial fines? But then there's a broader question. When it comes to the impact beyond Meta, if we're seeing this level of potential penalty, if we're seeing this level of potential action from litigation, what signal does that send to other platforms, including platforms who may think that their design is fine, who may think that they could win in court, but that the cost of that litigation alone could be a deterrent from offering their products perhaps to young people that could benefit from them, or even offering them more generally?
Meta, as you noted, has rolled out a number of user control features, how parents could potentially help monitor what their children are doing, what they can access, how long they can stay on these platforms. Is that a good enough case in court?
You know, it will be interesting to see how these features come up in court, but they are available. They're available both from the platforms themselves. Meta, as you mentioned, offers many of the features that are being asked, things that like being able to turn off the like button. They've offered a new kind of PG-13 version for teenage users, for teen accounts, that limits who can contact them and the information that they see. And beyond that, there are a number of options available to parents in the market who want to have more information about their teen's social media use. So certainly one of the questions that may come up is these features are available, the companies are making them available to parents. Why must the government force parents to make those choices?
Jennifer, can I just come at this from a very sort of standard approach? For a lot of people, I think, who heard about this case, shocked that they tried to make this addictive. Wasn't that the whole point? What was the difference between making something sticky and something more sinister? What was the dividing line?
I think this is going to be really careful, and it's something that we have to really consider when we're talking about these concepts. We'll often hear the term social media addiction thrown around, and that's not an accepted medical term. That's not something that's in the DSM, and it's something that could have significant consequences if we start to see the courts try and recognize this as an addiction when the medical community hasn't yet. That also means that oftentimes the way we may talk about things as a layperson is very different than the kind of sinister action that you talked about. There are a lot of different things that we may continue to use for enjoyment, that we may find beneficial in some cases, and that we may have to have some degree of self-control or oversight from others in our lives in others cases. And so really this is about making sure that users are empowered, and we've seen these platforms try and step up to provide those tools, particularly to parents and younger users. But it's also a broader question of how are we as adults also using these products, and are we modeling the type of behavior to young people in our lives that we want them to use with these products?
Jennifer, depending on what the court does, I think this is also going to be still a story in Congress. Could you see Congress acting when it comes to these social media giants?
These cases are occurring at a time when there's a lot of debate over potential legislation at a federal level as well as in various states. Now, while the cases and the litigation is separate from the legislation, it's undoubted that they'll influence each other. Proponents of this type of legislation will look to these cases as examples for why they view that the government may need to act. But the underlying questions in these cases, even if we do see platforms held liable, doesn't change the constitutional questions in potential legislation. There are still serious concerns about what legislative action that could mandate age verification or mandate age-appropriate design codes where platforms have to design their products in certain ways could have on the speech rights of adult users as well as on the privacy rights of everyone.
Jennifer, appreciate your time. Thank you. Jennifer Huddleston there of the Cato Institute down in Washington, D.C. Certainly don't want to undermine the nature of some of this reporting that we've heard around this company for the last, decade plus?
Yes.
Some of it deeply concerning.
Deeply concerning, which is why it's become a big issue in Washington. And you see another kind of bipartisan issue between Republicans and Democrats. Obviously, there are those individuals, though, that are concerned that if you go too far, do you start to limit free speech?
Let's give you an update on News Worldwide this morning with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Former Ukrainian Defense Minister Mikhailo Fedorov calling for wartime elections to unseat President Volodymyr Zelensky. Fedorov was recently fired by Zelensky, triggering nationwide protests, and says waiting to elect a new leader until after the war would be giving the power to Russia. President Donald Trump naming a new head of the FDA following a turbulent year. Sources telling us here at Bloomberg White House policy aide Heidi Overton will be the new head of the agency. Overton is a medical doctor and deputy assistant to the president on health issues. Target shares are lower in the pre-market. The company lifting its full-year guidance and results, outpacing estimates in the latest quarter. It raised its guidance for the second time this year now, saying it expects sales growth of about 5%. Shares are up more than 55% year to date. And that is your Bloomberg Brief. John.
A massive run-up into this quarterly print. Vonnie, thank you. More from Vonnie in the next hour. Up next on the programme, crowding out the bond market.
This is the fourth record month for the IG issuance.
Traditionally, you have a crowding out when yields get high enough, but that crowding out now faces a challenge from other needers of capital.
Up next on the program, Lindsay Rosner of Goldman Sachs, live from New York City. You're watching Bloomberg TV.
Look at the more successful economies in the region. The key to their success is continuity. But the way our constitution is written, it actually encourages a lack of continuity. And that's a problem. The terms for local government is 3 years. When I first became a congressman, it takes you a few months to learn the business and to make your connections, to network, etc. If, for example, you are not particularly favored in the majority, passing a law in a year and a half is not that easy to do. After about a year and a half, you already hear that there's somebody in your district beginning to campaign and is going to oppose you in the next election. So you have to go back to your district to take care of that. And how much work do you get done?
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Bringing you the latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
Equities right now in the S&P 500 looking to snap that 3-day slide. We're positive by not even 0.1%. We're down 1/10 on the Nasdaq. The bond market getting tons of attention. We've talked about it a lot. So you get a 20-year bond auction later on this afternoon. Typically, who would care about a 20-year bond auction? But lots more people do, because we're at 5.30 on 30s this morning. We're at 5.28. Yields just about unchanged. Under surveillance this morning, crowding out the bond market.
The demand for AI remains insatiable.
This is the 4th record month for the IG issuance.
Some of those hyperscalers, despite what you're hearing, are able to come to the market at concessions of maybe 10 or 15 basis points.
Traditionally, you have a crowding out when yields get high enough, but that crowding out now faces a challenge from other needers of capital.
So here's the latest this morning. Hyperscalers crowding out U.S. Treasuries in the race for capital. Big tech on track to issue a record amount of debt this year, helping to push U.S. government borrowing costs to multi-decade highs. Lindsay Rosner of Goldman Sachs writing, it's a market where there are places to play and places to avoid. In terms of hyperscalers, we are underweight in IG, given supply. Lindsay joins us now for more. Lindsay, good morning.
Good morning.
It's good to see you. Can we talk about that crowding gap, that phrase that's been thrown around quite a lot. Where do you stand on that? How much crowding out do you see?
Yeah, so that's actually not our thesis. We don't think that there's a crowding out. This year, you flashed the numbers. We're at 1.5 trillion in issuance in IG. That's up 34% year over year. Remember, the IG market is 10 trillion. How you think about how that supply has affected the big level of IG, you look at spreads. There are 81 basis points on the index, 3 wider on the year. That's not crowding out. In terms of hyperscalers, there has been a lot of issuance, but we are seeing that the market is handling it appropriately. And what that means is they're baking in risk premium, that we're seeing anywhere between 20 to 50 basis points of additional spread required to get the deals done. But the deals are absolutely getting done. And I don't think what's happening in the back end of the curve in rates is because of the IG supply.
Well, let's just spend some time on IG and then we'll get to the back end of rates. It's been orderly. I agree with you.
Yes.
Credit spreads are basically unchanged on the month, unchanged on the year for IG. I think they're tighter on the month on high yield the last time I looked. So you're not seeing that bleed into wider spreads. Good. What are you seeing at the hyperscaler level? How much wider are they trading compared to, say, other similarly rated debt in IG?
Yeah, so it depends. There's a menu. You have AAA all the way down to BBB. In the AAA, you're actually seeing hyperscalers trade tighter than the cohort. They just have a ton of cash there. In AA's, you're seeing it about 20 basis points wider at the 10 and the 30-year point. And then when you get down into lower quality like BBB, that's where you're starting to see a little bit more spread. And what you see in BBBs is always the question of, does something move from investment grade down to junk? And I think that's what the premium is, because that's the toggle of, will there be so much issuance that it's pushed? We actually believe that the hyperscalers that have BBB ratings right now are solidly going to stay investment grade. So we think it's an opportunity there. This
is the difference between an Oracle and an Alphabet, maybe?
Yes.
I mean, I'm trying to work out whether you're saying buy Oracle right now.
Not going to give any buy issuance. I can't. But what I'll say is that I think that the market's been really orderly, and back to places you want to play and places you don't. I think you got to do the fundamental work to figure it out.
When you think about the next 12 months, the additional supply that everyone seems to be bracing for, no idea if that's the right word.
Yeah, no, I think
bracing
is right. It's actually the perfect word, because what's going on and part of the market discussion right now is there are bigger issuers in the investment grade market. Take the banks, right? Big difference is the banks tell you what they're going to do, how much they're going to issue, and it's not a surprise. They have earnings, they hit the market. We're used to that, and it's a muscle memory. When it comes to the hyperscalers, this is really new territory, and we're not getting a heads up of exactly what it's going to be, and that's what the market is grappling with. Now, is it too much? Our estimate for 2027 is something like $450 billion for hyperscalers. We think the market can handle that. What's going to happen, though, is we'll reach a point in investment grade where we do run out of space, just by nature of how the index works, the Bloomberg index. If you take the biggest issuer at 2.3%, it's JP Morgan. We're not close there on hyperscalers. They are each somewhere between 0.3% and 1.3%. A lot more to issue to get to that 2.3% level, but we feel like that is a cap.
When it comes to all this issuance, how much is that affecting the Treasury market as one of the issues that we see yields rising?
Yes, so there is definitely investors saying, what do I want to own? Do I want to own Treasuries? Do I want to own these companies where there's unbelievable demand for compute, demand for AI? Pick and choose your spots. Is it what's causing yields higher in the Treasury space? Sure, there's a little bit of hedging going on, but that's not the reason the back end is higher completely.
What's the reason?
Yeah, so a few things. We've got this continuing war. We don't know when it's going to end. We have a Fed reaction function. We are really still unaware of what that looks like. Maybe the minutes will give us a little bit more. I don't think we're going to get much, but let's see. And Jackson Hole, I'd say the same. And you've got a question of, is inflation actually going to come down? And is this a Fed that, through that reaction function, will actually be working on that? And then you've got global risk premium. It's not just a U.S. story. It's across the board.
See it in Japan, see it across Europe. You see it
That's
everywhere.
right.
We noted it in the last 24 hours repeatedly through most of this year. When you look at all-in yields now, 85% of the all-in yield really is coming from the risk-free rate.
That's right.
Then you're getting a little bit of spread. How concerned are you about what's happening with the so-called risk-free piece of that all-in?
Yeah, I think we are in learning mode. And I think that is what feels really uncomfortable right now. I think if we were dealing with this under the prior Fed regime, we know what to expect and we can forecast where things are going. Right now, we're in a little bit of a wait and see to the minutes, Jackson Hole, when the task forces are done, what they tell us. And so that, I think, is the nervousness that you see in the market. Are those base rates to us concerning that we don't want to invest here? No. We feel that you're getting compensated with actual real yields. That feels right. And the bigger picture is what is going on with the economy. And the economy is doing well. We've got close to trend growth. And we just went through a tremendous earnings season. We had unbelievable revenues up. Guidance is good. I think it was 10 out of the 11 sectors in the S&P are up and positive. There's only one that's a problem. This is a really good picture. And so, yes, those base rates are higher, but I think that's actually an all-in yield you want to take advantage of, not one that you want to be scared of.
It's orderly.
Yes.
I think we all see the same thing. It's orderly, and I think you can construct the argument, and you just did, that it's a reflection of better risk appetite and a firmer backdrop for the economy. But there is that moment when it might become concerning. And if it's not now at 5:30, can you give us an idea of when it would become slightly more concerning?
Yeah, I don't think that there is like one yield number that breaks the bank or breaks the U.S. government, right? Because that's who's issuing debt at that level. But it's something we need to watch. We certainly want to watch what is the deficit. By the way, it's growing and continues to grow. But it's what is the economy underneath it? And that, at the end of the day, still looks solid to us.
6%, persistent 6% budget deficits, even with a pretty solid backdrop.
We're at $40 trillion, and one of the biggest growing parts of the U.S. budget, you'd think, oh, maybe it's defense. Actually, higher than defense is the net interest payments we have.
Yeah. We
Massive.
had corrective action back in 23. Yellen had to respond to some of this. Do you sense that the Treasury might have to respond and do something here?
Well, the Treasury is very much on top of what's going on in the price of capital. You've seen that they've moved the issuance in the curve as a result. So they are already making moves. But it really is a much bigger picture on, like, what are we doing in totality on fiscal? And that's what the back end of the curve is telling you. We have some questions.
Lindsay, thank you. Just appreciate it. This is what you get from Goldman, isn't it? Just sort of cool, calm. Things are okay. It's
cool,
orderly.
calm, collective.
Spreads are still tight.
And also, earnings are doing very well. Everyone continues to say that, and they are.
Just had a 30% quarter, 30% plus.
And I think you made a really good point yesterday. When you look at survey data on the American consumer, it's not great. Everyone is frustrated. Prices keep going up. But then you look at the Bank of America credit card data, wow, the American consumer is holding up.
Lindsay Rosner of Goldman Sachs. Lindsay, thank you. It's good to see you. 30s this morning at 5:28 on 30s. 10s around 4:70. Up next, we'll catch up with the guy who coined the phrase bond vigilantes. Ed Yardeni of Yardeni Research joins us next. Plus, we'll speak to Henrietta Trays of Vader Partners, Brian Hamilton of LiveSwitch, and Gennady Goldberg of TD Securities, looking ahead to those Fed minutes later on this afternoon and counting down to an important speech in Jackson Hole, Wyoming, from the Fed Chair Kevin Walsh.
It's going to be incredibly important. Does he do a Christine Lagarde, as you said, and close spreads kind of vibe?
A clean-up act out of Wyoming, maybe. That speech about a week away from New York City. The second hour of Bloomberg surveillance just around the corner.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
You're going to see disruption in certain job functions. I don't see how that's not possible. And I don't see how anybody can look people in the eye and say that's not possible.
What percentage of customer service gets displaced?
It could be a large percentage of customer service. I think that function, I forgot my password, what's my billing amount? Those are all simple and easy things for an agent to go do. Like what we're seeing in our customer service right now is the rote stuff can be done by agents. More complex is a combination of an agent and a human working hand in hand to be able to satisfy that customer much better than either of them could do alone. And so I think you'll see all of those things happen, but I'm going to lean heavy, as I think all of my colleagues will, all the Fortune 100 will lean heavy on AI. You cannot be a part of this age without understanding the technological revolution. We have a responsibility to put serious money, resource, and effort into training not just our employees, not just people that are impacted, but the communities we serve as well, because that's the age we live in.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this yield forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
The Fed has kind of been served a bit of bond humble pie here.
The bond market and the Fed is telling you they think inflation is the bigger problem here.
The Fed's got to establish credibility and get a hold of the long end of the market.
It's meaningful when the yield curve steepens, when rates are at this high of level.
Well, there could be some sort of action designed to try and get those yields back.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now. In our price action, your scores look like this. Equities just about unchanged on the S&P following a 3-day losing streak on the S&P 500. On the Nasdaq, down by 0.2. In the bond market, 2s, 10s, 30s. Yields at the long end, 528. Supply later on this afternoon, 20-year bonds coming from the Treasury. And then 1 hour later at 2 p.m. You get some minutes from the Federal Reserve and Kevin Walsh.
And today the minutes are actually kind of important. It's because we have this big question mark about the Federal Reserve, their reaction function, and really a vacuum of communication from this Fed chair, which is why everyone is putting a little bit of an emphasis on minutes that normally wouldn't be a catalyst, especially for where yields are right now. Capital Markets had a note out. In the new world of terse policy statements, cryptic posts, confab pressers, and less forward guidance, basically, this is going to matter.
We're looking at a new price to clear supply. The price is higher. The yield is higher. And you can see that in the auctions of the last week or so, right? You saw it in a 10-year auction. I think the highest yield at auction since 07 for 30, since 01 in the market yesterday. Intraday, we saw the highest yield level in the market since 2007. And you saw some massive moves as well in places like Japan, building over the year. Just the intraday move yesterday wasn't a massive move. It was a couple of basis points on 10, 30-year treasuries, lower, by the way, at the long end of the curve. But it's the levels that start to get people maybe getting some more attention in a more sinister way.
I think when someone like me, who's focused on policy and geopolitics, start to actually care about bond auctions the way Lisa does, that is a signal in itself that this is probably very important. And we have gone through the levels where this president actually reversed policy on his tariffs because the bond market was getting yippy. This is not just a Federal Reserve issue. This is going to be something that the Treasury Secretary is definitely focused on. And I am reminded about what he said on this program when he was just Scott Bessent, the hedge fund manager, saying that Janet Yellen was performing stealth QE by moving issuance to the front end, something that, well, he's going to have to continue.
So usually when everyone else starts paying attention to the auctions, that's usually a good time to buy. when you start
There's
to
your
see...
signal, Wall Street.
When you start... No, I wouldn't go that far. Because usually what happens, the old cliche is when the policymaker starts to panic, you can start buying.
True.
I don't know if we're close to that point, but when you start to see the corrective action, when you saw the corrective action under the Yellen Treasury, that was the moment to start buying into Treasuries. I don't know how close we are to that moment, and perhaps that's the thing to watch. Maybe you get some corrective action next week from the man himself, Kevin Warsh, that needs to clean up some of the fallout from the news conference a few Wednesdays ago.
Usually people expect August to be a little bit sleepy, but not this one. And potentially now he has this bar, this high bar to clear almost in a way. Or maybe it's so low because people aren't expecting much that he is going to outline really what is his reactionary function. Maybe what we get in Jackson Hole is an extension of the people familiar in the Financial Times.
That speech is about a week away. Those minutes a few hours away. We'll get those minutes at 2 p.m. Eastern Time. Coming up this hour, we'll catch up with Ed Yardeni of Yardeni Research, saying it's not time to worry about the bond vigilantes. Henrietta Trays of Vader Partners, with data centers becoming a growing issue among voters, and Brian Hamilton of LiveSwitch on why Anthropic has the edge over OpenAI ahead of their IPOs. We begin this hour with stocks fluctuating following a 3-day slide as the global bond market rout weighs on investor sentiment. Ed Yardeni of Yardeni Research isn't pushing the panic button just yet, writing, "We've often said that we'll worry about the US government debt problem when the bond vigilantes begin to worry about it. In recent months, they seem to be stirring all around the world." Ed joins us now for more. Ed, welcome to the programme, sir. It's been orderly. The levels are eye-catching, I get that, but it's been orderly. They've not been sort of massive moves that I would say were disjointed or were overly volatile. Ed, from your standpoint, what is the dividing line between something you're comfortable with and something you're uncomfortable with?
I think 5%. We already had an example of sort of a mini debt panic back in 2023 when the bond yield went from 4% in early August to 5% on November 1st. And as Anne-Marie pointed out, Treasury Secretary Janet Yellen kind of saved the day by doing a mini QE and issuing more in bills. Basically telling the bond vigilantes, okay, I get it. You don't want me to increase the amount of money I'm going to raise in the bond market. I'll do it in the bill market. And it looks like Treasury Secretary Scott Bessent, who at the time thought that was a bad idea, is doing exactly that. So I think that'll help some. But look, a lot of this increase in bond yield so far this year occurred in March when the war hit and oil prices soared. So there was a lot of concern about inflation back then. And now the concern is what's going on in Japan, that the Treasury Secretary had to intervene to support the yen by selling euros, which was, I don't know if he got permission to do that from the Europeans, but that was sort of a shocker. And then, as you mentioned, we've got the total uncertainty created by Kevin Warsh, where he keeps saying there's a task force for that. And that means he's kind of cornered himself to do nothing until he hears from the task forces at the end of the year. Very bad idea.
Ed, we've lived with a lot. We've lived through a lot, certainly since the pandemic. This market's got through a lot. I recall a conversation I had with Bill Dudley, the former New York Fed president, where early on coming out of the pandemic, he was talking about Fed funds that might need to get to 5%. And at the time, it sounded absolutely crazy, because if you said to anyone in this market the Fed would take rates to 5%, they would expect the economy, both the economy and the market, to crater. Sure. And Ed, that didn't really happen. Do you think we can live with this?
No, well, you might recall back in the early part of this decade, I was one of the few who said that we're experiencing the most widely anticipated recession of all times. That isn't going to happen. It all speaks to the resilience of the economy, the consumer, capital spending. Look, my view is, I know I'm supposed to get all panicked here because I coined the phrase bond vigilantes, and so I should get everybody all stirred up that they don't like what's going on. But I think 4 to 5% is kind of back to normal. I really dislike that phrase that interest rates are going to stay higher for longer, because it implies that somehow or other we should be getting to lower interest rates. I think we're back to normal interest rates. 4 to 5% is normal. I think it's a healthy sign of a healthy economy. It's a sign that the capital markets are properly allocating capital and the economy can deal with it just fine.
Ed, leverage and debt, is the backdrop for that built up over the last decade plus different to what things looked like pre-GFC? Because I hear that a lot. Pre-GFC, we're going back to normal. This is what it used to be like before we had the era of repression. Ed, do you see the backdrop as different, though? So, yes, we're going back to normal for yields, but is the backdrop different for leverage, for the debt levels? Does that make it more complicated?
Well, the debt levels are certainly higher, but everything is relative to the size of the economy. The debt levels are elevated, but they're not. You don't want to compare them in absolute terms. And everybody keeps talking about the $40 trillion of government debt. If you take out the government investments in its own debt, sort of the government buying its own IOUs and Social Security Trust and other areas, we're talking about $31 trillion that's held by the public. Now, I know that's a lot of dough as well, but everything is relative. And until recently, nobody was particularly concerned about things. The auctions were going perfectly fine. In 2023, it was the auctions that got everybody spooked. But at 5%, a lot of people said this is a great yield. And we may get to 5% this time around, and I think you'll see the same reaction, that this is a great yield to lock in.
Ed, on that $40 trillion of debt, and you've noted this in your research, we're paying $1 trillion a year in interest. At some point, do you expect policymakers to do anything?
Yeah, well, you quoted me as saying that I'm not going to worry about the debt situation until the bond vigilantes worry about it. So, I'm realistic. I have my eyes open. I was getting jittery in 2023, and the Treasury came in with the issuing more bills. And I'm concerned. I'm not going to tell you that I'm not concerned. But then again, I've been talking about 4 to 5% as being the new normal range. So I'm not going to particularly get freaked out by the fact that we're getting closer to the top of the range. Quite the opposite. I see it as a good opportunity to buy bonds. And with regards to the interest issue, it is a big deal. But at this point, I think the auctions will tell all. At some point, we may very well have what people like Ray Dalio have been saying could be an imminent debt crisis. But we do seem to be able to put it off for a bit. When I coined the phrase bond vigilantes in 1983, I went back and read what I wrote. And I wrote that the bond vigilantes were very upset about $250 billion deficits. Now we're talking about $1.5 to $2 trillion, and we're still basically at normal bond yields.
At competition with equities, you mentioned that maybe there's an opportunity to buy into bonds. Where does that leave you call on stocks?
Well, I'm still using 8,400 for the S&P 500 by the end of the year. Actually, I just kind of revived the Fed stock valuation model. Back in 1997, I coined the phrase Fed stock valuation model just in time for it to stop working. And now there seems to be a tight correlation again. They're tracking each other closely again, which is the 10-year bond yield and the S&P 500 forward earnings yield. The forward earnings yield is simply the reciprocal of the forward PE of the S&P 500. And at 5%, let's say we get to 5%, 1 divided by 5 gives you a 20 fair value multiple. Well, that's kind of where we are right now. And I think, meanwhile, earnings keep going up. I think by the end of the year, the market's going to be discounting $415 a share for earnings next year. Right now, the analysts are already talking about 408, so that's not a big call. 415 times, let's say, 20.24 is what it takes to get to 8,400. And I think we're still going to get there. Look, semiconductors had a bad day yesterday, but it's not because analysts lowered their heady earnings expectations. It's because the PE came down. They're getting cheaper.
Earnings have been tremendous, without a doubt. Ed, thank you, buddy. It's good to see you. Ed Yardeni there of Yardeni Research. Pretty comfortable with where bond yields are at right now, and comfortable buying into this equity market too, following a 5-day slide on the semis in yesterday's session. Equity futures at the moment just about positive on the S&P 500, with an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Good morning. Iran is weighing attacking U.S. military targets in Europe. The Financial Times reporting 2 regime insiders said forces have assessed striking U.S. assets in southeastern European countries if President Donald Trump escalates the war. Pennsylvania Governor Josh Shapiro ordering strict new guardrails to limit new data centers in the state, requiring that new developments obtain local approval to receive state permits for the projects. The new rules will also push projects to find local sources of clean energy. Moderna and Merck announcing their personalized cancer vaccine helped cut the recurrence of melanoma in a large late-stage trial. Shares of Moderna surging on the news, the results marking the first positive final stage trial for any mRNA-based cancer therapy. And that is your Bloomberg Brief, John.
Vonnie, thank you. More from Vonnie in 30 minutes' time. Up next on the programme, the growing backlash against AI.
We know AI is unpopular. We know specifically among younger voters, so 18 to 29. The concerns are really electricity inflation and what you're paying for your utility bill.
Up next, Henrietta Trays of Vader Partners, live from New York City this morning. Good morning.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Coming up later on this afternoon, this is what it looks like. Fed minutes at 2 p.m. Eastern Time. 1 hour before that, some supply. 20-year bonds coming from the Treasury. Increasingly taking on a bigger focus given the moves we've seen over the last several months. That's the week ahead. Here's the story in the market right now. Equity futures on the S&P 500 just about unchanged, slightly softer on the Nasdaq. In the bond market, 2s, 10s and 30s. Fixed income getting tons of attention. Big focus on what's happening on the supply side, not just from the Treasury, but also from corporate credit. We caught up with Lindsay Rosner of Goldman Sachs about 20 minutes ago. It's important to point out that, yes, we've had lots of supply. We had a record August for investment-grade supply, record July, record June. We're tracking to top 2020 for a record annual year, a record year of issuance from investment-grade issuers. And yet still, on the year and on the month, investment-grade spreads are only wider by about 3 basis points. The move, the higher capital prices that we're paying up right now, driven almost entirely by treasuries and what's happening at the long end of the curve. So what do you need to fix it? This from Ganeet Dhingra over at BNP Paribas. Either one, 30-year bond yields keep rising as Fed credibility remains in question, or two, the market needs to price 3 to 4 hikes, i.e. higher front end and long end yields before yields can stabilise. So Ganeet is basically making the point, we'll catch up with him later this week, that to settle this situation, you need higher yields from here, which is probably not what the Treasury wants to hear at the moment.
You have to have maybe some bad reactions, so then you get a good outcome potentially from the Federal Reserve. Mark Cabana yesterday was basically saying, I know everyone's talking about all these issues maybe affecting the long end, but it really comes down to the Fed. And it comes down to the fact that basically a question mark was left. after that press conference. It wasn't whiny bond market. It was the fact that the bond market was left basically to a lot of open-ended questions from this Federal Reserve. And the chair has a chance to maybe make it a little bit clearer next week.
Every new Fed chair makes mistakes. Every central banker at some point makes mistakes. But there was some rookie-level stuff in that news conference, right? We talked about it yesterday. A couple of things worth pointing out. Not really committing to the way we measure inflation right now. Kind of gives people the idea that
Can't
maybe...
move the goalpost.
Right, we'll move the goalpost. 2, on the primary tool to address inflation. Balance sheet, maybe, maybe not the interest rate policy. That's rookie-level stuff too. That all contributed to a lot of that stuff, to the uncertainty around interest rate policy. It's not been helpful. It doesn't help also because we've got a really unforgiving backdrop right now with crude, and you can check out crude this morning in the 90s again, at 92. And I think that's worth pointing out repeatedly. The backdrop for mistakes and communication errors is really unforgiving worldwide.
It feels very fragile right now when you have higher energy prices, and it's not just been for a few weeks. And of course, crude and WTI, maybe they're higher, but then look under the hood in what's going on in jet fuel and gasoline. These are some of the concerns that why I'm so excited to hear from the Walmart CEO. He said if these prices continue to go higher, it might start to affect how we have to price some of our goods.
Brent crude close to 92 so far this morning. Let's talk about the politics under surveillance this morning, the growing backlash against AI.
We know AI is unpopular. We know specifically among younger voters, so 18 to 29. The concerns are really electricity inflation and what you're paying for your utility bill. That is more a phenomenon at a regional level rather than national, but it's certainly part of the discussion and part of the reason we're seeing this real political constraint in building out these data centers.
So here's the latest this morning. Pennsylvania Governor Josh Shapiro ordering strict new limits for AI data center build-outs. Anne-Marie, we've seen this in New York. You've seen it in Texas. You're now seeing it in Pennsylvania, and you're seeing it show up as a topic of concern heading into the midterms.
Doesn't matter if you are running a red or blue state. The fact of the matter is right now, poll after poll, and there was a recent one in Pennsylvania, 75% of voters say they do not want a data center in their community. And Josh Shapiro is really having to walk this fine line because he wanted the tech companies to come into his state to have this capital investment. At the same time, he doesn't really want them to build data centers, so he's trying to put some more guardrails. I think this puts the president in a very interesting position. I remember being in a cabinet meeting where he showed Meta's new data center they were building in Louisiana. He was so excited. He was like, look at his size of Manhattan. This is going to be amazing. And then it's like, ooh, actually, voters don't want this. Doesn't matter if you're a Democrat or Republican. They do not want this. And you brought up a great point. What does this mean for the race for China? Very challenging.
To build on this, Henry Desrays of Veda Partners writes the following. There is a tremendous amount of risk coming for big AI. State-level policies will become a model for the federal government. Henrietta joins us now for more. Henrietta, welcome to the programme. We can see how this is building up heading into the midterms. How do you think this builds heading into 28?
I think this is going to be a major 2028 story. Right now, Democratic leadership are saying, hey, keep the conversation on AI. As your last guest just pointed out, I mean, you're talking about the cost of electricity. You're talking about the actual monetary cost of having these data centers. But the agita underneath the surface is so overwhelming that pollsters are having an absolute field day, finding that Americans would rather have nuclear waste in their backyard than a data center. Anne-Marie, you bring up Louisiana, where I live. I mean, you can go and talk to the folks where those data centers are, and they'll tell you they don't want to not be farmers anymore. They don't want to not have the roads that they were used to. They don't want new schools. They don't want any of the benefits that the AI community or the administration has tried to sell them on having this big black box in their district. They don't want it. They'd rather not have the tax revenue. A fascinating data set from last night out of Pennsylvania is a special House race at the state level in the 12th district, where they flipped a seat that Trump won by double digits to Democratic control. So this agita is all over the place, as you rightly point out.
How do politicians talk about this? Because it's not just Pennsylvania and New York. It's Texas. At the same time, they want big tech companies to come into their state for capital investment and jobs.
Yeah, they think it sounds good for the job creation part, but that's not where American voter sentiment is. The conversation is going to start when we ultimately get around to tackling AI. First of all, we have an incredible catalyst in that there's going to be 63 new members of Congress at least next year. These are fresher faces. They're younger folks. They have an AI plan that's 10 or 15 points long, waiting in the wings. And we really just need to get some fresh blood, younger blood in Congress to have this conversation. And when we get into 2027 and 2028, I think the presidential is going to be very much about AI, and the affordability narrative or inflation and prices are always going to be important. But child protection, consumer protection, data center build out, and then just generally where are our jobs going? That will be the pillar of whoever is running in 2028 across Democratic and Republican lines.
Jonathan brought up a great point last hour in terms of Beijing. China is racing in terms of trying to be on par with the United States, and China doesn't care and will just dictate where every single data center goes. At some point, are we going to have to see a national response?
I mean, it's a Democratic disadvantage. When you get elected and you get ousted by voters who don't like what you've done, it's not the Communist Party. That's something that is just a truth. The thing that I hear most amongst investors is this concern about the United States government having an ad hoc, very chaotic policy. I'm reminded of maybe a month ago when the White House just banned Fable and the international community was like, hey, we were using that. And maybe we should go to China because at least we know they're not going to shut it down. We don't have this arbitrary, not cohesive policy that we can deal with on data centers or access to AI or open AI. And that's very much a situation that the federal government's going to have to work out. And again, I think that's a 27, 28 story at the earliest.
But that's what I'm trying to get at. What could that cohesive policy be? Do you think they're going to have to just allow data centers writ large, mostly across the United States, because we cannot lose to China?
I think so. I do think that that is the case. And you're going to see rollout wherever is possible. And as Americans hopefully get a little bit more comfortable with understanding what AI is going to bring, that will be conducive to the conversation. But China absolutely has an advantage here in that they do not need to coordinate with their public. U.S. politicians need to do that. And I would say that they do not have a cohesive plan or strategy yet to roll out and really make that understood by the American public. It's a PR disaster, as I mentioned. I mean, if you're polling worse than nuclear waste, I can't help you.
Henrietta, thank you. Henrietta Trace there of Vader Partners. It's a PR disaster for the tech firms themselves. And in many ways, they've exacerbated these problems, given the way they talk about the technology and the impact it might have.
Like you're not going to have a job?
Right.
That doesn't help.
How is that going to help you with voters right now? And it was always going to become a political issue. I think it's just become a political issue much more quickly than some people anticipated.
Well, it's a political issue because people are concerned about affordability right now. That is the everyday concern for Americans at the kitchen table. And it's just following from COVID. This is what the problem is, because data centers mean potentially higher electricity and higher costs for houses that are close to that data center. So that's the primary concern. And then it becomes not in my backyard, will you take my jobs, et cetera, et cetera.
NASDAQ futures this morning down by around 1/10%. Equity futures on the S&P just about positive. In just a moment, we'll catch up with Brian Hamilton of LifeSwitch on why Anthropic has the edge over OpenAI going into their blockbuster IPOs potentially over the next 12 months. Plus, Yahira has some morning movers for you. Moderna surging on promising results from a new vaccine. Their stock is up big time in the pre-market. More on that in just a moment. From New York City, you're watching Bloomberg TV.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg. Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Stocks this morning doing okay, finding a firmer footing. We're just about unchanged on the S&P 500, down over the last 3 days by a little more than 1% on the S&P. On the Nasdaq, chips getting hammered in the last 24 hours, down 5%. That was the worst day so far this month. In August, on the Nasdaq 100 this morning, we're down by close to 0.2%. In the bond market, yields shaping up as follows. 30s in focus, around 530 at the moment. We're just about unchanged on the session. Yields came in a few basis points in yesterday's session, given all the jitters worldwide from Japan to Germany to stateside. In the US, the highest yields we've seen since 07 or so. In Japan, some of the highest yields we've seen going back to the 90s at one point. And we've seen that repeatedly on occasion throughout the year so far.
We are at decades high, and we just heard from Edgar Denny, the individual who coined bond vigilantes, and he's like, I'm not nervous. He feels like this is a normal range that we should be trading in. And right now, he's still laser focused on the fact that it's not impacting the earnings story. And that's all that matters right now.
That's kept this equity market so insulated. We came into 2Q looking for earnings of something like 20%. That's a really big number. We got something north of 30, which is a monster number. That's the kind of number you expect in a recovery coming out of a recession. Not like this in a year like the one we've got with GDP close to 2%. You don't expect to see massive moves like that in earnings.
And also a plethora of issues right now that individuals are contending with, whether or not it's conflict in the region, it's higher yields on the Treasury, the fact that we have all this issuance coming from hyperscalers. The fact of the matter is the earnings continue to chug along.
Crude, 92, check it out. Energy and that conflict across the Middle East, energy still elevated, 92. That is taking the temperature of what's happening in the Middle East right now. And what's happening in the Middle East, no one really knows. And that's the problem. When the president says there are no talks, there's no planned talks, we're kind of in no man's land right now. And this is the uncomfortable new normal we've talked about in this program repeatedly. We're right in the heart of it.
And the president says that the strait is open, yet 3 Chinese tankers, as of this morning, were forced to turn around. And is that because the Iranians, is that because the U.S. blockade? There's a lot of questions about how much crude is actually getting through the Strait of Hormuz. We know a lot of individuals are getting crude out through transponders. And then this story in the Financial Times has me thinking that Iran is really acting very aggressively. Is this to negotiate potentially with the United States? Or are they serious about really wanting to ramp up in terms of sending messages to the U.S.?
Brent crude higher by 0.7%. Counting it down to the cash open. 2 hours away. Let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. We start with the biggest gainer in the pre-market, and that is Moderna. Look at shares up more than 60% in the pre-market after a major breakthrough for its cancer vaccine with Merck. The vaccine used with Keytruda helped stop melanoma from coming back or spreading in a late-stage trial. And the reason this is significant is it's the first time an mRNA cancer therapy has succeeded in a late-stage trial. So that gives Moderna its strongest evidence that the technology that it used for its COVID vaccines could become a whole new way of treating cancer. So a potential major game changer there. Meanwhile, it was a beat and a raise quarter for Target, and yet shares are slightly lower, down 1%. But when you look at the results, you can tell that this turnaround is working. This is a company that has been trying to win back shoppers, for example, by doing things like bringing in trendier groceries, and that is starting to pay off with both traffic and comparable sales up. But as you mentioned earlier, the issue is shares have run up more than 55% year to date. So investors had a lot of that comeback already priced in. And it's another turnaround story for Estee Lauder, but those shares doing better, up 7.8% after the beauty giants beat on sales and profits and ended 3 straight years of declining revenue. It shows that it's pushed to cut costs, speed up product launches, and reach younger shoppers is starting to pay off. John.
Yeah, Harry, thank you. I had to give Moderna a double take. That's a huge move in the pre-markets. Some of the single names going into the cash open to look for over the next few hours or so. On our radar this morning, the cost of AI debt is soaring, with Alphabet selling Australian bonds at a record cost. The tech giant selling $3.9 billion of debt at a near 7% yield at the long end, the deal attracting over $12 billion of demand. Elsewhere, SK Hynix ADR is getting a boost after unveiling plans for a $29 billion share buyback. The chip maker also boosting shareholder returns and pledging to increase free cash flow to more than 50%. And finally, Anthropic moving to give the CEO, Dario Amodei, extra voting power ahead of its potential IPO. The information reporting the AI company is also planning on maintaining its non-shareholder trustees and elect the majority of members to its board of directors.
So I look at this, and on one hand, I'm like, what are they so worried about in terms of outside investors, maybe activist investors? On the other hand, this is very familiar for tech companies. We saw Snap do this. Obviously, Mark Zuckerberg has this when it comes to Meta. So it's not actually surprising. Obviously, the timing makes you think we are really on the precipice for this IPO.
He's part of the problem, the politics. We've been discussing it.
He's trying to sort it out, but it's not working.
I don't know how he sorts it out. Every big headline I could think of in the last 5 years that's been, or 2 or 3, stretching the time frame here.
It feels like 5.
Every headline I can think of, every story that's been written associated with job losses in this technology, his name's somewhere in that article.
White paper from Anthropic.
Right? His name's somewhere in that article. How do you turn that around? How do you change that?
That's one of the issues he has. The other issue, of course, he has, and this is where they have been trying to work it out, at least in the Oval Office side with Susie Wiles and the president, is obviously they have a very difficult relationship with this administration, so far that I still can't get over the fact that the DOD has Anthropic as a supply chain risk.
Yep.
That is something that the DOD has for Chinese firms. So they have a very difficult relationship with this administration. And at the same time, the public has a very, not a great view of AI in general, partially because of the white papers coming out of Dario and Anthropic and how he talks about it.
The political backdrop is getting worse, not better, let's put it that way. Let's stick with Anthropic. The Wall Street Journal reporting the Claude maker's sales for the second quarter topped OpenAI for the first time. This is both tech giants are racing towards blockbuster IPOs. Brian Hamilton, the chair of the enterprise software firm LifeSwitch, writing, "In the land of the insane," which is anything about AI, these are sane buying opportunities. Anthropic looks like a better buy based on just the financials. Brian, I'm pleased to say, joins us now for more. Brian, it's always good to see you, sir. Thanks for making some time for us. What do you think is the appropriate multiple to put on trading sales for a company like Anthropic, like OpenAI?
Great question. If you double a penny every single day for 30 days, as you guys know, it's $3 million. So these companies are growing incredibly quickly, Jonathan. Look at Anthropic. They grew 800% last year. I've never seen a company grow that much. So it's very difficult to peg these multiples. So they're going to be about 25 to 30 times trailing revenue. That's not super crazy relative to the market.
Is the price of that growth getting more or less expensive, Brian?
I think it's getting less expensive. You know, remember we talked about SpaceX and, you know, those guys came out at 100 times revenue. And now they've doubled their revenue. They're down to 50. So the key is this, growth. And they're spending a lot of money. But remember, guys, their net profit margin, they're losing money, but they're losing less money per dollar of revenue. So their margins are getting better. So it's really crazy. It's a nutty market. I haven't seen anything like this on the multiple side, Jonathan. But I think 25 to 30 times revenue is not super nuts, and I think people will make money. By the way, particularly people who invest pre-IPO, as you know. So I think they're going to do well. Both companies are at about $1 trillion in valuation right now, Jonathan. And if you look at the revenue, that is just, I mean, it's amazing. They're just growing like crazy.
Brian, can we just build on margins and pricing power specifically? Is there a risk that some of this becomes commoditized and ultimately they lose pricing power? Are you seeing that happening at all in any way, shape or form?
Yeah, no. Great question, really is. But here's the thing. We see it in other huge industries, Jonathan. You start with a bunch of companies and it starts collapsing and these guys get market power. I do not see that as a risk. I see this the opposite side. We're going to get an oligopoly where we get few companies who have pricing power. It's an old tech move. It worked with Uber. It works with big companies with tons of capital. You throw tons of capital and you get the market and then you have pricing control. So I don't see that at all. Now, maybe I'm wrong. I'm wrong a lot, but I don't think on that point.
Brian, everywhere you look, whether it's data centers, whether it's polling about concern about jobs, whether it's red states or blue states, there is a massive political risk right now for these companies. How are you weighing that?
Man, wow, what a great question. You guys are 2 for 2. My God. I think there's a big difference between the public and angst, and I don't want to understate that. But look, the companies are growing quickly, and you got to look at it. There's a difference between what the public thinks and what the investors are going to think. I think these companies are going to do well, and I hate saying it, and I don't like saying it because the implications of AI. You guys were talking about the Middle East before. What's easier to talk about, the Middle East or AI? They're both very complicated issues, and I would say AI is more complicated than the Middle East. We don't really know, but there's a lot of public angst. I don't want to understate that. But will that have an effect on these companies? It's just they're growing. I mean, look at ChatGPT, 800 million weekly users. So people are upset about it, Anne Marie, but they're using the technology, and the companies are growing. I mean, it's just sky high.
Well, Dario Amodei said himself, half of all entry-level white-collar jobs would vanish. Do they need to change their approach on how they communicate their technology to the public?
Yeah, wow. These are tough ones. I started early on in AI, neural network stuff about 25 years ago. I won't bore you with the details. These guys run good companies. They're growing very quickly. Will that happen? I don't know. Even in the Industrial Revolution, that didn't happen. What happened was we had a lot of money come in, a lot more economic return. These companies invested back in and created jobs. I'm not a huge buyer that these jobs are going to go away. Now, maybe they know something I don't know. So again, it's the difference between, hypothetical situations of what's going to happen in the future and what's happening with the companies today. So that's just a big unknown. It's a great question, but nobody knows. And I don't think they know either.
Brian, just a final question, the backdrop. I think you mentioned SpaceX. Does the post-IPO SpaceX experience in the stock market reshape the approach of these companies as they come to market? Not at a fixed price, maybe lose some of the hubris that we saw a little bit on Wall Street coming into the summer. Right. Do you see a different approach?
I don't know. I think, Jonathan, there's a big difference between SpaceX. I mean, SpaceX came out, as you guys know, I think way overvalued. I mean, the market's up and down right now with regard to the company. I don't know. But here's the thing. If you look at the growth rate of these companies, look at the net profit loss margin. You got to look at the margin. Anthropic is at negative 33% right now from a negative 81% last year. So the margins are getting better. So I think they're two different animals. I really do. And I think it's just nuts. I mean, Anthropic is about $1 trillion in valuation right now. They could come out at $2 trillion in valuation. It's amazing. But if you look at the growth rate, all bets are off on the valuation. I don't think it's a terrible value, actually.
The numbers are incredible. Brian, appreciate your time, as always, sir. Brian Hamilton there of LiveSwitch. We're going to see 1, 2, 3, the biggest IPOs we've ever seen in the history of capital markets.
Incredible. Anthropic is going to be incredible. OpenAI is going to be incredible because of the revenue these companies are bringing in, and how much everyone is valuing them right now and their future.
That's the latest on the race to IPO. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. A big upset in Florida's Democratic Senate primary. Democratic Socialist Angie Nixon beating the establishment candidate. With 99% of the votes counted, Angie Nixon defeating Alex Vindman 56 to 44%. Nixon will go on to face Republican Ashley Moody in November. Primary in Alaska could determine control of the Senate in November. With 70% of the vote counted, Democrat Mary Peltola and Republican incumbent Dan Sullivan will advance in the state's open primary. Peltola has 47.3% of the vote to Sullivan's 44%. TikTok is exploring a feature that would allow users send money to each other in direct messages, a move that would extend the social media app's push into financial services. TikTok Pay is currently only available in Vietnam, Malaysia and Thailand and is used to pay for TikTok shop purchases. And that is your Bloomberg Brief. John.
Bonnie, thank you. More from Vonnie next hour in 30 minutes' time. Up next on the programme, repricing risk.
The Fed has kind of been served a bit of bond humble pie here. I think it's still a market that recognizes, okay, the Fed is going to probably sit on the sideline for now. We still don't really understand what the longer run plan is. Investors are demanding greater compensation.
Mark Cabana of Bank of America has just been on fire the last couple of weeks. We'll extend the conversation with Gennady Goldberg of TD Securities, who will catch up with him on the other side from New York City. You're watching Bloomberg TV.
Anything we do in Africa is going to be more risky than the US. I think the approach we want to take is, how are we being compensated for that risk? And one of those is obviously going to be a valuation question. In our minds, valuation is a lot more attractive in Africa, even if we adjust for some of those Africa risks that a lot of Western investors see. So yes, in a lot of ways, you take some of those models that, as I said, might be more asset medium or asset heavy. There might be some more inherent risks. However, if we're saying we're adding some risk because of that kind of model, but we're now solving a core problem as opposed to maybe a nice to have solution in Africa, that might actually offset it. Where if you're solving something that people really absolutely need and can't live without, in a way that then that's a lot less risky. So again, we'd encourage investors to have a less binary view. In other words, the US isn't risky, Africa is risky. That's going to lead to a lot of complications down the road.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
Equity futures this morning just about unchanged on the S&P 500, finding a firmer footing so far in the session. The Nasdaq down by 0.2%, following yesterday's slide. At the epicenter of that slide, some weakness in the chip stocks. The semis down 5% in Tuesday's session. Into the bond market, 2s, 10s, and 30s. This one, the main event going into next week in Jackson Hole. 10s around 470 still, 30s still around 530. Under surveillance this morning, repricing risk.
The Fed has kind of been served a bit of bond humble pie here. I think it's still a market that recognizes, okay, the Fed is going to probably sit on the sideline for now, but we don't know where they're going to be over the longer run. We still don't really understand what the longer run plan is. And as a result of that, investors are demanding greater compensation to extend out the curve.
So here's the latest this morning. The Treasury sell-off easing ahead of the Fed minutes and today's 20-year bond auction, but markets expecting loose fiscal policy and stubborn inflation to keep rates elevated. Gennady Goldberg of TD Securities writing, "We believe the long end has been subjected to death by 1,000 cuts." Gennady joins us now for more. Good morning. Good to see you.
Good to see you.
Everyone's always looking for that one simple explanation for something, but I'm struggling to do that with this bond market. Are you?
Yeah. I mean, I think everybody likes to have their pet explanation. I've heard, one of the reasons we wrote the note was everyone's reached out with, do you think it's this or do you think it's that?
Confirming the price.
Right. And really, it's everything. It's a little bit of supply side, a little bit of demand side, and a little bit, as Mark said earlier, it's a little bit of this, what's the Fed's reaction function? We just simply don't know.
So how easy is it to fix, given it's been death by 1,000 cuts?
I think you can still turn the ship around. I don't think it's a lost cause by any means. I don't think things are so bad that they're unfixable. Chair Warsh gets another chance at bat next week. Let's see if he makes anything of that. I think the bond market sort of read him Miranda to some extent. I mean, if you think about it, they've basically said, we need, if you do not give us your reaction function, one will be assigned to you. And the one they're assigning to him is not the one that the Fed necessarily wants to be assigned.
Is there a tactical opportunity to get long into Jackson Hole?
I'm a little bit nervous in the very short term. The amount of conviction I hear among investors is just rock bottom. I mean, I feel like that's been the case basically for the last year. It has just been really, really low right now. And it's because of this combination of factors. It's supply side, it's demand side, it's the Fed. So, yes, the Fed can start to right the ship, but you also need the Treasury to start to play ball. And they've sort of started to kind of talk about maybe reducing long and auction sizes. But it's this global rise in rates that's really got everybody worried. So the worry isn't the next 12 or 24 months. Everybody knows that yields will do just fine over that horizon. The worry is the next 3 to 6 months. Maybe I get in at 470 on 10s, but perhaps they'll go to 5%, and I've actually missed the boat.
But the question is, the Financial Times gave the appetizer for how he actually feels. Don't you think in Jackson Hole he basically needs to socialize this and communicate this in a speech?
I think that's the assumption. The problem is we don't know. I mean, look, he could come out and just tell us nothing once again. And do we know that the FT was sourced from people who are actually close to the plan? I think that was an attempt to damage control, but we'll see if he does it again. I mean, so far, he's not given us all that much to chew on.
Who do you think is whining? And I don't mean to be cute here. Is it the bond market that's whining, or is it actually the Fed saying you've got addicted to this forward guidance? The bond market's like, we're actually not asking for forward guidance. We just need to understand your reactionary function.
I think the bond market isn't whining. I think the bond market's speaking. And when the bond market speaks, people listen, because it does tend to send, shockwaves through the system. We don't know where the instability lies. One of the things I was discussing just yesterday, everybody's worried about this move higher. Why isn't volatility higher? Well, it's been a slow bleed. And the longer this goes, the more likely this is to create some volatility in the system. And we don't know where the shockwaves will actually end up.
You mentioned the reaction function. I think there is a sense of an understanding of the committee's reaction function, given the way we rallied at the front end following weaker than expected data over the last 2 weeks. 2-year yields came in because people believe that'll keep their Fed on the sidelines. That's not uncertainty. What's curious to me is whether there are market participants who believe because they're going to sit this out, that's a problem. And I think that's a different kind of question.
I think so. To their point, I think a lot of the FOMC members in that core, the middle, so your Wallers, your Williams, the folks who are kind of teetering on maybe we should hike rates, maybe we shouldn't, have kind of hinted that their bar for hiking rates is actually a lot lower. Now, it's a little bit tricky when you don't have the data you need to kind of justify your move. But if that's the case, then the market will be a little bit more, I would say, kind of heartened by that. Now, if over the next couple of months the data just kind of continues to come in middling, we get core PCEs at 0.22s, 0.23s, the labor market stays pretty firm, that could continue to weigh on the long end. And I think that's the danger here, is that we're still sitting it out. The market's going to assume the Fed just kind of keeps coasting. And I think that's the danger here. So the question is, why not get ahead of it and actually hike rates? But they kind of need an excuse.
So you think hikes would help the long end?
I think so. I think the curve would flatten materially on a rate hiking cycle. It's not going to be one hike. It never was. If they do hike, and it's not our base case at TD, but if they do hike, it's going to be at 50 to 75 basis points.
What's your base case?
Our base case is a hold. We think they actually try their best to hold through it. Obviously, the risk case is by September, by October, that you actually get enough to hike rates.
So if you're at a hold, that takes care of the front end of the curve. Where's the long end going out to?
I think we hover around here. I don't think we break out to 5%. I think 5% is a good line in the sand. I think there's enough investors who are keen to pick up 5%, both in real and nominal terms, by the way. Real rates are actually quite attractive as well.
If they hold in September, and I know you're a base case hold for the whole year, but if they hold in September, there's no way they would be able to hike in October. Do you think politically?
I think they can. I think if you start to get 0.3s, 0.4s on inflation.
Before midterm election, days before?
They've done it before. They cut into the last election. So at the end of the day, they're going to, it's not something that really, enters their thinking as they're trying to do things.
Can they hike before the task forces give us, their prognosis of what's going on at the Fed?
I think so. I mean, I'll put it to you this way. I think we're actually very, very close to a September hike. Even though it's not our base case, I think the bar is actually incredibly low.
What do we need? We've got one more payrolls print, one more CPI print. What tips us over the edge?
We get a 4%, unemployment rate for good reasons, not for bad reasons. We get 150 to 200K payroll, and we get a 0.35 to a 0.4 on core PCE. I think that core of the committee, your Williams, your Wallers, your Cooks, your Jeffersons, are really going to consider it. And we know 3 of them already want to hike. They dissented. You don't need that many more people to basically overrule the Fed chair.
Gennady, it's good to see you. As always, thank you, sir.
Thanks.
Gennady Goldberg there of TD Securities on this bond market, death by 1,000 cuts. There are many, many reasons for this move.
But potentially one way to ameliorate all of this is for Kevin Warsh next week to come out and just run through to the world what his reactionary function is and how is he thinking, and kind of clean up the press conference.
If people want him to hike, let's just get to it. This whole conversation about reaction function, I get it, I understand it. I'm right there with you. There's some things that need explaining, but the move we're seeing is people actually asking for tighter policy from the Fed. And Mike McKee was pretty direct about it. He said in the news conference to him, you keep talking about it, you're going to do something about inflation, but you keep doing nothing. When are you going to do something?
Which begs the question, if he keeps talking about it, he is an inflation hawk, especially given his prior time at the Fed, does he actually need to prove he's going to hike to remain that credibility?
Up next, we'll catch up with Liz Ann Sanders of Charles Schwab, Sucharita Kodalia Forrester, the former St. Louis Fed President Jim Bullard, and Jeannie Sun of Citi Wealth. The third hour of Bloomberg Surveillance just around the corner.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, succession starts now.
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacqua. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream. And a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years, and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start on the third floor or the lobby. You actually have to start in the basement.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
We've had a very good rally in stocks, particularly off of the summer lows.
The appetite for risk is still exceptionally strong.
Things are not as screaming a buy.
It's fair to be skeptical. It's fair to be careful about it.
There is room for this to continue.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now. Bramo back tomorrow following that bond auction later on this afternoon. She's missed out the last few days. Your scores look like this morning. Equities just about unchanged on the S&P 500. The Nasdaq down by 0.25%. Into the bond market, 2s, 10s and 30s. Things settling down. Well behaved so far this morning. Yields coming back in by another 1 or 2 basis points at the front end of the curve, back to 415 on 10s at 468. We're down a basis point or 2 at the longer end of the curve. Here, looking out for the next 24 hours or so, I mentioned that 20-year bond auction taking place this afternoon at 1 p.m. Eastern Time. Also, 60 minutes later, the Federal Reserve and those meeting minutes taking place. We'll get those meeting minutes at 2 p.m. Eastern Time.
And there's this greater emphasis on these minutes because of how Fed Chair Kevin Warsh described the Federal Reserve meeting and basically the questions he left the whole world following that press conference. Everyone wants to learn from the minutes. Maybe potentially we understand a little bit more about his reactionary function from these minutes. It's become a catalyst when normally you would just look through that. No one would care about this.
Yeah, the goal was to de-emphasize a lot of this, I think, when Kevin Warsh came into the Federal Reserve, and now it's like every little detail gets more and more attention. Every speech from every Fed president gets more and more attention. And this was always the risk. Whenever the incoming Fed chair, whenever we talked about it, at every opportunity, we talked about a man who was going to try and de-emphasize communication, reduce communication. And we always said, you just outsource communication to somebody else. You put even more weight on someone else's speech. Jim Bianco of Bianco Research said it well. You've now got 12 individual policymakers, right, with equal power and equal weight. I don't think we're quite there yet, but increasingly that's the direction of travel over the past few months.
I mean, you said this a number of times going into that race, and then once we heard it was Kevin Warsh and how he wanted to conduct the communications over at the Federal Reserve, even though it's a task force looking into that right now. In the meantime, if he's not going to come out and be able to really describe the consensus of the committee and have the backing, what it feels like the committee, which doesn't sound like he does given that Wall Street Journal report, well then who's going to fill that void? Everyone else at the FOMC.
Pull up the bond market again this morning, 2s, 10s and 30s. The Fed chairman's had a role to play. That is undeniable. You saw it in the move, in the news conference, at the long end of the curve. Without a doubt, that much is true. We said earlier this morning, though, the backdrop in fixed income at the moment is so unforgiving. It's almost unfair to anyone new to step into this seat and try and make any kind of changes. He's going to have to learn to read the tea leaves right now. The tea leaves aren't great in fixed income. The problems are building beyond just the shores of the United States. We've talked a lot about what's happened with Japan. It's obvious why the Treasury Secretary got very nervous about the Japanese monetizing dollar reserves, because we're seeing these kind of moves at the long end of the curve.
Right, which is why we saw yen-intervention, and then likely, I can imagine, a phone call, and then you're seeing some policymakers come out and say, okay, maybe we'll have to hike interest rates. And it's not just Japan. It's Germany. It's France. It is worldwide. And on top of that, you also have massive amounts of issuance going to down under in Australia when it comes to hyperscalers. And you still have an inflation backdrop when it comes to higher energy prices. And you have the fact that more governments are just spending more to insulate their consumers and to expand their defense budgets because there are multiple conflicts right now in the world.
Let's talk about the hyperscalers. You mentioned it. Let's talk about the political backlash.
It's bad.
That you're covering in greater and greater detail heading into the midterms. At what point does that become a market story? Because it's certainly become a political one, and it's become a political one very quickly.
Well, I've been asking a lot of people about this, and they kind of brush me off. Well, you're the politics person, you have to ask this. No, this is a political story. There's a moratorium on data centers in New York. Josh Shapiro, who went out there and told the tech companies like Amazon, please come and invest in our state, is now putting guardrails around data centers. In Texas, there is concern about this. It doesn't matter if you're a governor in a red or a blue state. The consumer, your voter, is saying the same exact thing. I do not want a data center here. I do not want electricity prices to go up. This is going to be a huge story for not just this midterm, but 2028. And I can't see a scenario where both candidates are going to have to line up on this, because this is bipartisan.
Nasdaq futures this morning down by a few tenths of 1%. Coming up this hour, we'll catch up with Liz Ann Saunders of Charles Schwab as elevated bond yields weigh on equities. The former St. Louis Fed President Jim Bullard on why now is a good time to raise interest rates, and Jeannie Sun of Citi Wealth on deepening exposure to the AI theme. We begin this out with stocks steady following 3 consecutive days of decline. So Liz Ann Saunders of Charles Schwab writing yesterday's action was defined by bond yields and oil prices, a double squeeze on risk sentiment. Liz Ann joins us now for more. Liz Ann, welcome. Always good to catch up and get your response to what's happening in markets. That double squeeze has been on for months and months and months, and really started at the beginning of March. And this equity market has tolerated it pretty well. Do you sense a change, a turn?
Maybe at least in the short term. And it is still the case that if you look back on a rolling 1 month or rolling 1 year basis, the correlation between bond yields and stock prices is for the most part negative. And I think that's actually an undertold story right now. We're focused on the short term and the implications of certain levels on the 10-year. And I think it's level, it's velocity of move, it's volatility, but it's also the shape of the yield curve. And that drives whether we're seeing significant concerns about an economic impact or a market impact. But if you widen the lens a little bit, it's important to understand that well, I think everybody understands we've definitively left the Great Moderation era that went from the late 1990s up until about the 2022 inflation spike. Almost that entire period, with a little bit of an exception around the global financial crisis, bond yields and stock prices moved in the same direction, because what bond yields were keying off of was the growth side of the equation, not the inflation side of the equation. But you go back and you look from the mid-60s to the late 90s, more than a 30-year period of time, you had the opposite relationship. Bond yields and stock prices were inversely correlated, and that's because bond yields were keying off the inflation side of the equation, not the growth side of the equation. We've been calling that the temperamental era. I think we've exited the Great Moderation. We may be in an era that looks a little bit more like that prior era.
So, Liz Ann, some people are saying that's the return to normal. Can you build on that? Do you think it is the return to so-called normal pre-GFC?
Yeah, and I heard my friend and your friend Ed Yardeni on this morning, and I think to some degree this is a return to normal pre-global financial crisis era. So I think there's also this context problem here with the move up relative to the post-global financial crisis backdrop. I don't think that was the norm. I think the norm pre-existed the global financial crisis. And that's why I think we're not seeing such a dramatic impact either on the economy or the market. But I think it's also the shape of the yield curve that matters. We're so focused on levels at 470, is at 5%, as you were talking about with Ed. I think as long as the yield curve, which has been steepening, is in a structure that is somewhat supportive for the economy, I think it's therefore also somewhat supportive for the equity market. But I think we're in a secular shift here that's not getting enough attention.
Liz, what do you expect we're going to hear from the Fed minutes and then the Federal Reserve Chair? Because maybe if they're not entirely responsible for this, they're part of the problem.
Well, you guys just were talking about it in the lead into this segment. And this was something that I had interesting conversations with clients in the immediate aftermath of Kevin Warsh getting the nod to be Fed chair, and what could he do, and won't the administration influence him to change interest rate policy to cut rates. But you're right to reinforce what has always been the case, which is this is a committee of 12. So it's 7 members that have to agree on any kind of monetary policy decision, including not doing anything. And Maria, I agree with you. I think these are louder voices almost by default or by virtue of Kevin Warsh not being as communicative as he has in the past. Whether it's the markets that test him or that, or whether it is the press that tests him on that, I'm not sure he can continue in this environment of being somewhat closed-lipped when there are still a cacophony of speakers on the Fed that, to your and John's point, matter in terms of voting for policy changes.
So how important is next week? You know, we're in the middle of August. Next week, a catalyst for financial markets?
I think next week is important, certainly from a Jackson Hole perspective. The September meeting is important. We're watching the fluctuations in things like the CME Fed Watch tool, looks at the Fed funds futures market with every incoming data point. But I think we're at that moment where the pressure is on for Warsh to say something more, even if the Fed doesn't do anything in September. For greater commentary on, as you've been talking about all morning, what is the reaction function? Kevin Warsh wants to establish what has always been the hawkish credentials around inflation, but what do you actually do about that? And I think the bond market already is sending that message. And I think we'll more directly get that message from people like you, from the press, who have an opportunity to kind of press this, certainly at the point we get to the September Fed meeting.
Lizanne, you know that line, that when they start panicking, you can start buying. Do you think we're close to that?
So I'm not the bond expert, as you guys know. That's what you have Colin Martin on for. But I think that from a level perspective, I agree with Ed. I'm not sure, in the lead in to going north of 470 again, that was seen as a level, if not an actual technical level that matters or an economic level that matters, but a psychological level. I think we're okay around here. I think a move closer to 5% probably is the thing that might rattle the market, akin to what happened in 2023. I think if it becomes disorderly, like was the case in the aftermath of Liberation Day, then I think it's a bigger problem for the equity market. An orderly move, less of a problem, but I think that next psychologically important point is 5% as a feeder into what the equity market will do.
This has certainly been orderly so far. Lizanne, it's good to see you. Lizanne Saunders there.
You too.
Of Charles Schwab on the latest. Always appreciate Lizanne's experience. Really echoing something we heard also from Wells Fargo and Tom Porcelli. People love to use the phrase higher for longer. We actually detest that phrase, mostly because it's widely inaccurate. We would argue a far better characterization is normal for longer.
Yeah, this does feel like potentially we are going back to what? Pre-financial crisis levels in terms of higher yields. The problem, though, of course, is the fact that this is an administration that this might be too high for them. And I'm just always reminded of the president's reactionary function himself on policy. When the bond market started to get, in his words, yippee, yields went higher after his Liberation Day and the Rose Garden and all these tariffs after tariffs after tariffs, he reversed course in the end.
And yields now are higher than they were then.
Which is why you think potentially this is definitely getting his attention and the Treasury Secretary's
Look, the problem is so much of it is out of their control to some extent right now. You're seeing these global forces build and build and build. Equity futures on the S&P 500 just about positive. Let's get you an update on news worldwide this morning with your Bloomberg brief. Bonnie Quinn has more. Hey, Bonnie.
Hey, John, thank you. Iran is weighing attacking US military targets in Europe. The Financial Times reporting 2 regime insiders said forces have assessed striking US assets in southeastern European countries if President Donald Trump escalates the war. President Trump is pushing aids for a meeting with North Korean leader Kim Jong-un as soon as this fall. The Wall Street Journal reporting Trump is hoping to revive a diplomatic quest to convince Kim to abandon his country's nuclear weapons program. TJX shares lower in the pre-market after the company announced forward earnings guidance that underwhelmed investors. The discount retailer reporting comp sales for the second quarter that beat analyst estimates, and the CEO saying it's planning to accelerate store openings to 4% next year. And that is your Bloomberg Brief, John.
Bonnie, thank you. Stocks down 4% in the pre-market. Walmart 24 hours away. Up next, the morning calls. Plus, we'll talk about the retailers with Sucharita Kodalia Forrester as retail earnings ramp up through the week. From New York City this morning, good morning.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Then comes the question as to whether or not these interest rates will actually weigh on earnings growth, because it has been strong earnings growth that has forgiven all sins for this market. At this point, there seems to be no sign of that, but certainly that would be something to watch.
Cam Dawson of New Edge Wealth, looking at this bond market. Let's look at this bond market right now. 2s, 10s, and 30s. Look at the 30-year piece. You spent a few weeks away for summer, whatever it might be. You do your thing. You come back to work, and I say to you, based on the headlines, what do you think the 30-year bond yield has done through the month of August so far? What would you guess? You'd be like, it must be up like 15, 20, 30, 40, I don't know, 50 basis points higher. Everyone's freaking out. Yields on the month are flat on a 30-year. They're actually flat. They haven't done much. We've broken through these levels in the last 24 hours that we haven't seen since 2007. And yes, there was a move, a material move following the news conference with Chairman Walsh that is notable. What's more notable for me is that actually we've just hung out at these levels for longer. So it's not like you've had a massive explosive move through the month of August, which is why so many people are comfortable with it. It has been orderly. But we're holding out at these levels for longer, and you see that both in bonds and in crude. And Liz Ann Sonner was talking about this. It's like the double squeeze. It's coming from yields, it's coming from crude. Just holding on to these levels for longer.
And there's so many issues at play right now, which Mark Cabana yesterday, really amazing interview and kind of funny. He's really going after the Fed in the way that it's up to you guys, to Fed Chair Walsh, to really go out in Jackson Hole and have some clarity with us in terms of what is your reactionary function. At the same time, because it's been holding out at these levels, as you've mentioned, Jonathan, really giving that context, it makes sense that it's a number of issues at play here. Oil prices, the Federal Reserve, fiscal spending, the tech issuance. It's a dog pile when it comes to this bond market.
But even for the tech issuance, right? IG spreads, investment-grade credit spreads, we've just had a record month of supply. Following a record month of supply, following a record June, right?
Yeah.
3 months, breaking records for June, July and August. Only halfway through this month. Investment-grade spreads this month are virtually unchanged. I think they're wider by 2 or 3 basis points on the month, likewise on the year. The bigger move has actually been at the front end of the Treasury curve. It's been on 2s. Down at the front end by double digits off the back of weaker than expected data. So for all the complaints about a lack of understanding about what this Fed's going to do, I think for the committee as a whole going into the September meeting, there's an understanding based on the incoming data still, even with the absence of an understanding of where the Fed share stands on a bunch of things. It's an understanding that based on the data over the last week, there's less of a chance that they hike in September.
Right, given the data, I think it would be hard for the doves to cross the line and say, yeah, this month makes sense for us to have a hike. Everything has been softer, barring New York Empire manufacturing. Everything has been on the sides of the doves. And if they don't go in September, I don't see a scenario. I know we just spoke to a guest who said they could. They've done it before into an election.
It shouldn't matter, but people
I just think,
yeah,
I think a few days ahead of a big election, you hike, it's not a good look for anyone.
That's the bond market picture. Equity futures this morning on the S&P just about unchanged, on the Nasdaq down by 1/10, unchanged likewise on the Russell. That's the equity picture, the equity story going into the open in about an hour and 10 minutes away. Let's get you some morning calls. First up, Evercore raising its price target on Dow, saying an underappreciated storage portfolio can accelerate profit. Your second call from Jefferies upgrading Dollar Tree to hold, citing a return to basics and improving traffic. And finally, Bank of America cutting its price target on Home Depot, noting supply chain costs are weighing on margins. That name is down this morning. It's down by close to 1%. It's weighing on margins because you can't pass it on to the end consumer right now. That tells you something about the inflationary backdrop. And it's not the hawkish story you might be told by some Fed officials.
No, right now, it's just too expensive. I mean, I'm actually in the middle of a renovation, but that's a different story. But
prices are
prices are incredibly high. So people are doing some of their own stuff at home. You do it yourself. They're buying their own power tools. But yeah, it's incredibly high right now, even though Home Depot did actually have some decent numbers.
That does not scream hike interest rates based on what we've heard from that one company alone. Let's talk about the retail earnings then. In full swing, the bar is high. Target failing to impress despite signs that its turnaround efforts are gaining traction. Wall Street now gearing up for Walmart results due out tomorrow. Sucharita Gadali of Forrester joins us now for more. Sucharita, welcome to the program. Let's just park the stock move, the intraday move, the pre-market price action, because we had such a massive run-up in Target. Based on the results themselves, are you seeing signs that that turnaround over at Target under new leadership is starting to bite, starting to make a mark?
Yeah, absolutely. They seem to have raised their outlook for the year, which is impressive in an economy that is still a little bit questionable. The consumer still seems to be resilient and is spending a lot. However, when we're looking at consumer confidence numbers, those are still stubbornly low. And the truth is we are in a K-shaped economy, and the consumers that Target is trying to serve, those consumers are often shopping at places like Walmart and increasingly Amazon now. So I am impressed, but cautiously optimistic for what is to come in 2026 and 2027.
What's been the main driver of the turnaround that you think is actually working for the company?
A significant part of what had been Target's problems were related to store operations and just being able to clean up literally and figuratively the merchandise in the store, getting prices to price parity, getting beyond some of the controversial actions they took on social issues over the last few years, and just really focusing on ultimately delivering consumers essential goods. So that, I think, is really a significant part of it. I think that they're also trying where possible to get back to their roots of creativity and also having strength in some of those aesthetic areas like fashion and home as well.
How high was the bar, though, for today's report, given the fact that it's just been an absolute sky-high stock this year.
Yeah, I think that's probably some of the opportunity is that you have investors taking gains right now. There were some pretty strong buying opportunities for Target in the last year because the stock had been so low. And for the investors, I think that did buy it then, I think that they're looking for probably a little bit more of a flat line in the coming months. However, the stock number, the earnings numbers today were strong. And it seems to suggest that Target is on a trajectory to get back to its record high numbers from the pandemic and the years following that, because it had a pretty significant drop off in revenue subsequent. So I think that there's positivity ahead. And when there is momentum like this, it's a good sign for the company.
Whose lunch are they eating? Whose business are they taking away? Is the pie getting bigger or are they taking market share?
I do think that they are taking market share. My hunch is that they are, as I've mentioned, some of those essential figures are probably very strong, and some of the companies that are losing while Target may be gaining now are some of the traditional grocers, some of the regional grocers. So that's likely where we're seeing some of the erosion. When you look at some of those fashion categories, it could be some of the smaller fashion e-commerce merchants, or even some of the decline or the flatlining that we've seen in companies that were in hypergrowth mode for the last few years, but now seem to be stalling, like Temu and Shein.
Sucharit Gadali there of Forrester, the latest there on Target, taking market share and the price to pay at some of the discount retailers like Temu and Shein that we've been talking about.
So two things at play there. When it comes to Shein, all that like kind of trendy things you can buy cheaply, maybe even Amazon. One thing that Target used to do well in the past, and I could speak from experience, I loved when they did that Mazzoni collaboration. I'm pretty sure also it crashed their website. People were excited to get Mazzoni in an affordable way, and the products were cute. There were lines out the door. At the same time, we've also seen consumers go to places like Walmart, where maybe you remember Walmart as being like the place to go after Christmas to get electronics that are very expensive, to go get groceries.
Black Friday.
Yes. But now at Target, they've also expanded in terms of their offerings when it comes to groceries. So it's that two-prong approach, and also leaving the politics in Washington.
Walmart tomorrow morning. That's going to be a big focus for us as well. Walmart's a difficult one for me. When the Walmart numbers are good, people say it's really bad because everyone's shopping at Walmart because things are so tough. And then Walmart numbers are bad. That means it must be really, really bad. We play that game all the time.
I think, honestly, everyone shops at Walmart from the high end to the low end.
I agree with you.
100%. And if you go to cities that are outside of New York or Chicago, Washington, D.C., that are a little bit smaller, Walmart is the center where you can buy literally everything, even high end.
Walmart this morning in the pre-market higher by a few tenths of 1%. Up next on the programme, we'll catch up with this guy. Looking forward to this, the former St. Louis Fed President, Jim Bullard, and why now is a good time to raise interest rates. Plus, Shahira's got some morning movers. Another check on Moderna. Double take. That stock is up by 86% in the pre-market. That's the intraday move. That's crazy. It's next.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersecci in El Ola, Saudi Arabia, and this is Bloomberg.
Stocks this morning unchanged on the S&P 500, going absolutely nowhere. And the Nasdaq 100 this morning unchanged as well. The opening bell about 60 minutes away. Let's get some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We start with the biggest mover in the pre-market, and that is Moderna, soaring 85%, while Merck also soars. And all this is after a major breakthrough for a cancer vaccine with both those companies. The vaccine used with Keytruda helps stop melanoma from coming back or spreading in a late-stage trial. And the reason this is significant is it's the first time an mRNA cancer therapy has succeeded in a final stage trial. So this gives Moderna its strongest evidence yet that the technology used in its COVID vaccine could be used as a whole new way of treating cancer. So a potential game changer there. Let's turn to the retail earnings that we've gotten this morning. We start with TJX, shares falling 5% even after the company beat on comparable sales. This has been a retailer that has benefited from consumer unease as they look for value, but now the company wants to ramp up store openings starting next year, and that's where some of the investor unease is coming from, maybe worried that they're getting too aggressive at a time when the outlook on the consumer still feels a bit shaky. And we end on Lowe's, another retailer reporting earnings this morning. Shares are down 3% after the home improvement retailer cut its full year outlook, now expecting comparable sales to be flat. They told us what we heard, similar to what we heard from Home Depot yesterday, that consumers are still putting off those bigger home renovation projects as higher borrowing costs make those projects more difficult to finance. And of course, elevated mortgage rates keep people from moving and taking on those projects. John?
Yahara, thank you. Thanks for this morning. Lowe's is down about 3% in the pre-market. The next stop, we've talked about it repeatedly. We'll hear from Walmart in about 24 hours' time. Let's talk about the Federal Reserve. Very close-up picture of the Federal Reserve there. Beautiful building. Lots of problems with that building. We'll avoid those problems now. Wall Street awaiting those minutes from that Federal Reserve meeting from just a few weeks back. Mike McKee has a preview. Good morning, Mike.
Good morning, John. You've inspired me here in terms of that building. Of course, it doesn't look like that right now because it's under construction again. But the minutes aren't going to look necessarily like the minutes used to. For years, we've seen them kind of diminish in importance because we know a lot about what happened based on what all the Fed people have been telling us. But now they're not supposed to talk as much, and Kevin Warsh keeps telling us or teasing us with what we don't know. So this could be one of the beginning of a new life for Fed minutes. And the first question is going to be a question of many, some, several, or few. How many people actually would have voted against or voted for raising rates, at the last meeting if they all had votes? We know there were 3 dissents, but were there more people who voted but said, oh, I'll go along with the chair? or people who didn't vote, as Albert Musalem and Austin Goolsbee have told us, who would have, if they had had a vote, who would have decided to vote for it. Other questions, what are their forecasts and risks evaluations? We're not getting that from Kevin Warsh now. What was the sense of the committee in terms of what's going to happen next with the economy and with inflation? We heard about this idea of Kevin Warsh's that he floated, having fewer meetings during the year for the Open Market Committee. Let's see if the minutes flesh that discussion out and see more about what they were talking about and how that idea was received on the committee. And finally, we'll probably learn a little bit more about the task forces. They no doubt discussed.
Yeah, Mike, I'm going to jump in, buddy, because I want to jump to the bond market just quickly. Yields coming in just a little bit, and I want your reaction to a statement, Mike, we got from the Treasury just moments ago. It was on liquidity support buybacks beginning September 9th. So this is from the Treasury. Mike, you follow this stuff as well. I'll share this with you verbatim as we go through it in real time. The US Department of Treasury is increasing by at least double the size of liquidity support buyback operations for longer dated nominal coupon securities, 10s to 20 sector and the 20 to 30-year sector. The current maximum size of $2 billion per operation will be at least $4 billion per operation. This change is effective September 9th. If you can bring up the bond board and show the reaction as I read through this. Treasury will provide more information about future buyback sizes at the next quarterly refunding scheduled for November 4th, 2026. This increase in buyback operation sizes reflects Treasury's desire to provide greater liquidity support in longer-dated nominal sectors where there is consistent, strong sponsorship from market participants, as evidenced by the significant volume of high-quality offers Treasury routinely receives in longer-dated buyback operations. The move at the long end off the back of this statement, Mike, is notable. You've got a move of 6 basis points on 10s, close to 6 basis points likewise on 30s. Mike, what's your reaction?
Well, the timing is certainly interesting for this announcement, given the way the bond market has been trading over the last week or so, because essentially they're pushing up rates again, which the president is very opposed to. And it makes it much more difficult for the government budgeters who are working up on Capitol Hill. The idea of the buybacks is they buy back old off-the-run securities that are not heavily traded anymore, and that puts more people into the current on the market securities, which then creates more demand for it, would raise the prices, and then, in theory, lower yields. So we'll have to see how this all works out. The market had anticipated something like this, but the Treasury has been telling us at refunding that they weren't going to make any changes for quite some time. And now it looks like maybe they're being forced into it by the way the market's moving.
Mike, that feels like the first sense of blinking maybe at the Treasury, and maybe that's a little bit too strong, but the first step of corrective action to help put a lid on what's developing at the long end of the curve. Is that fair?
Yeah, that's fair. And I think that's probably the idea behind it here. They haven't had scale in terms of buybacks in order to really move the markets, but this is the first sign that maybe they're moving in that direction.
Mike McKee with the latest. Let's bring up that bond board again. 2s, 10s and 30s, and you can see this at the long end of the curve, 10s and 30s, that piece of the curve, yields coming in. We're down by 6 basis points on 10s, 30s down by 7. I actually think the market's taken a while to kind of process and digest what we're actually seeing from the Treasury right now. I'll go through the headlines again for you. That the US Department of Treasury is increasing by at least double the size of liquidity support buyback operations for longer-dated nominal coupon securities. The 10-year to 20-year sector and the 20-year to 30-year sector. The current maximum size of $2 billion per operation will be at least $4 billion per operation. This change is effective September 9th, will be effective for the remainder of this refunding quarter. Then this line as well. Treasury will provide more information about future buyback sizes at the next quarterly refunding scheduled for November 4th, 2026. The next quarterly refunding is going to be really, really important because we're going to have a conversation about whether we do actually change the size of longer dated issuance from this Treasury. We're now down 8 on 30s to 520. I'm not going to say the Treasury Secretary just blinked. I'm going to say this got his attention and he's responding to it.
I think that's fair to say this got his attention, especially when he is very keenly aware of what higher yields mean to our economy, to the American consumer, to this president. And the fact of the matter is, and I'm looking at what Zero Hedge is writing out right now, that resolves the debate whether Treasury buybacks are mini QE once and for all. And you're right to push this forward to the refunding announcement. This is a Treasury Secretary who went after the former Treasury Secretary, his predecessor, Janet Yellen, for issuing on the front end saying it was stealth QE. Well, what's he going to do when he's faced with higher yields?
We'll keep going back to this bond market board. We're now down 8 basis points on 30s, down to 520. And if you start to think about the intraday move on the 30-year Treasury and think about the highs of yesterday's session and compare it to where we are now at 519 on 30s, the highs of yesterday's session were 534. So you're talking about a 13, 14 basis point move in 24 hours, encouraged by this action from the Treasury just moments ago.
So it definitely got the Treasury's attention. We know that. And also, how much does this help Fed Chair Kevin Warsh next week at Jackson Hole when he's not facing maybe potentially as high as yields we were facing, say, yesterday? It almost feels like, once again, Scott Bessent to the rescue?
Yeah, we'll see if this sticks. It's important, it's timely, and the timing is getting our attention heading into that 20-year bond auction later on this afternoon. The former St. Louis Fed President Jim Bullard joins us now for more. Jim, I just want your reaction to the initial move from Treasury just moments ago. Does this help bring some stability to this bond market?
Well, the market reaction suggests that this is an important tactical move from the Treasury, a little bit unexpected, so you're probably getting outsized reaction right now. But I don't think it changes the fundamentals of big fiscal deficits and a Fed on the sidelines, which is what's driving longer-term yields higher.
Just on the deficits and on the supply more specifically, Jim, I think there's a belief that this might be the first step of maybe a few steps, and the next step might be to tighten up issuance at the long end of the curve again. Would you assume that's the direction of travel now into the next quarterly refunding later on this year?
Yeah, you could see that, and markets would have to react to that, and of course, supplies is critically important for the traders. But I don't think for the macro economy, that doesn't change the fundamentals. Unemployment, 4.1%. You've got inflation on PCE basis, core PCE basis running over 3%. The committee's still expecting over 3% at the end of this year, even with good inflation reports between now and then. You've got, longer-term yields, 30 years up over 5%, 10-year, heading toward 5%. You got to take some policy action here, I think, either on the deficit side or on the monetary policy side in order to make sure that we don't get too high of yields.
Well, I think you're seeing that policy action right now, and you're seeing the move in markets too. Yields down by 8 basis points at the long end on 30s, back to 520. That relieves some of the pressure in equities. Equity futures higher by about 1/3 of 1% on the S&P 500. Jim, we can park that for now. What's the role of the Fed in all of this? That's the important question for you, sir. Does the Fed have a role to play here to help stabilize this bond market?
Oh, absolutely. I think that the fact that the committee is projecting core PCE to be above 3% at the end of this year, that would be the same as in 2023, 2024, 2025, and now 2026. So that looks like a 3% inflation target. They have to take action to convince markets that they really want to get inflation back down to 2%. And Chairman Warsh has done a good job in saying that that's what he wants to do, but the market is going to want to see action. And why not take action? GDP now for the third quarter, up at 4%. You've got equity to, or let's say wealth to disposable income ratio at all-time highs. That's fueling ongoing consumption. Unemployment rate very low, claims, initial claims very low. So it looks like you have a good labor market. So it's a good time to reestablish credibility on inflation fighting and go ahead and make a move. You probably wouldn't have to do too much now, and then that'll save you from a headache that you might develop for 2027.
So are you saying that they should hike in September?
Well, I'd consider it. I don't think it's too bad of an idea. I think that markets are saying that, well, the jobs report was a little bit mixed, although unemployment is low. And overall metrics on the labor market seem to be that the market's in a good equilibrium. So, why not go in September? Or if not, then at least give a signal that you might go later in the year. Ironically, the September meeting has the most forward guidance of any meeting because the dot plot plots out what you might do over the next 90 days, over the remainder of 2026. So I'm wondering if Chairman Warsh will abolish the dot plot for this meeting. He could use Jackson Hole to do that, or whether he would let it go, and then the committee might come in and say that they're not planning to do too much, according to the dots anyway, not planning to do too much by the end of the year. I don't think markets would probably like that, and you'd see higher, longer-term yields.
Jim, before we get to September, I just want to stay on July, just for a beat. Some minutes coming out later, Jim. Now, typically, they're not that important, but this feels slightly different because we had a clean-up effort in the Financial Times for the Fed chair following the news conference. What would you look for in these minutes?
Well, the minutes are going to sound hawkish, you would think, and I think the tone of the meeting was pretty hawkish, and you did have the dissents and so on. You probably have other members, we know, I guess, that you have other members that are sympathetic with the dissenters, so the committee is very much split. That's what will come out in the minutes, but there has been data between then and now that has changed the complexion slightly, certainly a weaker inflation report. Although I would say that most recent inflation report really came in right on target. So it wasn't really like it was a soft report. It was like as expected, and maybe some relief that it wasn't hotter than expected. Then the committee would have really been under pressure.
Jim, it's good to see you. As always, thank you, sir. Thanks for reacting to that breaking news. Jim Bullard there, the former St. Louis Fed president, suggesting that maybe they should be hiking in September. We've got to get back to this story. Check it out, 2s, 10s and 30s, and look at 30s, down by 10 basis points at the long end of the curve. Your 30-year right now, it's a break of 520 after being north of 530 this time yesterday. This from the Treasury, announcing increasing sizes of buybacks, liquidity support buybacks, beginning in September 9th, so in a few weeks' time. The U.S. Department, according to them, the U.S. Department of the Treasury is increasing by at least double the size of liquidity support buyback operations for longer-dated nominal coupon securities. The current maximum size of $2 billion per operation will be at least $4 billion per operation. This change is effective September 9th. Will be in effect for the remainder of this refunding quarter. Treasury will provide more information about future buyback sizes at the next quarterly refunding. That next quarterly refunding scheduled for November 4th is going to get even more attention because people will start to assume this is the first step of a number of steps, and the next step might be to tighten up issuance at the long end.
Right. And Jonathan, you know this better than anyone else. Do you think that this is Bessent potentially signaling to the market that he is going to come in when yields get too high consistently? And do we now learn something from this, that there is a pressure point for this administration?
I don't know if he was concerned about the liquidity intraday in the last 24 hours. I wouldn't know. He'd have to speak for himself. I would say this, though. Clearly, the level has got their attention. And clearly, the fallout of the news conference has got their attention as well. You can see that based on how he responded to events in Japan. The nervousness he had, based on their own actions, about monetizing dollar reserves and trying to make sure that didn't happen. You can see that these levels have got the attention from the Treasury. I think the signal is obvious now too, and that's what the market will be queuing off. Less so the liquidity support, but the signal it provides, the next step. It's always the next question. OK, you've done this, what are you going to do next? People will just assume now they're going to be tightening up issuance at the longer end of the curve. I'd also add this in as well. If the Treasury is watching these levels, then surely the Federal Reserve is as well. And this is something that Mark Cabana alluded to. The Treasury Secretary's been meeting with the Fed chair. You'd have to assume they've met since the last meeting happened.
Oh, of course. They meet every 2 weeks.
Right? What does this mean for Jackson Hole a week from now?
And
the Treasury's done their piece. What's the Fed's role in all of this?
Yeah, and potentially is there a little bit of a nudge from Scott Bessent to Kevin Warsh on what really he should be saying when he speaks at Jackson Hole? And really, it's going to be a landmark speech for Kevin Warsh, his first at Jackson Hole as the Fed chair. Also, we have a 20-year auction today. Do you think this means there's going to be more decent demand now for that 20-year because the man who is self-described as America's top bond salesman has come out with this move?
Yeah, he certainly helped support that 20-year issue a little bit later on this afternoon. So I can tell you, yields are down at the long end by close to 9 basis points. It alleviates some of the pressure in equities. We were flat We're now positive by close to 0.5 on the S&P. In just a moment, we'll set you up for the day ahead. Plus, we'll catch up with Jeannie Sun of Citi Wealth on deepening exposure to the AI theme. Looking forward to that conversation. We need her reaction to this bond market move. Live from New York City this morning. Good morning. This is Bloomberg Surveillance.
How do you see AI changing gaming and game development in the future?
Look, I think the biggest thing that I'm thinking about is how do we just make sure it's solving problems. On the game development side, I've gone to a lot of our studios, with big and small, and I'm blown away with how they're using AI in the production pipelines, how they're using it for iteration and prototyping. That's not production ready, there's still work. And 30% of game development is software, and so there's the traditional applications that we see in enterprise. At the same time, I do not think AI will replace AAA games. I think it's entirely possible, though, that AI represents a new category of games and a new type of development and enables more people to create and participate. And we'll keep an eye on that, and we'll see how we best serve that.
The world's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
My view is, I know I'm supposed to get all panicked here because I coined the phrase bond vigilantes, and so I should get everybody all stirred up that they don't like what's going on. But I think 4 to 5% is kind of back to normal. It's a healthy sign of a healthy economy.
That was Ed Yardeni of Yardeni Research. Well, someone at the Treasury got stirred up. Additional liquidity support coming into this bond market. You could see it at the long end of the curve as they announce increased sized buybacks. Yields down by 8 basis points at the long end, 520 on 30s, leading to this move in equities higher by 0.5% on the S&P 500. Pleased to say we've got Jeannie Sun of Citi Wealth with us around the table. Jeannie, good morning. Good to see you.
Good morning. Nice to be here.
Thanks for dropping by. Your reaction to this, just some stability maybe in the bond market. Does that provide some support to stocks?
Look, I think the dynamics that we've been watching is there's definitely been more volatility overall and a lot of concerns, right? When we talk to our clients, the wall of worry that they've been climbing is not insignificant. That said, fundamentals, especially in equities, continue to be very, very strong. What's interesting about this announcement is, in general, historically, these types of announcements by Treasury are really to manage liquidity, but
we also know that we've been watching as well, just the increase in rate volatility. That's probably something that's going to stay, because if you think about like going back to fundamentals, not just in equities, but also in fixed income, the fundamentals would suggest that with sticky inflation, with just continued concerns about deficits, and also, candidly, growth has been relatively strong, you know, the pressure or the directionality for rates should be higher. And so for us, we're still sticking with the fundamentals. Equity fundamentals remain strong. Earnings growth has been incredible. And also on top of that, you know, watching rate volatility, and it influences just generally more conservative positioning in fixed income.
How insulated is this equity market with 30% earnings growth from these moves in the bond market? Is that comfort blanket going to be with us all year?
I think the fundamental side of the story should be, right? We've seen continued confirmation earnings season to earnings season, and it's not just in earnings growth and just, you know, the general like year-over-year changes. It's also what we're seeing underlying. There's, at this point, nearly half of the companies in the S&P 500 have expectations to grow CapEx 10% or more. So it's broader than just the AI story that people like to talk about. Now, that said, one of the things that is a part of our pillars of investing is just looking at sentiment, positioning, and I think that's where you're seeing some of this short-term translation. So if you were to say kind of like fundamentals is helping us understand the climate directionality longer term, you know, some of this volatility that we're seeing is a result of sentiment, positioning, sometimes being high and perhaps even a little bit crowded in certain areas. This is where that kind of like weather impact, and as we know, there's been a lot of weather.
Is there a yield, though, that potentially would start to hurt some of these equities?
You know, I think it's less about just the level. It's also for us the directionality, or sorry, the speed with which this happens. I know there's been a lot of focus on the more recent rise, but in general, if yields are rising alongside good growth, you know, and this inflation that we can understand and explain, and it's not really shooting up in a way that we don't think is manageable, and also the drivers kind of matter here, that's the part where we want to understand how those two things interact with each other. A really sharp spike driven by a surprise, and perhaps even some concerns about being able to keep inflation capped or reined in, kind of like 2022, that would probably be a little bit more concerning. That's not our take. When we compare some of the dynamics today versus 2022, just looking at inflation breadth isn't as wide. You don't have as many companies in surveys expecting to increase rates over the near term. You know, it's definitely higher than pre-pandemic, but it's not worsening, and it's not at the same levels that we saw back in 2022.
Jeannie, appreciate you dropping by and reacting to that breaking news. Appreciate it. Thank you.
My pleasure. Thank you for having me.
Of Citi Wealth, thanks for being here. Let's talk about this move. We're down 9 basis points at the long end of the curve, 30s. It's a break of 520 at the long end.
I'm sure this is the bond board. The Treasury Secretary is very happy with the afternoon move.
I have a suspicion that maybe he's watching right now and looking at these moves.
And he's excited because he basically came in and sort of did a little bit of a mini rescue mission before Kevin Warsh speaks at Jackson Hole. Less pressure, I think, now on the Federal Reserve.
Will we get a team effort? Will we see more from Warsh next week in a similar vein? Attempt to stabilise things?
It's a good question. I do wonder what they're going to be discussing on breakfast or lunch this week or next week.
Well, maybe that discussion's already happened. Yields down by 8 or 9 basis points at the long end of the curve. Equities pushing higher into the opening bout tomorrow. Krishna Gua of Evercore, Jack Manley of JP Morgan will catch up with Guneet Dhingra of BNP Paribas and the San Francisco Fed President, Mary Daly from New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars, Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Today, Wayfair sees immense potential in brick-and-mortar stores.
When we got into physical retail, our view was that, even if the market continued to grow for e-commerce, probably a large chunk of the market in this space would stay offline.
Kate Gulliver showed me around Wayfair's new 150,000 square foot Atlanta flagship store.
When customers who have seen us online come into the store, they're generally a bit surprised by actually the breadth of what we offer. Often if you're going online, maybe you're looking for something particular. But when you come into the store, you walk in, you see, the market square, you see all these pillows, you see the decorative accents. So what we're seeing actually is that in store, we do really well in some categories that online are, less a percentage of the total.
How does technology help in kind of making it seamless online to store?
I think
and vice versa.
The biggest thing is for the customer on the front end, that she can be in the store, that she can actually shop here, go back home, complete that purchase. And if you look at these sort of price tags and everything, they're all these digital tags. That's because they're the exact same prices they are online. So you're not going to be surprised that you saw something in the store and then you decided to purchase it online, that it's somehow different and that the offering is different. It's actually very consistent. But when she's here, she can have her app open and everything that she's doing here can be very similar to what she's doing at home. And I think that consistency is quite important.
Look at the more successful economies in the region. The key to their success is continuity. But the way our constitution is written, it actually encourages a lack of continuity. And that's a problem. The terms for local government is 3 years. When I first became a congressman, it takes you a few months to learn the business and to make your connections, to network, etc. If, for example, you are not particularly favored in the majority, passing a law in a year and a half is not that easy to do. After about a year and a half, you already hear that there's somebody in your district beginning to campaign and is going to oppose you in the next election. So you have to go back to your district to take care of that. And how much work do you get done?
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Futures spiked this morning alongside treasuries after the Treasury announced that they were doubling their buybacks. 30 minutes until the start of trading. I'm Danny Berger. Bloomberg Open Interest starts right now. Coming up, Target and Lowe's add to a mixed bag of retail results, with Walmart still to come. A major vaccine milestone, shares of Moderna soar with a melanoma trial win. And Treasury's buyback boost is powering a pullback, I should say, in long end yields. So that's what's powering the overall market so far this morning, that announcement from the Treasury. On the downside, though, we have some earnings to work through. And the big box retailers coming out in force. Target lifts its full year guidance, but shares fell as investors were hoping for a bigger earnings beat. Lowe's cut its outlook as the sluggish housing market weighs on sales. And TJ Maxx owner TJX sales beat estimates and announced plans to expand its global footprint. Let's get into all these. Joining us now is Bloomberg Markets correspondent Nora Melinda. Nora, it feels weird to say that expectations were higher for Target because this is a company that kept missing and kept having poor results. And I guess the turnaround's taking hold, so we need to see more of a turnaround?
I mean, we did see 3 back-to-back years of declining revenues, so it's interesting to see the run-up in the stock, up about 56% year-to-date heading into this report. So this is clearly a sign that the CEO's efforts to turn around this company may actually be paying off. You're seeing consumers coming into stores and the company leaning into more innovative ways to really attract and keep consumers here.
So you have that, and then you have Lowe's too. I guess a completely different story because this is so tied to the housing market.
Right. And so Lowe's, of course, we have to think about Home Depot earnings, which was reported yesterday as well. So Lowe's is actually focused on the DIY consumer like myself and you, whereas Home Depot is focused on the contractor. So what you're seeing here with Lowe's is essentially still a pressured consumer. So they're not necessarily having a hard time bringing in some of those contractors, but they are struggling to get those consumers to actually want to renovate their kitchen right now when, of course, money still continues to be tight for a lot of American shoppers. And so that still continues to be an overhang on this company. And what you're seeing analysts on Wall Street saying is that we're going to essentially need the housing market to thaw. We're going to need to see more job growth, wage income increasing, but then separate from that, rates coming down. And of course, we do know that the 30-year fix right now is sitting at about 6.7%. So still quite high for some of those consumers that are in the real estate market to feel excited about potentially getting a new home.
By the way, how kind of you to assume I might be a DIYer. I think the most I've done is like hang a picture. I don't think that counts.
I'm learning to turn, change a knob or two in the house.
A knob. Okay, Nora. Hey, that's big stuff.
Advanced.
That's big
advanced.
stuff. Okay, so that's the DIYers in the picture. Walmart. We're going to get them reporting results tomorrow. The behemoth, how are expectations for them?
Well, that's going to be super important to continue to watch, especially if we think about the fact that Walmart is one of the biggest employers here in the United States, but it's also catering toward that shopper that's looking for affordability. Walmart, of course, is very, very focused on how they can discount prices and actually continue to keep the U.S. consumer shopping when it comes to grocery, apparel, and honestly, you name it. I miss Walmart back in Virginia. Don't really have one here in New York City, but that's essentially going to be a bellwether when we think about retail earnings more broadly that are still coming out.
Nora, thank you very much. Looking forward to catching up later in the show. That's Bloomberg's Nora Melinda, and we're going to have more on retail earnings in the next hour. Joe Feldman of the Telsey Group will be joining us. Now to a potential breakthrough in the fight against skin cancer. Merck and Moderna said their personalized cancer vaccines help cut the reoccurrence of melanoma in a large late-stage trial. Bloomberg's Madison Moeller covers the sector and joins us. I don't know where to start, Madison, whether it's the breakthrough or just the huge move in Moderna shares this morning. This is a really big reaction to the study.
Totally. I mean, we're winning sort of on multiple fronts here, and I think that that's the takeaway. I mean, this is, at the risk of sounding like a total nerd, a really big and important moment in science. This is something that scientists have been chasing for almost a century, is a personalized cancer treatment, personalized cancer vaccine. And so we're seeing an mRNA cancer vaccine really succeed in the first large late-stage trial, like you said. So a win for cancer, a win for the companies. For Moderna, which is still trying to find its footing really after the pandemic, we're seeing investors look at this and say, okay, maybe this company really does have a future beyond COVID and potentially another really steady and big source of revenue if this vaccine does come to market as the companies expect next year. Obviously, that's still pending regulatory approval, but it's a pretty big moment both in science and for these companies.
Right, and as you and the team have been reporting, melanoma is the most deadly form of skin cancer, so this would be huge. But are you also suggesting that a win here isn't just a win against skin cancer, that it proves something about mRNA vaccines, that they could be applied to cancers more broadly?
Exactly. So that's what the companies still really need to figure out. They're testing these vaccines in other types of cancer right now. And so we'll see if those results translate into other forms of tumors. But that's the hope, is that these mRNA is an incredibly flexible technology. That's why it worked so well for COVID. You can plug in these different mutations and sort of adapt the vaccine to the different COVID mutations. Similar theory, sort of strategy for cancer, which these tumors also have mutations. And what these scientists do is they take a biopsy of the people's tumors, and then they can customize these vaccines to match the mutations that are most likely to have an immune response. And it takes just 6 weeks, which is also pretty crazy.
I don't know if there's a good answer to this, but also when I saw this news, I thought, how many people won't take this shot? Just because of the huge anti-vax movement that's happening right now, that people would avoid something that could potentially stop cancer from coming back because it comes in the form of this vaccine.
That's 100% right. And it's something that is really going to be a consideration. And there is so much misinformation out there right now about mRNA. There's a lot of fear around these shots still. But when it comes to something like cancer that is potentially so deadly, people will have to hopefully talk to their doctors and make that risk-benefit analysis for themselves. But, it's an important consideration that there's so much hesitancy and fear around vaccines
right now.
So,
just such an exciting story. Thank you so much for bringing us that. That's Madison Moeller from our healthcare team. Now, as I mentioned at the top of the show, the U.S. Treasury announced that it's ramping up buybacks of long-dated government debt after yields hit the highest level in years. Let's discuss with Bloomberg macro strategist Michael Ball. We'll get to maybe the motivations behind this in a second, but first, can you just chart with us the market reaction and why we're seeing such a steep one of yields down, stocks up?
Yeah, boom. I mean, this is kind of what we needed. This is starting to get a real front story driver of almost cross-asset price action for the last few sessions. We saw kind of risk yesterday take a little bit of a pause. Momentum finally died in the equity market. And it was all because, again, although sort of real rates have been methodical and linear, they've been creeping higher and higher, and people are sniffing out like pain and thresholds where we will start to have actually risk assets and risk appetite come off because we finally have a high enough real rate story going on in the back end. And again, the worry was we're going to not make it to Jackson Hole, where we would need clarity from Warsh on his reaction function and some further sort of guidance on how he's thinking about what tools to use in fighting inflation. Instead, now here, the Treasury's thrown him a lifeline in a lot of ways. Although the buyback size is relatively small, it's a strong signaling effect, and that's what the markets are gravitating towards, and that's why all of a sudden it's back to being a little more risk on. And of course, the most popular trade right now was sort of a steepener, so you're seeing a massive squeeze now, as guys really were expecting to hold this a little bit longer into Jackson Hole.
Of course, the irony, as many people pointed out this morning, is that Scott Bessent criticized his predecessor, Janet Yellen, quite frequently on using debt management as sort of like a quasi-monetary policy tool. Of course, what she did was different. It was issuing on the short end of the curve, which the Treasury is still doing. But do you look at this announcement, Michael, and say, maybe this is QE in disguise?
Yeah, I think that's sort of the puns. You know, you saw the zero hedges of the world already come out with that, and exactly right. I mean, it's interesting, too, right as the Fed was sort of reducing the reserve management purchases, here we go with another sort of instrument to support Treasury liquidity as it's officially kind of set out, but it also is purchases. So, yeah, to your point, it kind of is. Obviously, it's not the same as a larger scale QE program, but it buys time again, and it kind of calms the markets. Now, long end rate vol had been sort of drifting higher. It spiked post-July FOMC, kind of settled back down. The worry I was getting from a lot of traders was this wasn't like a capitulation move. This was an acceptance that yields should be higher, and that will eventually have real effects on the economy and obviously on financial assets because it, you know, tightens financial conditions.
You say that this calms things for now. What does the longer-term trajectory look like? Because this doesn't solve the problem of, you know, the AI debt spending boom and just how much this government is spending and taking.
Yeah, so actually was funny enough digging into all this before this headline broke this morning and was trying to get sort of the drivers because, I mean, we've had Mark Cabana on from B of A and he's really been hammering it hard. He was on this morning again and he did a good job. Or, I'm sorry, he was on yesterday and did a great job. And noting that growth expectations have actually kind of stagnated. They haven't gone up. We all know about the supply story. So the real driver over the last couple of weeks has been post-July FOMC uncertainty over sort of the Fed. So all these other variables are certainly in there, and they're certainly driving higher real rates. But the only change really has been the Fed's reaction function, the fact that the market's looking for more clarity there. And that uncertainty is causing greater volatility, albeit manageable still, mostly in the long end. And that's obviously meaning a higher term premium and a higher, basically, risk premium.
We are going to get an auction today, 1 p.m. 20-year bonds will be sold $16 billion of worth, kind of like the orphaned, unloved note anyway. Does it change anything for that? Or is it just like 20 years? Don't look here. It doesn't matter.
It's hit or miss. I mean, we're going to be going into it significant rally now. So that may mean there needs to be some concessions. But yeah, that's kind of a unique animal that has its own unique demand dynamics. What has been interesting, I think we got the tick data more recently showing that like foreign buying has been changing where the official counts have been stepping back. That doesn't necessarily mean anything for the 20-year, but it is interesting that the long end is seeing less official demand, although some of the private buying has gone sort of parallel because the dynamics though are not as great for the hedging front.
Hey, Michael, great to catch up with you. Great to get your thoughts this morning on that breaking news. That's Bloomberg's Michael Ball. And let's get a check on your markets this morning. The S&P, again, it is now rallying up 0.4% after clocking 3 consecutive days of losses. Mirror image on the NASDAQ 100, also up 0.4%. Perhaps we are sacrificing the dollar in order to get the yields down. The dollar now down by 0.5%. Brent crude still above $91 a barrel. And let's just take a quick look at the curve because as Michael was laying out, it is relief this morning. We're down by as much as 8.6 basis points on your 30-year yield. That is now below 520. Coming up on the show, President Trump hits pause on Canada tariffs as a tentative deal takes shape. This is Open Interest.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Oh, hello there. Just wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Let's get you some high-interest stories. A look at what's making headlines around the world. Long-dated treasuries are rallying after the Treasury Department said it will at least double buybacks in the sector. The move is aimed at improving liquidity, they say, after 30-year yields recently reached their highest level since 2007. The Treasury cited strong demand from market participants for expanded operations, but of course there has been some criticism lobbed at them that perhaps this is just QE in disguise. The UAE is cutting economic ties with Iran after accusing Tehran of firing ballistic missiles at its territory. Iran is denying responsibility. The move adds pressure on Tehran after peace talks stalled, and traffic through the Strait of Hormuz remains well below pre-war levels. And President Trump is delaying 50% tariffs on billions of dollars of Canadian goods for 3 days, saying the U.S. and Canada are close to a trade deal. The White House says that Canada has agreed to address barriers on U.S. autos, dairy, and alcohol. But Prime Minister Mark Carney says important work remains. The pause came less than 2 hours before the tariffs were set to take effect. Let's get more on this. Joining us now from Washington is Bloomberg Washington correspondent Tyler Kendall. Tyler, do we have any details on what this pause and what the agreements might look like, and if an agreement is actually even close?
Well, Danny, as you're outlining, we still have a lot of big questions here, considering that the White House came out and said that the two sides reached a deal, but Canada wasn't so definitive. Canadian Prime Minister Mark Carney falling short of saying that they had this deal done. We did get this document from the White House, which outlined that Canada is willing to take steps in regard to some of these issues where the U.S. has really been highlighting, whether that be alcohol or investment laws in Canada related to auto production. The USTR did tell us that the agreement will include, quote, comprehensive market access for U.S. goods, economic security commitments, and what they're calling digital trade alignment, but we haven't really gotten details beyond that. Keep in mind the context here is that President Trump was about to lobby these 50% tariffs under Section 338. This is a tariff authority that has never been used before, but does give the president the power to issue levies if the U.S. believes that U.S. commerce is being discriminated against. But importantly, the real crux of the trade issues between the U.S. and Canada right now have to do with those auto tariffs and those lumber tariffs, not under Section 338, but under Section 232. Those are those national security concerns that the administration has really tried to pile on in a bid to boost domestic production and protect our own markets. So the fact that we didn't really get movement on that does leave questions on where this is going to go. Even with with all these questions, though, Danny, it is considered to be a relatively positive step, considering the tensions between the two countries have really been ratcheting up. And we saw the U.S. fail to renew the USMCA agreement. We are expecting years of negotiations, but maybe this could be some sort of sign that they are making progress on a broader deal.
Tyler, meanwhile, domestically, we are getting first reads on how the electorate is feeling. Yesterday, we spoke about the importance of the Florida primaries. We have the results of those in hand. What did we learn?
So there's a few different races that we can pull on here, Danny. If we start with the U.S. Senate race in Florida, that was Angie Nixon. I can't even understate how surprising, perhaps, I think it's fair to say, her win was. She was up against somebody considered to have national name recognition. That was Alexander Vindman, known for testifying during the impeachment proceedings against President Trump. But if we look at sheer numbers, Vindman spent $9 million by the end of July compared to Nixon's $900,000. And it will no doubt bolster progressive momentum, but it does also likely weaken Democrats' chance to flip this seat. It is currently being held by Senator Ashley Moody. She was appointed to fill the gap left once Marco Rubio became the Secretary of State. So there's going to be a dynamic to watch there, whether or not progressive momentum can actually translate into wins for the Democratic Party come the general and the electability question. Very quickly, on the other side, the race that we were watching was, of course, the gubernatorial primary. Byron Donalds did end up clinching that. We spoke about this yesterday. He was considered to be the relatively more moderate candidate facing off some more far-right challengers that wanted this nomination. Danny, he is emerging with a massive war chest, more than $100 million. He has some big backers behind him, both in the political space, President Trump, but also names like Ken Griffin.
Tyler, thank you very much for your reporting this morning and every morning. Bloomberg's Tyler Kendall, live from the White House. Coming up on the show, we're going to catch up with Bloomberg Tech's Ed Ludlow on SK Hynix's share buyback and the growing backlash over data centers. This is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
The global economic playbook is being rewritten, and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
SK Hynix shares higher this morning after announcing a nearly $30 billion share buyback. Shares up 5%. Let's bring in Bloomberg Tech host Ed Ludlow. Ed, what do we make of the size and the timing of this announcement?
Yeah, it's a shareholder return policy to stabilize the stock, right? So SK's Korean shares are up 150% year to date. They rose 275% last year, but they are down significantly since the highs of June, where everyone was so fixated on high bandwidth memory. SK has a 60% market share for high bandwidth memory chips that go into data center. But what's really interesting about the mechanism of the buyback is that SK then cancels those shares instead of holding them under treasury stock. And if you remember, when SK did its listing of ADRs, they had issued new stock diluting shareholders, which was a particular grievance of the retail shareholder. So they're kind of unwinding that by doing this buyback then cancel, but also saying with everything that's going on in the world of AI and all of their capital commitments in Korea and here in the United States, they're committed to doing 50% of cash flows as returns to shareholders, which, you know, again, stabilization of the stock.
Yeah, stabilization, that helped this morning. The Treasury clearly stabilizing things too. Ed, elsewhere, sure. I wonder how much of this story is starting to register among investors, and that is this political pushback ahead of the midterms that we're seeing on data centers. Josh Shapiro of Pennsylvania becoming the latest to restrict data center development.
Yes.
We're working through, again, all of these local races at the moment. How much is that weighing on these companies' plans? Because they've committed a lot of capital to doing just that, building data centers in the U.S.
Yeah, American citizens' view of data centers is an issue for this midterm cycle. There is a very important feature on the Bloomberg today from the team that looks at the data on how that's manifested so far this year. So in the first 3 months of the year, $130 billion worth of projects, about 75 data center projects, were blocked in just the first 3 months of the year by varying local initiatives who are pushing back against their impact on communities. That 3-month tally is the same as all of the projects that were disrupted in full year 25. And it's completely bipartisan. It's not unique to Democratic states or Republican states. It is pretty much across the board. There are certainly some areas of focus within that. Michigan and Georgia account for many projects that right now are facing local opposition. And, you know, I would just go out and read like the full spectrum of reporting that's on the Bloomberg. There are even races at the gubernatorial level, for example, in Florida, where competing sides of the data center NIMBY debate are both backing the same candidate. You know, it shows you the bipartisan nature of this issue.
Thank you so much. Great to see you this morning. Looking forward, as always, to Bloomberg Tech, 11 a.m. Eastern. That's Bloomberg Tech host Ed Ludlow. Let's continue this conversation and bring in UBS Global Wealth Head of Global Equity Strategy, Nadia Lavelle. Nadia, great to see you. I wonder, we talk a lot about midterm risk, and I wonder how much of that should now concentrate on the risk to these hyperscalers and any of these big data center build-out projects. If, to Ed's point, what's emerging is a bipartisan NIMBYism to say we do not want data centers in our state.
Yeah, you know, it's something that we have been watching very closely at UBS and actually has published on this. And while we think that this is becoming getting more traction, it could delay some projects, and we are seeing a delay in projects, but we don't think that it derails the sort of story. We do think that a lot of these states will come to some sort of an agreement, whether it be pay your own power, right? I think that's a big issue. Also water, responsible use of water, hiring local, and all of that stuff. So I do think that the hyperscalers will emerge in some sort of an agreement with the various states, because reality is America needs to keep up in this arms race to build data centers, to continue to deploy AI. And so this can eventually become more of a national issue and less of so localized.
That's where I wanted to go, because I did have a conversation with Brookfield that one of their latest data center announcements was on federal land. And I asked them, that surely can't be a coincidence that you're looking to federal land where states can't block it. But in the race for this, how important is it to the U.S. government, considering we're not just trying to support these tech companies, but we're also competing against China, which can freely build wherever they want a data center?
And we know that one of the advantages that China has right now is really energy, right? And, cheaper energy. And so I do think that that's part of the story. And that's why we don't think that this gets derailed, that there will be some sort of a negotiation around that. And do think that eventually there will be government support. Then there is government support from the current administration around building out data centers and around our race in AI. And so I would expect that to continue. But yes, you're going to see some pockets around this, particularly around every election cycle has its issues, right? And this seems to be the one as we head into midterms and probably even into 2028 and the presidential cycle.
All right, Nadia, stick with us. We have to get through the opening bell. Nadia Lavelle. A quick check on your markets ahead of that opening bell. Just a few minutes to play for, and we are looking at higher equities as yields come in by now nearly 6 basis points on your 10-year yield. On the other side of this break, we'll have your opening bell.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Let's get this trading day started. Moments away from the bell, this is Bloomberg Open Interest. I'm Danny Berger. Stocks snapping 3 consecutive days of losses, the first time we've done that in about a month's time, thanks to a rally we're seeing in treasuries after the Treasury stepped in with increased buybacks as much as double on the long end. S&P futures up 0.4, as is the NASDAQ. Dow Jones also playing around the same level. Ringing the opening bells today, we have Russell Investments, the ETF provider, down at the New York Stock Exchange. You can see one of their listed funds, BD, is up there. They also have New York Stock Exchange, Texas. I wonder if they're listing in their Texas exchange, too. I know Texas has been a big push for the New York Stock Exchange and all exchanges. We're going to be down in Dallas later in the fall, by the way, for Bloomberg Invest, so come listen along with us. The NASDAQ, you have Tribeca Strategic Acquisition Corp. You can probably guess what that is. That is a SPAC they're listing. I think they're looking for a tech-related company as a target. I also want to show you what some of these earnings are doing pre-market. So we heard from Target Lowe's, TJX. The story with Target, yes, they've been on this rebound course. However, guidance fell short of what investors were hoping for. They wanted a bigger beat. Shares are up something like 50+% this year. Lowe's actually now positive. It was lower in the pre-market after their earnings suggested that there is some weakness tied, as you guessed, the sluggish housing market. That impacts them. TJX falling 5%. Yes, sales beat estimates, and it announced plans to expand its global footprint, but maybe we also expected more there too. Just want to point out Moderna, this huge gain in early minutes after the bell opened, up more than 80%. Its study found that its vaccine, combined with Merck's Keytruda, help reduce the risk of melanoma returning. A really big result from them that also suggests that they can do well with other cancer-related treatments. Elsewhere, we have to show you this move. It is another day where the bond market is dictating how the overall market feels. The Treasury announced that it's ramping up buybacks of long-dated government debt after yields hit the highest levels in years since 2007 for the 30-year yield. We're down now by 8 basis points. Let's bring back UBS Global Wealth Head of Global Equity Strategy, Nadia Lavelle. And Nadia, the immediate reaction to this announcement was yields move down and stocks move higher. How sustainable do you think that move is when the Treasury is coming in and increasing their buybacks?
The recent pressure that we've seen in equity, some of it has been attributed to the move on the long end of the curve. And you also think about the Treasury over the last just few weeks and it's stepping in to support Treasury markets in the fact that you had President stepped in several weeks ago to support the yen, right, in order to keep the longer end of the curve yields low. When you look at it historically, equities care why yields are moving, why bond yields are moving. And historically, while there isn't a magic level as to when equity starts to wobble around that, it has tended to get a little bit nervous around that psychological level of 5% or so on the 10-year. So we don't expect the 10-year to get to 5% in any sort of sustainable way. We expect yields to start to come back in on the 10-year. We're looking for about 4.25% by the end of the year and 4% by the time we get to mid of next year. And I think what matters for equity is the earnings environment, which has been quite strong. While bond yields can create some volatility in equities, I think the sustainability of this bull market is more dependent on the earnings growth, and we feel very good about that.
Right, so 30% earnings growth, but does that mean when we get past this earnings season and there's kind of a lull in news that the bond market does become more of a bully to how equities behave?
Well, I think short term, like you could see some volatility, particularly as we head into Jackson Hole, particularly as we head into the next FOMC meeting. But remember, we also have a big earnings next week, NVIDIA earnings coming up. So it's not that we are completely in this earnings vacuum. So we will get some incremental data points around that. And so while we think that there could be some temporary volatility, as you look into, the end of the third quarter into the fourth quarter, we're seeing upward earnings revisions coming out of this earnings season. Typically, you will start to see analysts trim estimates, but we're actually seeing estimates move higher. And so that gives us a conviction that the momentum in the earnings story will continue into year end. And despite temporary volatility, we would be buyers of any dips that are related to, bond market volatility that's being caused in the equity markets, because we do think that the earnings growth, at least into the year end in the first half of next year, is sustainable.
Though the chip stocks did sell off quite a bit as yields move higher yesterday, and I wonder for them if they're becoming increasingly tied to macro trends, tied to the bond market versus like idiosyncratic growth of chips. The question kind of leaning towards, okay, are all the good earnings priced in? So now the way that we move is maybe what the bond market is telling us.
It's several reasons why, you've seen some volatility in the semi space. It's not just the bond yields, but it's also, yes, the debt issuance concerns that are happening as you see more hyperscalers issue debt. You're also seeing some, company-specific data points over the last couple of days around run rates for AI monetization and cloud growth and so forth. So there are numerous things happening. And the fact is that you've had semiconductors that have run run a lot this year. So there's some profit taken happening. So we wouldn't put that squarely that all the pullback that you're seeing in chips has to do with what's happening in the bond market. We think it's more what's happening in terms of the hyperscalers and the monetization story, that's more important than the bond market, because clearly, like, hyperscalers are able to continue to fund this capex, whether it's through cash flow from operation or tap in the capital markets, which they had no problems doing, and diversifying that beyond the U.S. Debt market and into all the way to Australia. So there is no shortage of capital for this capex build out. So we're less concerned about that, and it's more about what does monetization look like, what does return on invested capital looks like. I think that's what the market cares more about in the AI trade than they do a bond market. The fact that bond yields are moving up, I don't think that that's going to derail whether you'll have Google go out and pay 7%.
So this might have the same exact answer, but what about supply? What about as we get more IPOs coming on market? Does that change things?
Yes, there's expectations for more, some of these, startup companies that are not really small in terms of startup. They're quite large coming to market this later this year. I think what the market wants to see is the financials around this. Like, again, what does the monetization plan looks like, and how fast is that happening? Because that would tell us, the demand story and how sustainable this is. I do think that we have some conviction in it, because when you look at the backlog of some of these hyperscalers, regardless of what's coming to market in terms of equity issuance, when you look at the backlog for the hyperscalers, the fact that you have backlogs for the largest hyperscalers at $2.4 trillion tells you that there's a long runway in terms of earnings visibility, despite the fact that you might have more equity issuance coming to market. So I think that the core story is still quite intact, at least over the next few years, around AI, the build out, the capex, and the demand, and the fact that we think that demand will continue to outstrip supply. I think, Amazon sort of hinted at that during the earnings season as well.
Yeah. So we were having this conversation with JP Morgan's Gabriela Santos yesterday. Basically, everything is so tied to AI now, because you also have companies, we hear from Walmart tomorrow, for example, a consumer company, but has been broadly adopting AI strategies. When you look through the portfolio, where do you find true diversification? Like something that does not touch AI, that can behave differently than the rest of the market?
I think that's a great question, because our Chief Investment Officer of Americas, Ulrika Hoffman-Bouchardy, actually put out a signal over noise on this exact same topic on Monday, talking about that the fact is that there's so many things that you think are diverse, add diversification to your portfolio, but actually doesn't, because AI compute demand is so linked to so many things now, whether it's utilities, industrials, financials, or tech, and even in the bond market. So you have to be mindful of that. I think what you're seeing in terms of reverse, look at healthcare, right? This is a sector that we have had an attractive rating on for much of the year, and it's finally starting to perform because it does offer that diversification. You see on days where tech and AI is trading off, that healthcare in the last 3 months, a top performing sector, it's healthcare. Right? And, you're seeing the news this morning on an innovation that's happening. We think that story will continue, whether it's in GLP-1s, diabetes and obesity, and also now cancer treatment. And you're seeing some alleviation in the pressure in the managed care space that was under pressure earlier this year due to concerns about reimbursement costs and also utilization and medical cost ratios. That's also, so you're finally seeing a resumption of earnings growth within healthcare, and valuation is not extended. So I think that that's a nice diversifier to the overall portfolio that isn't tied to AI capex story. Ultimately, we think that it will be a part of the AI monetization story, but that's, several years down the line.
Always so great to have you on, Nadia. Always a masterclass. Thank you so much for joining us, Nadia Lavelle of UBS Global Wealth. Let's get a check on your market about 10 minutes into your trading day, and we're still higher. Part of that is thanks to treasuries, but this market, as Nadia was saying, is moving on more than just that. Earnings look strong. We're up about a third of 1%. Healthcare, again, Nadia spot on. Exactly what she was saying is why the market is moving today. We're having these huge innovations coming from these healthcare companies. Eli Lilly is doing well, but the real standouts are Moderna and Merck. Moderna, well, the two of them together forming a treatment, an mRNA vaccine from Moderna combined with one of Merck's Keytruda treatments that helps halt the reoccurrence of melanoma, a huge advance. We're also seeing some other earnings in the winners column. Home Depot is there after we heard from Lowe's. In the losers column, it is a lot of the tech stocks that are selling off: Broadcom, AMD, Intel, Lam Research. Some financials not doing well either. I want to give you another look at how the 30-year yield is behaving after that announcement. Again, the Treasury announcing that they will at least double buybacks for the long end of the curve, for $4 billion. Look at this drop that we have seen today. We are currently on this 10-year yield trading at 30-year yield rather, at 520. The close yesterday, you can see it here, was around 530. 530 was the high that we closed earlier this week, which was the highest level since 2007. The timing here, perhaps not a mistake. Scott Bessent's Treasury Department coming in and announcing an increase of buybacks. 30-year yields plunge as the price itself rallies. Coming up, we're going to talk more about that pharma news. Bloomberg Intelligence senior pharma analyst Sam Fazeli reacts to the Merck and Moderna landmark melanoma vaccine study. That's up next. This is Bloomberg.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start in the third floor or the lobby. You actually have to start in the basement.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
So I just pointed out on the move screen on the Bloomberg moments ago that Broadcom, Alphabet, AMD, Intel, a lot of these AI stocks are falling. Just want to point out that viewer Brian Quartarolo points out that this is likely because of the Anthropic IPO. If banks are getting ready with this issue, the AI trades suffer because people need to take profits in order to accommodate some of that. So thank you. We always love viewer comments. Please write in. with all of your theses on market moves. Let's get some other moves and get your top calls. We teased her before. Here she is. It's Nora Melinda. Nora, what are you looking at?
Hey, Danny, 3 upgrades for you this morning. First up, let's look at Honeywell Aerospace, getting some love from Morgan Stanley. The firm upgrading the stock after a 27% drop since its spinoff, saying investors may be punishing it a little bit too much. Morgan Stanley says the customers are there, but the challenge is getting enough product out the door. You're seeing shares of Honeywell up by about 2.5%. Next up, over to retail, Jefferies upgrading the Dollar Tree to hold, saying shoppers are starting to come back. And while Target's still a threat, the firm likes what Dollar Tree is doing with its prices as well as its customer traffic. Shares up by about 2.7%. And finally, Danny, remember when it felt like all of our lives were spent on Zoom at one point? Well, Bank of America is taking on coverage of the company with a new buy rating, saying Zoom is becoming more than just video calls and a bigger part of how we communicate at work. We'll get a fresh look at the company when it reports earnings next week, but as for now, shares up by about 2.5%. Those are your top calls. Danny?
Nora, thank you very much. Now let's get through to the huge news coming from Moderna, a potential breakthrough in the fight against skin cancer. Merck and Moderna said that their personalized vaccine helped cut the reoccurrence of melanoma in a large late-stage trial. Let's get to Bloomberg Intelligence senior pharmaceutical analyst Sam Fazeli. Sam, I say huge news because the market reaction has been huge. So in the pharmaceutical world, is this a really big breakthrough?
Oh, hi, Danny. I think the best share price to look at is Merck because that's where you're getting let's say, dilution of the or involvement of short covering that's probably going on in the Moderna share price move at the open. So that's giving us a 6%, 7%, 9% rise, right? This is huge for Merck, depending on the data. Remember, the press release only says that they succeeded at this interim level. So it is a groundbreaking thing. It's a cancer vaccine, although they call it individualized neoantigen therapy. It's a vaccine, essentially, and it's one of the first to be showing in this kind of big indication using mRNA that you might be able to do this, which I think, therefore, there's a lot coming in here also for hopes for other indications, Danny.
Is there a risk, though, Sam, with the political climate, especially where I am in the United States and sort of the growing anti-vax movement, that as successful as this is, maybe the uptake rate will be limited because of that?
Yeah, I don't think so. I don't think that cancer has the same issues as infectious diseases or COVID or flu would have. And so, to be honest with you, if this is the good data in terms of the groups of patients that are responding, in terms of the magnitude of the benefit, and let's not forget, Merck has called this clinically meaningful, not just statistically significant, clinically meaningful. When pharma companies say that, it usually means that they're seeing a meaningful, significant benefit. Not just a statistical 20% reduction. So we're now, I think, setting up for a 30-35% reduction in the risk of recurrence of disease in these patients. So that would be a good win for patients for sure, and quite clearly for the share prices.
Sam, thank you so much for joining us. A really fascinating story. Sam Fazeli from Bloomberg Intelligence. Coming up, Treasury Secretary Scott Bessent stepping in as long-term yields hit decade highs. We're now down by more than 8 basis points on your 30-year yield as it forces gold to rally and the dollar to come in. That's next. This is Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersetchi in El Ola, Saudi Arabia, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend. This is Bloomberg Television.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
A big story driving markets this morning. The Treasury announcing that it will at least double the size of its liquidity support for buybacks in longer-dated Treasuries. Let's bring in Bloomberg Intelligence U.S. rate strategist Ira Jersey. Ira, the Treasury says it's stepping in to support liquidity, but should we also read this as the Treasury putting a ceiling on long-term yields?
Well, I think they would certainly like to see long-term yields come down a little bit, and certainly they have, at least for now. You know, this is a little bit like maybe the beginning of a larger coordinated effort between, issuance or buybacks and other things to try to arrest the sell-off that we've seen in the long end of the yield curve. One of the problems, though, that the Treasury is going to have is this doesn't do anything for the deficit. It doesn't improve the deficit at all, so there's still going to be a lot of issuance. It's just a matter about where along the curve it's going to be.
I guess the question is, if that doesn't help then, and we continue to see yields drift higher after this, Ira, is the next logical step outright cutting long-term issuance?
Yeah, and we actually wouldn't be surprised if they actually cut 20-year issuance in particular a little bit. It's kind of a sector that is very unloved, and I don't think it's been performing the way that some on the Treasury Borrowing Advisory Committee and others at Treasury had hoped. So it wouldn't surprise us at all if they cut the 20-year a little bit. There's still decent demand at the long end. You know, you look at the auctions, and we do have another auction today, so that'll be interesting to see how that goes in the 20-year. But last week's 30-year auction went fine. And yes, at much higher yields. But keep in mind, like, issuance is only part of the story here. We have to remember that a big reason why you have much higher yields is everything from Fed credibility to yields globally going up. So, a lot of the moves overnight, for example, were being led by Japan, not being led by treasuries. So this isn't just a U.S. story. It is a global story and a global phenomenon.
Right. I guess on the other side of things for the Treasury, what would be the justification right now, Ira, if you see any of needing to support this market in the form of increased liquidity?
Yeah, liquidity, quite frankly, has been okay. When you look at things like bid offers, I think that they call these liquidity operations, and it is a little bit more like I was mentioning, an operation twist. And the Treasury Department does have precedent for this. It's been 60 years since they did the original operation twist, but nonetheless, they're issuing more short-term debt. They're now going to be buying back some longer-term debt. But to your point, like at the next refunding announcement in November, it's very possible that they incrementally change the amount of issuance at the long end in order to try to keep long end interest rates a little bit lower than they have been more recently. But the best thing that the government could do is try to basically reduce the deficit. But they've tried that, right? That was the whole thing that Elon Musk was trying to do, and it just hasn't worked because so much of it is structural that you're going to wind up needing to actually increase issuance at some point in 2027 in order to keep up with both the deficit and then all the maturing debt that is really starting to ramp up actually kind of now.
There's some interesting points of tension that this sets us up for. One, which has been commented on already, this idea that Treasury Secretary Scott Bessent had criticized his predecessor, Janet Yellen, for intervening in the debt markets in a way that seemed like stealth QE. The other one, Ira, that I'm more interested in exploring is how this sets us up with this Fed, with a Fed governor who, for one, wants markets to be independent of monetary policy moves, and now it's a market that is moving based on Treasury moves, and two, a Fed governor who has said that in large part, it seemed like part of his hold was because bond yields were going higher and doing some of the work for him. How does this complicate things to have the Treasury stepping in? and to a large degree, at least in the short term, dictating market moves.
Well, we always forget there's actually in the Federal Reserve Act, there's this really awkward statement that the Fed's been contending with for the last 113 years, and that is that they're supposed to maintain moderate longer-term interest rates, but they don't. But the Congress hasn't defined what moderate means, when you look at where yields are now, Kevin Warsh has to be saying to himself, okay, how might I keep moderate longer-term interest rates, and how do I do that? And one of the ways to potentially get long-term interest rates down, ironically, is by raising short-term interest rates to get inflation expectations down, maybe growth expectations down a little bit, and all of that might help the long end of the yield curve. Now, he's probably not going to do that. I think that Chair Warsh would like to maintain interest rates where they are, even lower them over time. But there is certainly a case to be made that if your ultimate goal is to get long-term interest rates down, short-term interest rates maybe need to go up, at least temporarily.
So just quickly here, Ira, only about 30 seconds. Does this impact how Kevin Warsh is thinking, or what the Fed does from here to have this movement in long-term yields?
Yeah, I don't think very much. You're talking about 8 basis points. We've sold off 40-ish basis points in 10s and 30s over the last 2 months. So I think that a little bit of this is retracement, and the move itself, when you take it in the big picture, it's only about 2 days of what's been priced in terms of daily movements.
Ira, wonderful to have you on. Thank you for joining us, Ira Jersey from our Bloomberg Intelligence team. Coming up, we're going to continue this conversation. Kathy Bostiansik will be joining us, plus Betterment CEO on insights into Gen Z's long-term investment strategy. Hint, it has to do with sports betting. And the CEO of TrueCar discusses looming auto tariffs as Trump puts the brakes on with Canada for 3 days.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation.
As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlett Fu, who's taking a closer look at drone companies.
With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space.
Excellent reporting. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
When news breaks,
A redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need,
There's going to be now tons of tariff headlines until midterm elections.
hear it first on Bloomberg.
Bringing you the latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
ABC News. I'm Sherry Preston. The case has been laid out in the trial pitting attorneys general from around the country against Meta, creator of Instagram and Facebook. The social media giant is in California, accused of knowing its products were harmful to young people, but developed them anyway. ABC's Kana Whitworth has more on the first day's testimony.
This is an operation that lawyers described as hook, hold, harvest, and hide, claiming the company also harvested data and hid the truth from the public. They call the former Facebook employee to the stand as well, who testified that teens are being exposed to violent and graphic content that was 100 to 400 times higher than what Meta is reporting publicly.
In a statement, Meta calls the claims against it limited. Meta CEO Mark Zuckerberg is expected to take the stand at some point during the trial. The United Arab Emirates says it suspended all trade with Iran after the UAE says it had come under fire from Tehran. Renewed scrutiny of the Navy following news that a destroyer suffered a complete power failure last month in the South China Sea.
The 300 sailors on board reportedly had limited drinking water, no toilets, and no air conditioning after the ship suffered a complete loss of power. It was later towed to the Philippines for repairs. The Benfold was part of a fleet heading to the Middle East to relieve the USS Lincoln, whose crew has been at sea for a record 268 days as part of the war on Iran.
The USS Lincoln has been at the center of calls for investigations amid reports of deteriorating conditions on board. Another Democratic Socialist wins her primary.
What is going on right now is not normal in Washington, D.C., nor is it acceptable.
State Representative Angie Nixon beating establishment candidate Alexander Vindman in the Florida Senate primary. She will face Senator Ashley Moody in the November race for now Secretary of State Marco Rubio's former seat. Markets opened about a half hour ago. Dow's up 279. This is ABC News. New details are beginning to emerge in the death of 36-year-old actress Hayden Panettiere, who was there when she died.
According to police, Panettiere's on and off again boyfriend Brian Hickerson and his brother Zach were also there when Panettiere suffered a cardiac arrest, and they say the brothers called 911. They say the boyfriend's brother Zach was very emotional while EMS were working on Hayden.
ABC's Trevor Ault. Hickerson said to have become emotional when she was pronounced dead at the scene. Panettiere had written in her memoir that Hickerson had abused her in the past. The next battle in the separation of church and state, the 10 Commandments on classroom walls in the state of Texas. ABC's Jim Ryan says there's a court case now underway over it.
Supporters of classroom displays of the 10 Commandments say it's not about proselytizing non-Christians. Instead, says Alabama State Representative Mark Gidley,
this is about returning a foundational principle to our schools.
While opponents insist
no school district should be posting them.
Attorney Chloe Kemp is with the ACLU, which has asked the U.S. Supreme Court to consider the constitutionality of the Texas law that requires the posting of the 10 Commandments in every public schoolroom in the state. Jim Ryan, ABC News in Dallas-Fort Worth.
The battle over the name and the battle over the facility itself goes on. The Kennedy Center has now told a federal court it will not attempt to return Donald Trump's name to the Kennedy Center's facade until at least September 8th, as another legal battle over the center's future takes shape. I'm Sherry Preston, ABC News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, original Originals and the Bloomberg Business app.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, we're streaming live on YouTube, streaming live on Bloomberg.com as well. Scarlett Fu out on assignment today, but not to worry. Judy LaGrue steps in and for the next couple hours going to help us out.
I'm excited, Paul.
Thanks so much for that, Judy. A lot going on out there. Boy, Treasury coming into the bond market here, really pulling yields back, stocks higher. We'll get to all of that. Sam Fazeli, Bloomberg Intelligence Director of Research for Global Industries. He covers all the healthcare stuff for us, the biotech. I want to get his thoughts on Moderna. Really some big news with doing this deal with Merck, and Moderna stock is up like 80%, something crazy. But he told us about this several years ago. He said, watch out for these guys because this technology is very cool. Kelly Bogdanovich joins us here, portfolio manager at RBC Wealth Management. Get her thoughts on these markets. Deb Aiken, Bloomberg Intelligence luxury goods analyst. Talk to us about Estee Lauder and their earnings. Pretty good earnings from Estee Lauder. Gautam Mukunda, he's a lecturer at the Yale School of Management. He's also a Bloomberg opinion contributor. He's got a new column out talking about California. He's saying California knows what sparks business innovation. So we'll get some thoughts there. So a lot coming up over the next couple of hours. Let's kick it off right now with Alexis Christophers and a Bloomberg Business Flash.
Thanks a lot, Paul. And an early stock rally losing a little bit of steam here, but Treasury yields are lower after the U.S. government said it plans to boost buybacks of longer-dated bonds. It's a signal the U.S. wants to lower borrowing costs after yields hit multi-decade highs in the past week. The S&P 500 is up 24 points. You've got the Dow Jones Industrial Average rallying 220, but the NASDAQ has turned negative, down 32, and the NASDAQ 100 is off 120 as AI-related stocks slip today. We've got over in the oil pits, Brent crude up 0.5%, 91.42 a barrel there. West Texas Intermediate crude up about 0.7% at 85.50 the barrel. As for the bond market, the 30-year yield down 9 basis points, now at 5.19%. Remember, just a couple days ago, it was at 5.33%. The 10-year yield down 5 basis points at 4.64%. The 2-year yield unchanged at 4.17%. A personalized vaccine developed by Moderna and Merck helped reduce the recurrence of melanoma in a large late-stage trial. Analysts are calling this a milestone trial, and shares of Moderna more than doubling here, up 130%. We've got shares of Merck up better than 11%. And Estee Lauder shares jumping more than 17% after its results beat estimates and ended a run of 3 straight declines in annual revenue. Bitcoin at 65,222 and spot gold at 44.70 the ounce. That's your Bloomberg Business Flash. Back over to you guys.
All right, Alexis, thanks so much. We appreciate that. Judy LaGrue sitting in for Scarlett Fu here today, who's on assignment. And I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well, as Alexis was just reporting. Kind of red and green on the screen here today. Let's take a look at some of the stocks on the move today. We can do that with Bloomberg's Ben Weiss. Ben, what are you looking at today?
Hey, yeah, so like everyone watching the markets, I'm looking at Moderna, ticker mRNA. The vaccine maker's stock is absolutely soaring after it announced Tuesday that a personalized vaccine it's developing helped cut recurrence of melanoma. The pharma company has been working on the cancer vaccine for more than a decade, and the product could be approved as soon as 2027, said Moderna CEO.
Yep, and Sam Fazeli is going to be joining us in just a moment from Bloomberg Intelligence. We'll get some more color there. He's been highlighting the stock for a long time. What else you got for us?
Yeah, on a different note, love the name of this company. I'm watching Lazy Boy, ticker LZB. The furniture maker's shares are tumbling after the company's forecasted sales for the second quarter were less than analyst estimates. Still, Lazy Boy saw some growth from its company-owned stores, recording a year-over-year jump.
I didn't even know that was still a thing, a company. Like Lazy
Boy.
There's still Lazy Boy chairs.
Well, people need to sit down.
All right. They made like $500 million in the last quarter.
That's amazing. Good for them. One of my first jobs back in the day was being a railroad analyst, so I know the Norfolk Southern Corporation very well. What's going on there?
Yeah, so trains after vaccines and Lazy Boy. So Norfolk Southern Core, ticker NSC, is popping this morning after a regulator on Tuesday decided to resume consideration of an application from Norfolk and Union Pacific to create the first coast-to-coast freight network. The rail regulator had paused its review in May, asking the two companies to submit details about how the proposed network could affect shippers, other railroads, and the public.
I mean, this is huge. It would be the first east-west, coast-to-coast railroad in the United States.
Wow.
Yeah.
I mean, that's big, particularly for those of us who like choo-choo trains and stuff. This is huge. It'd be great for shippers, I think, although some shippers say it would cause rates to go up because then you'd have these two big guys together. I don't know. I think it'd just be very easy to put something on a railroad car in Norfolk and offload it in Los Angeles or vice versa. That would be pretty cool. All right, Ben, thanks so much for that. Ben Weiss, Bloomberg News, giving us those stock reports. For more conversations like this, subscribe to our Stock Movers reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, and anywhere you listen. When we were in the early days of the pandemic, and we were it was like early 2021, and we were starting to get some vaccine discussions, and this mRNA technology came to the fore. Sam Fazeli had to explain it to us like a million times because we didn't really get it, but he was saying it's going to be really helpful in delivering a coronavirus vaccine. He was right, and he says, don't sleep on this thing because you can use the same technology for different therapies for different parts and different things. And here you go today.
That's right.
With this news, with hooking up with Merck on a cancer drug. The stock's up 130%. I mean, this isn't an over-the-counter pink sheet penny stock. This is a 25 billion market cap. That's now 50 billion market cap in one day. Sam Fazeli joins us here. He is the chief go-to research analyst at Bloomberg Intelligence for all things healthcare. Sam, talk to us about this, what Moderna and Merck are doing today. What's kind of the science behind it?
Yeah, I mean, Paul, just to say, these are the days that I live for, right? Yep. When something goes right, even though I was really worried about this trial reading out, which is what? This trial is taking some mutations, identifying mutations in the tumors of patients who've had them removed. So you have melanoma, you're lucky enough to have been caught early, you do surgery, you debulk the tumor, you use that in their labs and their AI systems, etc., to identify what they call neoantigens, things that are more prominent in the tumor cells than not. Put that in a vaccine, mRNA vaccine, give that back to the patients, and at the same time, administer the Merck immuno-oncology drug that unleashes T cells if they find those mutations. So why were we worried? It's a new technique. It's really hard. This is a disease where you get a lot of good response, even as it is, with therapy, with the removal of the tumor, with Keytruda itself. This is a hit against Keytruda alone, right? That immunotherapy. So, and they say, although we haven't seen any numbers, that it's worked out here. So I think what's going on with Moderna, I'm going to speculate here, right, is that there is some major short covering. That squeeze is quite massive, right? 135% last time I looked. You're seeing a jump in other RNA names, Arcturus, Biotech up 23 and a bit %, because they're all trying to do the same thing. The question really is how good is this data? We'll find out in the next few months, I'm pretty sure. And then can you say it's going to work in other tumors? And I think that's a bit of a leap of faith. It's going to take some. Melanoma is the easiest step forward. So, but still, let's celebrate today.
Sam, I'm so curious about the share movement of Moderna. Could you tell me a little bit about whether or not you feel like the share move justifies this news? We're looking at Moderna reaching its best day on record. Tell me a little bit more about how you see this moving fitting in.
Just to remember, though, in the heydays of the COVID vaccines, this thing was traded at 400, I think, even. I don't know, I've got the chart up here. Over 400. But those were funny days, weird days, right? Nobody knew how to size this. Here, there is speculation, a lot of conversation in our industry chat with investors that there's short covering going on. And you might just see actually the stock's taking a little bit of a step back from the 135% up that it reached. There will be some short covering. I think the better way to look at it and see the impact of this is maybe looking at Merck. But even there, I think there could be some short covering and some relief rally that actually maybe Merck has got the ability to get through this Keytruda patent expiry that's coming up.
So availability, when do you think this new drug or this new application can be approved and get into the marketplace?
I love the way that you struggled with that, Paul, because this is not a drug. It is, you go in and you have to have it prepared for you. It takes weeks. They take your tumor, you go home, you get whatever therapy you get. And in the meantime, they're trying to identify what's different in your tumor to develop this vaccine for you. So it's a personalized neoantigen therapy, INT. So individualized neoantigen therapy. So what do we call this? It's got to be funky manufacturing. I'm pretty sure they'll fix it and figure it out. This is Merck we're dealing with, not just Moderna alone. So that's how this works. And how will it be priced? I don't know. I'm pretty sure, depending on the efficacy benefit or the benefit magnitude, they'll price it accordingly. I wouldn't be surprised if it comes back at, I don't know, $500,000 a year.
$500,000?
Yep, that's what these drugs are being launched at these days. I can't tell you for a fact because the company's never talked about that.
So when you talk about a number like that, how does insurance play into that? Don't you have to get insurance to buy off on this too?
Yeah, it's very hard for insurance insurance can start not paying up for your GLP-1 because the benefit is so far away. But in cancer, they tend to just accept it, right? And that is a conversation that pharma companies need to have. At what point do you stop constantly raising the bar on the price, right? Now, let's be honest and fair here. They are making significant difference to people's ability to live with cancer and live longer. So here the question is, I don't know that's the price they're going to come out with, but I wouldn't be surprised, especially given how complicated it is to produce this.
All right, Sam, thank you so much. Appreciate that. Sam Fazeli, Director of Research for Bloomberg Intelligence. He covers all the healthcare stuff, the biotech, the big pharma. And again, big day for Moderna here. The stock up 129%. So the market cap here, when it started today at like $24 billion, it's now $57 billion in market cap. So a good $30 billion of market cap has been created just today. It's really on the back. So it just kind of goes to, maybe some short covering, as Sam said, but that can't be all of it. So it's just, I think the market trying to discount what the total addressable market for such a procedure could be and trying to impute that into the stock price. I don't know, just extraordinary. And that's what happens in healthcare. You get these approvals and biotech stocks jump.
Big swings.
Crazy.
Huge.
Yeah, crazy thing there. So good stuff there. Good stuff for Moderna, Merck, and most importantly for those folks suffering from this form of cancer. Maybe some hope there. So that's the good news there. And that's what a lot of these companies, they can deliver. Nobody likes to complain about pharmaceutical companies and drug prices more than me. But man, when they come through like they did in COVID, they really can come through and make a difference. So a good day for the pharma space there. S&P up 22 points. The Dow up 250 points. The NASDAQ down 45 points. Coming up, Kelly Bogdanova. Who is Kelly Bogdanova? Wow, portfolio analyst at RBC Wealth Management. Get her thoughts on the markets. That's coming up.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Coming up on 1022 on Wall Street, I'm Alexis Christoforous from the Bloomberg Interactive Brokers Studio. It has been a big day for the retailers, and I want to start there. Target up more than 4% after lifting its full-year guidance after results outpaced estimates for the latest quarter. It suggests the big box retailer may be moving past a lengthy sales slump. We're going to hear from Walmart tomorrow. Also, TJX Companies, the parent of TJ Maxx, Marshalls, and Home Goods, down about 1.5%, reporting better than expected comparable sales for the quarter, but its new plan to ramp up store openings shook investors. We've got Lowe's cutting its outlook for the full year after posting results that missed Wall Street estimates. The home improvement retailer blaming the soft housing market for these results. Even so, we've got shares of Lowe's rallying nearly 5%. Its rival Home Depot reported better than expected results yesterday. As for the overall market, mixed picture for equities. S&P 500 up 24 points. The Dow Jones Industrial Average rallying 267. And the NASDAQ Composite is down 57, but the NASDAQ 100 getting hit harder, down about 165 points. Brent crude on its way back towards $92 a barrel, up 0.7%. WTI crude up nearly 1% now at $85.74 a barrel. And yields are mixed after the Treasury stepped in and said it's going to double the amount that it buys back in long-term securities. We've got the 30-year yield down 9 basis points at 5.19%, and the 10-year down 5 basis points at 4.64%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's a Bloomberg Business Flash. Back to Paul and Judy.
All right, Alexis, thank you so much. We appreciate that. Judy LeGroux sitting in for Scarlett Fu today. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Well, clearly, the market-moving item today is the U.S. Treasury unexpectedly announced it's ramping up buybacks of long-dated government debt, taking the action in the wake of yields on such securities hitting the highest levels in years. And we're seeing moves in the market, as Alexis was just walking us through. Let's talk to somebody who does this stuff for a living, Kelly Bogdanova. She is a portfolio analyst at RBC Wealth Management. I think she's out there in the Bay Area. Kelly, what did you make of this news here of the Treasury stepping in here? It's certainly moving stock markets and bond markets, particularly the long end.
Definitely the fact that it happened today was a surprise for markets. But if we step back and think about this, should we be surprised? We have a hedge fund manager as Treasury Secretary, and he was a skilled hedge fund manager. So when you've got headlines blazing, whether it's through the business press, the mainstream press, talking about yields and all this anxiety built up, what does he do? He comes in and he makes a move on the other side of the market. So, skilled move by the Treasury Secretary. Obviously, they want long yields to be lower. That's the desire. I guess the bigger question for me, though, over the mid and longer term, you can maneuver things in the short term, but over the mid and longer term, it's fundamentals that are going to rule. And that's what's been difficult with yields lately.
Can you talk about what you perceive to be the biggest risk here?
Well, if we step back, the market basically has been telling Treasury and the White House a few things. First off, the conflict in the Middle East, there's still risk there. So inflation is still an issue. Yes, we've seen inflation come down, but if that conflict persists, if the Strait of Hormuz continues to be closed for longer, and if this drifts into next year, then the work that's been done on inflation can be thrown out the window. So that's definitely a risk. The other thing that markets have been telling Treasury about is you're not the only game in town. We've got high quality AI-related debt, and that's been of interest to investors. So, there's more than Treasuries out there when it comes to high quality debt. And then the third issue is the deficit and the debt. The deficit numbers that we saw recently were lousy. And this Treasury Secretary specifically, even during the campaign time leading up to the election, talked about getting the deficit down to 3%. Well, that looks like a fantasy right now, a fairy tale. So they're nowhere in sight of that. So the market has been exerting this. Yields have gone up. he's done a maneuver today that is an impressive maneuver to bring yields down, but it's those issues over the mid and longer term that are still going to be prominent in investors' minds.
I mean, how did these buybacks even come about? Is it a president calling up his or her Treasury secretary and saying, hey, I need yields down, I need interest rates down, go buy some securities? Is that how it works?
Well, I don't doubt that there's been coordination and conversations between the administration and the Treasury Secretary, and we have a very active president, and we know that those two officials talk repeatedly. I would imagine it's multiple times a day, maybe even in the middle of the night, right? We hear about calls from the president at the middle of the night to key officials. But, you know, we have a Treasury Secretary who, like I said, he's been a skilled finance person for his entire career. He likely has a plan. They've likely run through these plans within the agency. So I would imagine that the agency is extremely involved in giving options to the president and the administration in general.
Can you talk a little bit about sort of your call with respect to a debt crisis in the U.S.? You don't expect a full-blown one, but you expect kind of a debt adjustment process. Can you talk a little bit about that and how you believe investors can best position themselves without making it an all-or-nothing bet against the U.S.?
Yeah, the questions we often get about a debt crisis, they usually do surround the whole deficit and debt issue. And this has been an issue that's been making retail investors nervous for decades. So the thing you have to step back and say, well, people were worried about a debt crisis in the 80s, and guess what? We haven't had one. So you can't invest based on the concept of you could have a debt crisis. I think more likely you do get a debt adjustment process. And if we continue to see high deficits, high debt levels, more than likely you get inflation ending up being higher than it would have been if the debt situation were more normal. And to some degree, we're already seeing this. You get long bond pain, and we've had that lately, right? So that may continue to persist. Periodically, you'll get flare-ups. And then eventually you get constraints on economic growth. So the best approach for investors, we think, is global diversification, rebalance frequently, and just have a healthy level of skepticism about the Treasury market.
Kelly, thanks so much for joining us today. Really appreciate getting a few minutes of your time. Kelly Bogdanova, she is portfolio manager at RBC Wealth Management based out there in the Bay Area. Get back to earnings here. Luxury goods maker Estee Lauder put up some pretty good numbers. The stock is up 16% today, which is a good day. It's still down about 6% year to date, but certainly having a good day today. We check in with Deb Aiken. She covers all the luxury companies for Bloomberg Intelligence. She's based in London here. What's going on with Estee Lauder? Deb, what'd you take away from their quarterly report?
Hi. I think that this is the first time that we get a clear indication and confidence that the profit recovery growth program that they set about a couple of years ago under the CEO, Stéphane de la Faverie, is really coming to fruition. So in fiscal 26, they have booked the top end of the 1.7 billion attributed to the plan overall, and starting fiscal 27, they're looking towards the top end of 1.2 billion. It was 1 to 1.2 billion. They're looking towards the top end in terms of that accumulating over the coming year for savings. Now that included things like streamlining, general savings, and 10,000 job cuts. And the market is expecting and believing now that we can start to see some of that coming through. We looked at the 4Q. There's clear acceleration on the 4Q. Their constant currency came in at 5%, a couple of percent ahead of the market. In particular, half of their business is skincare, and that achieved 7% growth. But not only that, we saw the op margin running from 8.2 towards 19%. And so a big rise there, and that's going to help them to deal with the rest of businesses with fragrance and makeup and really get those growth rates it's up to markets 3 to 5%. So they're focusing 27 on 3 to 5%, but we think they'll get towards the top end of that. Consensus is on 4. They upgraded operational outlook for 2027, and the EPS was well ahead. And I think when we look at 2027 already, we expect about 5% upgrade on EPS, and with some contribution running into 2028 as well.
Deborah, we're seeing the 4th consecutive quarter of organic growth for Estee Lauder. Could you break down a little bit in terms of how much you perceive this beat to be a true demand recovery versus the effects of restructuring?
So actually, if I look at the top line and the organic growth and the way that is made up, they're getting, they're reporting market share growth by value, so including volume plus price, ability for their brands to raise price in mainland China, in Korea, in Japan, and Western Europe in the 4th quarter, the rest over the full year. And then also volume growth is positive in the US, and I think with what they have planned, the way they're focused and restructuring, that they'll get that back to value growth too, so being able to command pricing in the US. So it's them, but also if we look at the US, one of the big things we've talked about has been the drag across these luxury goods type companies, the beauty premium companies, on travel retail, and they're saying travel retail is clearly coming back in mainland China and other areas across Asia. It's also moving to the east and to the west, so we're seeing some of that travel retail also doing well, coming from the Americas into Europe, and that is helping to absorb about 1.5% to 2% of growth being shaved from the top line from Middle East for all of these companies. So it's some company contribution and also some market synergies and contribution that are coming through.
Hey, Deb, about 30 seconds left. Are the Chinese consumers, are they traveling, or are they buying mainly in China, maybe Japan a little bit? Are they traveling to Europe and to the US?
We've certainly seen some of the movement to Europe. Not to what it was pre-2019, but certainly better than last year. And we expect that to continue. There's supposed to be some level of momentum in the second half. For the US, less so. Some are starting to travel, and there's expectation that will pick up more in 2027.
Deb, thanks so much. We appreciate getting a few minutes of your time. You are the go-to person on all things luxury. Deb Aiken, luxury goods analyst for Bloomberg Intelligence. You need a separate luxury goods analyst as opposed to just like retail, because it is a completely different market.
Absolutely. And with the K-shaped economy that we're hearing so much about, that pressure on the luxury goods market is only going to intensify over time. So
yeah, I mean, Deb walks into any like high-end shop anywhere, like in London, Paris, Milan, New York. They know her. They're like, it's like, the restaurant review dude from the New York Times. It's the same thing. You better be on your best behavior when she walks in the store. Looking at the markets here, S&P's up 28 points. The Dow's up 270 points. That's a 0.5%. We'll make note of that. The Dow's, that Nasdaq's off about 10 points here. But the real story is in the bond market here. 30-year bond, we're up 10 basis points. We're down 10 basis points, kids. 5.18%. This Treasury Secretary coming in, doubling the bond buybacks. The long end of the curve is taking note for sure. That's what they wanted. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
10:40 on Wall Street. I'm Alexis Christoforous from the Bloomberg Interactive Brokers Studio. Wall Street staged a rebound after the Treasury said it plans to boost buybacks of longer-dated bonds. It's a signal the U.S. wants to lower borrowing costs after yields hit multi-decade highs. The S&P 500 up 40 points now, or 0.5%. Dow Jones Industrial Average racing ahead, gaining 325 points, a gain there of 0.6%. The Nasdaq had been lower earlier. It's now in the green by 52 points, but the Nasdaq 100 is still down by about 20. We've got Brent crude at $91.70 a barrel, and West Texas Intermediate crude now at $85.83 a barrel, up more than 1%. The Bloomberg Dollar Spot Index down 0.8% at 1192.02, and the 30-year yield down 9 basis points to 5.18%. The 10-year yield down 6 basis points to 4.64%. Shares of Moderna spiking 140%. We've got shares of Merck up 11% after the company said their joint vaccine reduced the recurrence of melanoma in a large late-stage trial. That's raising expectations for treating the deadliest form of skin cancer, and it shows the promise of the embattled mRNA technology. Shares of Lazy Boy sinking 16% after second quarter sales missed estimates, and Viking Holdings shares climbing about 2% after posting strong profit and offered an upbeat outlook. Management also soothing investor concerns here about the impact of low water levels on the Danube and Rhine rivers. That prompted the cruise line operator to issue vouchers to some travelers, and I believe Paul Sweeney's going to be on one of those rivers
The
this
Seine
fall.
River in France, so I'll be on there.
We're hoping for a lot of rain. For a lot of reasons, we're hoping for some rain.
Yep.
Yeah,
Yep.
that's your business. That's your Bloomberg Business Flash. Back to Judy and Paul.
All right, very good, Alexis. Thank you so much. We appreciate that. Judy LaGrue sitting in for Scarlet Food today. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Well, in the media space, big story is California is leading a group of states suing to block Paramount Skydance purchase of Warner Brothers Discovery, claiming that the deal would give the company too much control, blah, blah, blah. Paramount executives, on the other hand, have responded by threatening to pull its operations out of California. This is kind of raising the questions of how much should states, municipalities do to keep incumbent businesses around as opposed to maybe, I don't know, incentivizing some new businesses. That is the subject of our next guest opinion piece. Gautam Mukunda, he's a lecturer at the Yale School of Management, and he's a Bloomberg opinion contributor. Zoom from Sweden. Don't ask me why. There is a story there, but we'll save that for another time. Gautam, thanks so much for joining us here. What are you taking away from what's happening with some of these big media companies in California?
So I think it's twofold. One is that there's just the standard push and pull where companies always threaten to leave because they're not getting exactly what they want, or that. But the second is, the politicization of everything, right? In particular for sort of Paramount Warner Brothers, with Larry Ellison being such a prominent supporter of Donald Trump. I almost want to ask them, did you not think there would be consequences? Like, is it shocking that Democrats, having seen these doors open, or not being reluctant to do things, are going to do these things themselves? Like, I'm not surprised. I don't know why they would be.
Gautam, I'm curious on that point in particular, what test do you believe that policymakers should use to distinguish between a legitimate warning and basically an incumbent reinforcing its position? Like, how do you see that, and how should policymakers really view that?
Yeah, so that's the trick, right? Because businesses always say that, and I mean, the worst offenders are sports teams, but there's this constant sort of strain of like, yeah, I'll leave if I don't get X, tax benefits, whatever. I think the clear test we have to understand is this something that I'm doing because it's a special favor that favors incumbents and blocks new entrants? Or is this a policy that I think is actually good for business climate in general, in particular would be good for new entrants? I have to say is that the distinction here is what is good for business is not necessarily what is good for business. And California is sort of the best example of that, because California is Silicon Valley and is the center of global innovation because it kind of accidentally stumbled into not enforcing non-competes. Without that, Silicon Valley doesn't take shape the way it does at all. But businesses, incumbent businesses, established businesses, they love non-competes, and they always fight any attempt to get rid of them. And that's sort of a big tell, right? That whatever they might be saying, this isn't about being good for business in general. It's just good for me.
It's interesting because you think about the technology industry globally, and why has it been so successful in Silicon Valley and not in, say, the Europe or UK. And a lot of folks say it's just been the light regulatory touch of the US and maybe even the state of California. That's seen as a good thing, right?
Yeah, so it's not just the light regulatory touch, it's the right regulatory touch, right? And we got to distinguish that, because if you were to go back to 1955 or 1960 and ask, where is the computer revolution going to happen? Where is the next that's going to happen? You wouldn't have picked California. You would have picked Route 128 in Massachusetts, where there was a much more favorable configuration of events than what happened in Silicon Valley, except for the regulatory environment, right? Boston, Massachusetts enforced non-competes. They enforced them strongly, and that really did drive new businesses into California, where they could create this sort of intellectual hub, right? So saying we will not enforce non-competes from the perspective of an incumbent business, that's a really unfavorable regulation, right? That's not a light touch. That's a pretty strong thing that they don't like. It was just really good for the environment. It was really good for business in general. And so we really, really need to, when we think about these things, to drill in on this question is, are you doing special pleading, or are you saying I'm actually something that's good for everybody?
Yeah, Route 128 in Mass is pretty good, but Silicon Valley really came from, guess where? New Jersey. Menlo Park, California, where did that come from? Menlo Park, New Jersey. Sand Hill Road in Silicon Valley, where did that come from? Sand Hill Road in New Jersey. The Institute for Advanced Study at Princeton University. I think this guy, Albert Einstein, that's where it all started. But these guys wanted better weather, so they all went out to California. That's the history.
I am a Stanford graduate, so this is all music to my ears.
I love dressing down these smart young guys out in Silicon Valley over the last 40 years when they tell me how smart they are. So,
please,
guys, you could have been in Jersey.
We need to be humble, I think. Gautam, another follow-up question on that, because I think that's a really fascinating point. How much causal weight can you really put on sort of the regulatory environment in California as opposed to Stanford, as opposed to immigration, venture capital, network effects?
Yeah, no, that's a really important question, right? So these things are always multi-causal, and you can't, if some other state or country just adopted California's regulatory environment wholesale, maybe they would get some improvements, but they're not going to get Silicon Valley, right? So there's clearly a complex ecology of systems there. Everything down to the weather. I mean, like, who wouldn't rather have California weather than Boston weather, right? Like, there is a differential between those two. But we shouldn't understate the role of that regulatory environment, because there are lots of other places in the country, in the United States, that had the same federal regulatory environment, that had the same sort of government technology investment, that had same access to the same sort of educated people. Stanford's wonderful, but it's not better than the combination of Harvard and MIT that Massachusetts had, right? But Silicon Valley still happens in California. So we have to think about regulation as a key factor. And sort of this is, a big driver for people in Silicon Valley right now who are sort of saying, the government is always in our way. The government is always the problem. I'm like, you guys are creations of the government, right? Every single technology that Silicon Valley is based on has its foundation in U.S. government labs, without exception. And sort of pretending that all of this could happen without the nurturing arms of the United States taxpayer is, it's ahistorical. It's frankly delusion.
And that kind of goes to the policy now of this administration pulling back some research grants from certain universities. A lot of folks say in the long term that could be harmful as well, because this country, certainly since World War II, was built on a public-private partnership investments from the U.S. government funding research at the university level, because, I don't know, that's where the labs are, that's where the sciences are, so that's how I always think about it. Gautam, thanks so much for joining us. Always appreciate it. Gautam Mukunda, he is a Bloomberg Opinion columnist for Bloomberg Opinion. He also has a gig up there at Yale Law School, the School of Management, doing some good stuff up there. But boy, the technology coming out of Silicon Valley is just extraordinary. What a great place in the world. And you just wonder, Judy, why doesn't that happen in Europe? Why doesn't that happen in the UK? And there's a lot of reasons for it, but it's been so concentrated in the valley there.
I think it's really a factor of the American ethos, right? Like, I remember being at Stanford and it was kind of like, go for it. That was definitely like,
the risk.
if you want to start a company, if you want to study something that hasn't been studied before, go for it. So,
and that's what I love about the valley is everybody out there, or most, they think, don't worry about it. We'll figure it out. We'll figure out a technology. Used to be, we'll figure out some software. Now we'll figure out an app. Don't worry about it. And you know what? They're usually right about that. This is Bloomberg Morning.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
Hi, Judy LaRue sitting in for Scarlett Fu. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Target reported some numbers. I guess they're pretty good. The stock's up 5% today, but man, I totally missed this. Stock's up 64% year to date. How did I miss that? I mean, Target ripping it. Craig Trudell joins us. We're not talking about autos, despite what the title says on my screen. We're going to talk about just some general news here and Target earnings. Talk to us, Craig. What did the company report here, and why is the street so bullish on this name?
Yeah, I think this is a pretty clear story of relatively new CEO, a company that has been really challenged for a few years and has gone through some real issues in terms of sales. Having a clear strategy to turn that around and showing some traction, putting up the numbers to get Wall Street more comfortable with it. I think you mentioned sort of Target and how this is a company that sort of built a reputation for its home goods and sort of more discretionary items that may be lost out as the consumer prioritized the items that were sort of musts, groceries. So to see the company sort of making a more concerted push in that department as of just in the last few months even, it seems to be paying some dividends here.
Craig, back to school shopping, right? Immediate test for the second half of the year, holiday even bigger. What stat would show you that this turnaround is complete versus in terms of like all of these events that happen in the back half of the year for Target?
Yeah. I mean, I do think it was interesting for all the optimism about the results this morning. We are seeing a bit of a slowdown from one quarter to the next in terms of sales increase. So the outlook for the full year, they bumped that up a percentage point to 5%. I do think that this is still a story where, it remains to be seen, just how sort of established this turnaround is, but it is going to be really important that the company keep this momentum up. And it's not going to be easy, right? I mean, we're hearing from other big box retailers this week, Home Depot and Lowe's in particular come to mind. I think Home Depot of those two, had much better, results than Lowe's did this morning. And yet both of them had some real consistent things to say about kind of the state of the American consumer that, big home improvement projects, for example, are things that the conditions of that, as Home Depot put it, are just frozen. So, the consumer may not have the sort of latitude to sort of splash out on back to school like maybe they did years ago.
Absolutely.
What I've learned just reading about retailers like a Target or Walmart is how important management is. I mean, so talk to us about this new guy, the new CEO, maybe what he is doing here.
Yeah, I mean, I do go back to this grocery story. I think it's going to be interesting to see how that plays out in particular because, you don't necessarily think of Target as being your sort of go-to grocer. Yep. And, they're trying to...
I don't think about Walmart until Jen Bartashis about 10 years ago said, no, the number one supermarket in this country is
huge.
Walmart. I didn't know that.
Yeah.
Absolutely.
Not in New York, we wouldn't know.
Yes.
Yeah.
And Walmart and Costco, these are two names that have really sort of, kind of taken over that space. And it is interesting to me that Target is both sort of leaning more into that segment of their business and yet sort of taking kind of half steps. They're not wanting to necessarily make the value play that you've seen Walmart make and sort of, consistently made over the years. Whether or not they can sort of walk this fine line of building that business, but also doing so profitably, that seems to be the play here that Fidelki is making. And it's interesting to see the street buy into it.
Has Target, in your opinion, actually turned the corner on their recovery, or do we need a couple more quarters? Do investors need a couple more quarters to really prove that turnaround has happened?
Yeah, I think, looking at just this year and even just, this is a couple quarters now of real serious traction. I think the thing that's of course going to be challenging is to kind of keep that going after what was a very extended slump, right? So this is a company that it's not just coming out of just a couple of bad quarters. This was a few years, and this wasn't just issues of product fit or things like that. I think there was also some real questions about sort of overall brand damage, right? The handling of some of the sort of cultural zeitgeist moments of the last few years. Some people, don't come back immediately to a brand after that damage is done.
Seeing some reporting from the BBC that Target has revealed it's received almost $1 billion in tariff refunds. Wow. A, that's a big number. B, are other retailers seeing that too?
That is another sort of fly in. I guess fly in the ointment is a negative, but this is something that's very much in the mix. And even just last quarter, I think we were starting to see some of this flow through. And it is making a meaningful difference for retailers, and to see the sort of puts and takes across these companies in terms of, how they sort of account for this and what their expectations are going forward for still having more to come in terms of what they're able to bring to bear.
That happened quickly. I would have thought that it would have taken years to get that money back, like it does for me and anybody else who tries to get a refund.
Yeah, and it may be the case, too, that we have more refunds to speak of, right, in that there are more and more challenges to these various elements of the Trump tariff, attempts here.
We'll see. Craig Trudell, thanks so much. We appreciate that. Craig used to be the auto guy. He wouldn't know a car if he tripped over it now. Now he is managing editor of Global Business Coverage. Wow, that sounds important. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network. Coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, originals and the Bloomberg Business app.
Judy LaGrue sitting in for Scarlett Fu. I'm Paul Sweeney. We're live here in our Bloomberg Intelligence program. We're here in our Bloomberg Interactive Broker studio in New York City. We're streaming live on YouTube as well. Coming up in this hour, we're going to talk to Lindsay Dutch, Bloomberg Intelligence Consumer Hardlines analyst on Lowe's. They reported some earnings there. Peter Cheer, head of macro strategy at Academy Securities, get his thoughts on these markets here. Mary Ross Gilbert, she's a Bloomberg Intelligence senior analyst covering the retail space. TJ Maxx plans to open more stores. So it's pretty interesting there. We'll take a look at that. A lot of folks like that TJ Maxx story. Sundar Singh Cassidy, CEO of Xero, on how AI is changing financial software and the way small businesses make decisions. So a lot coming up in this hour. Let's kick it all off by heading down to Washington, D.C. Amy Mars got world and national.
All right, thank you, Paul. We are seeing a bit of a rebound on Wall Street after Treasury said it plans to boost buybacks of longer-dated bonds. We do check markets for you all day long here at Bloomberg. The S&P 500 up 0.7%, NASDAQ up just about 0.5%, and the Dow up 0.6%. The Russell 2000 index up 1%. 10-year Treasury yield at 4.64%. The 2-year yield at 4.18%. Crude oil moving higher. WTI at $86 a barrel, and Brent crude closing in on $82 a barrel. The Treasury is stepping in after a rout in long-dated bonds, saying it'll at least double buybacks of 30-year Treasuries to $4 billion each time. Ira Jersey is chief U.S. rate strategist at Bloomberg Intelligence.
This is a little bit like maybe the beginning of a larger coordinated effort between issuance or buybacks and other things to try to arrest the sell-off that we've seen in the long end of the yield curve. One of the problems, though, that the Treasury is going to have is this doesn't do anything for the deficit. It doesn't improve the deficit at all. So there's still going to be a lot of issuance. It's just a matter about where along the curve it's going to be.
Ira Jersey with Bloomberg Intelligence. The move follows a bond sell-off this week that saw the 30-year hit its highest yield since 2007. Right now, it's hovering around 5.19%. A personalized vaccine developed by Moderna and Merck helped reduce the recurrence of melanoma in large late-stage trial. The trial met its main goal of showing that the vaccine, combined with Merck's immune drug Keytruda, reduced melanoma recurrences more than the immunotherapy alone. Moderna CEO Stefan Bancel says it could be approved as soon as 2027. Shares of Moderna now 131% higher, and Merck is now 11% higher. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Paul and Judy.
All right, Amy, thank you so much. We appreciate that. Judy LaGrue sitting in for Scarlett Fu. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio in New York City, streaming live on YouTube as well. All right, folks, now Bloomberg.com subscribers can shape the conversation on Bloomberg Radio. Submit questions for the experts and guests on our show. Visit Bloomberg.com/AskRadio. It's an exclusive feature for Bloomberg.com subscribers and terminal clients. Visit Bloomberg.com/AskRadio to join the conversation. As Amy's just reporting, we got some green on the screen here. Stocks mostly higher here today. Let's take a look at some of the individual stocks on the move today. We can do that with the Bloomberg's Christine Aquino. She is managing editor for Markets Live. She's here in our studio. What do you got for us, Christine?
All right, Paul, let's start with SK Hynix, ticker SKHY. Very much in green there. That stock is up nearly 3%, and all because of buybacks. The company said that it will buy back shares worth the equivalent of $29 billion between August 20th and November 19th, and then canceled them. And they're also raising their shareholder return pledge to more than 50% now of cumulative cash flow or free cash flow from 2025 to 2027. That's going to be about the equivalent of $170 billion. So a lot of damage control, it seems, for SK Hynix here, because their stock. They did. They raised $26.5 billion in a U.S. listing just over a month ago, but the shares have fallen more than 50% in 2 months. And so this seems like an effort to shore up or reshore up that investor confidence, given that massive share decline, especially because, you know, there are signs that investors are becoming more concerned about the durability of the AI trade and how much more hardware spending we're going to see from hyperscalers moving forward.
Boy, the volatility in that name is crazy.
Honestly. Christine, what are you seeing with Moderna?
Moderna, that's another stock in the green today, Judy. So ticker MRNA, and shares are up a whopping 130%, more than double today. And that's because of this massive breakthrough. They had a study taking a look at a drug that Moderna and Merck created together to reduce the recurrence of melanoma in a large late-stage trial. So this is the study, a first study, where it showed the first positive final stage trial for any mRNA-based cancer therapy. And it also provides the strongest evidence that the technology that made Moderna a household name during the COVID era will have a successful second act. You know, William Blair analyst Miles Minter puts it, Moderna has a clear line of sight to revenue diversification from the COVID business. And of course, it addresses the deadliest form of skin cancer. I didn't actually know that, but yeah, there you go. Big market potentially there.
Yep, very good. That's good news for those folks. All right, one more.
Let's take a look at Estée Lauder as well. Another stock in the green, so ticker EL. Those shares are up more than 16%. Good results all around. Fiscal fourth quarter revenue of $3.6 billion, beating estimates here. And their organic sales growth also accelerated to 5%. Now, Estée Lauder has billed this year as pivotal, and the company has, of course, done a number of things to boost profitability, including restructuring and reducing headcount. So the company said today that it expects a total net reduction of 10,000 positions. By the way, the advanced night repair serum from Estée Lauder, highly recommend, Paul.
The what?
It's called advanced night repair. So if you ever want to improve your skincare routine,
the nighttime skincare routine is so important. You know, you let it do the work.
Alex Steele back in the day told me you have to invest in your face.
I know.
So
yeah,
John Tuck and I obviously missed that.
You got to take care of your face for radio. So.
Yeah. I wear sunblock, right? I'm Irish. That's about the extent I go. I'm wearing sunblock. All right, Christine, thank you so much. Appreciate that. Christine Aquino with those stock movers there. For more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. The big story in the marketplace today is the U.S. Treasury unexpectedly announced it is ramping up buybacks on long-dated government debt, taking the action in the wake of yields on such securities hitting the highest levels in years. And it seems to be working, at least in the short term. The yield on the 30-year U.S. Treasury is down about 9 basis points. We're now at 5.19%. Let's talk to somebody who does this stuff for a living. Will Hoffman, Bloomberg Intelligence, U.S. and Canada rate strategist. Will, what do you make of this move by the Fed here? Does this have substance behind it?
So I would note this one's the Treasury getting a little bit active. If the Fed was involved, this would be a much different story, and something more akin to QE or a yield curve control type scenario. In this case, it was absolutely a surprise to us and markets why they chose to do this off of the quarterly refunding cycle. We just had the QRA announced on August 4th, where these were expected to be held flat throughout the quarter. And I don't think it's an accident that this was announced in a pretty thin summer trading environment with no major economic data when everybody and their mother is likely on the beach before the school year kicks off.
That's a cynical take there, Will.
And I think one of the reasons why you're seeing such a pronounced move in the curve with the long end kind of leading a bull flattener move. This is more signaling about what they could do in the future than the actual tweak in the language, which was at a minimum a $2 billion increase in buybacks across the quarter for both the 10 to 20 and 20 to 30 year bucket, which have been in demand since this program started back in 2024. Yeah.
I mean, in your opinion, could this really reduce liquidity in the benchmark treasuries, or does it improve overall market functioning, or neither? Can you tell me a little bit about the long-term effects of this?
Yes. So many who are smarter than I have done a lot of incredibly good research on this. And the biggest impact is on and off the run spreads, where they're actually buying. I should say the way this is funded is they purchase low dollar price, deeply off the run and illiquid debt using proceeds from on the run, call it benchmark bonds, and to an extent T-bill issuance. So the weighted average maturity of the debt does inch down. But all in, it's probably going to increase on the run liquidity and off, in my opinion. You free up some balance sheet on dealers, you free up some duration capacity from the buy side, with some managers just getting access to go direct to the facilities earlier this year. So it should help things on the margin, but again, it's more of an off the run, on the run spread than an active, I'll call it duration catalyst, which is another reason why we think that this is the first lever that they've pulled in terms of issuance since this administration rolled in. And I think that's why you're seeing such an abrupt market reaction, where we've all talked about it, of potentially they could lean more on T-bills, potentially they could increase buybacks in the long end, potentially they could cut long duration auction sizes. There's a lot of potentials, but they've been very reticent to actually touch any of those levers. And I don't think it's an accident that they surprised us in an off-cycle announcement just to give a pretty decent signaling boost to the long end when it has been floating around in pretty weak waters as of the last few weeks.
You know, we've seen I was just seeing some reporting earlier this week about how long end rates around the world are certainly higher over the last, several weeks, couple of months here. It's not just the U.S. here. So the fundamentals are what the fundamentals are. How do these interventions usually work? Do they have some permanence, or is it just kind of you shake it off after a day or two and focus back on the fundamentals?
I mean, I think it depends. I'm no yen strategist. I will leave that to our incredibly talented currency team. But I think the answer is it depends. If you look over to the Japanese currency markets, which were intervened in relatively recently, and that may paint a very different picture than what we could be looking at on the Treasury front. I will say they're usually, just looking at the count of incidents that we have over the last several years, they're much more likely to, or I should say much less likely to mess around with Treasury auction sizes and net issuance cadence. The Treasury always has a mantra, and it's not a hard rule, but they seek to be as regular and predictable as humanly possible with these things. And so when you do see an about face on something they just reiterated 15 days ago, that's usually a pretty good sign that this is going to be a lasting policy move. They don't pivot at like they're traders. So this is likely to be a pretty meaningful shift in how this administration is viewing duration issuance, and that they're going to start trying to support the long end. And as some of our users in our chat room have been cracking up about all morning, if you shenan once, you're bound to shenan again, is what we've been going off of this morning.
Very good.
So that's very much what's driving the market move, in our opinion.
All right, well, thanks so much. Appreciate it. As always, Will Hoffman, he does the rates thing for Bloomberg Intelligence alongside Ira Jersey. So that is a heck of a team folks we got looking at the rates market so that we're benefit from their wisdom, that's for sure. Let's get back to earnings here. Lowe's, they reported earnings. They cut its outlook for the full year after posting results that missed Wall Street estimates, showing how a stubbornly weak housing market is eroding the home improvement retailers' performance. Having not improved my home at all, I would know a hammer from a screwdriver. I'm the last person to talk to. That's why we turn to the pros. Lindsay Dutch, consumer hardline senior analyst at Bloomberg Intelligence. Lindsay, talk to us about Lowe's. What are they saying about their business and their consumer?
Hi, Paul. Thanks for having me. Yeah, Lowe's results came in a little bit different than what we saw from Home Depot yesterday. You know, we saw weaker than expected sales, and that was really on sort of a weak DIY consumer, people like you not looking to improve their homes. Pro spending was solid, but, you know, same-store sales 0.2% increase, you know, very, very minimal when Lowe's was really expecting sort of an acceleration in that second quarter from first quarter, and it didn't materialize.
In your opinion, right, so tell me a little bit more about this bifurcation between Home Depot and Lowe's. Why one reporting better than expected sales? Why under pressure for the other?
Yes, I actually think this is one of the most interesting things that came out of getting more details on the results from the earnings call this morning. So with Home Depot, we saw a build in same-store sales throughout the quarter. June stronger than May, July stronger than June. For Lowe's, we saw a very weak July, and what it seems to be was the case is, you know, some of Lowe's peers, probably including Home Depot, though they weren't named specifically, and other home centers, you know, they got those tariff refunds in June. They redeployed them by, you know, cutting prices and really trying to draw consumers in for those big July sales events. And Lowe's probably lost share in the month of July. They saw a decline in same-store sales with that customer choosing to shop elsewhere because of their focus on value.
Higher interest rates, it seems to be we're in a higher for longer environment. How does that impact, you know, some of the Lowe's, the Home Depots of the world? Presumably, people aren't going to be buying a lot of houses. How does that impact their business?
Right, so low housing turnover, you know, affordability, you know, those are major factors for these businesses. You know, they're awaiting a rebound in that market. We don't know when it will come, but, you know, these management teams are telling us that there is strong pent-up demand, and so when that rebound comes, you know, they're both pretty well positioned to gain, you know, a piece of that pie. I do think, you know, like there is still some spending happening, you know, that's probably coming from higher income consumers. You know, they're doing smaller renovation projects right now, it sounds like, or sort of maintenance and repair projects rather than like doing a complete reno. So we're seeing some spending, obviously muted, that is causing low growth for both of these companies, but they're both trying to make sure that they're investing today, you know, for that ultimate rebound so that they can win share and gain spending in the long term.
Could you talk a little bit about how inflation concerns and geopolitical uncertainty is really impacting the consumer as it pertains to Lowe's? What is the reasoning behind their 3Q outlook? How does that really work into all of this?
Yeah, so I think what we learned about the consumer, you know, I don't know that there has been a drastic step down, but the consumer is still very focused on value, very selective with where they're spending. So there's not necessarily a major pullback as a result of, you know, what we've seen so far this year, but, you know, consumers are just increasingly becoming more focused and more selective with their spending. You know, we've seen Walmart gaining share with higher income consumers. I think Home Depot's success with their July sales is probably, you know, someone who was thinking about upgrading and then they saw a price that they couldn't pass up on something like a grill. So I think that's what we're just seeing is just continued selectivity, maybe getting like slightly more selective, but no like drastic change in that overall consumer picture.
Lindsay, thanks so much for joining us. We always appreciate getting a few minutes of your time. Lindsay Dutch, consumer hardline senior analyst for Bloomberg Intelligence, is breaking down the numbers from Lowe's. They reduce their full-year outlook after they missed some numbers there. So keep an eye on that. Looking at the market here, we still got some green on the screen, holding on to some slim gains here. We got the S&P up 44 points. That's about 0.6%. The Nasdaq's up 117 points, about 0.4%. So across the board, some pretty good strength there. We're keeping an eye on that long bond here, down about 9 basis points, 5.19%. WTI crude oil up another $1.50, $86. No bueno.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. I'm Amy Morris. This Bloomberg Business Flash is brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver info guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. Stocks and bonds rallied after Treasury announced it will increase U.S. bond buybacks to stop the surge in long end yields. yields. The Treasury plans to add additional liquidity support for its buybacks of longer-dated debt, causing a sharp rally across assets. And we do check those markets for you all day long here at Bloomberg. The S&P 500 up 0.5%, NASDAQ up 0.4%, the Dow up about 0.4%, the Russell 2000 index nearing 1% higher. The 10-year Treasury yield at 4.65% and the 2-year yield at 4.19%. The 30-year yield now at 5.2%. Crude oil moving higher, WTI topping $86 a barrel, Brent crude more than $92 a barrel. Marvell Technology has entered into a commercial agreement with Google to develop custom semiconductor products. Marvell issued Google a warrant to buy up to 58.97 million shares. Shares of Marvell now about 8% higher. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris, and that is a Bloomberg Business Flash. Paul and Judy.
All right, Amy, thank you so much. We appreciate that. Judy LaGrue sitting in for Scarlett Fu. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio in New York City. We're streaming live on YouTube and Bloomberg.com, as well as Amy was just reporting the news today. Coming in out of the U.S. Treasury, unexpectedly announced it's ramping up buybacks of long-dated government debt. What's that doing in the bond market? Well, it's causing yields to come in, particularly on the long end. The 30-year U.S. government bond is in about 8 basis points, 5.20, had been as low as 5.18% here today. Let's see what it means for markets going forward. We can talk to somebody who does this stuff for a living, a professional. Peter Cheer, head of macro strategy at Academy Securities. Peter, thanks so much for joining us. A great day to join us. You know, we got the Treasury doing something a little unexpected here. What do you make of it?
Yeah, I think we're all trying to figure out, is this more of a one-off, in which case I think we fade it fairly quickly, or is this a sign that we're going to see a lot more cooperation between the Treasury and the Fed to kind of control the long end of the interest rates? So this is the Treasury doing it. The one thing that's not been discussed is, could the Fed do Operation Twist? And Operation Twist is where they sell shorter dated bonds to buy longer dated bonds. If they do that in conjunction, I think this move could be serious, but we haven't yet seen a sign that this is widespread and not just a one-off.
What do you think is driving the bond market more now? Is it more the inflation outlook? Is it fear of supply? Can you talk a little bit about the conditions that predated this action by the government?
Yeah, so I think right now when I look at the bond market, I view it very distinctly as 2 years in, and that's kind of the inflation story and the Fed story and whether Warsh is going to be able to avoid hiking. I think he's going to be able to avoid hiking. So I think that's been anchoring the 2 year and in part. I think on the long data side, it's much more about global debt issuance, right? Sovereigns are going to need to issue debt to, fund defense, to fund infrastructure. The Middle East went from being a big buyer of treasuries potentially to needing to issue their own debt. And then you've got corporate America, where you have all these great companies, very high rated companies, issuing debt to fund their compute build out. And so I think there's a lot of competition for longer dated treasury yields. And to be honest, I view treasuries now as very generic. They, 10 years ago, that was kind of the gold standard. If you wanted safety, you had to own the long dated treasuries. I think if you're in Europe, you look at German bonds, they're okay. If you're in Japan, you look at Japanese bonds, they're fine. And then even in the US and globally, I think, maybe I want that extra spread to own the hyperscalers rather than US Treasury. So they're being crowded out a little bit.
Peter, next week, some economic folks are going to head out to the West, out in Wyoming. And what do you expect to hear from Fed Chairman Warsh at the Jackson Hole meetings next week?
So, I'm really hoping he kind of puts on the foil, to quote a slap shot. But I would like to see him be very aggressive. And the one thing I think that he's doing that I think is most exciting is challenging the data sources we use. So I think these task forces that he's created, how we use QE, for example, in the past when we've used QE, we say we're going to buy 20 billion a month, and then we buy 20 billion a month until we buy 15 billion a month. And that's always kind of been nonsensical to me. To me, the power is, hey, we might do QE, but we will keep it a little bit secret. And maybe some months we'll buy more, some months we won't do as much. So I think we could change how we play with the balance sheet. I think we could change the data sources. Again, real-time rents. There's better ways to measure this than OER, which goes into CPI. I like Trueflation, for example, as an alternative to CPI core. I don't want to go rely on one or the other, but you want to take more data into account. So I think he's going to push back. And then the other thing that I think people have been getting wrong, and it's moving my direction, fortunately, or knock on wood, is the two main sources of inflation right now. A hike is not going to help. hiking is not going to help the problem with the oil flowing in Iran. It's just not. If anything, it makes it harder for us to produce our own, or more costly to produce our own because of interest rates. And the other big side of this is the compute spend. And these companies are trying to make 20x, 30x, 50x, you name it. So hiking 50 bips is not going to slow the compute spend. So I think it would be kind of, tilting at windmills to hike right now when the main sources of inflation are not going to respond well to a hike.
All right, Peter, we're going to have to leave it there. President Trump is speaking. Peter Cheer, head of macro strategy at Academy Securities. Right now, let's go to President Trump making some comments publicly. President Trump.
I get along with him very well. I can't let Iran have a nuclear weapon. And I know Kim Jong-un very well, and he's going to be fine. As long as we have a smart president, he's going to be fine. If we have a dumb president, then he's probably not going to be so fine.
Are you expecting to meet with him later this year?
Yeah, I will be.
Mr. President, today's about American production. Can you give us any update on your negotiations with Canada for a trade deal?
Yeah, we had a very good conversation with the Prime Minister last night, and we've come to a deal with Canada. As you know, the 50% tariffs across the board were going on against Canada today. And they called yesterday and they gave us the points that we had to have. Very fair deal for both. The tariffs will be non-existent for our farmers. Our farmers were paying tremendous tariffs into Canada, and those tariffs are going to be totally eviscerated, down to zero.
Is the U.S. going to lower tariffs on Canadian autos or lumber?
We're doing certain things. Got to give something, and we're doing certain things. They were paying a high number. We're reducing it a little bit. It's good for everybody. But our farmers are going to be thrilled. Our manufacturers are going to be thrilled. And basically, we have no tariffs going into Canada anymore. Canada was charging us tremendous tariffs. We no longer have any tariffs. And what I was able to do is we put, as you know, under the new tariff, I guess you'd call it the new tariff schedules that we came out with. They were going to get a 50% tariff on everything starting today. And we've held it back 3 days. It's all subject to finalization of documents. So subject to the finalization of documents, we have a deal with Canada, and I think it's a very good deal for both parties. It's great for our farmers. Our farmers will no longer be held up because they were being hurt very badly by Canada. Yeah. The Strait, last night we had a lot of boats come through. We have possession, complete control of the Strait. I mean, outside of nuisance value, and there is nuisance value when they shoot a drone every once in a while, and not everybody's going to go through, but they come through. And over the last couple of weeks, we've had a lot of oil coming out, a lot of oil. It's not going to be perfect, but it's a lot of oil coming out, a lot. In fact, people are amazed. One of the reasons that oil hasn't gone to like the proverbial $300 a barrel, it's at 83, 84, 85. And it'll be a lot lower when this is over because we have plenty of oil. But one of the reasons it never went into 3 and 350 numbers because we have a lot coming in. And people are finding alternatives too. And you know one of the alternatives? Texas. You know another one? Alaska, Louisiana. They're coming to the United States to get oil. And people say, oh, you shouldn't say that because it makes it sound, well, it is what it is. I mean, they're coming to Texas, Louisiana, and Alaska to get oil.
Mr. President, normally we have talks on that.
About what?
Reopen negotiations.
Maybe at some point, but right now, I think the situation is so good, but maybe at some point. Look, it's very simple. They have to get rid of no nuclear weapons. Iran cannot have a nuclear weapon. You know why? Because they'd use it, and we're not going to let them use it. So Iran cannot have a nuclear weapon, and they won't. Thank you very much. I'm glad you came out. Thank you.
All right, that was President Trump making some comments at the White House. Looks like a group of construction workers or just workers, and they all got their vests on, their brightly colored shirts there. So I'm not sure what the event was, but anyway, some comments there about Iran, about the pending, I guess, tariff truce, I guess, with Canada. Is that the way we'll call it there? So apparently the tariffs that were threatened to go back onto Canada now be not going on, which is a good thing, I think, for both sides. Let's get back to it, folks. We got some green on the screen. Stocks are higher. Yields are coming in. And earnings continue. And that concludes TJX. reported better than expected comparable sales for the quarter, but its new plan to ramp up store openings shook some investors here. TJ Maxx stock is down about 2.7% today. On a year-to-date basis, down about 4%. Mary Rose Gilbert follows this name. She's a senior analyst covering the retail space for Bloomberg Intelligence, located in our Los Angeles, California studios out there. Mary, talk to us about TJX. What did you see this quarter, and what's kind of the outlook here?
So, Paul, what's going on here with TJX is that they reported weaker than expected comp sales at Marmax. So Marmax comp sales came in at 1%. Analysts were looking for 2.8%. It was weaker than the company expected. There was some misexecution there. But as you pointed out, their overall comp sales were ahead of expectations, both guidance, which is always in that 2 to 3% range, and also analysts at a 4% comp. And the reason for that is because it's a global business. So they're diversified. They also have the home goods business, which outperformed. Their comp sales were up 7%. International was also up 7%, and Canada 6%. So you're seeing real strength across the board. And where they had some execution issues in the quarter, they're already seeing some improvement in the third quarter, and they expect by the fourth quarter they'll be back to trending where they usually do with Marmax.
30 seconds left. Mary, talk to us about store openings. We don't really talk about that too often in your business.
Yeah, so actually, well, with off-price, definitely. So they're increasing their long-term outlook. They now expect to add 500 more stores to about 7,500. That means that they have runway to open 2,200 stores over the long run. And that means that each year, instead of opening somewhere around, 130 to 140, they could be opening 200 stores a year. So they're really ramping up. They see a lot of opportunity in some of these smaller markets or little niche markets with some smaller stores. And the new stores, when they open, are outperforming expectations.
All right, very good. Mary, appreciate that. Mary Ross Gilbert, she's a senior analyst covering the retailers for Bloomberg Intelligence, joining us from Los Angeles. TJX, looking at the stock here, down 3% today. Down, I guess, call it about 4.8% year to date, but on a trailing 12-month basis, up about 9-10% there. So one of those retailers you got to keep an eye on because they do pretty well execution-wise. S&P up 35 points, the Dow up 190, and NASDAQ up 98 points. That's about 0.4%. Yields, that's the story today. The long yield, 30-year, comes in 8 basis points, 5.20%. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. I'm Amy Morris. This Bloomberg Business Flash is brought to you by IBKR. For the past 3 years, Interactive Brokers individual clients averaged 24.3% annually, beating the S&P 500. Lower costs and access to 170 plus global markets matter. Visit ibkr.com/performance. Former St. Louis Fed President James Bullard says Treasury's announcement that it's ramping up buybacks of long-dated government debt seems like an important tactical move, but does not change the fundamentals that are driving longer-term yields higher.
The market reaction suggests that this is an important tactical move from the Treasury, a little bit unexpected, so you're probably getting an outsized reaction right now. But I don't think it changes the fundamentals, big fiscal deficits and a Fed on the sidelines, which is what's driving longer-term yields higher.
Former St. Louis Fed President James Bullard on Bloomberg Surveillance. Stocks climbs as Treasury steps in to support the bonds. We check the markets for you all day long here at Bloomberg. The S&P 500 up 0.4%, NASDAQ up 0.25%, the Dow up 0.3%, the 10-year Treasury yield at 4.65%, the 2-year yield at 4.18%, and that 30-year yield bond 5.19%, almost 5.2%. It's just shy of that. Estee Lauder posting quarterly results beating estimates, ending a run of 3 straight declines in annual revenue. The company reaffirmed its 2027 full-year sales outlook, raising guidance on its adjusted operating margin, a key metric of profitability. Estee Lauder shares now 16% higher. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Paul and Judy.
All right, thank you very much, Amy Morris and Judy LeGroux. And sitting in for Scarlett Fu, I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Well, as this AI story continues to resonate with in the market over the last several years, the market's trying to discern winners and losers. And one group of companies and stocks that are under risk would be software companies, particularly software as a service companies. We saw the stock market sell off a bunch our earlier this year, called the SaaSpocalypse, I guess, is that the way to go?
That's correct, the
SaaSpocalypse. Our next guest probably has some thoughts there. Sukhinder Singh Cassidy joins us, CEO of Xero, which is a New Zealand-based accounting software company. The ticker's ASX. And that stock, along with a lot of other software names and software as a service names, down about 27% year to date. Sukhinder, thanks for joining us here. Talk to us about your company, Xero, and maybe how it fits in an AI world here.
Sure. Well, first of all, thanks for having me. So Xero, as you noted, was originally founded in New Zealand, but I think important that the business today operates in over 180 countries. Most notably, our big markets are the US, the UK, Australia, and serves almost 5 million small businesses and their accountants and bookkeepers. So we feel like we have a pretty good view. Obviously, I'd say contrary to what the market perceives, we think of AI as a massive tailwind to our business. Why? Because we are the digital enablers and the technology arms for the small businesses we serve. They historically don't have access to technology and look to us to make software make sense for them. And if you think about the tasks of accounting, payroll, bill pay, these are the types of tasks we do on Xero. Being able to have them just done for you in an accurate way with AI is a massive opportunity to give them back time and savings.
In terms of AI adoption among small business owners, what factors do you believe influence the pace of adoption among this population?
It's a great question. I think first and foremost, ease of use. So at Xero, as an example, over 2 million of our 5 million subscribers today already benefit from AI. Why? Because AI is all over the product in ways that make it easy for them to use. A good example is using AI to capture receipts from your mobile phone. That is a use of AI, traditional and generative. Another good example is when you log into Xero and you have to manually categorize your transactions, having them auto-categorized, having the transaction reconciliation just done. So I think the key to adoption is ease of use in the core tasks that give them a lot of value.
So you're at a conference right now with a lot of small businesses. What are they asking you about, accounting software, the type of products and services that you provide? What are they asking you for in terms of, this is what we really need going forward?
Yes, first of all, it's a wide spectrum. You noted I am at a conference. I'm at ZeroCon, which is called the Coachella for accountants. It's a conference we put on every year. We have over 1,200 accountants and bookkeepers here in Denver this year. We just came from ZeroCon London, where we had almost 2,000 accountants and bookkeepers for our UK market. And I would say we hear a couple of things. First of all, take away the repetitive toil and tasks. So they are looking to us to not just automate things like reconciliation of bank statements, but simple things, as I said, document capture, document chasing on late payments and invoices on behalf of their small business customers. So that's one spectrum. Please take away the repetitive toil. And then we have a small minority that are actually quite advanced on AI already. They're already working with companies we partner with. We partner with Claude, we partner with OpenAI, we partner with Microsoft, so that you can access our data through those platforms also. And that small cohort of customers that's more advanced, they're asking to access our infrastructure to build more low-code, no-code apps so they can actually automate advanced workflows on Xero. And for that, we have a product called Xero Force. So think of Core Xero, ease of use. They're looking for it to do the manual repetitive tasks, and then a small minority, but vocal, are using our APIs and our newer products that are more speculative but more innovative, like Xero Force, to build low-code, no-code apps.
As AI really becomes more integrated into these processes, what, in your opinion, are workflows that are best suited to automation, and where does sort of human review still stay relevant, and how has that line changed in your time at Xero?
Yeah, by the way, another great question. So first of all, one of our principles at Xero is what we call accountable intelligence, which is holding ourselves to a higher standard of providing the contextualator, the model training, so that you can give more accuracy in the AI on Xero than a generic LLM model. So I think that's an important characteristic. But when you think about, really this question of how they want to use it and where they want to use it, I think they would say that the easiest tasks to get done first with AI are repetitive. And they're simple. I think they would say that on probabilistic tasks, you should do something like unstructured chat to get a range of answers, but you can't count on a model to be accurate on an inaccurate subject. So if you want to ask a subjective question, AI is still going to give you a probabilistic, not a deterministic answer. So I think they're looking for repetitive tasks. I think they're looking for things that are easily categorizable, easily definable. That's why I said something like auto bank reconciliation, where we really identify the categories we think are a match. And all of them want control. So the way we build AI is we definitely put a human in the loop at the end. Even when we think we have the answer, we allow them to double check the answer.
So can you lay out for us kind of your competitive landscape these days, and how it has changed and how it may change going forward?
Yeah, sure. Well, first of all, we're one of a handful of global accounting software providers. There are very few in the world that operate across the breadth and depth of markets that we operate. So in that way, we're pretty unique. When we think about how the competitive landscape is changing, I think there's certainly a plethora of startups that are promising, I would say, to think about, accounting in a whole new way. Clearly, their challenge is they don't have the infrastructure of a Xero, and they don't have the data to train models to perform with high accuracy, not just on core cases, but edge cases. I mean, think about the billions of transactions we have processed at Xero over the last 20 years. So the competitive landscape is filled with startups, but I think they often are fixated on a feature, and we're looking at a bundle of features that have to work at high scale, but have the advantage of being trained on 20 years of doing this well. That's the biggest change in the competitive landscape, I would say.
Semiconductor, thank you again for giving us a few minutes of your time. I know you're busy at your conference there in Denver. Sukhinder Singh Cassidy, she's the CEO of Xero, which again is a New Zealand-based accounting software company, but that is a global company with obviously a large presence in the U.S. It trades on the Australian Stock Exchange, and I just was looking at the ANR function and the DES function. They come to market quite a bit with offerings, equity offerings, to fund their growth. So keep an eye out for that. Looking at the markets here, S&P is up 36 points. That's about 0.5%. The NASDAQ up 114 points. That's about 0.4%. So we're seeing some moves there. But really, I think the news and the action today is in the bond market here, with the Treasury stepping in and upping their buybacks of fixed income securities. The 30-year U.S. Treasury bond is down. It comes in about 9 basis points, 5.19%. So we'll keep an eye on that. Even on the 2-year, pretty flat, 4.17%. So most of the action here today is on the longer end of the curve. The 10-year in 5 basis points. We'll have more coming up. This is Bloomberg. Good morning.
You're listening to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
Judy LaGrue sitting in for Scarlett Fu. I'm Paul Sweeney. We are live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. I tell you, if you're Meta, I think you've got, maybe it's saying it's existential moment is too much, but this is an important time for Meta. They have, I don't know, 12 states suing them, saying, because we all spend too much time on our phone, and this goes to about the kids and trying to limit the time kids are on their phones and you know, hanging around on social media. This is going to trial, and this could be really big for Meta and for social media in general. So we wanted to go to an expert, and we have an expert in-house. His name is Matt Schettenhelm. He's a media litigation analyst. Yes, we have a media litigation analyst for just these types of situations. This guy, his phone is ringing off the hook from investors saying, what do I need to know about this trial with Meta and the state's attorney general? Matt, thanks so much for joining us here. Flesh out for us, what is the case and what are the potential scenarios here?
Yeah, the stakes are high here, Paul. As you said, we have really up to 29 states that are suing Meta. And based on the primary claim is a claim that basically Meta was deceptive in talking about how safe its product, its social media product is for young people. Basically an allegation that the company said, you know, this is safe. We don't try to hook users, including young users, when internally Today, the company allegedly was saying the opposite, that yes, we need to hook these young users. And so it's a basic claim from the state attorneys general that the company was acting in an unfair and deceptive way with respect to the youth. And the big problem for the company is that these state laws allow the attorneys general to obtain civil penalties that are set per violation. And when you have potentially 9 million teenagers affected by this, that math on those civil penalties adds up pretty quickly. And so, as you said, we are at the final stage of litigation, at least at the lower court here. We're at trial. We're on day 2 of trial. And so the stakes are pretty high when you do the math in terms of how big a penalty could be for the company here.
I mean, absolutely. We're talking in the trillions of dollars when we look at it, and when you compare it to Meta's market cap, right? Absolutely a cataclysmic event for the company potentially. Can you tell me a little bit about the legal enforcement of those penalties? What would that possibly look like? Have we seen a penalty of this magnitude before? And if so, what has that looked like?
This definitely has the potential to be unprecedented. In the tech space, we really haven't seen enforcement actions rise to the level of settlements above maybe the $5 billion range. Meta did a settlement with the FTC 5 or 6 years ago around that range. Here, as I said, you can do the math. The states initially were said to be seeking 1.4 trillion. I think they pulled back on that a little bit, and it's $193 billion. I'm not sure that's really realistic, but if Meta lets this go all the way to the end and lets the judge write a number on paper, it could easily be in the double-digit billions. It could set new precedent. Now Meta is a highly profitable company, and maybe the number, it can tolerate that as a one-time thing. Maybe the bigger threat is changes to its service and that sort of reduce young people's use of it going forward. But still, it's hard to get past the potential scale of the threat here. Meta does have a chance to knock this out. It could win before this jury and this judge. And then there's a second phase to actually set the remedy. So Meta might try to win in phase 1. Hey, we didn't do anything wrong, before anyone can put a number on paper. That could play out into next month.
That kind of goes to, this is a bigger issue item. It's not for Meta because this kind of goes to the whole social media experience and all the other companies out there, because if there are limitations on how people access these apps, then we're talking, that gets important for the whole industry here. How do you think, are they going to try to limit the scope here?
Yeah, so really all of this is driven by the fact that Congress has never been able to regulate in this space. Yep. They've never been able to get to that final step. So Meta thought it was sort of operating in a free pass land. There is no federal law, so we can operate here. But there are these judicial doctrines that are coming up in this litigation. What this all could escalate is actual action industry-wide from Congress to set standards that don't just apply to Meta, but apply to others. And Congress is very close to passing a couple bills that address harms to youth. As this case plays out, it adds momentum to Congress to maybe actually finally get something done there.
Yeah, because this is a bipartisan issue for sure, one of the rare bipartisan issues. So we'll see how that plays out. But we'll stay. I think Meta shareholders are going to be paying attention to this trial here. Matt Chettenholm, I know you're going to be paying attention to it, and we appreciate that. Matt Chettenholm, he's a media litigation analyst for Bloomberg Intelligence, truly expert. So if you're a Meta shareholder, reach out to Matt because he's got opinions on how this could play out. And there's other things he looks at. Disney, First Amendment lawsuit, against the FCC. That's a big one for the Walt Disney Company. So there's lots of legal stuff out there that has material impacts on companies, and we cover it at Bloomberg Intelligence. Judy, thanks for hanging in for 2 hours here. We appreciate it.
It's been great. It's felt like 10 minutes.
Awesome. I know it just flies by. It just flies by. All right. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. Your top stories and global business headlines are coming up in just a moment. S&P up 33 points and Dow up 150. The NASDAQ up 100 points, 10-year Treasury yields in 5 basis points. Lots of movement out there on a quiet summer day. This is Bloomberg.
From ABC News, I'm Michelle Franzen. At the White House, President Trump touting renovations, even though the ballroom construction is on hold due to legal challenges. The president says he's focusing on other projects on site.
I love construction. I love seeing things properly taken care of. As you know, we've redone the colonnade, going to the Oval Office. We put the black granite down, and now we're out here. So for 50 years, more than that, they've wanted to have a heliport, but nobody knew how to go about it. And we are building a great heliport.
The president also taking a victory lap. The Republican governor's race in Florida in yesterday's primary races. His pick, Representative Byron Donalds, winning the GOP nomination for the midterm elections. He'll face Democrat David Jolly. In Alaska, race results also coming in. ABC News political director Avery Harper says Trump's choice in a key Senate race won the Republican primary, but there are hurdles ahead for November elections. U.S. Representative Mary Peltola won the Democratic primary.
This was a warning sign for Republicans. Alaska has what's called an all-party primary, and so they will advance the top 4 candidates from the primary that was held last night, including Mary Peltola and Dan S. Sullivan, the incumbent Republican. Mary Peltola got a plurality of the votes, and so I know for Democrats this morning that I talked to, there was certainly optimism about this seat that they must win if they want to take control of the Senate.
Just minutes last night before a new round of tariffs were set to take effect on Canadian goods, President Trump putting a pause on the tariffs for 3 days. He said so talks between the U.S. and Canada can continue on finalizing a trade deal. In California, the trial against Meta continuing following yesterday's opening statements. Meta, the parent company of Facebook and Instagram, facing a multi-state lawsuit that the platforms are designed to be addictive for young users. You're listening to ABC News. In Philadelphia, the hunt intensifies for a masked man who chases joggers.
Chilling video released by investigators shows a man wearing a disturbing doll face mask.
He's actively engaged in running up to people. It looks like he's attempting to scare or antagonize them.
Police now scouring surveillance video in the area, believing he's threatened or chased at least a half a dozen people. Police say the suspect is seen using a cell phone, appearing to film the terrifying encounters. Intelligence units now scouring social media.
ABC's Rhiannon Alley. Toothbrushes, bags of chips, and cat food cans dropping from the sky. Amazon expanding drone deliveries to millions of its potential customers.
In communities across 7 states, Amazon drones can be seen hovering over homes, lowering their payload of household items, and then flying off to make their next delivery. Amazon Prime Air plans to serve nearly 500 cities and towns by the end of this year, dropping off packages within 60 minutes of the order being placed.
ABC's Jim Ryan. The city of Griffith, Indiana, still in the dark 7 days after storms knocked out power to the region. Town officials and residents like Tom Serator blaming the electric company.
In communities,
we've never been out of power for longer than 24 hours, and this has been the worst I've ever seen.
The utility company urging patience, saying it hopes to bring everybody back online by the end of the week. Meantime, much of the southern U.S. baking under triple-digit real feel temperatures today. Michelle Franzen, ABC News.
Live from Washington, D.C., This is Balance of Power with Joe Matthew and Kaylee Lines.
Scott Besson delivers a surprise for the bond market, and Angie Nixon delivers a surprise for Florida. Welcome to Balance of Power. I'm Kaylee Lines. Joe Matthew is taking the day off on a day in which we're seeing yields plunging on the back of the Treasury Department's surprise announcement to double its buyback program for the long end. So how worried is this administration about higher yields, and how effective will this move be? We'll get into that with Bloomberg's Michael McKee. Plus, we'll check in with Bloomberg's Tyler Kendall at the White House as the president also punted on Canadian tariffs for at least 3 days. Remember, they were supposed to go into effect at midnight. And of course, we'll recap the results from yesterday's primaries and the surprise from a Democratic socialist in Florida. We'll get into that with our political panel and Bloomberg's Bill Ferries. But first, let's check on the markets, because whoa, is it a big move in the bond market in reaction to the Treasury's move. Let's get a check on that and everything else with Amy Morris here in Washington. Hey, Amy.
Hey, Kaylee, and you're absolutely right. We are seeing a rebound on Wall Street after Treasury said it would be boosting buybacks of longer-dated bonds. We check markets for you all day long here at Bloomberg. S&P 500 up 0.5%, NASDAQ up 0.5%, the Dow up 0.3%, Russell 2000 index up 0.8%, the 10-year Treasury yield at 4.65%, the 2-year yield at 4.18%. Now, Treasury stepping in after a rout in long-dated bonds, saying it'll at least double buybacks of 30-year Treasuries to $4 billion each time. Ira Jersey is chief U.S. rate strategist at Bloomberg Intelligence.
This is a little bit like maybe the beginning of a larger coordinated effort between issuance or buybacks and other things to try to arrest the sell-off that we've seen in the long end of the yield curve. One of the problems, though, that the Treasury is going to have is this doesn't do anything for the deficit. It doesn't improve the deficit at all, so there's still going to be a lot of issuance. It's just a matter about where along the curve it's going to be.
Ira Jersey with Bloomberg Intelligence. The move follows a bond sell-off this week that saw the 30-year hit its highest yield since 2007. Right now, it's 5.2%. A personalized vaccine developed by Moderna and Merck helped reduce the recurrence of melanoma in large late-stage trial. The trial met its main goal of showing that the vaccine, combined with Merck's immune drug Keytruda, reduced melanoma recurrences more than the immunotherapy by itself. Moderna CEO Stéphane Bancel says it could be approved as soon as 2027. Shares of Moderna, 131% higher, Merck now 11% higher. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Now back to Balance of Power with Kaylee Lines.
All right, Amy Morris here with me in Washington. Thank you so much. Washington, of course, as we know, a town that loves a deadline. And the president is included in that. We know President Trump likes deadlines as well. At the very least, he likes to set them, if not always stick to them. And we had a new deadline midnight last night for tariffs on billions of dollars of Canadian goods that could have faced a 50% levy if no deal was in the offing. And it seemed like no deal was in the offing, at least until 10:15 p.m., less than 2 hours before they were slated to go into effect. The president announced a punt on Truth Social, writing, quote, "I have paused the 50% tariffs against Canada that were scheduled to kick in tomorrow morning for a 3-day period based on the fact that Canada and the USA, subject to the finalization of documents, have a deal. The great Keystone XL pipeline, long ago killed by sleepy Joe Biden," he says, "may be awoken from the grave." Bloomberg's Washington correspondent Tyler Kendall is live at the White House for us now. She's in the press pool and had the chance to question the president about this today. Tyler, what did he tell you?
Well, Kaylee, at this point, the White House says that a deal is done, but we haven't really gotten that firm of confirmation from the Canadian side, sort of downplaying the idea that there has been something agreed to by both sides. We're getting some of these headlines out. The USTR alongside Canada's trade minister coming out saying that some of the irritants have been addressed, but that they are still working to finalize and put this into place. So as we try to glean details on exactly what is in this agreement, I asked President Trump what it may entail. Can you give us any update on your negotiations with Canada for a trade deal?
Yeah, we had a very good conversation with the Prime Minister last night, and we've come to a deal with Canada. As you know, the 50% tariffs across the board were going on against Canada today, and they called yesterday and they gave us the points that we had to have. Very fair deal for both. It's good for everybody, but our farmers are going to be thrilled. Our manufacturers are going to be thrilled. And basically, we have no tariffs going into Canada anymore.
I then asked a follow-up question, Kaylee, about specifically lumber and auto tariffs, which have repeatedly been sort of the crux of the trade relationship issue between the U.S. and Canada. There are an array of things, but those may really be at the top of the agenda. Keeping in mind the tariffs that the president delayed today were under Section 338, a levy authority that hasn't been used before, but that gives the president the ability to authorize tariffs up to 50% if the U.S. deems that their commerce is being discriminated against, versus these levies when it comes to lumber and autos that are under that Section 232 authority related to national security concerns. He did tell me that you do have to give a little bit in a negotiation, seeming to perhaps preview that maybe some of those rates will go down. But at this point, we are waiting for that finalized agreement text to come out. But according to the White House, there is now this 3-day deadline to try to get something done.
And how does the Keystone Pipeline factor into this, Tyler? Do we have any detail on that?
We didn't get much detail beyond what the president posted. We know that this is something that the president has spoke a lot about, but unfortunately I didn't have the ability to ask him any sort of follow-ups on that. So I can't really give you any additional details beyond to say that this really has the backdrop of what has been a increasingly tense relationship between President Trump and the Canadian Prime Minister, Mark Carney. There have been a lot of thorny issues between these two countries when it comes to broader relationships, but maybe what we are hearing today could be a step in the positive direction, particularly when you think the backdrop here is that the USMCA deal was not renewed, which is now setting up these broader negotiations. And maybe the two sides are starting to talk a little bit more with each other because, Kaylee, as you know, the U.S. was negotiating on a bilateral basis with Mexico instead of our northern neighbor, Canada. But maybe there's some fuel now for Canada, too.
All right, Bloomberg's Tyler Kendall getting the president on the record on policy, even though he assembled the pool because he wanted to talk about the new helipad on the South Lawn. He signed a piece of stone for that helipad, had a lot of remarks on that we we'll talk about maybe another time, because there are other issues at hand here as we consider tariffs as well as the war in Iran that this administration has pursued. They have had an impact on inflation. And when you take concerns about inflation and couple them with concerns about a growing U.S. national debt, which, as we told you on this program yesterday, is slated to reach $40 trillion far sooner than expected, what you got was a lot of pressure in the bond market and long end yields seeing the highest level in a couple decades, since 2007 in the case of the 30-year, as we saw earlier this week. And we all took note of it. No surprise, the Treasury Department did as well. With Scott Bessent today announcing just 2 weeks after releasing the scheduled buybacks for this quarter, says that the Treasury Department will be increasing that by at least double for the 10 to 30-year duration. A tactical move to rein in yields, certainly, but does it do anything about the fundamentals? Let's ask that question to Bloomberg's Michael McKee, our international economics and policy correspondent, who's here with me now in our Washington, D.C. bureau. So, Mike, is this signal more than anything else?
It is signal more than anything else, because what they're doing is trying to treat a symptom, not a cause. The causes, as you mentioned, are the budget deficit and inflation, also the chaos and confusion about what's going to happen with U.S. policy. It's just increased the need for investors to get more compensation for the risk they're taking at the long term. But this is only basically $4 trillion, $2 trillion more than they're spending, $2 billion more than they're spending right now on buybacks, and that's a pittance in the markets. So it's basically telling people that the Treasury doesn't like what it's seeing and may do something more about it.
Well, what are those other options if they want to take this further?
Well, there isn't a lot more for them to do. Basically, what they're talking about doing is shortening the maturity of what Treasury is issuing. Although that comes with problems of its own, they would have to issue more bills to pay back those buybacks, but it would give more money to the people who have invested in the longer-term bonds, off-the-run bonds, and they could then buy more with it, more of the on-the-run bonds. And the Treasury obviously needs to sell a lot of on-the-run bonds. They could also push the Fed, which Scott Bessent has done, to make available the repo facility for foreign banks in case there is any kind of a cash crunch. And The odd thing is it sort of increases the odds of a Fed rate rise, excuse me. Because if you raise rates, maybe in September, then you're signaling to the markets that you're going to keep a lid on inflation, which brings down the longer end, maybe lowers mortgage rates a little bit. So by raising rates, maybe Kevin Warsh can tell the president, I got you what you wanted.
Even though the president expressly does not want to see higher interest rates, but maybe the end result, to your point, if it lowers mortgage rates, is something that he would find himself able to live with. Of course, it's not just a matter of the Fed setting interest rates that Kevin Warsh is looking at. They're also looking at the balance sheet. He has a whole task force to conduct a review of that. And I wonder how we should consider the Fed's own buying and holding of these very same assets in tandem with what the Treasury is doing, and how these two forces may work for or against each other.
Well, Warsh came to office suggesting that he would like to change the maturity profile of what the Fed owns, and it's basically been Fed policy. They want to move back towards an all bills almost portfolio. That's going to take some time, but he's also talked about a Treasury Fed accord, and so that may lead into something like that where the Fed announces that it's going to definitely move that way and Treasury is following, or vice versa. We don't know what exactly they're going to come up with, but if they lower what the Fed is buying, that just means that the Treasury needs to sell more to the markets, and so they need to adjust what they're doing to try to make the Treasuries saleable. What's ironic about this whole thing is you go back to 2024, you may remember this, Stephen Myron, who became a Fed governor, published a paper that said Janet Yellen was manipulating the markets by shortening maturities and buying issuing bills instead of longer-term treasuries. And now Scott Bessent, who piled on that paper and criticized Janet Yellen, is doing the same thing.
Interesting thing to note, Mike, before you leave us, because you got to run to the Fed, there's minutes coming out at 2 p.m. Eastern time. What are we going to be looking for?
Well, everybody's going to be looking for clues to what they're going to do next, which they're probably not going to find a lot of, but it may give us a sense of how many people who weren't dissenters, because we know who those were, still wanted to raise interest rates, and you get a sense of where the committee is on that. Also, remember, Warsh has talked about maybe shortening the number of meetings, cutting back on the number of meetings, so there may be some discussion on that as well, and also something on the task forces and where they are. So a lot of things that could be in there that may make these minutes more interesting than they have been in a while.
And of course, setting the stage for Jackson Hole next week, where we'll find Bloomberg's Michael McKee, our international and economics and policy correspondent. Thank you, as always, Mike, and good to see you here in D.C. I do want to mention just a bit of breaking news. The president confirming a scoop that Bloomberg brought you last night, that he's nominating Dr. Heidi Overton to be the next commissioner of the Food and Drug Administration. The president just confirming that on True Social. We have more ahead here on Balance of Power. We'll turn next to the results from yesterday's primaries and the surprise DSA victory for the Florida Senate seat. We'll have more here on Balance of Power.
It's 12:21 on Wall Street. I'm Amy Morris. Stocks and bonds rallied after Treasury announced it will increase U.S. bond buybacks to stop the surge in long-end yields. Treasury plans to add additional liquidity support for its buybacks of longer-dated debt, causing a sharp rally across assets. And we check markets for you all day long here at Bloomberg. The S&P 500 up 0.6%. NASDAQ up 0.6%. The Dow up 0.4%. 10-year Treasury yield at 4.65%. The 2-year yield at 4.18%. Checking that 30-year yield now, it is at 5.2%. Crude oil's higher. WTI nearing $87 a barrel. Brent crude topping $92 a barrel. Marvell Technology has entered into a commercial agreement with Google to develop custom semiconductor products. Marvell issued Google a warrant to buy up to 58.97 million shares. Shares of Marvell now nearly 10% higher. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Now back to Balance of Power with Kaylee Lyons.
All right, Amy Morris, thank you so much. Checking on the markets for us as of 12:20 or so p.m. Eastern Time. We thought we would be 12 hours into new Canada tariffs being put in place. Remember, they were slated to go into effect at midnight tonight. And in fact, we got a 3-day extension from President Trump announced in the 11th hour last night as he said that the U.S. and Canada were close to a deal. And it does seem we're getting some confirmation of that from the Canadian Prime Minister, Mark Carney, who has just taken to X to announce that the Canada and the U.S. are, quote, moving towards an agreement on trade, saying that Canada will secure the best terms in each strategic sector. And of course, we'll keep you up to date on this story. But we are also digesting here another night of primaries in the United States. It's the morning after once again, and we had a number of noteworthy results. Of course, perhaps most notably, a few races in Florida where there were expected outcomes in a number of cases. Byron Donalds got the gubernatorial nomination on the Republican side. Congresswoman Debbie Wasserman Schultz, the Democrat, was able to win in a new district that historically has gone more toward black representation, given it is a black majority district. You had Congressman Corey Mills, the Republican, who at one time was endorsed by President Trump, who Trump apparently today, he said he should have gotten out of the race long ago, was ousted. Another incumbent goes down. But where the big surprise was in the Democratic senatorial primary. It was Alexander Vindman, the retired lieutenant colonel, the star witness in the first impeachment trial of President Trump, who had a massive fundraising advantage. We're talking 10x the amount of money that his opponent, Angie Nixon, had. And yet it was her, a member of the DSA, who came out victorious last night and was in a celebratory mood.
Ashley Moody and the corporate politicians in Washington, they like to label us. It's easier to try to make voters afraid of me than to defend the choices they keep making to make our lives harder. They look at this movement and they call us extreme. They call us radical. But I think people see through that. Yes, they do. I won't let them define me, and I know you will always know where I stand. With you, everyday people. Everyday hard-working people.
Angie Nixon, who we just heard, will now be going up against the Republican incumbent Ashley Moody for this seat, which, according to Sabato's crystal ball, has moved to likely Republican or safe Republican from likely. It seems that the feeling is that this makes the general election odds for Democrats a little bit longer. So let's get into this now with Bill Ferries, who's helping lead our midterm coverage here at Bloomberg as a senior editor and is here with me in our Washington, D.C. studio. So, Bill, this was a surprise outcome, especially in light of the fundraising disadvantage. Will she have to moderate herself if she wants a real chance of ousting Moody come November?
Well, she may try to moderate herself, which is what a lot of candidates do, of course, heading in from primaries to the general, regardless of party. I think the challenge is she does have that Democratic Socialist label in Florida, and there are a lot of people, a lot of voters in Florida who fled socialist regimes abroad who are active voters and will make note of that when it comes to election time. So I think the bar is very high. It's a deep red state. It was always going to be headed towards the Republicans. I think in some ways this might make more money flow to other races in the Democratic side. She will have to stand on her own here for a while. She'll have to show that she can raise money. She'll have to show that she can get a lot more momentum before the DNC or other party committees take a serious look at her.
Well, it wasn't a clean sweep for DSA candidates in social last night. Jared Moskowitz, the incumbent Democratic congressman, handily dispatched his DSA opponent. He won by, what, 30 points?
Right.
Almost. So it's conflicting signals, is it not?
It is. It is. I mean, both sides, I think, have something to cheer about here. I think in the end, though, the more moderate Democratic candidates like Moskowitz, and you talk about Debbie Wasserman Schultz, I think they are much more secure in where they're headed in November. Those are much safer Democratic seats. Florida statewide has no Democratic representative at all. The Democratic Party within the legislature is very small, so the odds remain stacked against someone like Angie Nixon.
Well, Florida has obviously gotten a lot of attention. I do want to ask you quickly about Alaska, which is a bit more unique. The top 4 candidates, regardless of party, advanced to November. But on top of the primary vote last night was the Democrat, Mary Peltola, the former congresswoman who is obviously the real direct head-to-head matchup will be against the incumbent Republican Senator Dan Sullivan. What do those results from the primary tell us about her odds of potentially flipping this seat?
I think the Alaska results are probably a big sign of it will give a big boost to national Democrats, because you have Peltola, who right now is at 48% with votes coming in. She seems to be creeping towards 50% in a very big race. She is winning the rural areas handily. She's winning basically everywhere outside of Anchorage very, very handily over Dan Sullivan. This is going to give, I think, the Democrats a lot of confidence that this toss-up seat, according to Cook Political Report, can actually maybe start to lean Democrat in November.
And that would be critical if Democrats want to ultimately flip the chamber. They got to find 4 seats somewhere. Bill Ferries, our senior editor here at Bloomberg News, thank you so much for joining me. And I want to get more now into these results and what they mean, not just for the American political climate, but for business as well, as we turn now to Gautam Mukunda, lecturer at Yale School of Management and also a Bloomberg Opinion contributor, who's here with me now on Balance of Power. Gautam, thank you so much for joining me. You write a lot for Bloomberg Opinion about business, therefore about capitalism. And I wonder if, as you look across the results across a number of primaries, be it New York or Michigan or now in Florida, if you see that capitalism really has something to fear with rising socialist movement.
I'm not sure capitalism has something to fear, but it might have something to prove and something to deliver. I'm also, I'm confused, right? Like, the defenders of capitalism, the President of the United States says he's a big opponent of capitalism, and has taken stakes in 30 private American companies, which kind of sounds pretty socialist to me. So I think we're having a lot of confusion on terms from a lot of different sides here. But what's really striking is you're seeing the DSA is a factional movement within the Democratic Party that's trying to gain control of the Democratic Party. You can see that, some members of the DSA seem to be a lot more energized about attacking Democratic leadership than they are sort of, going after Republicans, which seems interesting. And the parallel that a lot of people are drawing is that this is sort of like the way MAGA took over the Republican Party. I don't buy that parallel, but it is something to watch.
Why don't you buy it?
So, at a first order, if we sort of built like a toy model of the Republican Party in say when Donald Trump takes over in 2016, think about like standard corporate Republicans, right? Mitt Romney types who are offering tax cuts and deregulation and, sort of a smattering of social conservatism. But like, they are massively optimizing for a Republican donor class that really cares about tax cuts and deregulation. But median Republican voters don't. Depending upon the opinion poll of voters right about then, this is Republican voters, somewhere between 40 and 60% of Republican voters wanted to raise taxes on the rich, right? Romney's platform, the platform of those sorts of standard issue corporate Republicans, just offered nothing to the base of the Republican Party, and by which I mean most Republicans who were kind of like saying, well, I'm going to take the more socially conservative party in Republicans, but what the people we're nominating don't speak to us. The Democratic Party isn't like that. It's vastly more diverse. You have its single core, most important constituency are black voters who are actually more conservative than the median Democrat by most measures. Not more liberal, more conservative. That's the core of the party. And then you have sort of the DSA, which is coming on. So Donald Trump sort of offered Republican voters social conservatism without the economic conservatism that they didn't like all that much. The DSA isn't adding to the coalition that way, it's subtracting. It is both more left than everybody else on economic issues and more left than everybody else on social issues. It's really hard to see how you can piece together a coalition that takes over the party that way when you are not in agreement with most members of the party and not offering them anything to bring them over to your side.
Well, that's a really insightful analysis. And when we consider the kind of economic ideas that the DSA is standing on, these notions, as we were just hearing directly from Angie Nixon about universal health care, universal child care, I do wonder in your mind if there is even real viability in reality to a lot of what it is that they are proposing.
I mean, like, look, you campaign in prose and you govern. You campaign in poetry and you govern in prose. Donald Trump promised that he would pay off the national debt, which just hit 40 trillion. So when people are running, they tend to make promises that they can't keep. And that's just gotten more and more egregious with time. I think what's striking is that a lot of what they're saying, you know, on the economic side, it'll poll well until you have to implement it, right? So everybody likes the idea of universal child care or universal health care. If you poll it, it looks really well. People are, when you poll people at the policy level, they are in general very liberal. Then when you have to pay for it or actually have to shake up people's existing healthcare, those numbers go down really, really fast, right? So where the DSA, if I were giving them strategic advice, which I'm not, but if I were, I would tell them, pick something, right? Like, are you guys really, really motivated on the social, on the economic issues? In which case, you should take sort of the big open ground in American politics, which Donald Trump did, of being like socially moderate. And I know that's not how he governed or his rhetoric, but that is how he was perceived by voters in 2016, right? The only thing that matters is how the voters perceive you, whatever other people might think. That's what matters. And he was perceived by voters as socially moderate and economically liberal, and you might win some elections. But that's not the strategy that they're taking.
Well, I know you're not giving anyone advice, but if you were to give any elected official or wannabe elected official advice as to how to approach data center policy, the NIMBY issue of this cycle, what would it be?
This is just the most astonishing thing I can remember seeing in polling data. Let me put it this way. We have finally found an issue that conservative Republicans and liberal Democrats agreed upon. A year ago, no such issues existed, and now we've got one. Everybody hates data centers. It is just astonishing. And when you think about that issue even more, it like compounds, right? These things come in, they bring investment, they bring jobs. Usually politicians will give blood and sell organs to bring something like that to their district, right? And instead they're winning votes by pushing them out. I think the polling data is just very strongly that while, you know, living next to a data center is often like not fun, it is possible to put those in places where that's less disruptive. And what's really happening here is a deep and profound rage at not just the AI industry in particular, but sort of, you know, like the Silicon Valley tech industry, which seems to have done everything possible to alienate the median American in ways that I, you know, sort of wonder about the strategic choices there.
All right, Gautam, we got to get you back to talk more about this in depth. Great to have you. Bloomberg Opinion contributor and Yale School of Management lecturer Gautam Mukunda here with us on Balance of Power on Bloomberg.
It's 1240 on Wall Street. I'm Amy Morris. Former St. Louis Fed President James Bullard says Treasury's announcement that it's ramping up buybacks of long-dated government debt seems like an important tactical move, but it doesn't change the fundamentals that are driving longer-term yields higher. And he recommends some Fed action.
It's a good time to reestablish credibility on inflation fighting and go ahead and make a move. You probably wouldn't have to do too much now, and then that'll save you from a headache that you might develop for 2027.
Former St. Louis Fed President James Bullard on Bloomberg Surveillance. We do check markets for you all day long here at Bloomberg. The S&P 500 up 0.4%. NASDAQ up 0.4%. The Dow up 0.25%. Russell 2000 Index up 0.75%. 10-year Treasury yield at 4.66%. The 2-year yield at 4.18%. And the 30-year Treasury yield at 5.2%. Crude oil higher now. WTI crude oil at $86.72 a barrel, and Brent crude topping $92 a barrel. Estee Lauder posted quarterly results beating estimates and ended a run of 3 straight declines in annual revenue. The company reaffirmed its 2027 full-year sales outlook and raised guidance on its adjusted operating margin, a key metric of profitability. Estee Lauder shares now 17% higher. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris, and that's a Bloomberg Business Flash. Let's return to Balance of Power with Kaylee Lines.
All right, Amy Morris, thank you so much. Here on Balance of Power, it probably won't surprise anyone who listens or watches us on YouTube frequently. We talk a lot about data centers. I was just talking about data centers with Gautam Mukunda, who's a Bloomberg Opinion contributor, and we've talked to pretty much everyone about this because it is the NIMBY issue of this election cycle. The very infrastructure that is drawing billions and billions of dollars in investment, promising to bring more jobs to the areas in which they are built, powering an AI boom that is therefore powering these equity markets, is receiving massive blowback from the American electorate. And on a bipartisan basis, it's not just Democrats, it's also Republicans and elected officials, and those seeking elected office are rushing to make their stances known on the data center issue. Take Texas, for example, where the Republican governor, Greg Abbott, put in place a stop on new data center development until audits could be conducted. A stance that evidently doesn't go far enough for his Democratic challenger, who joined us on this program yesterday. Gina Hinojosa talked to us about how she wants to approach data centers in Texas. Listen.
I will say that right now, data centers are an issue that has gotten a lot of attention, especially in our rural Republican areas, where what has happened is data centers have descended into the rural Republican areas. There's almost been like a gold rush. These hyperscale data centers have emerged in their communities, and people just feel helpless. They want a seat at the table to decide if and how these data centers come.
She thinks a moratorium should be put in place until a special legislative session in Texas is called to put into place new laws around this space. You're seeing it elsewhere, too. As we were having that conversation with her, almost at the same time, the governor of Pennsylvania, Josh Shapiro, was getting in on this. Remember, he had previously welcomed data center development as a way to attract tech companies to his state of Pennsylvania, and now he's switching gears. He signed an executive order yesterday, keeping in mind that he is up for re-election in November and could very well have his eye on 2028. His order essentially putting in place new strict guardrails on the data centers he once championed. Listen.
These speculators are nevertheless scaring our communities, being aggressive with township officials, bullying our neighbors, our fellow Pennsylvanians, and refusing to listen to the people. And they are threatening to fundamentally change the character of our communities. As your governor, it is my job to listen and to use my authority to accomplish things for the people of Pennsylvania, to protect the people of Pennsylvania.
So let's get into the politics of data centers now as we turn to today's political panel. T.W. Arrighi is with me, Vice President at Push Digital Group and Republican strategist, alongside Democratic strategist Allison Jaslow, former White House Special Assistant during the Obama administration. Welcome to you both. T.W., I'll start with you on the way in which this issue seems to be permeating most races you look at. Most candidates want to have their voices heard on this issue. Do you have to be anti-data center to get elected these days?
Well, I think you need to listen to the people. You said it right. It is the NIMBY issue of this cycle, but we're stuck between a little bit of a rock and a hard place here. We know, at least the leadership knows, that we need to be at the forefront of the AI race to stop China from superseding us. And what that necessitates is data centers. You've seen states like Virginia have a lot of data centers that have run into problems: noise, water, electricity. Those are all major issues. And I work with candidates all across the country. Data centers is coming up everywhere, from New Hampshire to North Carolina and everywhere in between. What needs to happen is, A, as Josh Shapiro pointed out, there should be no bullying of local communities. Local communities need to have control. But also, not just guardrails need to be put into place, but promises. We need to talk about small nuclear reactors at these facilities to get their own power. And if they supersede that power, to put it back to the grid to lower people's costs. They need to address the water issue. Beyond guardrails, it's actually promises to these local communities to make it beneficial, and also explain the new technology. This technology that these data centers prop up, this has changed. It's not like it was 10 years ago. That needs to be communicated better. Bullying it and bulldozing it's not going to play anywhere.
Well, so to TW's point, Allison, is the solution here bring your own power, figure out water, pledge to make sure it doesn't affect utility costs, and everyone ends up happy?
I mean, first of all, I'd say, there's an ism in politics that when you're explaining, you're losing. And TW had a lot of explanations about data centers. But I think the bottom line up front here is if it's impacting your local community, whether there's a data center already there or whether a company is exploring putting one there, if you don't get guarantees that this data center is not going to increase your energy costs in the short term, then it's hard to be bought in on, the AI economy and what that's going to deliver for you in the long term. And so I think that's what you're seeing play out in the current election cycle, where you also have, you mentioned governors who I think are straddling the tension between trying to infuse their states with economic growth, but also understanding the real pain that people are facing right now and not wanting to add to that pain.
Well, so as you talk about the economic conditions people are facing right now and understood on the cost side, is there not a credible argument to make on the job side, at least when it comes to building out this infrastructure, Allison?
I actually think that there's reporting out there that says that the job promises the data centers have made, or the companies that are building them have made, have not come through. And so I think if that was the case, this might be a different conversation. But I think that, unfortunately, some of these facilities not only aren't creating the jobs that you want to, they're creating noise and higher energy costs that are creating a real burden for local communities.
Well, so TW, you talked about how candidates need to have a way to talk about this and a message that they need to send. What if you were advising these companies, these hyperscalers, the ones who want to make investments in this technology? Is it really them that need to make the adjustments on messaging here?
Yes.
How do they do that?
Absolutely. Again, people are not going to want to see data centers come into their community with the veiled threat that their utility costs could go up when they're already struggling to meet those bills every month. So the onus is on them to, yes, if you're explaining you're losing is the right maxim here, but the fact is you do need to teach, you do need to, advocate for yourself in the public. So yes, you need to talk about the ways that they are going to offset energy costs, how they are going to address the water issues and the noise pollution, how, if there isn't going to be jobs there, how those spaces can be used in a multitude of fashions. You saw the Colorado project that got all the headlines that Kevin O'Leary was involved with, trying to explain that we're going to make this a multi-use space that isn't just going to be for data centers. It's a hard mountain to climb. The people are already against it, but the onus falls on them to make the case, not the people who are struggling to pay their bills and do not want it to go any higher. And by the way, the amount of space, the eyesore they usually are, the noise, all those things are massive concerns that they need to address. They should have got ahead of it a long time ago, but no better time than the present.
Well, and the president obviously is the most immediate challenge in this cycle, the most immediate challenge in 2026. But as we look toward 2028, I mentioned Josh Shapiro in the mix on data centers here as well. How much do you expect that this is going to be a defining issue on the federal presidential level, Allison, not just one that's left to states and localities as we're seeing in this midterm cycle?
I mean, I actually think it's a real big X factor. I know that, viewers, especially voters, want a certain level of certainty, especially those who are trying to pick a horse in an upcoming presidential race. But the technology, I believe, is evolving so quickly. I think the terms in which we are having the AI conversation could be very different, not just in 2028, but in 2027 than we are having in 2026. I mean, this debate has evolved very quickly just over the last 6 months. So I think it's really remains to be seen. And obviously, the candidate that is probably going to be able to succeed in this environment is somebody who's very quick on their feet and can ride that wave.
As we consider the technology itself, to your point, Allison, the actual artificial intelligence, beyond implementing itself in a real physical way and the issue around the infrastructure and data centers, how else, TW, are you thinking about its impact on the elections in this cycle and the elections to come in terms of the money that will be spent on candidates from lobbies for lobbying groups for the industry as a whole, and also, frankly, the amount of AI-generated content that we're already seeing permeating the airwaves?
Yeah, the AI-generated content, the AI slop is obviously a massive concern. And I know that there are discussions on Capitol Hill on how properly to address that. I think broadly speaking, though, I look at AI as a national security concern. Not only is it the race against China to make sure that we are at the forefront of it and always one step ahead, but AI is going to permeate so much of our national security apparatus. And we in America have a lot of guardrails in place, and we see ourselves as the responsible actors. But there's a lot of people around the world, other nation states, that are not responsible actors. And some of this cutting edge technology and AI usage within the defense space in the hands of bad actors is a really frightening prospect. And automation is already, seeping into the Navy, seeping into the Army, seeping into the Air Force. That's all well and good. But when it starts going into the decision-making factors of bad state actors, mistakes can happen. And that, I think, needs to be at the core of any debate over AI, and not just the practical uses for the people, but when we talk broadly, presidential candidates, it needs to be in the scope of national security and the threats that are out there if we do not stay on the cutting edge of it.
Well, Allison, I'd love to hear from you on that as well. You are an Army captain. You're a veteran. How do you think about this in the context of national security?
I mean, that's a point where I'd agree with TW, is that if we aren't staying on the cutting edge of technology, there are national security implications. And I think something that my generation of war veterans faced in the Iraq and Afghanistan wars was, candidly, the bureaucracy here in the United States holding back the innovation that was needed for the warfighter abroad. Obviously, there's a completely different battlefield that we're fighting on now between drones and, the real threats to cyber attacks. But I think being able to still be on the cutting edge of this technology that, let's be honest, is a technology that's going to continue to exist and is going to continue to evolve. And making sure that it doesn't hurt families here at home, but also that we don't so hamstring the technology and the innovation that it also has broader implications like those to our national security.
Well, so is there an actor that you feel is doing this responsibly? Allison, TW was talking about how the U.S. by and large is trying to be a responsible actor here with implementation of guardrails, but China may not be thinking about this the same way. Obviously, some of the different labs have different approaches to safety. Think about Anthropic versus others who are looking more toward open source. Is anyone doing this really the right way, or does everyone have room for improvement here?
I mean, I would say that electoral politics is one thing, right? And oftentimes what is litigated for the sake of a campaign has everything to do with a moment in time. Also, you mentioned at the top of this segment that it's the NIMBY issue of this campaign cycle. What's happening in your backyard is very different than what's happening abroad and or in an area of operation where U.S. service members are having to, defend us right now. But I would say, actually, as a Democrat, I think that there's one thing that I feel like the current administration is doing right, which is actually pushing for innovation and also having an ethos of supporting disruption in the DoD. And I think that's where the intersection of, AI technology and its future is right.
All right, Allison Jaslow and T.W. Arrighi, thank you for being our political panel today. We'll have more with them in the next hour of Balance of Power. We'll get into the results of yesterday's primaries. Still ahead on Bloomberg.
Live from Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lines.
The Trump administration is watching the bond market, Canada, and tech. Welcome to Balance of Power on Bloomberg TV and radio. I'm Kaylee Lines. The president punting on new Canadian tariffs that were set to go into effect today, and instead shifts his focus to a meeting at the White House this afternoon with the leaders of big tech and crypto companies. We'll get the latest from the White House from Bloomberg's Tyler Kendall and talk about the CEOs who weren't invited to this meeting the ones that lead prediction markets, with the former governor of New Jersey, Chris Christie. Plus, we also have to talk about the Treasury's new, bigger buyback program for long-end rates as they look to put pressure on yields that have risen to the highest level in decades. We'll talk about Scott Bessent's move with Ira Jersey of Bloomberg Intelligence. We'll get into the results of yesterday's primaries as well, Florida and Alaska in focus. But first, let's talk about these financial markets and the bond market reaction to Bessent's move as we turn to Amy Morris here in Washington. Hey, Amy.
Hey, Kaylee. Treasury is increasing the size of liquidity support buyback operations for securities dated from the 10-year to the 30-year sector by at least double. Now, the move is intended to rein in long-term borrowing costs from multi-year highs. That's what's kept U.S. mortgage and other borrowing rates high. The ramped-up buybacks are set to begin September 9th. This has all sparked a Wall Street rebound. We check markets for you all day long here at Bloomberg. S&P 500 up 0.3%. NASDAQ up 0.25%, and the Dow up about 0.2%. The 10-year Treasury yield now at 4.65%. The 2-year yield at 4.18%, and the aforementioned 30-year Treasury yield 5.19%. Crude oil moving higher. WTI closing in on $87 a barrel. Brent crude now topping $92 a barrel. A personalized vaccine developed by Moderna and Merck helped reduce the recurrence of melanoma in large late-stage trials. The trial met its main goal of showing that this vaccine, combined with Merck's immune drug Keytruda, reduced melanoma recurrences more than the immunotherapy alone. Moderna CEO Stéphane Bancel says it could be approved as soon as next year. Shares of Moderna now 141% higher, and Merck shares 11% higher. And Target shares are nearly 6% higher. Target lifted its full-year guidance after results outpaced estimates in the latest quarter, suggesting that Target may be moving past a lengthy sales slump. Target now looking for consistent growth following 3 years of declining revenue. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Amy Morris. That's a Bloomberg Business Flash. Let's go back to Balance of Power with Kaylee Lyons.
All right, Amy Morris, thank you so much. Watching the markets for us, markets that do not have to adjust to a new reality of a stricter tariff regime on one of the United States' largest trading partners. At the very least, not yet. Remember, as of 10:14 p.m. last night, there was a very real chance that those 50% levies on billions of dollars of Canadian goods would go into effect at midnight. Then at 10:15, the president announces a punt on Truth Social, writing, quote, "I have paused the 50% tariffs against Canada that were scheduled to kick in tomorrow morning for a 3-day period, based on the fact," the president says, "that Canada and the USA, subject to the finalization of documents, have a deal." And now the Canadian Prime Minister, Mark Carney, is weighing in as well, saying on X that Canada entered these discussions with the best overall trade terms. We are now moving towards an agreement that reinforces that Canadian advantage, including by securing the best terms in each of Canada's most important strategic sectors. And as we consider the path toward a final deal in the next 3 days here, we turn to Bloomberg Washington correspondent Tyler Kendall, who is live at the White House and had a chance to question the president directly about this earlier today. Tyler, what did he tell you?
Well, Kaylee, at this point, as you're outlining, we're getting optimistic talk from both President Trump and the Canadian Prime Minister. But the one thing that we're still missing are those details, those key details on what is actually going to be in this agreement that ultimately caused this White House to stop its intent to impose some really punishing tariffs up to 50% on nearly $20 billion worth of Canadian goods. But as you mentioned, I had the chance to ask President Trump directly to see if we could glean any sort of details on what may be in that agreement. Can you give us any update on your negotiations with Canada for a trade deal?
Yeah, we had a very good conversation with the Prime Minister last night, and we've come to a deal with Canada. As you know, the 50% tariffs across the board were going on against Canada today, and they called yesterday and they gave us the points that we had to have. Very fair deal for both. It's good for everybody, but our farmers are going to be thrilled. Our manufacturers are going to be thrilled. And basically, we have no tariffs going into Canada anymore.
Kaylee, there's there's a few points of context here that we should provide. One, these 50% threatened levies were going to be under Section 338, which has never been used before, but does give the president authority to issue tariffs up to 50% if the U.S. feels that a country is discriminating against U.S. commerce. But I will say that perhaps the more stickier part of trade negotiations between the U.S. and Canada comes down to those Section 232 tariffs over national security concerns related to autos and lumber. I followed up by asking the president if we could expect any sort of a lowering of the rate when it comes to those levies in particular, and he seemed to nod at the fact that there may be some movement. He said things still need to be finalized, but that ultimately the U.S. needs to give some things in a negotiation too. That's how the deal is going to work. So that's something to keep your eyes out on as we try to figure out what the agreement is really going to look like.
All right, Tyler, we'll let you go in a minute. I know you got to get back into the White House because an important meeting is going to be taking place in just about an hour. The president meeting with a number of tech and crypto executives in particular. Tell us what we should expect.
So, Kelly, this is being billed as sort of a preview to a CFTC summit tomorrow that is going to focus on some of those top issues related to crypto, digital assets, and also prediction markets. There is reporting that prediction market CEOs will not be in attendance for this. It is going to be more of those CEOs related to crypto. We're still waiting for a final confirmation list. But, Kaylee, I don't need to tell you at this point, we are closely watching what the Senate is going to do when it comes to that market structure bill, the Clarity Act. September 15th is the day that we are expecting that vote to happen, but it's not a done deal, and that is going to leave open big questions about regulation for the industry is going to look like going forward.
All right. Well, we'll look forward to your coverage from this afternoon. President Trump slated to speak at 2:30 p.m. Eastern time on that. Bloomberg's Tyler Kendall live at the White House for us. Thank you so much. Now, as we were talking to Tyler, we did just get a red headline crossing the Bloomberg terminal pertaining to the $16 billion 20-year auction we just saw from the United States Treasury. More issuance. And as we consider the takedown, it did draw a slightly higher yield than the presale when issued yield of 5.199%, drawing instead 5.204%. This, of course, follows the big announcement from the Treasury Department earlier today as Scott Bessent, just 2 weeks after having released the buyback schedule for this quarter, announced that for long end yields, 10 to 30-year duration, they're going to at least double that. A move, perhaps, to address the fact that yields at the long end had been surging toward multi-decade highs. We hit the highest level since 2007 on the 30-year yield earlier this week. So let's talk more about that now as we turn to Ira Jersey, U.S. rate strategist for Bloomberg Intelligence. Ira, as we consider the Treasury's move today, is this simply a tactical one, or does it address the fundamentals at all?
It does not address the fundamentals one iota. It really is, I think, just an acknowledgement that, hey, yields are higher than we want it to be as an administration, and we only have a few tools that we can really use, particularly in the short term, in order to try to stop yields from moving significantly higher. And so they took their shot. Now, what's interesting about this whole thing is not so much that they did it, because actually we had thought that there was the possibility that this would happen, but it's that, like you said, they didn't do it at the quarterly refunding announcement 2 weeks ago. They did it kind of on a, relatively a liquid midsummer day, right? Instead of a couple of weeks ago, we're waiting to November.
Yeah, timing, as they say, is everything. Also, of course, coinciding with the day at which they were auctioning off more debt that falls into this duration category. $16 billion of 20-year bonds sold. Ira, how should we think about the takedown?
Yeah, it went okay. And in fact, we do this grading system from D all the way up to A+, and we gave it a B+ on our system, primarily because it had pretty good demand. Now, compared to where these bonds were issued a month ago or when the new bond was issued in May at the last refunding auction, yields are significantly higher, right? So I think the higher yields, and now the idea that maybe there's either going to be less bonds issued or some bonds bought back, it enticed investors to come in and buy a little bit. It wasn't exactly at the one issued, but it was close enough that that is kind of noise rather than anything major in terms of thinking about how this auction was taken down.
Well, of course, this was the big event for the bond market in the 1 p.m. hour. I wonder if anything you expect could be a catalyst in the 2 p.m. hour when we get Fed minutes. Ira, typically because the minutes are backward looking, not so much, but I wonder if this time may be different under Kevin Warsh with a September meeting and Jackson Hole, frankly.